Hello everyone, here I am with CMA Final Law Marathon for the new syllabus, that is syllabus 2022 in complete English, right? So I would consider this to be a pleasing and a good news for my South Indian students. So enjoy this marathon. Undoubtedly, we have the entire coverage in this marathon, but since it is a marathon and which itself means that covering a huge portion in a short duration of time, so I hope you understand that 100% or you can say the intricate details of every topic will not be covered. This is for revision purpose. Now I have used my handwritten charts throughout the marathon, which of course you might be demanding. So we have three options. Option number one, you may note the charts as you progress and watch the marathon. Option number two, you can purchase the charts in hard copy format, which might be costly for you because they come undoubtedly in colored format that we give. So if that is not a barrier to you and you want and you're willing, you can do that. And the third option that we have created for you is a digital version of the charts. That is, the charts can be viewed in the app itself, right? So that will be economical in case you're facing that finance issue. Now, this particular marathon is as per your new syllabus. Okay, so according to what is incorporated in your syllabus for 2022, we have done the revision in the same manner. Hope you find it useful. And first, you have to drop a like, and thereafter, you can proceed watching the marathon. Wish you all the very best. Happy learning, dear students. I hope you all are ready with the charts as well as the material provided by me to you, because we are going to revise it from the charts as well as the material. So both should be handy with you. And let's start. See, one simple reason, I think I've told this before also, and I'm telling this again also, why we can't take up revision or as of that matter, the whole classes from the institute's material itself, because that material is first of all not updated, not in the sequence as I want it to be, not covering the questions or examples that I want to be, right? So we have to modify it a bit. Of course, the complete coverage is from the institute's material itself, but with necessary changes. So mutatis mutandis, right? Now, let's start our revision of the first chapter, company formation and conversion. So here we begin. First of all, the first thing, what do we mean by a company? Because we have started with company law, we are going to read about Companies Act, we have to read about company, how is it formed and all that. So what at all you mean by company? That is the first and the foremost question. Okay, so company basically is, if you understand the meaning, it is a group of people. A group of people who voluntarily want to come together and do a certain business. They have a common objective, that is called as a company. But if you go by the definition, that's not what a company is. I mean, maybe 4 people are working together. Can they be called as a company? No. They will be called as a company if they're registered under this act. If they're registered under this act of previous company law. So according to section 2, clause 20 of Companies Act 2013, a company is going to be called as a company only if it is registered under this act of previous company law. Previous company law, that means any previous company law. Fine. We have certain basics of Companies Act. If at all you choose this particular form of business organization, that means you have chosen company. I want to start a business. I have chosen that I am going to form a company. If I choose to form a company and I form a company, everything from scratch till end, from tip to toe, is going to be governed by Companies Act 2013. How am I going to form the company? How am I going to run the company? How can I close the company? How can I take decisions in the company? Everything will be told by and under Companies Act 2013 only. So what is Companies Act 2013? It is nothing but a law which governs this form of business organization known as company. So if I want to run a company, I have to follow this law. I have to follow this act. Just like if I want to drive on road, I have to follow Motor Vehicle Act. Likewise, if I want to run a company, I have to follow Companies Act 2013. Now, Companies Act 2013 is huge. It's divided into 29 chapters, 470 sections, 7 schedules, and a lot of rules. Right, so ma'am, we have to read the whole Companies Act. No, you have a limited and a selected coverage, although it's again huge. Because you are at the final levels, what can you expect? You cannot expect a coverage of 10-20%. It's a huge, but still it's not complete, right? Now, this act is applicable to the whole of India. It even extends to the special types of companies, that is banking, insurance, electricity. Banking, insurance, electricity also have the respective laws. So if there is any contravention, if there is any confusion, if there is any conflict between what is given in the specific law and what is given in Companies Act, the specific law will prevail over Companies Act 2013, right? Under this act, for companies, we have different authorities. What are the authorities? We basically have ROC, which is Registrar of Companies. Registrar of Companies, they maintain full records relating to the company, right? See, the whole country is divided into different states, and every state has a Registrar of Companies. In 2 states, we have 2 ROCs also, right? Now, if supposedly I am a company, I want to start business in a state of Uttar Pradesh. So I am going to form a company in Uttar Pradesh. My complete records will be with ROC Uttar Pradesh. So ROC is an authority which maintains all the records, where we do all the filings. Although we don't have to walk in physically anywhere, now the complete thing is online. So we go to a website, mca.gov.in, and we do the necessary filing. All our records are the records of all the companies. They are sent to the respective ROCs through that online platform only. Apart from this, we also have a regional director. Regional director who is the head of the region. So in one region, there might be some 2-3 ROCs. So that is the regional director. Okay. Apart from that, we also have NCLT and NCLAT. National Company Law Tribunal and National Company Law Appellate Tribunal. They are the replacement of courts for corporate matters. So if there is any dispute, they're the governing body where we can approach, right? Slowly and steadily you'll realize everything. NCLT is also constituted under Companies Act itself. Fine. So that is what the administration part, basic part that you must know about Companies Act. Fine, ma'am. Now, since we are starting with Companies Act, we must know certain things about the company at first place. Okay, ma'am. So we will first analyze the basics of company. Company is an artificial person. That means it cannot see, it cannot hear, it cannot speak, it cannot marry, it cannot get divorced. So nothing like that, because it is an artificial person. Then what can it do? It can hold a property. A company may have a bank account of its own. A company may have a land of its own, right? A company may sue. So that means it is given a legal identity to do legal things, to obviously, but it is an artificial person. It is not a natural person. It gets birth by law. It is dissolved by law, right? It dies by law. Then comes your separate legal entity. That means the company is different from its members, directors, whoever you call it. The company is different and we are different. One simple thing, if I am doing a proprietorship business, I take a bank loan of 10 crores and I'm unable to repay it, what will happen? The bank officials will pick me up, my children, my parents, my house, my car, everything they can pick me. They can pick, not literally, but kind of, right? But if I form a company, I am running the company, I have formed the company, but I have taken the loan in company's name. So company has taken a loan. If company doesn't pay the loan, company will suffer. I will not suffer. So my property, my parents, my children, they're all intact, right? Nothing is going to happen to them. So that is what is the simple thing which relates to both these points, kind of separate legal entity and limited liability. Basically, we are different. The company is a different identity. So whatever company is doing, company has to be liable for that. I cannot be held liable. It doesn't matter. I am the one who's running the company, right? For this, we have a very famous case law. Salomon versus Salomon and Company Limited. I think this is one such case law which everyone remembers. What happened in this particular case law? Let's have a quick recall. There was a person named as Salomon. He was doing a business of leather and boots, great. He decided to form a company and he formed a public company. So for public company, you need at least 7 people. He got all that 7 people in-house only. He, his wife, his daughter and his 4 sons, right? So they all formed a public company. He kept all the shares with him and gave one share each to all these different people. Now, this is a business of leather and boots. He formed a company. Now, this company is going to take over the business of leather and boots. So, whenever you take over some business, you pay something. That is known as purchase consideration. So, the company paid the shares, gave away shares in exchange of the business to Salomon, his family, and also some debentures. Now, see what happened. In the balance sheet of Salomon and Company Limited, there were assets and there was share capital, there were debentures and there were other creditors also. Fine, ma'am. After some time, this could not turn out to be the best of business and eventually ran into financial difficulties. So there was financial stress and the company had to be closed. What happens when the company has to close down? The assets of the company are sold and out of the money realized from the asset, the liabilities are paid off. Fine. The liabilities are paid off in a sequence that first of all we'll pay the debenture holders, then we will pay the creditors and then we will pay the shareholders. Fine. These creditors got really angry and they said that the company is paying first to the debenture holders, which is who is nothing else, no one else but Salomon himself. That means Salomon has formed a company, he was running the company, and when the company ran into financial difficulties, through this debenture mode, he is taking all his money and we are left with nothing. So do you think it's fair? The court contended, yes, it's fair. Why? Because Salomon is different. He is taking money in the capacity as a debenture holder and the company has to pay money in order of whatever has been stated. So Salomon is different and his company is different. Whatever company is unable to pay, it's not because of Salomon, right? So this is a principle which was established in the case of Salomon and Salomon Company Limited. Fine. I think that's clear. Now, next is limited liability. What do you mean by limited liability? See, the liability of company is unlimited. That's not limited. That means if a company takes a bank loan of 10 crores, it cannot say that I am going to pay only 5 crore, my liability is only up to 5 crores. No, whatever your liability is generated, you have to pay. So there is no limit on the liability of the company, but the company cannot take money from its members or cannot force the members to pay money. Like it happens in a proprietorship, as I told you, right? See, if there are 4 members and each of them has agreed that I will buy 10 shares of the company each. Fine. Now, supposedly one shareholder, the final price that the shareholder had to pay to the company for his shares was 10,000 and he paid only 5,000. So, company can ask for balance 5,000. No, company will say that you had to give me 10,000. You have given me only 5,000. So, you are liable for 5,000 more. That is, the member is going to be liable for the unpaid money, the money which you have not paid on the shares which you hold. Right? We have a different type of company called as limited by guarantee also, in which the members undertake to guarantee. Supposedly one member has given a guarantee of 1 lakh, other has given a guarantee of 50,000. So his liability is 50,000, limited to 50,000. His liability is limited to 1 lakh. Right? So a company can be limited by shares also, it can be limited by guarantee also. When we go on to read the different types of companies, we will understand this even better. Great. Next is perpetual succession. No matter who comes and who goes, the company is going to go on and on and on. How many of you know LIC? When was it formed? Do you think when it was formed till now, there is one person who's running LIC? Someone comes, someone retires, someone dies, someone comes again. But LIC is going to go on and on and on. LIC is not a company, it is a body corporate. But the feature of body corporate is same as of a company. Supposedly Mr. Ambani formed Reliance Industries Limited. Now what is going to happen to the company? He dies, the company dies? No. The company goes on and on and on. He dies, someone else comes. In private company, usually the businesses are being run by the family itself, but in public companies, there are different people who are hired, there are different people whose shares get transferred, there is government may be involved, so government, if it is involved, sometimes the other person is president, sometimes the other person is president, right? So it is the office. President or central government holds shares of the company, the government keeps on changing, but the shares are held, right? So it doesn't matter who comes and who goes, the company goes on and forever. Next is common seal. Now what is common seal? That's common seal. Company doesn't have hands to hold a pen and actually sign. The company cannot do that, right? So there was a concept of common seal, that we have prepared an official signature of the company. So if company is buying that particular shares or buying that particular property or dealing with any person, entering into a contract, the company will sign, affix that stamp, that is known as common seal. Now eventually over the period of time, government realized that since the company doesn't have actually hands, the company cannot pick up that stamp and put it wherever they want to. So company is not making a decision. It is the ultimate directors who are making a decision, who are picking up that stamp and affixing them. So instead of picking up that stamp and affixing it, why don't they themselves sign it, right? So over the period of time, companies' common seal was made optional. So now we have it optional. It is not mandatory for every company to have a common seal. Some companies may have that common seal, some companies don't have common seal. So in companies where you have common seal, that is affixed on every document, if there is no common seal, the persons who are representing company in the dealings, they sign it, right? We have proper provisions for the signing part also. Okay, now next is transferability of shares. Transferability of shares. What do you mean by transferability of shares? We all have heard about stock exchange. In fact, nowadays, these times, everyone has a demat account and you're doing some share trading for sure. Maybe you're not an intraday person, maybe you hold shares for a longer tenure, but whatever it is, you're buying shares, you're selling shares and you're making money. At times losses too. But the whole point is that you are buying shares and you're selling shares. When you sell shares, what are you doing? You're transferring the shares from you to someone else. You do that, right? Although in a private company, you cannot freely transfer shares like this. That means you cannot do that. Okay, you take my shares, someone else is selling the shares to someone else. We have conditions, we have restrictions, but otherwise, the shares can be transferred from one person to another. What do you mean by share? Just like any form of business organization, it has capital. The company also has share capital. Share capital is the total amount of money that the company has raised. Right? So supposedly the share capital is 10 lakh rupees. The company may decide, the company cannot raise this 10 lakh from one person itself. Right? It is from all the members. So the company may decide that, okay, I'm going to keep the price of my share at 100. Someone can buy just one share, someone 2 shares, someone 100 shares, someone 500 shares, right? So share is nothing but the smallest unit of division in the share capital of the company. Okay. Separate property. Separate property. Okay. What do we mean by separate property? Just like company is different from its members, so is its property. Let's say, for example, Mr. Salomon, he formed a company, right? And he wanted to buy a car maybe. He bought it from company's bank account and in the name of company itself. and decided to use it personally because he wanted a car. His wife wanted a car, his children wanted a car, so he did that. He said, it's my own company, I'm going to buy from the company's bank account and I'm going to use it personally. Now what happened is the company was closed. Company was shut down. Do you think Salomon can claim that this car belongs to me and not the company? So this should not be sold and the liabilities of the company should not be paid out of the proceeds of this car. He cannot claim that. Why? Because no member can claim himself to be the owner of company's property, right? Not when the company is running, not even when the company is going to be wound up, right? So that is something which is not possible and which is not allowed, right? So company does not even, that is what separate property means. This is another line which has a case law of McQuarrie also, but I'm not explaining you here in the revision class. Now, capacity to sue and be sued. See, if I enter into any transaction on Flipkart, now I have a complaint. Who am I going to sue? The owners of Flipkart or the Flipkart company itself? Flipkart. Because company is a separate legal entity, I can sue the company. If they have a problem, they will sue me, right? So they can be sued and they can also sue, right? It means filing a suit. Filing a suit or case in a court of law. Okay. Now, a new concept. Corporate veil. What do we mean by corporate veil? What is it? See, veil means a curtain, a kind of protection. Why do we put curtains in our houses? To protect us from the sunlight, or maybe we want some privacy, we don't want people to see us, we want to hide behind the curtains. That is what the curtain, that is what is the purpose of curtain, right? Now, that is what is the veil, veil of incorporation. Whenever a company is formed, although every action that this company is doing is being guided or is being actually done by these directors or by these members, whatever you call, right? Directors, members, they're different, but I'm trying to explain you the concept of corporate veil over here, fine. But still, if a company does not file some document, company is responsible. Penalize company, company will pay penalty. Although I am the one who forgot this deadline. You get my point? I am the one who forgot this deadline. But this is a protection which the members of the company get. That they are different from the company, they are shielded, they are protected from company's actions. That whatever company is doing, company is going to be liable and I am not going to be liable for that. Fair enough. But what if they actually do some fraud in the name of company? They know that they are never going to be caught. So what they do is they enter into some contract, take money from bank and they run away. And even if they are caught, they will say that company has run away. Company took the money. I did not take the money. Or you are the one who is using the name of the company and filling your pockets or doing whatever you want to. So in these situations, we lift this curtain. We lift this particular curtain and we want to really see who is hiding behind this company, because they are the ones who are doing wrong and they are the ones who deserve to be punished, right? So that is known as lifting of corporate veil, when the law disregards the corporate entity and actually looks at the individual members who are doing it. Now, see, we have some statutory provisions and we have some judicial interpretations. What are these? What are you trying to tell us? See, statutory provisions and judicial interpretations. Supposedly, I called a company has cheated on me. See my potential. The company even cheats on me. So let's say, for example, the company has cheated on me, and I drag this particular company to the court. The court penalizes the company, but I actually emphasizes on the court that it is not the company which is cheating, it is the management of the company who are doing this. And if you leave them like this, they will again do like this. So they are fraudulently, they are defrauding the people around, and their intention is that only. So don't leave them. The court says, but the company is different and they are different. How can I penalize them? So I can find out a way. In these type of circumstances, in these type of situation, the court says, fine, we will lift this particular curtain and we will penalize the actual person who is doing that. So at times, in a lot of judicial cases, this has happened when the court has disregarded this separate legal entity concept and has actually penalized the one who is involved. Fine. So has removed this, has not paid any heed to the protection which is given to the members. So these are the judicial cases which we read over here. Now we have some statutory provisions also. That means even in Companies Act 2013, there have been many instances like if there is a mistake in prospectus, of the company. Now, ideally, this is a mistake which has been done by company, so company should be penalized, but court say, but the provisions of Companies Act, the statutory provisions of Companies Act tell us that no, not the company. For this, we will make the people who have made this prospectus, they are going to be responsible. So, these statutory provisions we read over the period of time under Companies Act, but the judicial interpretations are given here itself and we are going to read them. Fine, ma'am. First of all, protection of revenue, Dinshaw Menegji Pettit. What happened? What this person did is, he had a lot of income and he had to pay taxes. For avoiding taxes, he formed 4 companies and he transferred some of his investments to these 4 companies. Now, these 4 companies are doing nothing. They're just formed to hold that investment. So, in this way, he reduced his tax burden. Court realized that no, he has formed the company only to evade taxes and there is no other purpose for these companies to be formed. So in such a case, we will lift the corporate wheel and we will not say that the company is different and Dinshaw Menegji Pettit, you are different. No, we will club it all and every income will be treated as the income of Mr. Dinshaw and accordingly he will be taxed. Fine. Next is determining enemy character of the company. What is determining enemy character of the company? You have heard about, you have read about actually Indian Contract Act and you know the concept of alien friend and alien enemy. Supposedly, not that I want it ever and with no controversies or no offense, supposedly India is at war with Pakistan. Fine. Do you think in the times when there is a war going on, anyone of India would want to enter into any contract with a person of Pakistan, or any person of Pakistan would want to enter into any contract with the person of India? Do you think that's going to happen? That's going to happen? No, ma'am. Fine. Now, just think of this. We have this Pakistan and we have India. We have a company. We have another company. They both are Indian companies, so they can contract with each other. They can enter into a contract. That's the problem? No, ma'am, that's definitely not a problem. But this particular company is being run by all Pakistanis. All the directors, all the members, they're all Pakistanis. Now, do you think entering into a contract with this particular company who's run actually by Pakistanis, don't you think it is not fair? But this is an Indian company. If we keep this concept of separate legal entity alive, this company is different and this is different. So they can't be said they have a separate legal entity. But in this situation, they will lift the corporate wheel and look behind the real persons to determine whether this particular company's character, its particular character is of enemy or of friend. Fine. So that is Daimler Company Limited versus Continental Tire and Rubber Company Limited. Now the next, Smithstone and Knight Limited versus Lord Mayor. Now, this is basically what you have to remember in this is, a company has formed other company to act as an agent. Now, you have to remember that the agent binds the principal. It does not bind himself, right? So, the agent and principal, they're one thing only. Whatever agent is promising, it is ultimately going to the principal itself, right? Likewise, if I have formed a company to become my agent, it is not a different company, it is me only. Fine, so in such cases, corporate wheel may be lifted. Then we have State Officer Chandigarh versus SE's Information Technology Limited. In this case, corporate wheel could be done in case of transfer of shares of a company which actually was sale of land which the original allottee was prohibited to do so. What is happening over here? One company has been allotted some land, and on the condition that this land is not going to be transferred for at least 3 years, the company transfers some shares to another company maybe. Now what is happening? The ownership of this land is somehow shifted to another person. However, the transfer of land was not permitted. So in such a case, we cannot say that no, members are different, company is different, etc., etc. We will club it all and we will look behind the real person who has done this, right? So we cannot say that there is a wheel of incorporation. That wheel is going to be lifted in this particular situation. Fine? Okay. Now, next. Company formed for fraud, Jones versus Lipman. Fraud is a case where definitely corporate wheel is lifted. And lastly, we have avoiding legal obligations, Workmen of Associated Rubber Industry Limited versus Associated Rubber Industry Limited. See, we all know about a Payment of Bonus Act, right? What is happening in that particular act? Whatever profit company makes, some portion of that profit has to be given as bonus to the workmen. If a company makes more profit, more bonus will be given. If a company makes less profit, less bonus will be given, right? So accordingly, the bonus gets adjusted. Just to avoid this bonus or just to lower this bonus, what this company did is formed a company and transferred some income to that particular company. What happened? The profit reduced and the bonus also reduced. Court realized that the company is being formed just to reduce the profit so as to not pay payment of bonus, which is avoiding your legal obligation. If you try to avoid your legal obligation, then we will not consider this as a different company. We will consider this as one only. This will not get this shield or protection that they are different. They will be considered as one and accordingly have to pay bonus. Clear? Okay, ma'am. Now, classification of companies. We have different types of companies about which we have to read. First is on the basis of incorporation. Registered company and statutory company. First of all, what is statutory company? It's like LIC. In common parlance, we say it as statutory company, or that's what is it? It's a body corporate. They are not registered under this act. They are formed under a special act of parliament, directly under a special act of parliament. And for the companies who are registered under this act or previous company law, as I told you, under the definition of company, they are called as registered company, or as of that matter, only company. Fine. Then we have on the basis of liability. See, the members, companies' members, their liability may be limited, their liability may be unlimited, although that's hardly a case that you'll find now. Unlimited company, wherein the most beautiful feature of forming a company, why do you form a company? To avail this particular feature of being limited liability. So if anyone is getting unlimited liability in a company, why will you form a company? Right? So this is not something which is very practical, firstly. Secondly, the member's liability may be limited by shares. It may be limited by guarantee with share capital, by guarantee without share capital. Limited by shares, I have already told you this. Limited by guarantee, I have told you this also. If it is having no share capital and having share capital. Supposedly, I am a member in a company and my liability is limited to the amount of shares, to the amount I have not paid on shares. I hold 10 shares of 1000 each. On that, I have paid only 500 rupees each. That means 5000 I have to pay. So if company calls for that 5000, I have to pay because I'm liable towards the company for that amount. Supposedly, I'm a company which is a guarantee company. I have taken a guarantee that I am going to pay 1 lakh to the company. So if company asks for that 1 lakh, I will pay that 1 lakh. Supposedly, I'm a combination of this. That means it is a guarantee company with share capital. So I have taken a guarantee of 1 lakh plus I have shares of 10,000. On guarantee, the amount of liability is 1 lakh and on shares, the amount of liability is say 5,000. So my total liability comes out to be 1,05,000, right? So I hope you have understood that there can be a company which is limited by shares, there can be a company which is limited by guarantee, and there can be an unlimited company also. Okay, next. On the basis of members. On the basis of members, we have 3 types of companies. Private, 2 members at least. Public, 7 members at least. And 1-person company with just 1 member. So these are broadly 3 types of companies which may be formed even according to Companies Act. Section number 3, you will read it later. Now, let's read about these type of companies one by one. I'll take you to the charts. Private company. Section 2, clause 68. Private company, what is it? It's a private space. Just like your private parties, no public can, no outsider can enter into a private space, right? Whoever you allow, whoever you invite, only that person can attend your private party. So it's a private company. It has its own private space. Public is not allowed to enter into that private space. So private company is formed with just 2 members. Minimum number of members required to form a private company is 2, and the maximum number of members that is required that can be in the private company is 200. So minimum 2 and maximum 200. Fine. How do we identify, ma'am, whether it's a private company or it's a public company? See, Reliance Industries Limited. Can you read or can you find the word private? So it's a public company. Reliance Industries Limited. Limited. It's a limited company. The liability of the members is limited and it's a public company. What if I say ABC Private Limited? It's a private company. So where the suffix private limited is added, it's a private company. If the suffix SIF only limited is added, then it is a public company. And if in bracket it's written 1-person company, so it's an OPC, right? So that's the difference between 3 types of companies. Now, private company, there are 3 things in a private company which distinguishes it. In the Articles of Association of a private company, there is a restriction on transferability of shares. There is a limitation on the number of members, that the maximum number of members can be 200, and there is a prohibition on inviting public to subscribe to its securities. See, as I told you, in private company, the shares cannot be freely transferred. I mean, if I have got the invitation to attend my friend's birthday party, I cannot give it to some random person and say, see, I have got the invitation, you take this invitation and you can also go. But if I've got a pass to some public concert and I'm not going there, I can give the pass to someone else also, right? Likewise, the shares of a public company, they're freely transferable, but the shares of a private company, they cannot be transferred to anyone like that. But they can be transferred. There is a restriction, there's no prohibition, right? But at no cost, you will give this general invitation to public. So public cannot subscribe to securities at all. You identify a person, okay, you have been given an invitation, that is okay, but not to the general public. Fine. Now, see, suffix private limited in articles you have restriction, prohibition, limitation. One-person company is nothing but like a private company. It is a private company with some special features. Small company again is a private company. The number of members minimum 2, maximum 200. Exceptions present and past employees. That means if there are 160 members in a private company and that company decides to come up with ESOP, employee stock option plan, and wants to give away shares to its 50 employees, the shareholders, the number of shareholders will rise to 200. Will it amount to non-compliance of this section? The answer is no. Why? Because these 50 will not be included when we are counting this limit of 200. So the present employees or the employees who have left the employment but continue to hold shares, that is the past employees, they are also not included. Fine? Okay, ma'am. So that's about private company. See how in-depth revision we are doing. Then we come to public company. Section 2, clause 71. One which is not a private company is a public company. Great. So we add suffix limited. It's not a private company. The number of members minimum 7, maximum there is no limit. 200, 500, 5,000, 5 lakh, 5 crore, no limit at all. The public company can be started with which? How much capital, ma'am? See, there is no requirement which is being prescribed for either public company or private company as of now. No minimum paid up capital requirement has been specified for private company or public company. Okay. In articles, obviously there is no such restriction, prohibition or limitation. And one special thing about the definition of public company is that the subsidiary of a public company is deemed to be a public company. What do we mean by that, ma'am? Supposedly, we have a public company and that public company holds 60% shares or bought 60% shares of a private company. Now, this particular private company will not get the exemptions of being a private company. Because in this company, a lot of money of a public company is at stake. So if this becomes a subsidiary, you will read about holding subsidiary later. You have read about all of it. We are just revising although, but still, right? This particular company will be treated as a public company and will have to comply with all the requirements for a public company and will not get any exemption which is given to private companies. Fine? Okay. Moving further. One-person company. Section 2, clause 62. One-person company are special types of companies. They are, it's basically a private company, but it has some unique features. What type of features it has? There is just one member needed. See, earlier also there was a concept called as one-man company. Now we have one-person company, which is basically to help and promote the individual or sole proprietors, right? So they can also get that status of being a corporate and enjoy the benefits of incorporating a company. No minimum paid up capital required. See, one beautiful feature of a company is perpetual succession. That means no matter who comes and who goes, the company is going to go on and on forever. But in a one-person company where there is just one person who is managing the company, he is the one who is the director also, and if he dies, what will happen to the company? Who will take up the company? What is going to happen? The company will run into financial difficulties and will close down for sure. So to avoid that situation, the Act has come up with an idea and has specified that in a one-person company, you must appoint a nominee. Just like you do for your FDs. If you open an FD, you give a nominee. If you take a policy, you have a nominee. What if I die? All the money should go to my nominee. Likewise, what if I die? All the control should go to my nominee. So the nominee will become the sole person of the company. So that is one beautiful part and one different part about one-person company. Okay. One-person company, a natural person, that means a company cannot form another one-person company. It has to be a natural person. It has to be Indian citizen, whether resident or not. I am an Indian citizen, I am a natural person, I don't live in India, I love to live in abroad, I can form a one-person company. How do you determine whether I am a resident or not? If I am there in the preceding year for 120 days, I am a resident. At least 120 days I am a resident, but doesn't matter whether I am a resident or I am a non-resident. I can still form a one-person company, or I can be the nominee of one-person company. I can still be. Okay, so this is something, natural person, Indian citizen, whether resident or not, I can incorporate a one-person company. Fine, I can incorporate a one-person company. The special thing is that I have to name a special person who is going to act as a nominee. Usually in my classes, I give this classic example that forming one-person company is like finding a girl for your marriage, right? It's like getting married, in fact, right? And we establish the differences and similarities, and it's good. But right now, it's kind of same. See, if I take a policy, if I'm taking a life insurance policy, I say if anything happens, whatever amount of policy is should be given to my son. Okay, I don't need permission from my son to make him my nominee, because he doesn't have to do anything. All he has to is to receive money, so it's for his benefit. He's not liable towards anything. But when I am making someone my nominee to run the company, I have to take that person's consent also, his permission also is needed. If anything happens to me, you will become the sole member. So now you will be responsible for non-compliance and all that part, right? So you have responsibility. This is a responsibility that I'm giving. So I need to also obtain consent prior hand. So that consent I have to obtain. That consent may be withdrawn also. After some time, I find that no, I don't want to appoint this person as nominee. Fine, I'll not appoint this person as nominee. I'll change the name of the nominee. He thinks that no, I don't want to run her company. So he can also withdraw the consent that he has given. So that is also an option which is permissible. There is a form, in fact, INC 4, through which you can do that, right? Through which that can be done. Now, only one person as member, minimum paid up capital, no limit. Memorandum is going to indicate the number of the nominee's name. His consent is to be obtained. He can withdraw the consent. This person has the right to form one-person company. Minor cannot be the member of one-person company, and a one-person company cannot be converted into a Section 8 company. What is Section 8 company? Section 8 company is a company which is formed for charitable purpose. Okay, see, a single person cannot do all that task which is needed in charity, so he cannot form a Section 8 company, although he can convert his company into a private or a public company. Right? Now, next, on the basis of control, we have holding company, we have subsidiary company, and we have associate company. What is holding company, subsidiary, and associate? They are basically relative concepts. They cannot be read standalone. Oh, this is a holding company. Oh, this is a subsidiary company. No, you cannot say that. You can say this is a private company, this is a public company, but you cannot say this is a holding, this is a subsidiary. Holding to what? Subsidiary of what? Right? So they are relative concepts. Fine. How are they related? We have two companies. One company holds more than 50% of voting power on this company. This will be called as subsidiary, and this will be called as holding. More than 50% means, ma'am, 50.00001% is also more than 50%. Voting power is as good as share capital unless you have differential voting rights shares, right? So if you have DVR shares, then it's slightly different, Otherwise, voting power is as good as share capital. So if this company holds 60% shares of this company, this is subsidiary and this is holding. We also have another condition. If this company controls the composition of board of directors of this company, then also this is called as subsidiary and this is called as holding. So these are two cases in which the company can become a subsidiary and this company can become a holding company. One company can have a lot of subsidiaries, but layering of subsidiaries is not allowed. That means A has 60% shares of B, B has 60% shares of C, C has 60% shares of D, D has 60% shares of E. This is layering which is not allowed. Fine. Why? Not exactly why, we cannot get into every if and but right now in the revision video, but 2 layers, beyond 2 layers, it's not allowed. Okay, ma'am. Now, associate company. What is associate company? See, this company does not have more than 50% shares of this company. So it doesn't become its subsidiary. But it has got 30% shares of this company. So it has good, significant influence. Significant influence is when you have more than 20% voting power. So it has significant influence, although it doesn't become a subsidiary, but has significant influence. So we cannot call this as subsidiary and we cannot call this as holding. In that situation, we call this as associate and we call this as investing company. Okay. Next, on the basis of capital and listing. On the basis of share capital, we have companies with share capital and without share capital. Now, on the basis of listing, we have listed company and we have unlisted company. What is listed and unlisted company? See, if I want to sell my product on Flipkart, how can I do that? Ma'am, you have to list yourself as a seller. You have to get your product listed on the portal, listed on the website, and then you can sell it. Likewise, we have companies. Companies who want their securities, that is their shares, their debentures, to be sold in a marketplace which is stock exchange. They can get their shares listed on that stock exchange. So such companies are called as listed companies, and those companies who do not do this process, they are called as unlisted companies. Fine. So section 2 clause 52 has given us the definition of listed company. Now there was a rule 2A, which came as an amendment rule, and it brought about certain types of companies which will not be treated as listed companies for the purpose of Companies Act 2030. Fine. That means, example, the public companies who have not listed their equity but have listed their debentures. Right. So some companies will not be treated as listed companies. So we have that part. Now, moving on to our next company, holding, subsidiary, associate, and then we have small company, right? Section 2, clause 85. Section 2, clause 85, small companies. Okay. What is small company? See, if we have a lot of market players, a lot of anyone, a lot of people, or maybe say we go to a park and there are thousands of people around. I want to protect these people. I know that someone who is of the age of 30-35 can protect himself, right? But someone who is of 3 years or 5 years may not be able to protect himself, right? So I have to protect the children. So maybe I can give them some extra benefits, extra advantages. The children can form another line. They can come to a special area or whatever like things, right? But if I know that with these children, there is some elderly person, I know they will take care of the children, so I don't need to involve myself. Do you get my point? The whole intention is here also. We have some companies who are operating on a very small scale or a very small level. Government wants to encourage them, wants to protect them. So they are being conferred the status of small company and they are given some extra benefits and exemptions and privileges, right? But if you call yourself to be a public company, that means you're not a small company. If you call yourself to be a Section 8 company, we don't see charity being done by someone who has very little. Maybe they can still go out and help others, that's not the point what I'm telling you, but they cannot anyway open a charitable company. Right? They cannot do that. So small company will not be a public company. It cannot be a Section 8 company. If it is a holding company, that means you are big enough to hold another company. You're not a small company. If you are being held by some other company, that means you are under protective hands. You cannot be a small company. So if you're not any of these and you're a private company, then if you are within this threshold, then you will be called as a small company. What is the threshold that has been given, ma'am? The paid up capital has to be less than or equal to 50 lakhs or such higher sum as may be prescribed by government. And not just this, two conditions have to be fulfilled. The turnover of that company should be less than or equal to 2 crores or such higher sum as may be prescribed. What is the highest sum which is prescribed by the government? It's 2 crores for paid up capital and it's 20 crores for turnover. Okay, it's 2 crores for paid up capital and it's 20 crores for turnover. That's clear? I hope that's clear. Government has the power to prescribe up to 10 crores and here up to 100 crores. But that does not mean we have to check these limits. What limit we have to check is 2 crores and 20 crores. That means supposedly I am a private company and my paid up capital is 1.5 crores and my turnover is 10 crores. Can I be a small company? Yes. Because this is something which we will check currently. Fine. Okay. Moving further. Section 8 company we are going to do a little later. Nidhi companies we will do later. Public financial institutions, LIC, IDFCI, then UTI and the institutions which are notified by the government in consultation with RBI. They are all called as PFIs. Then we come to government company. Like ONGC, it's a government company. Now government company means the shareholders are government. Ma'am, there can't be any other shareholder. There can be, but at least 51% of the share capital should be held by government. Which government, ma'am? It can be central government, it can be state government, or it can be combination of both. Right? So that will be called as a government company. And supposedly if ONGC acquires 60% shares of some other company, this other company will also be treated as government company. Why? Because a subsidiary of a government company is also a government company. Okay, subsidiary of a government company is also a government company. Okay, ma'am. Then we come to dormant company. What is dormant company? You have heard about dormant bank account, right? What is dormant bank account? When there is no operation, no activity in that bank account, that is known as dormant. Likewise, we have formed a company but there is no activity going on in the company. Nothing raw material purchasing, nothing sale happening, nothing happening. You are just sitting idly. Then why are you wasting time of being a company? Apply to the ROC and get the status of being a dormant company. So now everyone knows that you are a dormant company and you are doing nothing. Fine. So if I have formed a company for some future transaction, I incorporated a company but I have the intention to start the business after 3 years. Or if I am an inactive company, when will I be considered as inactive? If in the last 2 financial years there was no business or no significant accounting transaction in the last 2 financial years, or I have not filed financial statements or annual return for last 2 financial years. So I am an inactive company. If I am an inactive company or I am a company which is formed for future purpose, I can apply to ROC and obtain the status of dormant company. The question here is that what do we mean by significant accounting transaction? See, if I have taken a building, of course I will pay building rent. That is not a significant accounting transaction. That is an accounting transaction which has to be done. If I am filing some form with ROC, I have to pay ROC fees. Undoubtedly, I have to do that, right? So again, that is something which is not a significant accounting transaction that has to be done. But yes, if I buy raw material, that is a significant accounting transaction. Why? Because it signifies that there is some business going on. Okay. Now, that is a dormant company. Okay, ma'am. Joint venture, it's a normal joint arrangement. Next we have illegal association. What is illegal association? See, according to Companies Act 2013, section number 464, if there are 10 people working together, be it partnership or any other form of business organization, you're working together, fine, you can do that. 20 people, again you can do that. 30, 40, you can do that. But, if it's more than 100, you cannot do that. In fact, the current limit prescribed is 50. So for us, 50 is the limit which we have to keep in mind. So if there are more than 50 people doing business as a partnership or anything else, it's illegal. They have to incorporate into a company. Ma'am, supposedly we are 60 chartered accountants, or we are 60 CMA professionals, or we are 60 company secretaries. We have incorporated our partnership firm. Is it illegal? And if we form a company, we cannot become the auditor of anyone, because a body corporate cannot be the auditor and all that like things that we already know. So what are you trying to tell us? See, for professionals who are governed by special acts, it is allowed. It is allowed. Otherwise, any association shall not be formed for carrying out any business unless it is registered as a company. Plus, one exception is also there, which is HF. If a family has 60 people, husband, wife, and maybe, I don't know how many children, they can continue. They will not be treated as illegal association. They are legal only. Fine. So apart from that, other than that, it's going to be illegal association. Clear? Fine, ma'am. Now, we come to an altogether different part, which is about forming a company. So we have read about what do we mean by company, what is the concept of corporate will, what are the features of the company, what are the different types of companies, and when registration is mandatory. So if I voluntarily choose to form a company, or I am forced to convert my business into a company, whatever the choice be, I have to now form a company. And how do I form a company? That is what we are going to read and revise now. Section 3 tells us, Section 3 of Companies Act 2013 tells us that a company may be formed as a private company, as a public company, or as a one-person company. Who forms the company? Supposedly, I have this idea, okay, I want to do business and I want to form a company for this. So I am a promoter. I will decide the name of the company. I will decide what work company is going to do. I will hire people. I'll prepare documents. I'll do all that part. I am a promoter. Right, later on you can identify me. My name may be found in prospectus or in annual return, or board may be working according to me. Right, so that is what the definition of promoter covers, not an important one. So a person gets an idea, decides to form a business organization. If he decides company, then he has to do that preliminary steps, that is gather people. For one-person company, I am sufficient. For private, I need something else also. And for a public company, I need at least 7 people to form a company. I also have to prepare documents. See, documents are a must. If I have to apply for PAN card, Aadhaar card, or passport, anything, I need ample of documents here. So here I am forming a one-person company. Of course, I need a lot of documents. Not a one-person company, but a company. So of course, I need a lot of documents. Now, say Mr. Ambani ji, he decides to form another company. So he gets this idea, he gathers people also, but now he doesn't know how to incorporate a company. If I take my example, I have incorporated a lot of companies, right? So I know where to fill the form, how to fill the form, how much fees to pay, everything. I know the whole incorporation procedure, so I can do it. But maybe he'll not be able to do it. So he goes to seek some professional help. And that person assists him in doing the necessary filing and helping him prepare the documents and all that. So is he the promoter? He is the professional who is rendering professional services. Promoter is Mr. Ambani only. Fine. Okay. So he decides the name of the company, does the filing, etc., etc. Okay. This section we'll do a little later. Now, so this is the formation of company overview. Promoter decides what type of company to form, obtain DIN and digital signature. DIN is director's identification number and digital sign. See, the whole process of company incorporation is now online. Nothing is offline. So offline signatures also don't work anymore. We have digital signature certificates. I'm sure you all know about it, right? So that is how you affix signature on the online documents, right? On the documents which are in your system, right? So that is how you affix signature on them. After that, you apply for name. See, name is the most crucial part in a company. Nowadays, if I want to get a Gmail ID, it's difficult because all the usernames have been blocked and so are the names of the companies. You don't find the name of the company available, or even if you find it available, it may be close to some other company, etc., etc., and you have some name rules. So complying with all those rules, it's difficult to find a name which suits your company and everyone around, right? So you have to apply for a name. And the form that we use for company incorporation is SPICE Plus, right, which is divided into two parts, part A and part B. Part A is for name and part B is for other part of incorporation. Both the parts can be filled together also, and they can be filled one by one also. Preference is that you reserve your name and then you fill the other part of incorporation. Fine. After that, you have to prepare documents and then you file the form and you're being allotted certificate of incorporation. Fine. When we read about documents, we have these two special documents, MOA and AOA. Let's read about them and understand what do we mean by Memorandum of Association and Articles of Association. Fine, ma'am. Memorandum of Association, section number 4. See, association. Memorandum, which is for memory purposes. So we have to record about this association. This is the most fundamental and basic and charter document of a company, which is all about the constitution of the company. What is the name of the company? That is the name clause. Where is the company registered? Not the full address of the company, but where? State of Uttar Pradesh, state of Karnataka, state of Rajasthan, where? Situation clause, that's it. Object clause. What is the purpose? Why the company is formed? The company is formed for construction of bridges. So construction is the purpose, right? The company is formed for providing fashion designing services. So fashion designing is the purpose. So whatever is the object, whatever you write in the object clause, you can do only that part. You cannot do beyond anything, right? Liability clause. The liability of the members is going to be limited to the amount of shares which is unpaid by them, right? Or whatever the case is. Capital clause. With how much capital your company is going to be registered. There is no minimum paid up capital requirement, right? These are the 5 clauses in Memorandum of Association of all types of companies. But in one-person company, we have an additional clause. Why? Because in one-person company, we also have to mention about the nominee. So in case of OPC, you have to name a nominee, which is there in succession clause. Fine? Okay. Now, as I told you, Companies Act has 7 schedules. In schedule number 1, you have this Memorandum of Association and Articles of Association, different formats. If a company is limited by shares, then you can pick the memorandum, you can pick Articles of Association, make necessary changes, and it becomes your memorandum in your articles, right? So forms have been specified there. Your memorandum is going to be signed, divided into paragraphs and all that. It is prepared by every company at the time of registration. And one important point to be noted. If I don't like my name, can I change my name? Yes, ma'am, not advisable because people know you by that name, but you can change your name. If I don't like the name of the company, can I change the name of the company? Yes, ma'am, you can. That means in memorandum name clause, I wrote something. Can I change it? Yes, ma'am, you can. Can I change the city of my company? Yes, ma'am, you can. State of my company? Yes, ma'am, you can. So that means your memorandum of association can be altered later according to section number 13, that is 13. Clear? Fine. Now, articles of association. What are articles of association? They are basically the internal rules, how a company is going to be governed, how the company is going to run, right? So section number 5, it is exactly the same thing. They are also specified in tables of schedule 1, and they are also divided into paragraph. They are also numbered, prepared by every company at the time of registration, and can also be altered later on. That means there are a lot of conditions, a lot of clauses which are there in the articles of association. You can change any clause later on by altering it according to section number 14. Fine? Okay, ma'am. Now we come back to the process of incorporation with a little in depth. So this is our steps of incorporation. We'll read it from the charts. We will revise it from the charts itself. That's going to be more helpful. As I told you, it's advisable that first you reserve the name and then go for the process of incorporation. However, you can do both of the things together as well. So you fill SPICE plus part A. Whatever name you are going to choose, you have to be careful because section 4 specifies certain restrictions to the name you can choose. It should not be identical to any existing company. See, if I also choose a name as Reliance Computers or Reliance, it might give an impression that it belongs to that Reliance group. So I cannot choose a name like that. I cannot choose a name which constitutes an offense. The name itself is an offense, right? And I cannot choose a name which is undesirable according to central government. You may ask me, Ma'am, what is undesirable? Rule 8A has been prescribed for the same, and we don't have to read them. So you just have to keep this in mind, right? Moreover, there are certain words. If we use those words, it gives an impression that this entity, this company belongs to the government. Like if I use educational board sensation limited. Don't you think using the word board gives an impression that it belongs to the government? So I cannot use some words which are clearly given in rule 8b. If I want to use these words, I have to get the approval of central government. Right? I have to get the approval of central government for the same. Right? So keeping all these points in my mind and subject to the availability of the name, I decide one particular name, and if it's available, I file the same with ROC. If there is no defect in my form, ROC will approve it, and if there is any defect in my form, ROC will give me chance to rectify the defect, and within 15 days I can again do it and my name will be approved. If my name is approved, it is reserved for 20 days. So I get a time period of 20 days to fill part B of SPICE Plus and get my name and get my company incorporated. Supposedly, I filled part A giving some wrong information, and the authorities found it out. They found out that I have reserved this name giving some wrong information. There can be two situations. I have not yet filled part B, so the company is not yet formed. They will cancel the name that they have reserved and they will put a penalty of 1 lakh on me. And what if the company is also formed? Now the ROC can direct me that change your name within 3 months, or shut down your company, or I'll remove your name. So these type of orders may also be passed. One more thing, if I am an existing company, that means I have already formed the company. Now I want to change my name. I can again do that. keeping the name restrictions in my mind, and my name can also be reserved for 60 days here. Okay, and I can change the name accordingly. Now, if I have reserved my name, or maybe I have not reserved the name and I'm preparing both the parts of Spice Plus together, both can be the situation, I have to prepare the documents. MOA, AOA, which we have already discussed, declaration of compliance by CA and director, that yes, the person has complied with all the formalities which are necessary. Declaration of no offense, that we are not involved, we have not ever been found guilty of fraud information of a company. So we have conditions of offense. We have to give a declaration that no, I was not involved in any of the offense. Particulars of your registered office. If you don't have a registered office ready with you, any correspondence address you can give right now. The subscriber details, directors details, and their consent that yes, they are ready to act as the directors. All these documents are being prepared and the form is being filed with ROC. ROC gives us a certificate of incorporation that yes, your company is now incorporated. It also gives us a corporate identity number, which is unique in all respects. SIN, corporate identity number. Now, just like we read about incorrect details in reserving a name, here also we might have given incorrect details for company's formation, not just for reservation of name but for company's formation. Again, there can be two situations. Company is not yet formed. The person responsible, they are attracted to section number 447, which is punishment for fraud. Since they have fraudulently given wrong information, they are given punishment for fraud, which is there specified in section 447. If the company is formed, they will be liable for fraud, plus moreover tribunal can pass these orders. It may say that we will regulate the management. Your directors are not competent enough to run a company because before formation they are involved in such huge fraud. What will they do after formation of the company, right? It may direct that the members' liability, earlier it was limited but now it will be considered as unlimited. It may direct that no, your name should be removed. It may direct that close down your company or any other order. So such orders can be passed if you give incorrect information and your company is formed on the basis of that incorrect information only. Clear? Fine, ma'am. So this was about incorporation of company. Okay. Now we have effect of registration, section number 9. See, according to section 9, a very small section, this section actually doesn't tell us anything very important. When you form a company, before a company is formed, you have subscribers. You don't have members, because members of something which is not in existence, it doesn't make sense. So you have subscribers who sign the memorandum, and as soon as your company is incorporated, these subscribers become members. Company gets the status of being a company, so now it can hold property in its own name, it can sue, it can be sued and all that part. So that is what is written in section number 9. We have another section, section 3A. See, one thing that we have established so far is that for a private company you need at least 2 members, for public company you need at least 7 members, and for 1-person company you need at least 1 member, but for that we have a backup called as nominee, so forget that. For private and public company we need at least 2 and 7 members respectively. Now, it may so happen that one member of a private company died. Ram and Shyam, they were doing business together and Mr. Shyam died. So now what is going to happen? Ram is continuing the business of a private company, but in a private company you must have at least 2 members. So should the company shut down, close, what should happen? Ram is given a time of 6 months. Go find another Shyam and then continue the company. Even after 6 months, if he continues the company with just him alone and no other member, what will happen is that whatever contract he enters into, he is going to be personally liable. Fine. So that is the case which is written in section number 3A. Then we have section number 10A, which is about commencement of business. What is this, ma'am, now? See, if you are a company incorporated before the 2nd November 2018, you receive certificate of incorporation, you start your business, nothing to worry. But if now you are incorporated, if you are a new company which is incorporated after this date and you are a company with share capital, then you need to do certain more things. You are a company with share capital. Have you received your share capital? The subscribers who said that I am going to buy 10 shares, I am going to buy 50 shares, have they actually paid money to the company? If yes, that is the declaration which your directors will file with ROC. That yes, subscribers have paid money. So that is the declaration INC 20A which has to be filed with ROC. Moreover, every company, according to section number 12 of Companies Act 2013, must have a registered office from 30th day of its incorporation. When I am forming the company, when I am incorporating the company, I may not have a registered office right now. So I just gave a correspondence address. But after I have incorporated a company, I must have an office to run the company. If I don't have the office, I cannot run the company. So I have to give this office address also within 30 days. So if I do both these things, then I can start my business. Otherwise, I cannot start my business and I have penalty for the same. Section number 12. Section number 12 is simple. Every company must have an office, and outside every office you must affix a board which is going to contain the name of the company, which is going to contain the address of the company, right? And that has to be proper in some characters which you can read, fine, which you can read. That's it. I think that's sufficient for you. Now, Memorandum of Association. Memorandum of Association, Section 2, Clause 56 gives us the definition. The definition is not at all important, so I'm not dealing with it. And the rest of the part we have already discussed. We have discussed about the clauses of memorandum also. What we have not discussed is the alteration of memorandum. Okay, before we switch on to alteration of memorandum, amongst the chart I also have the one-person company process of incorporation, which is exactly similar to any company's process of incorporation. The difference is that these people can form one-person company. They have to find nominee, they have to obtain the consent of nominee, and they can change the nominee's name later on also by filing INC 4. If one-person company wants to convert itself into private or public, they can do by filing an application with ROC. Okay, now, section number 13, alteration of memorandum. Alteration of memorandum. See, there are 5 clauses to memorandum, and the first clause is the name clause. So if a company is formed and after that company wants to change its name, can it do so? Well, yes. You have to ask your members. How do you ask your members? You have to call your members. To call your members, you have to hold board meeting. That means all the directors will come together to decide when to call our members, to decide about the general meeting. General meeting is the meeting of shareholders, meeting of the members, right? So when to call the meeting? You call the meeting, in that you seek permission of your members. Not simple majority but special majority, that is 3/4 majority. Special resolution is needed. Fine. After you after you obtain approval from your members, you have to get approval from central government also. Okay, So you apply to central government. After you get both these approval, you give this intimation to ROC and ROC gives you a new certificate of incorporation. But if you are a defaulter company, that means you have not filed your annual returns, or you have not repaid your deposits or debentures in time, then you're not eligible to change your name. Fine. So if there is no default, then you can change your name, and if you want to change your name, this is the procedure that you follow to change your name according to section number 13. Is that clear? Fine, ma'am. Now, this was when we wanted to change the name. At times, we don't want to change the name, but the government wants us to change the name. Now, this can also happen. Yes, this can also happen. Like, ma'am, if I want to change my name willingly, I can change my name, but how can someone else force me to change my name? Central government is like your in-laws place. Your in-laws can force you to change your name, right? Anyways, why are we forced? Because we have not complied with the provisions. So maybe if we have complied with the provisions, when we may not be aware of the prospective companies or same brand name which may be available in the market. So we have taken their name, we have to change our name. If I fill the form part A of Spice Plus and I got the name available, so my company was incorporated, later on it was discovered that yes, there is a company which is exactly with a similar name and it could not be identified at that particular point of time. So government will direct me to change your name. We are giving you a time limit of 3 months. Fine. One more situation. I work under the brand name of Book My Video. It's not a company. Supposedly you decide to form a company, Book My Video Private Limited. Now I have a registered trademark in the name of Book My Video. So although I am not an existing company whose name you have taken to be identical with, but I am a registered trademark and your name is identical with my name. So if I make an application and oppose this, you will be directed to change the name within 3 months. Fine. Okay, so once you change your name, you have to intimate ROC within 15 days that yes, your new name is this. Okay, ma'am. So alteration to name clause, we have to rectify our name if central government tells us to, and we can voluntarily also change our name by following the provisions. Next is situation clause. Situation clause means what? Situation clause means shifting your situation, physical situation of a company. See, it may so happen that I want to shift from Karol Bagh to Patel Nagar. That means within the city, within the same ROC. Second situation, I might want to change from one city to another, but my ROC remains the same. From some part of Pune to some neighboring city of Pune, ROC remains the same. Then maybe I want to shift from Pune to Mumbai. ROC is changing, but I am in the state of Maharashtra only. But there might be another situation where I want to shift my office from Maharashtra to Uttar Pradesh. So my state is also changing. So there can be 4 different situations. 4 different situations. What you need to remember? For the first situation, within the same city, pass board resolution, inform ROC about new address. Second, pass special resolution. You need to seek permission from members for changing your city. You are still in the same ROC. You are governed, you are under ROC, that ROC only. But you need to obtain SR and then inform ROC. Next, your ROC is changing. Your state is still the same. When ROC changes, you have to seek permission from regional director. So apart from seeking permission from your members, you also have to seek permission from regional director. And when your state changes, you seek permission from from your members, plus you seek permission from central government, because now you are changing the state. Both the states are under central government. It's not within the powers of regional director to do so, right? So now you have to go to central government, and central government assures or ensures that the interest of creditors, the interest of debenture holders, that does not suffer. For that, you are being asked that you give notices to these people, you receive their objections, and government is going to consider their objection. After considering their objection, then they will grant you approval that you can change your office from one state to another. Okay, so that is how it happens. Fine, ma'am. Next is object clause. It's simple. If I want to do another business, I can. If I don't want to do my existing business, I can change it. Only thing is, SR is needed. Simple. Clear. But there is one special point in change of object clause. What is that special point, ma'am? See, if you have raised money, if you have shown an offer document to public, prospectus to public you have shown, and you have said to people that you give me money, I will invest money in this real estate, do this and that. You've collected money, and now you're changing the object of the company and saying, now I'm going to do this. People might get angry. And don't you think you need their permission to do so? That is the simple case. If the company has unutilized money which you have raised from prospectus, then you have to publish the same in newspaper also. And the shareholders who do not agree, you will give them an exit option, a dissenting option, an exit option, that fine, if you are not in, we return your money. Fine. So that is how you can change your objects. Okay. Liabilities are ideally not changed, but there are special circumstances of liability and capital alteration that we read in the chapter of capital. Here you don't have to actually read it. Now we come to articles of association. Articles of association. We have read about articles also. Right, we know the meaning, we know the form. Section number 14, alteration of articles of association. How do we change any clause that we want to? Simple thing, SR. Pass special resolution. To pass special resolution in general meeting, you need to call your members. To call your members, you need to hold a board meeting to decide how and when to call your members, right? So that is what happens, simple. Simple. Now, one more thing, that if you want to convert private company to public company, private to public, that means you need to remove those restrictions from articles, right? You take permission from your members and you submit it to ROC. If you want to convert public company to private company, you also need to obtain approval from central government, right? That is the additional thing. Now, once your company is incorporated, that means the documents that you have prepared, memorandum and articles, they have been registered with ROC. They are registered with the authority. Section 10 tells us what is its effect. Members are bound to the company. If in the articles of association it is written that if a member does not pay call on money on 2 notice reminders, their shares will be forfeited. Members have to be bound by this particular clause. If it's written that the company will pay interest at the rate of 6% to the members, they have to pay. So company is also bound to the members. Members are not bound inter se, and company is not bound to outsiders. What does it mean? If in the articles of association it is written that Mr. X will be managing director till the life of the company, and company changes this particular clause, Mr. X cannot sue the company. The articles don't bind the company to the outsiders, they are for the internal rules only, right? So that is what is the effect given in section number 10. Okay. Now we have, my dear, some doctrines. This is section number 17. Simply tells us that we have to give these documents to our member if they request. Simple. So our members will have easy access to memorandum and articles and all the filed resolutions. So if they want a copy of that, the company has to give it. Now we come to doctrine of ultra vires. What is it? First of all, what is doctrine? Doctrines are basically principles, some rules which are formed. These are all formed because of the case laws. See, we have been given the object clause of Memorandum of Association. We have been told that this is what a company is permitted to do. Now what if company does anything which is not given in the object clause of memorandum? The company does it. Has the company done correct? No, the company is incorrect in doing so. So what should be the contract? Is it going to be valid? Is it going to be not valid? And what if all the shareholders are okay to it? They all accept it, that whatever director has done, it's all correct. That is the question which comes to our mind, but this is the question which does not have any answer in Companies Act 2013. So for that, we have some doctrines, my dear. These are the principles which have been established to read company law, how we read it, because of the case laws, right? So we have different doctrines, and 3 doctrines that we have to read, of course. Doctrine of ultra vires, doctrine of constructive notice, and doctrine of indoor management. Fine, so let's read them one by one. The meaning of the term ultra vires is beyond the powers of. Beyond the powers of. Beyond the powers of what? See, object clause tells us something. Companies Act tells us something. We cannot do anything which is beyond this, which is not written in this, right? If we do that, it is going to be void. Void means something which is not valid. And even if you want that, okay, I am going to change this object clause later on and I am going to amend this and everyone should agree and we are going to make this act a valid one, you cannot do that. You cannot do that. That means if something is beyond your power, you cannot later on go on to justify it that all my shareholders agree, they have ratified the same, they have accepted the same. No ratification is possible. If you're doing any such thing, stay order can be obtained against you, right? So we have a case law, Ashbury Railway Carriage versus Iron Company Limited and Iron Company Limited versus Ritchie. Now, the company's object was to make, sell or lend or hire railway carriage and wagons, which carries it. To carry on the business of mechanical engineer and general contractors, fine. To purchase, lease, work and sell mine, mineral, land and buildings. Now this is the work which they have been permitted to do. But instead of doing this, the company entered into a contract to finance the railway line. Now you only think that, does this object clause permit the company to finance? They're not permitted to carry out financing activities, right? The contention of the company was that all the shareholders have accepted it. They agree that we can finance. Your shareholders, even if they agree, doesn't make your act a valid one. So you cannot make an ultra vires act to be valid even if your shareholder, even if every shareholder of the company assents to it, right? So doctrine of ultra vires, if you do anything which is not within your powers are defined by your object clause and memorandum of association. So if it's not within your powers, you cannot do it, and if you do it, that is going to be treated as void. It will not be a valid act, right? Okay. Next is doctrine of constructive notice. Okay. What is doctrine of constructive notice? This actually works in the favor of company. See, when I am filing the document, the company is incorporated and the memorandum of association and the articles of association, they are with ROC and they are available as public documents. That means anyone can go to ROC and obtain these documents. They are available to general public. So you must read these documents before contracting with the company. If you are a third party, you must have knowledge of these documents. You are presumed to have notice of these. Whatever is written in this, you're presumed to have notice of this. You're presumed to have notice of this. So whenever you're dealing with a company, you're advised to have knowledge of this. Why? See, let's first read the case law. Kotla Venkataswamy. Articles require that deeds should be signed. If there is any deed, it should be signed by managing director and working director and the secretary. So if I am a third person and I'm dealing with the company and the company is giving me this deed, I must know that a valid deed according to this company will be the one which is signed by these three people. I must know this. Supposedly the company has given me this deed which is signed by working director. Okay, which is signed by working director and which is signed by secretary, but it is not signed by managing director, and I accepted that deed. Why did I accept this deed? It is my mistake or company's mistake? It is my mistake also. Yes, company will get the benefit of it because I have also incurred a mistake. What mistake have I incurred? I must have this knowledge of articles of association, because in this articles of association it was written that this sign should also be there, and if I had this knowledge I would have asked the company to get this signed also, right? So that is going to be my mistake. Now exactly opposite is the doctrine of indoor management, which works in the favor of third party and against the company. How? Royal British Bank versus Turquoise. See, as per the articles of Royal British Bank, the board of directors of the bank were authorized by the articles to borrow funds on bonds, provided the board of directors were authorized by the shareholders in the general meeting. See, what is it? In the articles of association, it was written that board of directors can be authorized by a resolution to borrow. I read this articles of association. Fine. According to doctrine of constructive notice, I read about this articles of association and know that board of directors can get this power to borrow if they are authorized by resolution. So when board of directors came to me to borrow, I gave them money. But later on I came to know that, oh my God, these board of directors were not authorized by this resolution. Now you tell me, am I supposed to inquire internally that whether this resolution was passed or not? No. This doctrine says no. This doctrine says no. If any person deals with the company, they're satisfied that whatever transactions they're doing, they're in accordance with memorandum and articles, they're not bound to inquire into any regularity of internal proceedings. Simple. Okay. But imagine, I knew about this. I knew that they have not been authorized by resolution. If you knew this, then you should not have given money to them, no? Right? You should not have given money to them. So if you knew about the irregularity, then you are not going to get this benefit of doctrine of indoor management. Likewise, if you did not know about memorandum and articles, then you should have definitely inquired. Supposedly you do not know that board of directors can be given the powers. Of course, the board of directors don't have the powers, so you must have inquired. If it is a case of forgery, forgery is complete nullity. If it is forgery, no matter who is suffering and who is not suffering, the case cannot be made a valid one. And negligence. If I had a doubt that yes, I had a suspicion, then I must have went deep into the inquiry and tried to find out what is the real situation. So if these things are involved, then I will not get this benefit of doctrine of indoor management. Otherwise, I get this benefit. Okay. Now, moving on to our next segment. In incorporation only we have section 8 company. What is section 8 company basically? What is section 8 company? See, company which is formed for charitable purpose, that is for promotion of sports, promotion of education, promotion of culture, right? So this is a company that you have formed and your intention is not to make profit out of this company. So whatever surplus is being generated, how surplus will be generated? Maybe you get donation of 1 lakh and you have spent only 10,000 in a financial year. So you generate a surplus of 90,000. That will not be used to fill your own pockets, because you have formed a company for promoting charitable objects. So you are not permitted to take dividend from such type of company. Fine. How do you form this company? This company formation process is again same. The special part is that you need to obtain license from government. Why? Because government gives you a lot of exemptions. When government is giving you benefit for something, it will also ensure that you are the right person to form this company. So it gives you license. So you have to apply for license for running a Section 8 company, for incorporating rather a Section 8 company. Okay, so first thing is that you apply for name, and there is one single application. Earlier you had another application for obtaining license, but now you have one single application for obtaining license also, and for incorporation of that particular company also. Fine. So you make one single application, you have all the same attachments. The extra thing is this: you have to give your estimated annual income and expenditure for the next 3 years, which is helpful in obtaining the license, which is needed for getting the license, right? You get the license, your company is incorporated. Now, when you get license to do something, the same license can be revoked also. It can be taken back also. Why, ma'am? And how? See, if you have been given license, you must comply with the conditions on which you have given license, you must comply with Section 8 requirements, right? If you don't comply with it, your license can be taken back by government. If you do fraud or you are violating your objects, you said that I'm going to promote sports, but you're promoting something else, or your affairs are not in the best interest of public, in such situation, government can take back your license. And when government takes back your license, you are no more a Section 8 company. Section 8 company may be a private company, may be a public company, right? And once your license is revoked, again you restore the status to a private or a public company, and then you continue to operate. Okay. There are more minute details about that. How do you convert a Section 8 company? Can you convert it? Yes, ma'am. Why not? If any other company wants to become Section 8 company, you need license. And if you want to become a normal company, take permission from your members and apply to Regional Director for approval. So you get these 2 approvals, you can convert your status. Okay. So other types of conversion I have already told you. We also have Section 18, which clearly tells us that alter your memorandum, alter your articles, and file the necessary form with ROC, and you can convert your company. Okay, we'll now revise the topic of conversion of LLP. We have read different types of conversion under Companies Act. We know that the company, a company under Companies Act may be formed as a private company, as a public company, or as OPC. And these type of companies can be converted into other types of companies like private to public, public to private, OPC to them, then them to OPC, Section 8 to other kind of companies and all that. Here we are discussing about conversion of LLP. What is LLP? LLP is a different form of business organization, which is a body corporate. So it, as the name suggests, it has the benefits of limited liability and flexibility of partnership, limited liability partnership, right? So it is a combination of company as well as partnership. Now, we may choose any form of business organization as we intend to. But supposedly we incorporate LLP and later on we may find that, okay, fine, we want to raise some funds, we want to issue shares and all that. That's something which is not possible in LLP, and hence we want to convert our LLP into company. So do we need to close it down and then reinstate and all that? No. We have a provision for conversion. Although the provision for conversion of LLP into company is not available under LLP Act. It is given in Companies Act under Section 366, read with Companies Authorized to Register Rules 2014. Ma'am, what is the procedure? First disclaimer, in your syllabus, you don't have to read the entire elaborate procedure. Undoubtedly, you have the procedure, you have the steps, everything, but it's not complete. I wouldn't say that every step has been incorporated, that okay, fine, after these many days, we have to file this form, then this form, then this, then that. No, we have a broad picture of conversion of LLP to company and vice versa. So what is the process? We are trying to convert our LLP into company. So we have partners in LLP. We will take approval from all the partners. Then we will give an advertisement of the newspaper, local newspaper, where our LLP was registered, seeking objections. Third, we will take NOC from the ROC, that is registrar, where we are registered. Then we will file the application for name approval. We all know that under Companies Act, we have a section number 4, which talks about name restriction. So considering all that, we apply for a name and then the name is approved and it is reserved for 60 days. Within that tenure, we have to file the form. Which form? The most important thing in this topic is file form URC1. And for conversion of company to LLP, E-form 18. So these are the two forms that you must learn for this topic. So filing form URC1. Now it's going to be filed with certain attachments in the prescribed manner. What are going to be the attachments? The member details, first director details. Whoever is going to become the director of your company must have DIN, must have DSC. So if they don't have that, you are going to apply for that and they must be available. The LLP agreement and certificate of registration, as we had the consent of all the partners, NOC from creditors, NOC from ROC, and copy of newspaper advertisement as we discussed above. Right, so all these documents should be available, and apart from that we have other optional attachments as well. So these are the broad attachments that I have told you. Along with URC1 in the prescribed manner, we have to file, and thereafter conversion takes place. Right, again, only a broad picture. We don't have the elaborate procedure because we have other forms also to file, but that is something which I'm not discussing. Then comes our other way around thing. That is, we have incorporated a company, and now I find that maybe LLP is better and it has better features or it has better things to offer, and I want to convert my company into LLP. LLP can be converted into private company or a public company, just that the requirements are different. So in private company, you just need 2 members, which are already available in LLP. But for public company, there may not be 7 members, so you have to gather 7 people, right? When we are converting a company into LLP, can private company be converted into LLP? The answer is yes. Can public company be converted into LLP? Again, the answer is yes. But listed public company, not directly. It has to be first time listed. Now, how did this take place? How this happens? Because it is a company, we need consent from 2 people. First, the board of directors meet, they pass a resolution. Secondly, the shareholders meet and they give the consent. So we need consent from these 2 people. Then we file the application for name. Then we file the form. But before filing the form, it is advisable to prepare the LLP agreement. Although this LLP agreement can be submitted to the authority even after within 30 days of incorporation, but to avoid any dispute, it is advisable that LLP agreement be first drafted, and thereafter you file the necessary form necessary form required to incorporate LLP. What is the necessary form? E-form 18. Along with that form, there are certain attachments: statement of shareholders, statement of assets and liabilities verified by the auditors, list of creditors with their consent, and partners' details. So broadly, again, we have these documents which are going to be attached, and the filing has to take place. So they have to do broadly these steps to convert LLP to company or company to LLP. Let's now revise the chapter of deposits. Ideally, what is deposits? But before that, from where does this chapter come from? It is part of the chapter investment and loans, right? So investment and loans ideally has 2 components according to our syllabus. One is the deposits, which is read in a separate chapter in company law, which is an altogether separate chapter, right? And has a very few sections starting from 73 to 76A. And other, we also have a topic about investments, which is just a part of chapter that we discuss later, right? So first of all, deposits. What do you mean by deposits? Any receipt of money. So company, if it is receiving money in any form, whether you call it deposit, whether you call it loan, whether you call it any form, it will be treated as deposit. However, there are certain categories of receipt of money by a company which will not be treated as deposit. They are the categories prescribed in consultation with RBI. Okay, like basically, if you try to understand the gist of deposits, what is it? If company is receiving money in any form, it must be regulated. That is the main intention of law. Now, if company takes a bank loan, they have an agreement. So it is being regulated, right? So we have terms and conditions, and company cannot unnecessarily exploit the lender. Likewise, when you're issuing shares, and raising money from public, then you have proper regulations which are being made under company law. When you issue some securities which are listed, then listed, that is SEBI has made a lot of regulations with which you have to comply. So ultimately it is important that all the receipt of money by companies should be regulated. However, there are certain unnamed category or receipt of money which remain unregulated because they do not have a name. So that leftover receipt of money, they are actually included in deposits. That means if I say if you receive amount from government, it's regulated by government. So not deposit. If it is through some foreign source, it is regulated by FEMA, RBI approval and all that. So it's not deposit. If it is from banks, it is not deposit. See, we have certain prescribed category of receipt of money, which are not deposit. So any type of loan, any type of instrument that you issue in accordance with RBI, you take some money from another company, you take some application money which you're bound to either refund or make an allotment in the same regard. If you receive money and you don't make any allotment within 60 days, it has to be refunded in next 15 days, right? If it is not done so, here the time limit is different. If it is not done so, then it will be treated as deposit. Otherwise, that money is not deposit. If you receive from your director of company or from relative of director of private company, it's not deposit. Secured convertible bonds, debentures, listed debentures. So unsecured debentures which are not listed are deposits. So unsecured debentures which are not listed, they are going to be treated as deposits, and you must comply with the provisions which are given for deposits. See, they basically prescribe that if you want to take money from anyone just like that, then you have to comply with certain requirements. That means you must return the money, you must give them proper offer, you must give them interest, right? This should be the minimum period, this should be the maximum period. All the terms and conditions are specified. Fine. If you receive amount from employee which should not exceed your annual salary, and no interest should be there on that amount, right? If we hire someone, we might ask him to give a security deposit which is non-interest bearing. Then if any amount is received just in trust, that you keep it, it belongs to me, but you keep it, non-interest bearing. Then as a part of your trade, advances, that means you have taken advance for supplying some goods, you've taken advance for selling the immovable property, you've taken advance, you have taken some security just to be sure that the contract will be performed, right? There is some amount that you receive from your customers in the form of warranty that you are going to provide for in future, or you have taken some advance for some publication. Publication means maybe magazine, journal, so they subscribe for it annually. So that is not deposit. Okay. If the money is received from the promoters, now sometimes if I am a company and I go to the bank and request them to give me loan, bank might say that you ask your promoters also to contribute. So banks have placed a condition that if your promoters contribute, then only I will pay the loan. So if the loan is brought by the promoters as a stipulation by bank, so till the bank loan is repaid, the promoters also have to pay that amount, and company cannot repay it back. So till that time, the amount received from promoters will also be treated as will not be treated as deposits. After that, it will be treated. Chit fund, nidhi, CIS, not deposits. If the amount is received by startup, because startup companies need a lot of funding, So people invest in the startup, and if they have given at least 25 lakhs in a single tranche, um, which will be later on converted into equity, then that's not deposit. And if you receive from any of these funds which are registered with SEBI, that is alternate investment fund or venture capital funds, right, or real estate investment trust and all that, then it is not deposit. Okay. So company is the one who is receiving money, and there is someone else who is giving money to the company. That someone else is a depositor. That someone else or the depositor can be the member of the company or can be general public. But only an eligible public company is allowed to receive money from general public. Otherwise, all the companies, whether private or public, can receive these deposits from their members subject to the limit and conditions given in this chapter. Right? Okay. So can deposit be accepted? Yes, by a private company from its members, by public company from members as well as public if it is eligible to do so, after complying with the provisions and conditions. Fine, ma'am. There are some types of companies which are absolutely exempted from these deposit provisions, but for obvious reasons. If it is a banking company, its core business is to accept deposits. We cannot place restrictions on deposits every now and then, right? So banking companies, NBFC, HFC, that is housing finance, and other which may be specified in consultation with RBI, they are all exempted. Okay, so they can receive any money without complying to this chapter. Fine, ma'am. Now, firstly, section number 73. When you receive deposit from your members, what are the conditions that you have to comply with? First thing, call general meeting and pass ordinary resolution. So when your members permit, then you can accept deposits. Then you have to prepare a circular. What is preparing circular? It is nothing but like an offer document wherein all the details will be prepared. Okay. Then you also prepare a certificate that you have not done any default in repayment of any previous deposit or its interest thereon. File the circular with ROC, appoint a deposit trustee, execute a deed with them, and then issue the circular to members for inviting the deposits. Okay, once you've accepted the deposits, it's important that the deposits must be secured. So, creation of adequate security. And once you accept deposits, within 21 days, depository receipts should be issued to you. There should be a deposit repayment reserve which will be created. And whatever deposits are maturing in the following year before 30th April, 20% of the deposits which are maturing, you will transfer to that reserve, which will be used for repayment undoubtedly. And every year, a return of deposits is filed, that is DPT3, before 30th June with ROC. And it is very obvious that if you have accepted deposit for 2 years, after 2 years, you have to pay it. Whatever are your terms of interest, you have to pay accordingly. If there is failure, then the depositor can make an application to tribunal and tribunal can pass adequate orders. Fine. Now, there are some clauses which are not applicable to certain company. Now, the certain company I will explain you a little later. We'll revise little later. Fine. And this section also will revise little later. First of all, let's understand other aspects of deposits. Whether it's a private company or it's a public company, if it wants to receive deposits, the minimum tenure or the tenure has to be 6 months to 36 months. That is minimum 6 months, maximum 36 months. More than that is not allowed, and less than 3 months is also not allowed in any case. But less than 6 months but more than 3 months is allowed if you want it for your short-term needs and the amount does not exceed 10% of paid-up capital plus free reserves plus securities premium. Ma'am, is this the limit for normal deposits as well? The answer is no. This is the limit on deposits. If you are a private company and you fulfill certain criteria of exemption, that is this, then there is absolutely no limit on you. That means if you are a startup for 10 years, You're a private company which is not a associate or subsidiary, and your borrowings are less than lower of 2 times of paid up capital or 50 crores, and there is no default in repayment of deposits. Okay, so if you comply with these conditions, then there is absolutely no limit. If you fulfill the criteria of exemption, no limit. You can accept as many deposits as you want to. And for other types of private companies, 100% of your paid up capital plus free reserves plus securities premium. Okay. For public companies, you have to check whether you are eligible or not. If you are an eligible company, then you can receive from non-members also. In that case, from non-members up to 25%, from members up to 10%. If you are not an eligible company, then you have an overall limit. Okay. Now, if you are an eligible government company, then also this bifurcation is not there. Then also you have an overall 35% limit. Okay. Deposits can be accepted in the joint names also, but not exceeding 3. This can be a question of MCQ. And the rate of interest will not be more than the rate specified by RBI for NBFC. I hope that's clear. So these are the conditions of deposits. Now, how do you accept that deposit? If you want to accept it from members complying to that condition, follow section number 73. If you want to accept from general public, then follow section 76. Section 76 is nothing but a replica of section number 73 with slight addition. Okay. It actually gives reference to section number 73 only. So if you are an eligible company, only if you're an eligible company, all public companies are not allowed to receive deposits from general public. Only eligible public companies are. So they can accept deposits from public after complying with above conditions. So resolution, what is additional credit rating mandatory, and the circular will not be given to members because here you are giving offer to general public, so it will be issued in the form of an advertisement. So advertisement will be published in newspaper, on website, right? It also has validity, and thereafter the deposits will be accepted, charge will be created, deposit receipt will be issued, everything is the same. Then question is, who is an eligible company? If you are a public company and you have net worth of more than equal to 100 crore or turnover of more than equal to 500 crore plus, you get consent from your members. If you want to accept deposits within the limit of section 180, consent can be a simple ordinary resolution, otherwise SR. So if these conditions are fulfilled, then you become an eligible company, and only an eligible public company is allowed to receive deposits from non-members or general public by following these provisions. Apart from that, deposit register will be maintained, which will contain all the details. It will be preserved for 8 years. It will be kept at the registered office. There are 2 disclosures which must be made in the financial statement: amount that you receive from directors, and in case of public company, an amount which you receive from directors as well as relative of directors in case of private company. You have to appoint a trustee for depositors. So before issuing any circular, you have to find a deposit trustee who is not disqualified, obtain his written consent, prepare a trust deed, file this trust deed also, and then issue the circular along with the statement that we have received the consent of the requisite person. He will discharge the duties which are prescribed. He can be removed before his term also, subject to following of conditions. Now, who is disqualified to become the deposit trustee? That means who cannot become deposit trustee? If you are a depositor, if you're a director or KMP or employee of company holding subsidiary associate, if you're indebted to company holding subsidiary associate or subsidiary of holding, if you have a material pecuniary relation, if you have given guarantee of some deposits, or if you're a relative of above. Okay. Of course, in the chapter of deposit, you have a lot of things which you have to learn. In case you haven't learned them yet, it will be difficult for you to connect with me at this pace. So in case you don't remember these limits, you don't remember this tenure, you don't remember the flow, please learn it also. Then you will be able to revise well with me. Right? Okay, so then there is contravention. That if you contravene the chapter of deposit, then you have penalty on company as well as officer in default. And if fraudulent intention is proved, then also liable under section 447, right? Let's now revise the chapter of dividend. The dividend chapter. It is chapter 8 of Companies Act 2013 and contains very few sections, section number 123 to 127. First of all, we need to understand what do you mean by dividend. If we go by the definition, it is defined in section 2 clause 35. However, it only tells you dividend includes interim dividend. So what exactly is dividend? We are unable to identify. We only get to know that all the provisions of dividend should apply equally to interim dividend as well, because dividend includes interim dividend. Fine. What is dividend? Whenever a company earns profit, if there is no profit, of course, there will be no dividend. Whenever a company earns profit, it has two choices to make, whether to retain the profits or to distribute it, or how much to retain and how much to distribute. When it decides to distribute the part of profits to shareholder, this can be done in two ways: distributing it in cash or distributing it by capitalizing some shares in the form of bonus shares, which is absolutely a separate topic and is a part of the chapter of share capital according to section number 63, which we are not discussing right now. Right, we are discussing about that part of cash profits which is distributed to the investors, distributed to the shareholders when the company earns profit. Okay, now there are certain types of confusion which the students have. Confusion number one is with respect to preference dividend and equity dividend. Preference dividend, you have to remember certain things. Rest, forget everything. The chapter revolves around equity dividend. Okay, what things you have to remember for preference dividend? Whenever the company wants to go for any declaration of dividend, they have to first give the dividend to preference holders. Their rate of dividend is fixed. They are being given dividend, which is part of profits. So obviously, if there are no profits, preference dividend also cannot be paid. However, if it is a cumulative preference shares which have been issued, then the preference dividend which is unpaid for any year will be added and will be paid in the next year. However, if it is non-cumulative preference shares, then the dividend, if not paid, goes in vain, right? It's not added, it's not accumulated. So if the company doesn't earn profit, it may waive off the payment of dividend. But in any case, before paying dividend to equity shareholders, dividend to preference shareholders will be done. Fine. Now when we talk about the dividend, they can be of two types: final and interim. Final dividend is proposed by the board and declared by shareholders only at annual general meeting by passing ordinary resolution, as it is a matter of ordinary business. Interim dividend is declared and proposed and declared, everything is done by board. When it is declared, between the annual general meetings. So right, not exactly between, yeah, you can say between annual general meetings. So the duration ideally is from start of the financial year till the end of the financial year, and even after that till holding of annual general meeting. So ideally, board has to take a call whether to pay dividend or not. If yes, at what rate dividend should be paid, for which financial year dividend should be paid, and how do you want the dividend to be paid. If you want the dividend to be paid as a final dividend, then it will be declared by shareholders. So the board will propose the same. The shareholders can reduce it, they cannot increase it, and it will be declared. If the board wants to do it themselves, then they can propose, they can declare it. Okay, fine, ma'am. No equity dividend will be paid if there is a default in the repayment of deposits. Okay, section 73, 74 default. If there is, if that default persists, then you cannot pay dividend to your equity shareholders. Now, section 123 has a lot of things incorporated into one. However, we will read first the segment of interim dividend, and thereafter we will proceed the whole section. Because for interim dividend, you just have to remember two different things: declared by board, and secondly, the sources of payment of dividend are different. Apart from that, every provision of dividend applies to both the types of dividend, whether it is interim or it is final. Okay. So it can be declared during financial year or even after financial year till annual general meeting by board. What are the sources? There are three sources. For this chapter of dividend,
P&L account and free reserves are two different things. Ideally, they are the same for us, but for this chapter, they're two different things. P&L means the undistributed profits. However, the profits which are transferred to reserves cannot be used so easily for payment of dividend. So point number one, the sources. Whatever profit is lying in your P&L account, whatever amount is lying in your P&L account, that can be used for paying interim dividend. Secondly, the profit which has been earned in the financial year or for the financial year for which you're paying interim dividend. Fine. Thirdly, supposedly we are talking about financial year 22-23, and after the financial year ends, we are paying interim dividend for that financial year. Possible? Yes, ma'am. So in which year we are paying? We are paying in 24-25, right? So we are paying in the next year. In this year also, till this date, till the preceding quarter, the company must have earned some profit. So that profit can also be used for the payment of interim dividend of preceding financial year, ideally. Okay, so these three profits can be used. Now, when you are paying dividend after the end of the financial year, then preceding quarter has to be checked. If preceding quarter has witnessed a loss, then law puts a limit on how much maximum dividend you can pay. What is the maximum interim dividend that you can pay if the previous quarter has witnessed a loss? Then what is the maximum interim dividend that you can pay? Not more than average of preceding 3 financial years. Fine. Okay, fine. Now we ideally come to section number 123, and these are the sources that we are talking about the final dividend, because for interim dividend we have read separate sources. So these are the sources of dividend that we are discussing for the final dividend. Fine. Out of current year profits, after providing for depreciation, out of past year profits. Now past year profits are of two types, as I told you. If it is undistributed, stays in the P&L account. If it is transferred to reserves, they are different, and for utilizing that you need to fulfill the conditions of rule 3. Okay, so the three sources of dividend without any condition compliance are the current year profits after providing for depreciation, the balance lying in P&L account after providing depreciation, and the money which CG or SG has provided as a part of guarantee. So if central government or state government takes any guarantee, in the case of government company, of course, that investors, you invest and we guarantee you that we'll pay you this dividend. If the company doesn't make profit, then we will provide you the money to pay dividend. So the government provides money, and out of that money, dividend can be paid. Fine. Dividend will always be paid after setting off the losses and depreciation. Fine. If the company does not have sufficient profits in the current year or in the P&L account, and wants to use reserves for paying dividend, can it? The answer is yes. So even in case of loss, you can pay dividend using the past year profits which have been transferred to reserves by complying with 4 conditions given in rule 3. What are the 4 conditions? The rate of dividend will not exceed the average of last 3 years. Whatever amount you draw from the reserves, it's not going to be more than 1/10 of paid up capital plus reserves. The amount that you draw will be first utilized to set off losses, and then it will be used in the payment of dividend. And fourth, after withdrawing from the reserves, the balance of reserves should not fall below 15% of paid up capital. So if these 4 conditions are satisfied, then money can be drawn even from reserves for payment of dividend. Fine. The depreciation shall be computed according to Schedule 2. Okay, fine, ma'am. How the dividend will be paid? The dividend will be paid only in check, cash, electronic mode, or dividend warrant. The dividend has to be deposited within 5 days. Whenever the dividend is declared, whether interim or final, whenever it is declared, it has to be within 5 days transferred or deposited in a separate bank account. And within 30 days of declaration, it has to be paid. If it is paid, great. If not paid, then you have certain consequences given in section 127. Apart from that, if it is not paid for certain reasons, of course, there can be genuine reasons that the person did not claim. We wanted to pay, but we could not pay. The person did not claim. So within 7 days, you have to open a special account named unpaid dividend account in a scheduled bank, and you have to transfer the amount over there. If you don't transfer, then there is an interest at the rate of 12%. If you transfer it, within 90 days of transfer, you have to prepare a statement about the last known names and addresses of the investors, which we consider as prospective, and they should have been there to collect the dividend, or they are entitled to dividend, but they haven't collected it yet. So a statement of the same is going to be prepared and put on the website. Now, any investor who comes to know of it later on can apply to the company. The company will make the payment accordingly after verifying the identity and everything. If in that unpaid dividend account, the amount remains unpaid for 7 consecutive years, then it is going to be transferred to IEPF. It is going to be transferred to IEPF. If it is paid, great. If it is unpaid for 7 consecutive years, it is going to be transferred to IEPF. What is IEPF? Investor Education and Protection Fund. Investor Education and Protection Fund. The question is, what is IEPF? We read about it in section number 125. Central government establishes a fund, and which has an authority. Authority is constituted which administers the fund, right, which manages the fund. In very simple language, it maintains all the accounts, that from where the money is coming, from where it is going, prepares an annual report, the audit is also done, everything is done. Now there are some credits and there are some uses of this fund, that is from where the money comes to this fund and from where it is used. Not a very important section, however. See, government grant from unpaid dividend account, just like we read. In the same manner, there are a lot of investments, there are a lot of application money, there are a lot of deposits. The deposits have matured, the debentures have redeemed, but there is no one who claims them. So ultimately, it is not the government's money. Government owes it to the people, and the people are not there to claim. That doesn't mean that the government will leave the company. Okay, fine, you keep it and enjoy. No. You have to transfer it to IEPF, and IEPF, from there also people can claim later on. If they come to know that they have to take something from the company which has been transferred to IEPF, they can make an application to IEPF, provide the adequate proof, and they can take money from there also. Okay, so all that part is credited to the fund, and the fund is utilized for refunding money, of course, for promoters' education, for reimbursement of legal expenses and all that part. Okay. Now, Section 127 is an important section which provides the punishment for failure to distribute dividends. If the dividend is not paid within 30 days as it is supposed to, then there is penalty. The director and the director who is knowingly a party is liable to imprisonment as well as fine. Imprisonment can extend up to 2 years, and the fine for 1,000 per day, and the company is liable to pay a simple interest at the rate of 18% per annum. However, in certain cases, the company is not liable. Why the company is not liable? Because the company tried to pay dividend, but the company could not, because of maybe operation of some law. That is, there is a foreign investor and we have to make dividend payment, but the provisions of FEMA are not letting us do that. We cannot. It's not our fault. It's not company's fault. See, company will be penalized or punished only for its fault. This is not company's fault. Secondly, the shareholder gave us a direction which cannot be complied with. The shareholder told us to issue a dividend warrant only, and the warrant returned at the address mentioned by the shareholder. What is our fault? There is a dispute. We do not know the shares belong to Mr. A or Mr. B. The shares have been transferred, they haven't been registered in proper name, the document is inadequate or something like that. So we do not know who to make payment. So we have refrained the making of payment, not our fault. We have to take something from the shareholder. Maybe call money is due from the shareholder. So we have adjusted the dividend against that call money. Rightfully done. And any other thing which is not our default. So if we are not at fault, we will not be penalized. Otherwise, we will be penalized. Right? Dividend, once it is declared, it cannot be revoked. This is simply the time limit just to make you revise the same. Let's now revise the chapter of accounts of companies. Now this is chapter number 9 of Companies Act and contains section 128 to 138. Right? What is it all about? The first thing, company has to maintain books of accounts and books and papers. Now this the first chart that you're seeing is nothing but an intro chart. This is not any section chart. Okay, so company has to maintain books of accounts, books and papers for whole year. The question is, what do you mean by books of accounts? If I talk about books of accounts, it means your details with respect to expenditure and income, your details with respect to assets and liabilities, your details with respect to sale, purchase, and cash records. So that is books of accounts. Now, books and papers ideally includes books of accounts plus deeds, voucher, the supporting documents. So they have to be maintained for the whole year. And at year end, you prepare financial statements. The question is, what do you mean by financial statements? Balance sheet, P&L, cash flow statement, statement of changes in equity, and explanatory notes. Cash flow statement is not required to be made by one person company, small company, dormant company, and a startup private company, right? So every company, whether private, whether public, whether small, whether big, every company has to maintain books of accounts. Books of accounts and books and papers for whole year. And financial statements at year end, which is first approved by the board, signed by the board, then given to auditor for audit, then audit report is obtained, it is circulated at an annual general meeting, it is laid before the members, and it is adopted by passing ordinary resolution, as it is a matter of ordinary business. After it is adopted, it is filed with ROC. The books of accounts may be reopened according to section number 130. Okay. So this was the general view of the whole chapter. Now, if we go section by section, section number 128, that is the first section that we read in this chapter. Every company has to prepare books of accounts, we read earlier. For every financial year, they have to be prepared on accrual basis, as in when they accrue it on double entry system by complying with accounting standards, which must give true and fair view. Now, these accounts may be prepared physically or even electronically. But if it is prepared electronically, we must follow the rules prescribed. Like it should be accessible in India, retained in original format, it should be unaltered, there should be proper storage and retrieval things, right? The details of service provider, and this is now 23. Audit trail feature is also mandatory. See, if you're using an accounting software like maybe Tally, SAP, ERB, whatever accounting software, QuickBooks you're using, you must ensure that it has an audit trail post 1st April 2023. Okay, so you have to ensure that. Fine, ma'am. Now, the books have to be preserved for 8 years. There is penalty for contravention. Supposedly investigation is going on, then it will be preserved for even longer tenure till investigation. Where do you maintain these books of accounts? The books of accounts will be kept at the registered office of the company. If it relates to some branch, then it can be maintained at the branch, and then the periodical returns will be sent to the head office. If it is a foreign branch, then quarterly returns will be sent. Supposedly, the board of directors don't want to maintain books of accounts at the registered office. It is completely the discretion of board. You don't have to confuse between register of members and the books of accounts. Register of members may be kept at a place where 1/10 of the board members reside, etc., etc. Right? Here we are talking about books of accounts, and books of accounts may be kept at any place which the board may decide. So it will be shifted there, but within 7 days in AOC form, AOC 5, you have to notify this to ROC. Your books of accounts, which are kept maybe at a registered office or some other place, and the summarized returns of the branch or other financial information from outside India, this is all open to inspection by the director or his agent during business hours. And it is the duty of all the employees to give proper assistance. Then we come to next section, that is financial statements. I already told you what are financial statements. So company has to prepare financial statements which shall give true and fair view. There is a schedule 3 which prescribes the format, but this format is not applicable to banking company, insurance and electricity company, as they have their different format of reporting. Okay, so you have to comply with the AS, and you don't have to you have to comply with all the accounting standards. In case there is any deviation, it must be disclosed. Why there is deviation? That also must be disclosed. And what is the effect of this deviation? That also must be disclosed. Apart from this financial statements, if the company has subsidiary or associate, then it will also prepare consolidated financial statements in the same form and manner. But if it is an intermediate holding, that means ultimately there is another holding which is actually consolidating and preparing CFS, then you can skip it. Okay, then that is then CFS is not required. Now financial statement, CFS, and a statement of subsidiary, you can say that all is going to be the set of financial statements and laid at annual general meeting. Your financials, your CFS, before it is handed over to the auditor, it is first approved by the board. Now, how will the board approve it? It is signed on behalf of the board. If the chairman is authorized, then the chairperson signs it. If he is not authorized, then two directors, one of whom shall be MD, and CEO, CFO, and CS if appointed. Okay, in case of one person company, it is just signed by one director and handed over to the auditor for audit. Okay, now once the audit report is prepared, it is the right of every member, debenture trustee, and every person who is entitled to the notice of general meeting to receive the set. What set, ma'am? Financial statements, consolidated, audit report, board report, and extras, everything. Okay. So it has to be sent. When it has to be sent, at least 21 days before AGM, along with the notice of AGM, it is usually sent. But if you obtain the consent of these people, then it can be sent at a lesser period also. In case of listed company, it's not important or mandatory to send the whole set. You can circulate it as above, or you can keep this available for inspection before 21 days and send a brief statement containing salient features of the same unless some member asks for the full statement. Okay. And if you're a listed company, undoubtedly your shares will be in electronic mode only, so you have to send it electronically. And if there's a public company with this net worth and the shares maybe they are not in demand, then you can obtain the consent and send it electronic mode. Otherwise, you have to send it physically. Fine. Okay. Now, reopening of the accounts. Supposedly, the accounts that were made and they were finalized, they were fraudulent, or the affairs were being mismanaged, basically fraud. It is the case of fraud. Central government, SEBI, income tax, any other statutory body or any person concerned identifies that fraud, makes an application to the tribunal. NCLT sends the notice to all these authorities to seek their observation, to seek their representation, and order the company to reopen their books, but not earlier than 8 years. So 8 previous years, the books may be reopened and the accounts shall be revised or recasted, and that recasted account shall be final. There is another section, section 129A, which is made for ideally unlisted companies, which has given power to central government, that central government can ask the unlisted companies that you prepare financial results on some periodical basis, maybe quarterly, half yearly, and they have to give reports that way. Okay. We have another section 131, which talks about voluntary revision. So here the directors ideally pass the board resolution and they apply to NCLT. Why do they apply to NCLT? Because the accounts that they have prepared, the financial statements that they have drawn, they do not comply with section 129, or the board's report that they have made does not comply with section number 134. So for past 3 years, they can make an application. Again, NCLT will give notice to income tax authorities and CG to seek their representation and then pass the order for revision. It is like filing revised return, but you are given just one option to revise. So once a financial year, that's the maximum that can be done, but only on these two grounds. Now, what do you mean by board's report? We have a section 134, which talks about board's report, and there is a huge list. Obviously, I am not going to read the whole list over here. You can read it. There is a lot of content. It is ultimately the responsibility of the board, which the board is addressing to the shareholders, and has to speak about all these matters. For OPC and small company, we don't have such elaborate boards report. We have an abridged form. So there are lesser contents which are needed in the abridged report or in the boards report of OPC and small company. Okay, I think that's clear. Right. Now, after that, we have a section 135, which is the 134 we have discussed. 135 is corporate social responsibility, CSR. Now, what do you mean by CSR? And which companies are required to go for CSR? So, every company which has net worth of more than 500 crores, turnover of net worth of more than equal to 500 crores, turnover of more than equal to 1000 crore, or net profit of more than equal to 5 crores during the immediately preceding financial year has to formulate a CSR committee. CSR committee is not required if your expenditure does not exceed 50 lakh. So you have to prepare a CSR committee. Now, the CSR committee is responsible for preparing a CSR policy, that where should we spend, because it is mandatory. It is made mandatory by law that out of your net profits, at least 2% of your net profit, average net profit that you have made immediately preceding 3 financial years, the average 2% net profit must be spent towards society. We have Schedule 7, where there is a huge list of CSR activities, possible CSR activities which you may undertake. So it depends upon the CSR committee to formulate this policy and recommend to board, who is going to approve and thereafter undertake CSR activity. Who shall be the part of CSR committee? 3 or more directors, out of which at least 1 shall be independent director. Okay. So this CSR policy will be placed on the website also. How CSR activities can be implemented? Through any company, any NPO which is established by the company itself. Like we have seen in case of Reliance, right? Any company, any Section 8 company which is established by CG or which is established by some government or any under any other act of parliament, or any other company, Section 8 company, if it has 3 years of track record of similar activities. There is another form which has been introduced, Form CSR 2. So it has to be filed. Earlier, we only had to give information about CSR in our board's report. Now we also have to file a report with ROC in CSR 2. If you do anything just for your employees, or if you do anything outside India, or if you contribute to some political party, or if you're doing the activity as you do in the normal course of business, then that will not be treated as CSR. Now, we have another provision of set off for CSR. Sometimes it happens that we want to do something good which will take time. So we want to spend money in a project which will take for 2 years. So we have spent that amount, but only half of it is utilized. The remaining is unutilized because the project goes on for 2 years. So whatever is the unspent money, that has to be transferred within 30 days to some scheduled bank, and then you can, or if you have spent it excess, then you can later on set it off. If it is not any ongoing project and you had to spend 1 crore, but you ended up spending only 70 lakhs, so the remaining 30 lakh, you must transfer it to some fund which is specified in Schedule 7, and it will be treated as your CSR expenditure. Okay, fine, ma'am. Okay, coming back to a section that we missed. Section 137 talks about filing of financial statements, filing of documents. Annual general meeting, if it is held, then in these cases you need XBRL reporting also, AOC4 XBRL. Otherwise, financial statements, CFS, other documents, all that annexure, all that set, plus accounts of subsidiary, they all would have been laid at AGM because AGM is held. So it would have been adopted. If it is adopted, file the set with ROC within 30 days of AGM. In case it is not adopted, then also file it. ROC will keep it as at provisional records, and at an adjourned AGM when it is adopted, then you will refile it. Supposedly AGM is not held for whatsoever reason, then also you have to file the whole set and also state the reasons why AGM was not held. Of course, this does not apply to one-person company, because in one-person company you don't have to conduct any annual general meeting. Once your financial year ends, within 180 days, you file the financial statements. Okay. We also have a section of internal audit. Internal audit section 138. So we have these prescribed companies. Every listed company, unlisted public company fulfilling any of these criteria, private company fulfilling any of these criteria, they are going to appoint an internal auditor who can be a chartered accountant, cost accountant, or any other professional. He can also be an employee, individual or partnership, and he is going to discharge the functions within scope as determined by audit committee, or if the audit committee is not there, then of course the board of directors. Okay. Chapter of Audit and Auditors. Chapter 10 of Companies Act and contains sections 139 to 148. Right. Okay. So what is audit? In this chapter, we talk about statutory audit, which is mandatory for every company. Right. So audit is mandatory for every company, every financial year. So if you have a company which is incorporated under this act or under any previous act, then it is mandatory for it to find an auditor who is eligible to get the accounts audited. Right? Okay, fine. Who can be the auditor? Only an individual if he's a CA in practice. If you go for the firm or LLP, where the majority of partners are CA, but only CA can sign the audit report. Provided they are qualified under section 141. So section 141 subsection 3, we read a list of disqualifications, very important for examinations. If a person is not disqualified, then only he can become the auditor. And when he is doing the statutory audit of the company, he should not render certain services. So certain services are prohibited which are given under section 144. How the auditor is appointed, of course, we find the auditor, we see whether he's eligible or not, we check whether he's disqualified or not, we check whether his appointment is as per term or not, we check whether he is doing the audit within the ceiling limit or not. So we take that certificate and all that from him and also obtain his consent, and thereafter appoint the auditor in the manner which is prescribed in this given chapter. We inform the auditor that you have been appointed. We also file the notice of appointment with ROC. The auditor can be removed, he can also resign. He has certain duties and rights which he can exercise, and he has to discharge. Okay. Now, how the auditors are appointed, that is the first thing. We all know that it is the management which prepares the financial statements. They are approved and thereafter they are handed over to the auditors for audit, for obtaining a true and fair view on the financial statements which have been prepared. Right. Section 139 is a huge section. It talks about the appointment procedure. It also talks about some rotation, and it also talks about if there is casual vacancy in the office of auditor, how that is going to be filled. And it makes a distinction between the normal types of companies and government company, because the auditor of government company is appointed by CAG, that is the Authority, Comptroller and Auditor General of India, right? So by CAG. So that is why everywhere we will read this difference and distinction. Now, one more thing before I start. Although audit committee right now we don't discuss, it is discussed in section number 177. However, what is audit committee? Audit committee is nothing but a group of directors who are dedicated for this audit purpose. Right. So they supervise the whole audit process going on in the company. So in case audit committee is not mandatory in all types of companies. If you exceed a certain threshold, or if you're a listed company, then audit committee becomes mandatory. In case your company has audit committee, then all the decisions will route through audit committee. So first audit committee will recommend and thereafter board will do. But if there is no audit committee, then directly from board. So this is the distinction that you have to keep in mind. After you keep this in mind, we are good to go to start with the appointment of auditors. Okay. So first of all, let's talk about the non-government company, that is the usual case. when we are appointing the auditors for the first time, there can be two cases. Company has audit committee, there is no audit committee. If the company has audit committee recommends a suitable name to the board and the board appoints. Board appoints within 30 days of registration. If the board fails to appoint, then the members call EGM and they appoint within 90 days, who are going to hold office till the conclusion of first AGM. So whenever they are appointed from there till first AGM is concluded, the auditor holds the office. Thereafter, subsequent auditor will be appointed. But supposedly we don't have an audit committee. Now, in case we don't have audit committee, directly board comes into picture and board appoints. If board fails, members appoint. Simple. Right? Now, the first auditor retires or leaves the office at first annual general meeting. He can be reappointed. That means the same person can be reappointed for another term from first AGM to sixth AGM. But we can also appoint someone else as the auditor. Again, there are two cases. If there is audit committee, the board committee recommends name to board recommends to members. The first auditors are appointed by the board. However, the subsequent auditors are appointed by the members. Appointment of auditors is a matter of ordinary business and requires ordinary resolution. Okay, if there is no audit committee, then the board directly recommends the name to the members and members recommend to the, members appoint it. Okay. If you want to reappoint the same auditor, you must ensure that no resolution has come to you for his non-appointment. No special notice has been received for not appointing him and he's not disqualified. Okay. If at annual general meeting an auditor could not be appointed or reappointed, he will continue. He will be deemed like existing auditor shall continue. Now, when we come to government company, in government company, the first auditors are appointed by CAG within 60 days. If they fail to appoint board within next 30 days, if they fail to appoint members within 60 days at EGM. Subsequent auditors within 180 days from the close of financial year by CAG. No other option. Okay. So this is undoubtedly something that you have to learn. You don't have a choice. Next is rotation of auditors. Rotation of auditors. What is rotation of auditors? And rotation of auditors means one auditor cannot continue for a long tenure. But obvious reasons are there, but this is not mandatory for the small type of companies. Listed and prescribed companies. What are prescribed? If you are unlisted public company with paid up capital more than equal to 10 crores, private company with paid up capital more than equal to 50 crores, or company which has a public borrowing or public deposits more than equal to 50 crores. Okay, so these are the companies which are prescribed, or if you are listed, then you must follow the provisions of rotation. That means you cannot continue with the same auditor for a longer tenure. If you are appointing an individual as the auditor, he can be appointed for maximum one term of 5 years. If firm, 2 terms of 5 years each. After completion, there has to be a cooling period again. And thereafter, cooling period of 5 years, thereafter they can be reappointed. And in that cooling period, you also have to keep something in mind that if there is an audit firm which has a common partner, then that audit firm is also disqualified. Okay. Members internally can resolve that, okay, fine, we will rotate within the firm. That is something which is possible. But again, the condition of firm will remain the same. Right? How the rotation is going to happen? In the same manner. If the tenure of an individual auditor has expired, then audit committee will recommend a name. The name will be recommended to board. Board will propose the name to members. Members will appoint. Okay. If their casual vacancy arises in a government company, it will be filled by CAG within 30 days. If it is not, then by board. If it is a non-government company, then it is important to know the reason of casual vacancy. If the auditor has resigned, there might be some conflict with the management, and therefore he must have resigned. So it is important that you take the approval of members. So casual vacancy will be filled by the board within 30 days, but they has to be approved by the members within 3 months. But if it was for some other reason, maybe the auditor died, if the auditor has died, then the vacancy can be filled by the board within the time period specified, right? So it will be filled by board within 30 days, of course. Okay, so I think that's clear. Okay. Now, here also you can write within 30 days, not to be confused. Disqualifications of auditors, section 141(3), very important. A body corporate cannot be the auditor. Only an individual or LLP can be the auditor. Moreover, officer or employee can be the internal auditor but cannot be the statutory auditor. The partner or employee or of officer or employee of the company, they cannot be. Then comes your next point. Any person who, his relative, his partner, holds security in company, holding, subsidiary, associate, or subsidiary of holding, not eligible to be appointed as the auditor. However, relatives are allowed to hold security up to 1 lakh. Supposedly, relatives are holding security 1 lakh and it exceeds 1 lakh, then you are given a time period of 60 days to take the corrective action. And thereafter, the disqualification will be attracted if the corrective action is not taken even within the tenure of 60 days. Next, if they are indebted in excess of 5 lakhs to company, subsidiary, holding, associate, subsidiary of holding. If you have given guarantee or security of some third person to company, associate, subsidiary, holding, subsidiary of holding. Okay. If you have a business relationship with any of this plus subsidiary of associate also, or if there is a person whose relative is a director or is in employment as a director or KMP, fine. Or if you have been convicted by an offense involving fraud and 10 years have not elapsed, or if you render the service which is prohibited, or if you exceed the ceiling limit of 20 companies which is given for any given auditor. So if any of the above disqualification attracts, vacation also attracts. That means immediately you have to vacate the office of director and it amounts to casual vacancy which is going to be filled by the board or CAG as the case may be. Right? Okay. Now, removal of auditor before the term. Before annual general meeting, that is before annual general meeting, the board wants to remove the auditor, they can do it by passing BR, but they require CG's approval. So application within 30 days is made in the form ADT2 to central government, obtain their approval, and within 60 days, thereafter pass special resolution at general meeting, and the auditor will be removed. He will be given an opportunity of being heard. If the auditor himself wants to resign, then they have to file ADT3 with company, registrar and CAG if it was a government company within 30 days, indicating the reasons why you are resigning. There is also an option that NCLT can also remove an auditor in case of fraud. Okay. And you can also be removed at annual general meeting when a special notice is received specifically stating that we do not want to reappoint the retiring auditor. This special notice has to be received by eligible members. Who are eligible members? The ones who hold at least 1% of total voting power or 5 lakh paid up share capital. Now, they are the eligible members. Whenever AGM is going to take place, obviously you don't know that, so pre-hand you have to send, or if you have received the notice of AGM, you have to ensure that at least 14 days before AGM, you send the special notice in which you are requesting to appoint some other person, or expressly stating that this will not be reappointed. So whenever company receives such special notice, company sends a copy to the retiring auditor who is eligible to make representation to the members that we have. I have done so much for you all and you are now removing me, or whatever they want to, right? And this representation will be circulated. If it cannot be circulated, it will be read out at the meeting. And auditor also has a right to make oral representation. But sometimes auditor tries to defame the company and tries to abuse this right. In such a case, any aggrieved person can apply to the tribunal, and tribunal, if satisfied, then the tribunal will say that, okay, fine, there is no need to make the representation. So the representation will neither be read out nor be circulated. Okay. As I told you, the tribunal also has the power to change the auditor. So if any person is concerned, they can make an application to tribunal. And if tribunal is satisfied that, okay, this auditor is doing some fraudulent manner, we also have NFRA now. NFRA constituted under section 132 of the Act, which is overseeing the quality of professionals, right? Apart from the body that we come from, that is our CA Institute, because only CAs are eligible to do statutory audit. So they also supervise us, and over and above, NFRA also supervises us. And if somebody makes a complaint, then NCLT also can remove us if we are involved in fraud. Okay. And then another auditor will be appointed. What do we do as an auditor? What is our duty? To make report, to make inquiries, to follow all the auditing standards, to exercise reasonable skill and care. And what is our right? Right to have all the books, right to receive notice, right to be informed, right to receive remuneration, right to make inquiries, and right to lien. I can retain the audit report if you don't pay my audit fees. So right of lien also. Then there are certain special types of audit. Audit of government company. CAG shall direct the manner, and the government company's audit will be done. CAG appoints the auditor, that we have read before also. Whoever auditor is appointed has to submit a copy of audit report to CAG. Okay, and within 60 days of the receipt of audit report, they can order supplementary audit or comment upon the audit report to supplement the audit report. That is something which is possible. Branch audit. See, if there is a branch also, the audit of branch can be done separately by some other auditor, which is very well possible. And that auditor will give his report, and the main auditor, the statutory auditor of the company, will compile it. Okay. So such branch auditor can report and give to company's auditor, or the company's auditor can also do that audit. Okay. Now, one important section over here is reporting of fraud. While doing the audit, if auditor comes to know that there has been a fraud in the company, it is the duty of the auditor to report the fraud. If the fraud is of lesser quantum, that is less than 1 crore, then you report it to board and audit committee, and they will disclose it in their board's report and take corrective actions. However, if the fraud is 1 crore or more, then you will immediately inform. Within 2 days, you will inform to board and audit committee and seek their reply. Once you receive their reply, then inform to central government also that this is the report, this is my finding of fraud, and this is the committee or the board's reply. If you don't receive their reply, then also you send the details to central government. So they are bound to reply within 45 days. But supposedly they do not reply, then also you send the details to central government. Section 144, if any person is the statutory auditor of the company, he cannot do internal audit, actuarial service, investment banking, other financial service, design the financial system, investment advisory, no, management service, no, accounting, bookkeeping, although a lot of CAs do that, but it's not permitted. If it is a company, if it's a proprietorship firm, there's no governing law as such. Others as may be prescribed. Now the last section. Section 148, cost audit. Cost audit is not mandatory in all the cases. It is only mandatory for certain types of companies. Which types of companies? The companies maybe which are involved in manufacturing, so they have to maintain cost records. So the companies which are prescribed to maintain cost records also have to hire a cost accountant to do cost audit. They will prepare the report in CRA 3 within 180 days from close of financial year and give it to board, and board shall furnish it to central government with explanation. CG may ask for further information, right? Section 147, we have punishment if you contravene it. Section 146, section 145, all that is auditor's right plus duties, right?
Okay. Revision of the complete chapter of directors, appointment and qualification of directors, containing section number 149 to 172. So we have a lot of sections along with the relevant rules, and we are going to revise the same now. Let's begin. First thing is, what do you mean by directors? See, directors are someone who are appointed to the board of the directors of the company. Directors do not have any power individually. They have collectively power, right? They have collective power, which is, you can say, the board of directors or the directors or the board. These all three terms are synonymously used, and they have the power. Why do we need directors? Because company is an artificial person and company cannot run on its own, so we need someone to direct the company. All the company directions cannot actions, directions, they cannot be done by the shareholders who are the investors of the company. Simple reason being because they are in huge number and everyone cannot be interfering in the management of the company. That's why we need directors to manage the company. So Companies Act has divided the whole powers of company into two authorities. One is the board of directors and other is shareholders. So at times we need permission from shareholders, and the day-to-day management is being handled by the board of directors. Section 149 mandates that every company must have board of directors. Section 149 tells us that minimum number of directors and maximum number of directors, what are they? Minimum number of directors you need 1, 2 and 3. 1, 2 and 3. 1 for OPC, 2 for private and 3 for public. And maximum number of directors for all types of companies is 15. This 15 can be increased. That means a company may have even 20 directors provided it passes a special resolution in this regard. So by passing SR, the maximum number of directors can be increased by any company, right? This particular requirement does not apply to Section 8 company as well as government company, not applicable to government and Section 8 company, right? That means if a Section 8 company wants to have 20 directors, it can have without even passing special resolution, So minimum 1, 2 and 3, maximum 15, which can be increased. Now, that was the first proviso. This was the first proviso. It can be increased by passing SR. Second proviso to Section 149(1). So we are talking about one subsection and its second proviso, which is very important. That's why you must learn this. Second proviso to Section 149(1). Now, what does it mean and what does it talk about? It talks about woman director. Every company needs a woman director, ma'am? No. If it is a private company, there are 2 directors just, out of which one should be woman. This will be harsh on the directors, harsh on the companies. So this is not the requirement which has been imposed by the Act. What has been imposed is that certain set of companies need at least one woman director. You are such a huge company, you have so many board of directors, out of which at least one director can be a woman director. So this is the mandatory requirement which is imposed on listed company, and listed company means listed public company only pursuant to the definition, pursuant to amendment in Section 2 clause 52 definition of listed company, which I'm not discussing here again right now. And if it is other type of public company, then it has to satisfy either of the 2 criteria. Paid up capital more than or equal to 100 crores or turnover more than or equal to 300 crores. Fine. So if it's a listed company, one woman director must. If it is an unlisted public company, if you come under these 2 categories, any of these 2 categories, then you must have one woman director. Fine, ma'am. Now, if it is a new company, newly incorporated company, and it's paid up capital, the turnover will not be, you will not be able to get to know turnover within 6 months of incorporation undoubtedly. But yes, the paid up capital and the listed criteria, it may meet. So the whole intention is that the company pre-hand knows that I have this requirement of woman director, and so it has to appoint woman director within 6 months of incorporation. Otherwise, we don't have any specific clarification or law given as to if the threshold increases by when woman director should be appointed, right? All the directors are being appointed in general meeting, and so this woman director will also be appointed. If we look at the financials, and if we find the financials, yes, it is crossing the threshold, thereafter this will be appointed. But what if it is a listed company and a woman director was appointed for a tenure of 5 years, but before that only the woman director died? This gives rise to intermittent vacancy, because if it is not filled, it has to be filled. Because if the woman director has died, there is no woman director and it is non-compliance of law. So it must be filled. Who has the power to fill it? The board has been conferred the power to fill it. By when? Immediate next board meeting or 3 months, whichever is later. So intermittent vacancy has to be filled within this particular time limit. Okay? Within this particular time limit. Now, Section 149(3) resident director. This is for all types of companies. Even if you are a private company, you are a public company, or a one-person company, you need at least a resident director. Who is a resident director? Someone who stays in India. For how long? For more than or equal to 182 days in previous financial year. More than or equal to, that means if a person stays for even 182 days, he will be called as a resident. He will be called as a resident. So a director who is also a resident of India is known as resident director, and every company must have at least one resident director. Fine. Every company must have at least one resident director. Now, basically, if you try to recall, there are two types of directors. One are executive directors and one are non-executive directors. Executive directors who are in the whole time employment of the company, non-executive directors who are not in the employment of the company, that is independent director or part-time director. And executive directors, we have example managing director, whole-time director, right? Ma'am, women director have to be appointed as executive or non-executive. It can be appointed either ways. It's not a requirement that they have to be appointed as executive only. No, even if an independent director on the board of a company is a woman, it is sufficient compliance for second proviso of section 149(1). Okay. Likewise, ma'am, the resident director, has it to be executive only? No. Again, no such requirement has been given. So it can be executive, it can be non-executive, that does not matter. But every company must have at least one resident director. Okay, I hope that is clear. Fine, ma'am. So we know the requirement of directors. Now, how do we appoint directors? See, section 149 is not over yet. It has a huge part of independent director, which we will do a little later. Why? Because I teach you in that manner only in the regular class as well, right? So we will revise it also in the same manner. Now we are talking about the appointment of directors. How the directors are going to be appointed. See, the directors are to be appointed by members, by shareholders in general meeting. That is what section 152 tells us, right? However, in certain cases it can be appointed by the board of directors also, it can be appointed by NCLT also, and it can be appointed otherwise also. So we will discuss how can we appoint the directors. Section 152 gives us three things. How first directors are going to be appointed, the requirements of being a director, and the rotation of directors. So it has three concepts involved in it. Fine, ma'am. Who can become a director? An individual. A company cannot become a director. An individual who is holding in, who is not disqualified, who has given his consent, right? And who has furnished MBP1, right? So such a person can be appointed as the director of the company. Fine. Supposedly I fulfill all this criteria. What are the methods? How can I be appointed as a director in the company? The appointment of first directors is given in section 152. The appointment of subsequent directors is given in section 160. And the appointment of retiring directors is given in again section 152. So that's how the appointment is spread over different sections. Okay, ma'am. So every director who has to be appointed to the board of the company must have DIN. What is DIN? It is an identification number which defines who you are, right? So anyone who wants to become a director in a company must have DIN, director's identification number. Without DIN, you cannot be appointed as a director in the company. So you must have DIN. How do you get it? There are two sources of obtaining DIN, DIR 3 and SPICE Plus. We'll read about this later. Okay, fine, ma'am. So you obtain DIN, you give this DIN, and you give a declaration that you're not disqualified, DIR 8. You give your consent, DIR 12, to the company. The company in turns file form DIR 12 for your appointment within 30 days of appointment, right? Section 170 mandates the requirement of filing return, DIR 12, for appointment and wherever there is change in the appointment or change in the directorship or KMP. Okay, fine, ma'am. So anyone who is an individual, anyone who has DIN, anyone who is not disqualified, anyone who gives the consent, can be appointed as the director in general meeting by the shareholders unless otherwise provided in the act. So something else can also be provided in the act. In that case, that will apply, but otherwise this is going to be the appointment. However, for the first directors, we cannot wait till general meeting because we are in a hurry. We need directors immediately when the incorporation happens, right? Because we cannot, for one day also, who will manage the company? To call general meeting, who will call the general meeting? So we need directors as and when the incorporation takes place, and that's why the first directors of the company, the appointment cannot be deferred. We need immediate appointment of the same. So what is given? According to section number 152, the names should be mentioned in the articles of association. So the articles of association are going to clearly specify that these will be the first directors of the company. Supposedly the articles of association don't specify. They will specify the manner. How will they be appointed? Supposedly they don't even specify that. So we will check whether table F can be applied or not. If we have specifically striked out table F that it shall not apply, then it shall not apply. Otherwise, it will be applicable if our articles are silent. What is table F? Table F is the model articles of association for a company limited by shares. So if our articles give the name Mr. X and Y will be the first directors, they will be. If it has given the manner, they will be elected in such a manner, elect in that manner. If first 2 points are not applicable, table F will apply. What does table F tell us? Table F tell us that it will be decided by the subscribers. It will be decided by the subscribers, whoever has subscribed to the memorandum. Supposedly, no name is given in articles. We don't say provide the manner, and we say that the table F shall not apply. In that case, the individual subscribers become the first directors of the company. See, the subscribers may be individual, they may not be individual. A company can become the member of another company, right? So maybe on the memorandum of association of that company, a company has signed, right? A company's common seal is affixed or their representatives have signed. Quite possible. A company cannot become the director for another company. Only individuals can become the director, because again, company will be an artificial person. So all the individual subscribers become the first directors of the company. Okay, fine, ma'am. First directors are going to hold office till the ensuing general meeting, and after that they can be reappointed or they may leave. If they want to be appointed again, they have to give their candidature, because for appointment in general meeting, how appointment at general meeting is going to happen? When you give your candidature under section 160, your name is proposed, and general meeting, the shareholders pass OR and appoint you as a director. So now that is going to happen. Fine, ma'am. And after that, you can be appointed as rotational director or non-rotational director in case you are a director of a public company. If you are a director of a private company, you can be permanent directors also. That's not a problem. But if we are talking about the directorship of public companies, then you can be appointed either as rotational director or as non-rotational director. Fine, ma'am. Now, before I move to this particular part, DIR 2, that is the consent part, it is not required in case of not-for-profit organizations, that is not-for-profit companies, as well as for government companies. So they have this exemption from filing DIR 2. Okay. Now, if we are talking about a public company, from the total number of directors, minus your independent directors. Supposedly, a company has total 14 directors and 5 are independent directors, 9 are left. Out of this 9, 2/3 of 9, that is equal to 6, will be rotational directors. And out of this 6, 1/3, that is equal to 2, will be retiring. Will retire at every annual general meeting. Right? So, whatever is your total number of directors in a public company, it's 2/3 have to be, at least it's 2/3 have to be rotational director, whose office is going to be determined by rotation, right? Out of this 2/3, 1/3 is going to retire at every annual general meeting, right? So here in this case, as an example, 2 directors will retire at every annual general meeting. How they will retire? The person who has been in the office for the longest will retire first. Supposedly 2 people have been appointed on the same date, they will mutually decide who is going to retire in this general meeting. If they cannot decide, then some lots will be drawn. then some lots will be drawn and they will decide. Okay, they will decide. Fine. Supposedly, they have to retire at general meeting. They have to retire at general meeting. That means they will go. They can come back also, but the chances are they will go also. Right, so they can go, they can come back. Supposedly the directors did not call general meeting. Can they continue? They cannot. If the AGM is not held, they will have to vacate the office on the last day AGM ought to have been held. If AGM is held, then the two directors, that is 1/3 of the rotational directors, will retire. They can be reappointed, or in their place someone else can be appointed, or the company may resolve that they don't want to fill the vacancy. Either of the three will happen. Either of the three will happen. Supposedly none of the resolution is passed, then the AGM will be adjourned. It will not be conclusion of AGM, AGM will be adjourned. When AGM is adjourned and the vacancy is not even filled at the adjourned AGM, it amounts to automatic reappointment of the retiring director. That means he will be automatically reappointed. But there are certain cases of exception where he will not be treated as reappointed. Supposedly Mr. X is retiring and Mr. X has clearly said that I don't want to be reappointed. So he has expressed his unwillingness in writing that he doesn't want to be reappointed. We cannot reappoint him. We cannot reappoint him. Supposedly he is disqualified. He has become of unsound mind. How can we appoint him? Specifically in the act is written that we need OR or SR for his appointment. We cannot appoint him. There is contravention of section 162. When Mr. X was appointed, his appointment was only void. That means he was appointed through a single resolution, wherein appointment was needed by a separate resolution. Two appointments were made by a single resolution. So it amounted to contravention of section 162. Now since your appointment itself was void, you cannot be reappointed. And we tried for your reappointment. So we proposed a resolution in front of the members to reappoint you, but this resolution was lost. That means our members do not want you to be reappointed. So no automatic reappointment will apply to you. Okay, fine ma'am. Now there is one more point over here. What does it tell us? See, some public companies may say that no, we want a transparent vision in our company and we want all our directors to retire at every AGM. So all the directors retire, someone who's good comes back and then others leave the company. Companies Act tells if you have such strict provisions, way more stricter than what law says, great, follow them. So if your articles say that all the directors are going to retire at annual general meeting, so be it, right? But if they don't say it, then this is something that you are going to follow. This is something that you are going to follow, right? So section 152(6) tells us about rotation, and section 152(7) tells us how the vacancy will be filled pursuant to this retirement of rotational directors. Ma'am, what if they don't follow? If they don't follow these provisions, we have a section 159, which gives us the penalty, Section 159 tells us that if you contravene section 152, this penalty will be attracted. So the penalty is not given in section 152, rather it's given in section 159. The rotation part does not apply to unlisted government company or its subsidiary. Fine. Okay ma'am. Section 160. Section 160, what is it? It is a section for new candidates. That means, see, who will be the first directors? They will either be the subscribers or they will be someone who is known to the board. Supposedly, I am incorporating a company and I know an efficient person. I will take his consent and I'll write his name as the first director. So I know that person knows me. That's why he could be the director. But section 160 gives a chance to anyone. If you want to be the director, you can propose your candidature. So anyone can propose candidature. Just to screen out or just to have those serious applications, there is a deposit, a refundable deposit of 1 lakh. It's not refundable in all cases, but it's refundable in these two cases. So what you have to do is, if I am a member and I want to become a director of my company, or if I am not a member, or if I know someone, I can propose his candidature also. So we propose someone's candidature. How do we propose candidature? We give it to the company. We say that we want this particular person to be appointed as a director in the upcoming general meeting. What you have to do is you have to give a 14 days notice to the company. That means whenever company is going to hold its general meeting, 14 days prior to that, you must give that notice plus 1 lakh rupee deposit. Now this deposit will be refunded if the person is elected as a director or. Even if he is not elected but his votes are 25%, more than 25% of the total votes which have been cast, it shows that he was a serious and eligible candidate. So in this case also the refund is made. Fine. So you serve this notice to the registered office of the company. What does company do? Company sends this notice of candidature at least 7 days before general meeting to all the members. It can be done by sending individual notices or a public advertisement in 2 newspapers, English and vernacular. And it also has to be placed at the website of the company. Fine. So all the members receive this notice that someone has been proposed to be a director. At the annual general meeting, simply by passing ordinary resolution, they can appoint the director, or if the resolution is not passed, the person will not be appointed. The section does not apply to a private company, because in private company not everyone gets the power that they can nominate themselves. No. It does not even apply to a 100% government company, wholly owned subsidiary of such 100% government company, and section 8 company where election is happening by ballot system. Right? Okay, fine, ma'am. In certain cases, you don't need deposit. Why? Or in what cases? In case of independent director. If independent director is proposing his own candidature, independent directors are someone who are anyway highly knowledgeable, highly professional, highly qualified people. You cannot doubt and you cannot say this is not a serious application. Of course, it's damn serious. So they don't need deposits. Moreover, if a person is recommended by board or NRC, probably they are the people who have much knowledge, and if they are recommending someone, he is a deserving candidate only, right? So in this case, you don't need a 1 lakh deposit. No, supposedly someone who has retired, a person was appointed as a rotational director in a public company and he retires according to section 152(6). Now he wants to be reappointed. The question is, do we need to send the notice and 1 lakh deposit under section 160 for his appointment? Answer is no. Section 160 does not apply for the case of reappointment of retiring director. It clearly says that a person who is not a retiring director in terms of section 152 shall also be eligible to be appointed as the director if he gives a notice plus 1 lakh deposit to the company at the registered office, etc., etc. So that's how the process begins. Fine? Okay, ma'am. Now, we know that individuals who are holding DIN and who are not disqualified can be appointed as the director. So the next question comes out is, what is DIN? DIN, Director's Identification Number. How do you obtain DIN? How do you get DIN? DIN can be obtained in 2 ways. See, the provisions of DIN are covered in section 153 to section 159. 159 is that last penalty part. Any individual who wants to be appointed as a director, you cannot be appointed unless you have DIN. How do you obtain DIN? You can file an application in DIR 3 with these attachments. There is also an option that Spice Plus. Supposedly, I am forming a new company and I have never been a director of any company. So what choice I have is in Spice Plus only I can fill my details and it is going to work as an integrated form and will also provide me DIN apart from incorporation of the company. Right, so this is also a method of obtaining DIN. Otherwise, the general form and the regular form that we have for DIN is DIR 3. Now, just like you can obtain PAN as and when you need, you cannot obtain DIN as and when you need. For DIN, what is required is that you must be a director of some company. Ma'am, how can we become the director without DIN? You must be proposed to be a director of some company and only then you can obtain for DIN. That means government needs to know that where do you want to be appointed as a director. and then only they will give you DIN. Why? Because in attachments there is a need for board resolution. So the company which is proposing you to be appointed as a director will give a resolution, and then only you can submit this application. Once your application is submitted, central government examines your application. Central government examines your application. Just a second. Central government, if they find that your application is not defective, then what are they going to do? They are going to allot you the DIN. But if they find that yes, your application is defective, then they are going to intimate you via mail or via website, and you have to rectify the defect within 15 days. So you get a chance to rectify the defect within 15 days. Supposedly the defect is rectified, then again you can be allotted DIN, and if you do not rectify the DIN, then it has to be rejected. Right, so the application will be rejected. Now whatever DIN you have obtained is going to stay with you for your life. No matter in which company you become a director. You become a director in XYZ, PQR, X Limited, Y Limited, doesn't matter. One DIN for all the companies and one DIN for your life. It's not going to change. It's never going to change. Fine. Okay, ma'am. Only one DIN is allowed for every individual. Just like you cannot have a duplicate PAN, you cannot have a duplicate Aadhaar, likewise you also cannot have a duplicate DIN. Okay, so first thing, you make an application for DIN in DIR 3. Second thing, central government allots you the DIN when they find the application is in order. Third thing, you're prohibited to obtain more than one DIN. Okay, whatever DIN you obtain, supposedly if now you want to become the director of any company, you cannot become without DIN. But for the directors who were already directors, before these rules came into picture, before this concept of DIN came, they were already directors. Now they are also being given a time limit that they have 1 month from the receipt of DIN. They have to inform central government. Okay, they have to inform the companies, and the company in turn will inform the ROC. So existing director has to intimate DIN to the company and the company to ROC. That is section 156 and 157. Okay. Fine, this is clear. Now, any director, if you have DIN, wherever you are quoting that you are the director of ABC Limited or whatever like that, you must state your DIN. Your name is not sufficient. To identify you, we need that DIN. Just like we quote membership number wherever we are doing that, right? CS membership number, CMA membership number, CA membership number, we quote that, right? That is important. So likewise, directors also have to quote their DIN. Okay? Fine, ma'am. Now tell me, ma'am, something that can we surrender our DIN once we have obtained the DIN? Can we surrender the DIN? The answer is no. You cannot surrender the DIN just like that. Supposedly, I have worked as a director in a company, I have done enough fraud, and now I simply surrender my DIN and I go away, and now I take another DIN and I become the director of some other company. So whatever frauds I'm doing, I'm never traceable. Can I do that? The answer is no. The answer is no. But supposedly I have unused DIN. Unused DIN. That means, ma'am, how can that be the case? I was being proposed to be appointed as a director in some company, and that's why I made an application in DIR 3 to obtain DIN. I obtained DIN, but in this company OR was not passed for my appointment, and so I could not be appointed. And thereafter I have not been appointed in any company as a director, but I have DIN. I know that I'm not going to use this DIN, so I want to surrender this DIN. Can I? Yes, you can. If you have unused DIN, you can surrender that DIN to the government, and the government is going to deactivate your DIN, right? Otherwise we don't get this power. Then what happens, ma'am? RD or central government can cancel or deactivate our DIN. When? If we have duplicate DIN. If our DIN is being obtained in some wrongful manner, that means we have given some misinformation and we have got DIN, or we have got DIN with the intention to deceive someone. In both cases, our DIN can be cancelled. If we die, if we turn out to be of unsound mind, if we turn out to be insolvent, if we surrender our DIN, or if we fail to do KYC. If we fail to do KYC, that can also lead to deactivation of DIN. What is KYC? What is KYC? We have a rule 12A. Earlier you had to read a lot about KYC, not now. What is KYC? Know your customer, right? So know your director. Basically, it is an annual e-verification. Whenever you become a director of some company, every individual who holds it, no matter you are a director or you're not a director, you are holding it, you have to file this form DIR3 KYC. And every financial year there has to be a simple verification DIR3 KYC web through that, right? So all your records are available. It is an online facility. You just approve the same. Why? Because the government records cannot be updated. We're talking about directors. We're talking about the corporate world. The records cannot be old, right? So they have to be updated from time to time, and the responsibility is being conferred on the person holding it. If you have done, it's your duty to do that. If you don't go for annual e-verification, your DIN will be deactivated. Fine. Okay, ma'am. We also have another rule, Rule 12, which talks about the changes in DIN. So whenever there is any change, not in DIN exactly, in our details, maybe my address has changed. So it is my duty that I intimate the company within 15 days. Moreover, I file DIR 6. I attach the proof of change. It is verified, that is the DSC of CA, CS, CMA is attached. I submit the form for verification. Central government incorporates all the changes and informs ROC also. Ma'am, why this is happening? Why don't we directly file the form to ROC? See, you are doing an online filing only. So you are filing this DIR 6 also on MCA website, but it goes to the central government and not to the ROC. Why? Supposedly, I am a director in a company of Kolkata, Mumbai, Delhi, Karnataka. So I am a director of 4 companies in 4 different states. To which ROC it will go? So the DIN cell intimates it to the concerned ROCs. Fine, ma'am. Number of directorships. What do you mean by this? Supposedly, I am an eligible person. I have DIN. And I want to become a director in 50 companies. Can I? Why not? 50 companies. If you have that caliber, why not? Well, this is not like eating a donut eating competition or a puchka eating competition or something like that. It is becoming a director in companies, which requires time, effort, energy, efficiency, everything. And the government itself has given a very generous limit of 20, out of which 10 can be public companies. So if you are a director in 20 companies, you should know that you are highly efficient, like Rajnikant or something, right? You cannot be holding 20 directorships in active companies just like that, right? So we have a limit. What is the limit? Maximum number of directorships in all companies, 20. So I can be a director in maximum 20 companies. But this does not include section 8 or dormant company, but includes alternate directorship, out of which maximum 10 public company directorships I can hold, right? So if I am a director in 20 companies and I have 9 public companies and 11 private companies, this is something which is allowed. But 11 public companies and 9 private companies, it is something which is not allowed. Now, when I am computing which is the public company directorship, I have to make sure that I include this also. What is it, ma'am? Private company, which is either a holding to some public company or it is a subsidiary to some public company. This is going to be treated as public company. This is going to be treated as public company for the purpose of, for the section 165, for computing this limit. Okay. Now, supposedly before commencement, there was a person who was a director in 50 companies and there was nothing rule like this. There was no provision like this. When this provision came into picture, he has been given a time period of 1 year that you choose in which companies you want to stay as a director. And the rest of the companies you have to leave. So you resign in the rest of the companies and you intimate your choices to ROC. Okay, fine, ma'am. But after commencement of act, this is going to be the maximum number of directorships. Now some companies, they do it that if you want to be the director of my company, you cannot hold more than 10 directorships. Ma'am, can the companies do so? Yes. By passing SR, you can have strict provisions in this regard. So you can reduce the maximum number of directorships. You cannot increase it. You can reduce the maximum number of directorships. Fine. So that was section number 165. Section 164. This talks about the disqualification. See, this section is divided into three parts. Part number 1, that is section 164(1), which talks about 9 grounds of disqualification. If any of the ground of disqualification is attracted to the person, he is disqualified to be appointed in any company as a director. Okay, ma'am. And supposedly, after his appointment, some ground of disqualification is attracted to him, then he has to vacate office according to section 167 of the Act. So we have two different sections. One is for disqualification and other is for vacation, but they go hand in hand undoubtedly. Okay, fine, ma'am. Section 164(2) also talks about 2 grounds of disqualification, but these disqualifications are attracted to the individual because the company in which they are holding directorship has done some default. These disqualifications are attracted to an individual. These disqualifications are attracted to a director. If you are not a director of any company, there is no point of this particular subsection. And section 164(3) talks about additional grounds of disqualification. That is, a private company has been given the power that you can provide additional grounds of disqualification also. Okay, ma'am. Let's read them one by one. First of all, the 9 grounds of disqualification that have been given in section number 164(1). First is unsound mind. It doesn't matter whether I consider myself of unsound mind or not. It is that I have to be declared by the court. Undischarged insolvent. The court has declared you as insolvent, but you have not been discharged yet. So in that period, you are undischarged insolvent. Third, if you have applied for insolvency, but you have not been declared by the court as insolvent or not solvent, whatever. That means your application is not disposed of yet. You have applied. So during that tenure also, disqualification is attracted to you. Next, if you have been convicted by court, that means you have been found guilty by the court. See, you have done some offense. The offense is moral turpitude or otherwise. You have been found guilty by the court. The court has given you a sentence of imprisonment. The imprisonment is 6 months or more. Imprisonment is 6 months or more. Then you are disqualified for 5 years. Okay. See, if your imprisonment is less than 6 months, you are not disqualified even for a single day. If your imprisonment is 6 months or more, you are disqualified for 5 years. But supposedly the imprisonment is 7 years or more. 7 years or more. Then you are disqualified for life. You can never be appointed as a director in any company. Any company, any time in the future, you cannot be appointed. Fine. Whatever disqualification we are checking is, of course, at the time of appointment of director. So whenever you want to appoint, you check whether the person is of unsound mind, discharged, insolvent, is his application pending, has this disqualification attracted to him. For 5 years, he will be disqualified. 5 years from the date of, not court's order, but from the date of expiry of his sentence. So when he has completed his tenure of imprisonment of 1 year, 6 months, 2 years, whatever it is, after that 5 years, he has been disqualified. After that 5 years, he will be disqualified. Next, court's order. If the court has given you an order that you are disqualified, you are disqualified, simple. Unpaid call till 6 months. Now this is for shareholders. See, a director may be a shareholder, he may not be a shareholder. It's not imperative that he has to be a shareholder only. If he is a shareholder, or if a shareholder wants to become a director, then he has to check this disqualification also. I am a shareholder of the company. The share price of the price of one share is equal to rupee 10. out of which 6 I have paid to the company, 4 is unpaid. The company calls for this rupee 4 and I fail to repay it. I fail to pay it. Now imagine appointing someone like me as a director who cannot pay her own call money. You think I have the capability to collect other people's call money, to be responsible for the compliances? No, this shows my responsibility, how irresponsible I am, right? But this irresponsibility cannot be checked at the immediate moment, right? So we have been given a time period of 6 months. 6 months. Right. So during the 6 months, if I pay, the disqualification is not attracted to me. The disqualification gets attracted to me when the tenure of, or when the period of 6 months has elapsed from the last day fixed for payment. Okay, then I am disqualified, and this particular disqualification attracts only for company in which call money has not been paid. In which call money has not been paid, and not in other companies. So in other companies I am qualified to become a director. Only in this company I cannot become a director. Now supposedly you are already a director. So I vacate the directorship according to section 167 and I cannot be reappointed. Reappointed till when? Till I pay this call. Offence under section 188. Related party transactions offence. So if I have been found guilty for this offence, I cannot be appointed. Till when? Preceding 5 years. So we check for preceding 5 years. If preceding 5 years this offence is existing, I cannot be appointed. If in preceding 5 years this offence is not existing, I can be appointed. He has not been allotted then. Without then you cannot be a director. And if your directorship limit is exceeding 20, you cannot be a director undoubtedly. So on all these 9 grounds, you are disqualified. You cannot be appointed as a director. You cannot be appointed as a director. Fine, ma'am. Then we come to section 164(2). From examination point of view, this is very important, but although it's very small one. Supposedly, I'm a director in some company, and that company fails to file its financial statements or annual return for a continuous period of 3 years. Or it does not pay its deposits, debentures or dividend. They remain unpaid for 1 year or more. Either of the two situation gets attracted, the company becomes a defaulting company. And if I am the director of the defaulting company, I become disqualified. That means if I want to be appointed in some other company, I cannot be appointed. I cannot be appointed. And ma'am, you have to vacate office also from this company? No. This is the catch over here. Not from this company. Not from this company. See, vacation has 8 grounds. If a director is disqualified under any of the ground of section 164(1), he vacates the office. If you are disqualified under section 164(2), then also you vacate the office, but not from the defaulting company. That means if a person is a director in 4 companies, A Limited, B Limited, C Limited, D Limited, and A Limited has not filed its financial statements, the directors of A Limited are disqualified. They cannot be appointed in any other company. And whoever is the director of A Limited is also a director of B, C, D, you have to vacate office, but in A Limited you will continue the office, right? Because you are responsible for all this. Okay, fine, ma'am. Now, supposedly there is a new director who joins, and before he could actually analyze what's happening in the company, this default gets attracted. And when the default gets attracted, all the directors of the defaulting company, they become disqualified. So Mr. X cannot be appointed in any other company. Oh, very unfair, right? So this disqualification does not apply for 6 months from the date of appointment. So a new director gets the benefit, he gets the time to, he can rectify the defaults, whatever is going on in the company. So he gets a benefit of 6 months. Okay, fine, clear? For this, you also have to give a declaration, the IR 8, that I have told you a number of times. Now, vacation. Grounds of vacation, section 167. First 2 grounds I've already told you. Third is, if the director is absent in all board meetings during 12 months, see, not in the financial year, not in the calendar year, we check for any 12 months, any 12 consecutive months. So, the director skips the first board meeting, from there we check for a tenure of 12 months. if he does not attend any board meeting, doesn't matter how many board meetings are held during that particular time, if he does not attend any board meeting, he has to vacate the office. He vacates the office, can he come back? Why not? Because this is not a ground of disqualification. So when we want to reappoint him, when we want to appoint him again, we check the grounds of disqualification. We don't check the grounds of vacation. So again, he can start. These two grounds both relate to one section. Section 184. What is Section 184? It talks about interested contracts. A director may be interested in some contract. If he is interested, he must disclose it pre-hand to the board of the directors. So he has to disclose it. Moreover, if he is interested, he will stay away from that particular contract. He will not participate in that board meeting. He will not vote, etc., etc. So there are two requirements on part of the director that he has to do. So if you fail to disclose your interest, or if you participate in that meeting of interested contract, both are an offence under Section 184. And if you contravene these two, you have to vacate office of director. You have to vacate office of director. Okay, ma'am. Next is if you are disqualified by court. If you are disqualified by court, it is included in this. So you vacate office. If you have done an offence, imprisonment 6 months or more, disqualified, included in this, vacate office. Why given separately? Because in such situation, the vacation of office is postponed till disposal of appeal. See, whenever anyone passes a court order against us, we get a time period. What time period? We get certain time period to file an appeal. This is our right. So if court has said that you have done an offence and you are being sentenced to imprisonment for 1 year, this is my fundamental right, I can appeal. And when I appeal, will this disqualification be attracted to me? Do I need to vacate office? What is going to happen? So I have made a beautiful chart for that. Let's discuss this. Order of court. So we have a court order and the court order finds us guilty. I have two choices. I can either file an appeal or I don't file an appeal. If I don't file an appeal, I get a chance to file an appeal within 30 days. If I don't file an appeal, on the 31st day, I vacate. If I file the appeal within 30 days, then I will not vacate office till this appeal is disposed of. See, if the court has declared me as guilty, I am disqualified, I cannot be appointed in any other company, but the directorship that I am holding is going to be delayed if I file the appeal. So I don't have to vacate immediately. I will vacate when the appeal gives its order. Okay, so next court order I receive, I'm not guilty, I don't vacate. And if I am guilty, I again get a chance to file an appeal within 7 days. If I file the appeal within 7 days, if I don't file the appeal within 7 days, I vacate on the expiry of 7th day. But if I file the appeal, again I will not vacate the office till this appeal is disposed of. And after this, I don't have a chance for further appeal. So if I'm guilty, I have to vacate. If I'm not guilty, I'll not vacate. Okay. So that's why these 2 points are given separately. Then, if I'm removed in pursuance of the provisions of the Act, Section 169 gives the power to shareholders that they can, by passing ordinary resolution, remove the director. So if a director is going to be removed, he has to vacate the office undoubtedly. And moreover, if he is appointed by virtue of holding office, if he is the CEO of a subsidiary company and he has been appointed as MD because he is the CEO, if he ceases to be CEO, he will cease to be MD also. Simple. There can be a situation that all the directors have vacated the office. Now, the company again cannot run on its own. So, we need the directors. Where will we go? We will go to the promoters. The promoters will appoint the directors. In their absence, we will go to the central government and central government will appoint the directors. They will hold office till the general meeting, and in general meeting, we will the regular directors can be appointed, or these directors can only be regularized. Right? Just like a private company has the power to provide additional grounds of disqualification, it also has the power to provide additional grounds of vacation also. Okay, fine, ma'am. Now, section 161. A very important section, even from examination point of view. It is divided into 4 parts and you have to remember all 4 subsections. Section 161.1, additional directors. 161.2, alternate directors. 161.3, nominee directors. And 161.4, casual vacancy. 161.1, additional directors. Who are additional directors? Anyone. See, if you appoint first directors, if you appoint the directors in general meeting, if you appoint additional, alternate, casual vacancy, whatever type of director you appoint, if you appoint nominee director, if it is appointed by NCLT, whatever it be, one thing is must, or the basic requirements are must. Such person must have DIN, such person must give consent, such person must not be disqualified, and these are basic requirements. Okay. So even when you are appointing someone as additional director, you have to ensure these things. General rule given in section 152 is that the directors will be appointed by the shareholders in general meeting. This is an exception to that. So section 161 here, the appointment is not happening by the shareholders in general meeting. It's happening by the board of directors. Right? So the board of directors are appointing here. For additional director, the board of directors can appoint by passing BR, provided they have an authorization in AOA. If AOA is silent, table F can also authorize. Okay, ma'am. So, if the board has authorization, they can appoint someone as additional director by passing board resolution. Now, this additional director is going to hold office till AGM only. Supposedly, AGM is not held, last date on which AGM should have been held. Okay. Supposedly, Mr. X, he was proposed in the general meeting and he could not be appointed because his resolution was lost. Now he approached the board of directors and they appointed him as additional director. This is something which is not allowed. Someone who has been rejected by the members cannot be appointed by the board. So a person other than someone who failed to be appointed at general meeting can be appointed as additional director. Alternate director. Alternate director. If a director goes out of India for 3 months or more, right? The board has the power. From where do they get the power? They get the power from either articles of association or through ordinary resolution in general meeting. So if they have this power, they can fill the vacancy of that director by appointing someone else. How? Simply by passing ordinary resolution. Now, he is a replacement. Although you have to understand that alternate director is not a proxy of the original director, he is not the agent of the original director, he is having a separate terms of employment with the company. But it is just that he is appointed to fill that vacancy. So if the original director returns, he vacates. If the term of original director expires, he vacates. So he cannot hold office beyond that particular period. Moreover, a person who is going to be appointed as an alternate director has to be someone who is not already a director of the company. And one person cannot hold alternate directorship for more than 1%. Right? Alternate director is not an agent of the original director. It has its own duties and own liabilities. Okay, ma'am. Section 161.3, nominee director. See, okay, before that, one more point for alternate director. Supposedly, alternate director is a retiring director. He is a rotational director and he has to retire at annual general meeting. So he retires. At annual general meeting, there was no ordinary resolution which was passed for his reappointment or appointing someone else or resolving not to fill the vacancy. So AGM was adjourned. At adjourned AGM also, none such resolution was passed. So it leads to automatic reappointment of retiring director. Now this retiring director is out of India and we have in its place an alternate director. So who will be reappointed? Alternate director or original director out of India? Original director out of India. So the reappointment is not automatic. Reappointment does not happen for alternate director. It happens for original director. Okay, ma'am. Now, nominee director. Nominee director. For alternate directors, you have to remember all those basic points, that it does not matter whether the original director is going to out of India for whatever purpose. So the purpose is not important. When he comes back, he has to vacate, right? So all these minute points also we have to remember. And now fine, nominee director. Nominee director, section 161(3). See, the board, if he gets the board gets a nomination, that means supposedly the company has taken loan from a financial institution and they have an agreement that we are going to give you loan only if you allow one person who we are going to nominate to be a part of your board of directors. So financial institution is nominating a person and the board has to appoint that person as a nominee director on their board. Likewise, it can be nominated by central government if they have a shareholding, of course, in a government company. So that is the situation, and it can also be in pursuance of some law. So if the law states or mandates, that is also going to be nominated. So whenever financial institution or other institution or government, they nominate a person by virtue of their shareholding, by virtue of law or by virtue of an agreement, the board, by passing board resolution, appoints such person as a nominee director, subject to articles. Clear? Fine, ma'am. Then we have casual vacancy. Casual vacancy is not like intermittent vacancy. The director who has been appointed by the shareholders in general meeting, it is for the director appointed in general meeting and not for the director appointed by board or any other manner. It is for the director appointed in general meeting only. Supposedly his office ends otherwise than in normal course. He was appointed for a tenure of 5 years, but before 5 years only, after the expiry of 2 years, he dies. This is a casual vacancy. This is not intermittent vacancy. Why? Because in intermittent vacancy, it is imperative. It must be filled. Otherwise, it will lead to non-compliance of law. Here, a director has died. It is not non-compliance of law, right? So it may be filled by the board. It may not be filled by the board. Okay. So this is known as casual vacancy. If board has power through articles, it can fill this vacancy. How? By passing a resolution at board meeting. Now, it is a casual vacancy. For 2 years he worked and for remaining 3 years he could not work. So his vacancy is for 3 years only. This is casual vacancy. So whoever fills this position is going to hold office only up to the date which director in whose place he is appointed would have held had he not vacated. That means this particular date. So anyone who is filling the vacancy, casual vacancy, is not going to hold office beyond this tenure, beyond this date. Beyond this date, he cannot hold office. He cannot hold office beyond this particular date. Is that okay? Is that fine? Okay. Now, there is one more requirement in case of casual vacancy, because he is going to hold office for a very long tenure. Say for 3 years, 4 years, 5 years, it could be anything, right? For the remaining tenure, it also needs approval from members. So, although board has the power to appoint anyone wherever casual vacancy arises just by passing board resolution, they have to seek subsequent approval from the members also by passing OR in whichever next general meeting comes. Okay? Clear? Fine, ma'am. Now, section 162. Appointment of directors to be voted individually. This section applies not to a private company. It does not apply to a private company. What does this section tells us? It tells us that appointment of a director, 2 or more directors, appointment of 2 directors or more directors cannot happen by a single resolution. I cannot say that I propose to appoint or resolve that Mr. X and Y be hereby appointed. The members are being deprived of the freedom of choice over here, because either they have to appoint X and Y both or they have to reject X and Y both, which is not allowed. So for every appointment of director, we must have a separate resolution. Appoint X, yes, no. Appoint Y, yes, no. Appoint X and Y, yes, no. Doesn't work. So separate resolution is something which is allowed for appointment of 2 or more directors. However, single resolution may also work when ma'am, when can it work? When a prior resolution is passed. That means before the single resolution, another resolution is passed which tells us, resolve that appointment of X and Y is going to take place by single resolution, whether you approve or you disapprove. So you are taking prior permission from the members for proposing single resolution, and when you obtain this prior permission, it's not going to be OR, it's not going to be SR, it's going to be a resolution with no vote against it. That means there shouldn't be any objection raised to the passing of single resolution. Before single resolution, there has to be another resolution which has to be passed. Okay, fine, ma'am. Supposedly, you did not meet these conditions, you did not meet this requirement, and without meeting these requirements, single resolution was passed. Without taking this permission, single resolution was passed. Then all the appointments will be void. And this section 152(7) deemed reappointment shall not apply. We discussed this as an exception. When the retiring director automatically reappoints in adjourned AGM, there is an exception. This is an exception. I told you before only that section 162 does not apply to a private company. It does not apply to a 100% government company and wholly owned subsidiary of such 100% government company. Wholly owned subsidiary of such 100% government company. Okay, ma'am. Section 163, proportional representation. What is proportional representation? See, if there is being given the power in article, some companies may choose to appoint their directors by proportional representation. Normally what happens, a person is proposed, OR is passed. If we get simple majority, he is appointed as a director. But in PR, we have a special voting method. This is by majority, simple majority. The minority shareholders might have to say that we cannot propose someone, our proportion is not being represented, etc., etc. So we have differential voting methods. What are the 3 voting methods which are recognized by this section? Single transferable vote, cumulative voting, or otherwise. So you have to remember these 3 names. The procedures are explained in the regular classes. Now, if your articles permit you, the company may resolve to appoint the directors by proportional representation, right? If you choose PR, then at least 2/3 of your directors are going to be appointed by PR, which cannot be removed by using section 169. Okay, this is an overriding section. So if you choose PR, all other things get stagnant. No rotation, nothing. Okay. The appointment is like the elections. It happens for 5 years, again election will happen. So likewise, here the appointment is happening for 3 years, again after 3 years, again PR. Again after 3 years, again PR. Right? The same people can be appointed, that's not a problem. Okay? Now, this section is again not applicable to 100% government company or wholly owned subsidiary of such government company. The directors who are appointed by using this particular section of proportional representation cannot be removed using section 169. They cannot be removed using section 169. Clear? Okay. Next we have section 168, the resignation of directors, a very simple section. Before we go on to resignation, let me discuss with you, what do the directors do? What are their duties? The directors have to act in accordance with the Companies Act. They have to act in accordance with the articles of the company. They must act in good faith. They should not be negligent towards the company. They should have due diligence. Their interest and the company's interest should be common. They should not ever have a conflict of interest. They should never attempt to have any undue advantage of any situation or gain anything which make secret profit or anything like that, right? And more importantly, prohibited to assign office. This is the most important duty which is covered under section 166 of the Act. Prohibited to assign office. You cannot transfer your office of directorship to anyone else. If you do, or if you do not follow or diligently perform any of the duties of the director, then you can be attracted to a fine starting from 1 lakh to 5 lakh. Right? So all the duties of the directors must be efficiently discharged by the directors who are appointed to the board of the company. Okay, fine. Now, resignation by director. Director may resign. Director cannot be stopped by anyone else. If it wants to leave the company, he or she may leave the company. What they have to do is, they just have to give a notice in writing to the company, right? It is company's duty to further inform ROC that their director has resigned. So there is a form DIR 12. Within 30 days of receiving that resignation, you have to inform ROC. Whenever a director is giving resignation to the company, the resignation is going to be effective from the date when the company receives the resignation, or the date you have specified in the notice, whichever is later. So from that date, your resignation will be treated to be effective. Okay, fine. And when the board comes to know about the resignation, they have two duties. They have to intimate ROC, plus they have to also include it in their board's report. As and when it will be made. Now, there is an optional requirement given in section 168 which tells that a director who is resigning may also inform ROC. Although it is not this duty of the director who is resigning to inform ROC, it is the duty of the company to inform ROC. But you may also voluntarily inform ROC within 30 days of giving resignation in DIR 11. Okay, fine, ma'am. Now here also there may be a possible situation that all the directors have resigned. So again we will go to the promoters. The promoters will fill the position of directors, and if it cannot be filled, then the central government is going to take charge, right? Central government will appoint the directors. Next is section 169, which talks about the removal of directors. What happens? Supposedly the board wants to remove any of the director. It cannot. The power to remove director is with the members. How can they do it? By just passing ordinary resolution. Now, removal before expiry of their term, because when their term has expired, they automatically leave and vacate the company. Before the expiry of their term, the members have the power that they can remove the directors, right? But for removing the directors, you must send special notice to the company. And to send special notice, you must be eligible. How do we come to know whether we are eligible to send special notice or not? Section 115, right? So it tells us that the members who are holding at least 1% of voting power or 5 lakh paid up capital in value is eligible member. So if you have the eligibility to send a special notice, send a special notice. This is just a name, nothing very special about it. It's just that this notice has to be sent 14 days before general meeting to the company. General meeting, any meeting, AGM or EGM. This special notice can contain two things. One, remove, we propose, or the intention, we intend to propose for the removal of Mr. X as a director. Point number one. Or it may say, we intend to propose to remove Mr. X as a director and appoint Mr. Y in his place. So there are two situations. One is you just want removal, and the second is you want replacement. So when you want replacement, you suggest a name also. And when you want removal, it's just removal, right? So there can be two probable situations. So you give this special notice to the company. Now what does the company do? The company sends a copy of this notice to the concerned director, for whose removal the notice has been received. This concerned director gives a written representation to the company, what he has to say to its members, right? This written representation is being requested by the company to be forwarded to the members. But what happens sometimes, the concerned director tries to misuse this power. He has been given an opportunity that he can convey his message to the members. But instead of using this opportunity, he is misusing the power and writing all the bad things that he can about the company, about its directors, about its management, etc., etc. Now, when the written representation reaches to the company reads it, they get disturbed. And they feel that how can we let this be circulated to our members? So to seek a solution, they may move to tribunal. So they make an application and they say that we understand that the director has a right to make a representation, but such type of representations that he is making cannot be circulated. So the tribunal might order that there is no need for circulation of this written representation or reading it out at the meeting. Right. So in such case, this written representation may not be circulated. Otherwise, it will be circulated. Fine. So eligible member sends special notice to the company. The company forwards the copy to director. Director gives written representation to the company. The company sends written representation plus notice 7 days before general meeting to the members. Quite possible there is time constraint or any other thing, and the meeting and the notice as well as the representation could not be sent, so it will be read out at the meeting. That's not a problem. And quite possible it is sent. Whatever the case be, general meeting is held. By passing OR, the director can be removed. Now, when he is removed before the expiry of his terms, it again leads to vacancy which has been created. Right? Ideally, this is a case of casual vacancy, but supposedly we got the special notice of replacement and Mr. Y's name was also proposed. So, by passing OR, Mr. Y can be appointed. Supposedly, he was not appointed or no name was proposed. Then it will amount to casual vacancy which can be filled by the board by using section 161(4). Okay. So, we are removing directors just by passing OR. There are certain type of directors which cannot be removed by OR. What type of directors? Director who has been appointed by the tribunal. The director who has been appointed by proportional representation. By proportional representation. The nominee director. The nominee director. And. See, independent director. Independent director, he is appointed for 5 years. By passing OR. He can be removed by OR. He is appointed again for 5 years, that means for his second term by passing SR. He can be removed also only by passing SR. He can be removed also only by passing SR. So, independent director in second term removal requires SR. Clear? Okay. Now, broadly we have completed the chapter and we are left with two important topics, independent director and SSD. Before that, section 170. What is 170? It tells about the maintenance of register. So, every company has to maintain a register of directors as well as KMP. This is going to be maintained at the registered office, which shall also be open for inspection by the members according to section 171. They can inspect this. It will also be available in every annual general meeting where members can come and see it. They can take extracts. It is company's duty to provide extracts within 30 days. If you fail to do so, an application can be made to ROC and ROC will order you immediate provision of the same, right? So that is something. Section 171 talks about inspection. Section 170 talks about maintenance of register. Apart from maintenance of register, section 170 also talks about DIR 12. That whenever you appoint a director or whenever there is a change in director or KMP, file DIR 12 within 30 days. Within 30 days. Section 170 as well as 171, they both are not applicable to government companies. They both are not applicable to government companies. Section 172, this talks about punishment. So if if the punishment, if you contravene section 149 to 171 and there is no specific punishment provided in that particular section, example, non-maintenance of register, non-appointment of women director, all this is, no specific punishment is given in that respective section. So you follow the punishment of leftover section, that is section 172, which states that minimum penalty 50,000, 500 per day continuing default, and maximum penalty 3 lakh and 1 lakh. 3 lakh for company, 1 lakh for officer in default. Okay, 3 lakh for company and 1 lakh for officer in default. Clear? Now we move to independent directors. Independent directors. Who are independent directors? Someone who is a highly experienced, highly knowledgeable person and who is not connected with the company. So when he comes to the company, he brings high level of expertise, and since he is not connected with the company, he will bring an unbiased opinion. We don't need independent directors in all types of companies. They are needed in certain limited companies. Listed company, if it's listed, we don't need to check any threshold. Listed companies straight away have to have 1/3 of their directors to be independent. If it's not listed, we have to check 3 criteria: 10, 100 and 50. Paid up capital more than equal to 10 crores, turnover more than equal to 100 crores, or loans, debentures, deposits more than 50 crores. If either of these 3 criteria is satisfied, then you have to appoint 2 independent directors, at least 2 independent directors. Okay, so every listed company, at least 1/3 independent directors, and unlisted public company, if you meet the threshold, at least 2 independent directors. Whatever independent directors you are appointing have to be subject to the requirement of audit committee, NRC, any other law. That means if audit committee says you need 4 directors, independent directors, and this section says 2, appoint 4. Okay. Supposedly, the company is an unlisted public company and has crossed the turnover of 100 crores. So 150 crores is the turnover, you appoint independent director. Next year, the turnover comes down below 100 crore. Again below 100 crore, again below 100 crore. So if for constant 3 years you fail to meet that threshold, then there is no requirement for appointment of independent director. There is no requirement for appointment of independent director. Just like the vacancy in the office of women director is filled immediate next board meeting or 3 months, whichever is later, like that here also, the intermittent vacancy which is created in the office of independent director has to be filled up immediate next board meeting or 3 months, whichever is later. To appoint anyone as independent director, what is needed is the person should be an individual. He should not be disqualified. He should have given in. He should have given consent. He should meet the criteria of independence given under section 149(6). Apart from all that, and his name should be included in the data bank. What is this? We will read it a little later. Okay, so all these requirements, if they are fulfilled, then his name can be proposed, and when his name is proposed, he is appointed in the general meeting by passing ordinary resolution. Okay, ma'am. To be an independent director, independent director comes under the category of non-executive director. So you cannot be MD or whole-time director or nominee director. You cannot be these 3, and if you are not these 3, then if you meet the criteria of independence, you can be appointed as independent director. So not MD, not WTD, not nominee director, and satisfying all conditions below can be appointed as independent director. Point number 1. He should be the person of integrity, experience and expertise. Not in our opinion, but in the opinion of board. If it is a government company, in the opinion of respective ministry. He should not be the promoter of company holding subsidiary associate. This you can call as CHSA, this you can call as cash, this you can call as group, however you may learn it. Not related to PD, that is promoter director of cash, PD of cash. Someone should not have a pecuniary relationship, that is a monetary relationship with cash or with PD of cash during preceding year or 2 preceding years, during financial year or preceding 2 years. Now this has an exception. It is quite relaxed that if your pecuniary relationship does not exceed 10% of total income, it's okay, you may have it. Still you will satisfy the criteria of independence. Right, still you will satisfy the criteria of independence, integrity, experience and expertise, not related to PD of cash and not a promoter, not having a pecuniary relationship. So these are the first 3 clauses, easy ones. Then comes D, which is for the relatives. So your relative should not be holding security in cash, that is CHSA. Your relative should not be holding security in CHSA. There is a limit that if it holds security up to 50 lakh or 2% of paid up capital, it is allowed. Your relative should not be indebted to CHSA or PD of CHSA. If it is indebted in amount of less than equal to 50 lakhs, it is allowed. Your relative should not give guarantee to CHSA or promoter of CHSA or director of H. If it gives a guarantee for an amount less than 50 lakhs, it's okay. It's okay. You can write for an amount of 50 lakhs or more. Right? It's okay. Your relative should not have a pecuniary relationship with CHSA. For an amount 2% or more of turnover or total income, pecuniary relationship, again monetary relationship. We have done a detailed discussion on all these points, right? So now I think you are well in a situation that you can quickly recall this, and this is learnt by you, right? Okay, so clause D was for relatives, 4 points: not holding security, 50 lakh, 2% paid up capital, not indebted in excess of 50 lakhs, not guarantee for 50 lakhs or more, no pecuniary relationship, 2% or more of turnover or total income, right? So these are the 4 points for relative. Now, you or your relative should not have been a KMP or employee in CHSA preceding 3 financial years. However, relative may have been an employee. You or your relative should not have been employee, proprietor or partner in audit firm of CHSA, CS firm of CHSA, cost auditor firm of CHSA, or such a legal firm which is getting 10 or more % of its total income from CHSA, right, in preceding 3 financial years. You with your relative should not hold more than 2% of the voting power of company. You with your relative, you or your relative should not be a director or executive of such NPO which is getting 25% or more of its receipts from CHSA or the director or promoter of the company, or holds 2% or more voting power. Who possesses other qualification as prescribed. What are the other qualification prescribed? You can be an expert in finance, you can be an expert in law, management, sales, marketing, administration, research, any other discipline, etc., etc. Fine. Now, every person who is going to be appointed as an independent director must give a declaration that yes, he has fulfilled the criteria of independence. So whenever you are appointed as independent director, in the first board meeting that you participate, in the board meeting of every financial year, and wherever there is a change in circumstance, you have to give a declaration. It is your duty. We have a code, Schedule 4, code for independent directors, how independent directors must react to the situations, how they should behave. You must follow that. You must follow that. What will you get? Because you cannot get salary, you are not an employee. You will get profit related commission. Even if there is no profit in the company, then also you will get commission. Then also you will get some amount. You will get sitting fees, right? You will get reimbursement of expenses. Okay, but you will not be entitled to stock option. That is one thing that you need to remember. You will be appointed for 5 years. For 5 years. You may be appointed for a shorter term also, but you cannot be appointed for more than 2 consecutive terms. And any term shorter than 5 years will also be treated as one term only. So here you can be appointed for 5 years by passing OR, again for 5 years by passing SR, and then you need to have a cooling period. Then you need to have a cooling period for 3 years. Cooling period for 3 years. Again you can be appointed for 5 years. Okay, during the second term, if the company's shareholder want the independent director to be removed, they have to pass SR for removal. OR will not suffice. OR will not suffice. Okay. Now, whoever is the independent director or any non-executive director, he cannot be held liable for everything that's happening in the company. He will be liable only for those acts where he has given his consent, he had knowledge, or he had not acted diligently. Only for those cases he will be responsible. Only for those cases he will be responsible. Independent directors don't retire by rotation. Don't retire by rotation. Now, as I told you about data bank, right? What is data bank? Section 150. Section 150 basically tells us about data bank. That central government, see, every company, it is mandatory for listed companies and the companies which are meeting this criteria, it is mandatory for them to appoint independent directors. From where will they get these independent directors, for which central government has maintained a data bank. Now this data bank has been maintained by the notified institute of government. What is the notified institute of government? Indian Institute of Corporate Affairs has been notified by central government. So any company who wants independent director, they can go to that data bank, they can select a person, they have to perform their own due diligence, and if he meets all the criteria of independence of your company, etc., you may appoint such a person as independent director. Fine. Okay ma'am. Now we have a rule 6. If I want to be the independent director, or I have been the independent director, I have to comply with this rule 6. What does it tell us? What does it tell me? That I cannot be an independent director unless my name is included in the data bank which is maintained by this institute. How do I include my name, ma'am? I have to make an application to the institute along with the relevant fees, and my name will be included. Okay. That means before this rule came into picture, there were many independent directors. They also have to include their name. Yes, they have been given a time period of 13 months within which they can apply to the institute for inclusion of their name along with the fees. The name can be included for 1 year, 5 year, or for lifetime. And after this rule, anyone who wants to be appointed as an independent director, that means some companies proposing you to be appointed as independent director, you must before your appointment include your name in the data bank. And supposedly I'm not being appointed by anyone as independent director yet. I find this as a career opportunity and I want to include my name voluntarily. I don't even have DIN, I'm not a director of anyone. Can I? Yes, you can. So voluntarily also you can apply for your name as an inclusion in the data bank. Now, when you apply for your name as an inclusion in data bank, within 2 years you have to pass a test, online proficiency self-assessment test, OPSAT. With 50% passing criteria, there is no limit on the number of attempts. So within 2 years you have to pass it. You have n number of times. So within 2 years you can appear for the test n number of times and you can pass this test. You have to. If you don't pass it, your name will be removed from this particular data bank. If you pass it, great. Supposedly you enrolled your name for 5 years only. The tenure expires. Within 30 days you can renew it. If you don't renew it, your name will be removed. Fine. Now, what has to be, what else is there in this rule which needs to be remembered is the exemption. What exemption, ma'am? Now, some very proficient people are not required to appear for their test. They will apply to the institute for inclusion of their name and this step is excluded. They don't have to appear for their test. Who, ma'am? Someone who has 3 years of experience as a director or KMP in listed public company, unlisted public company with paid up capital to 10 crores or more, in any body corporate which is listed either in India or in such a country which is a member of FATF or IOSCO. Any body corporate which is incorporated outside India but having paid up capital more than equal to 2 million US dollar. Any other statutory corporation. Or if you have 3 years experience in the pay scale of director or above in the Ministry of Corporate Affairs, Ministry of Heavy Industries, Ministry of Public Enterprises, Ministry of Commerce, etc. Right? Or if you have been in the pay scale of chief manager or above in SEBI, IRDA, RBI, PFRDA. So all these are excluded from appearing for test. Moreover, if you are an advocate in practice, if you are a CA in practice, if you are a CS in practice, if you are a CMA in practice, and you've been in practice for 10 years, at least 10 years, then also you are exempted from the test. Okay? Fine. And this is probably the last section that we have to discuss, that we have to revise. We've covered all the sections. SSD, Small Shareholders Director. Who are SSD? SSD. The directors who are elected by the small shareholders. Who are small shareholders? Small shareholders are the shareholders who have less than or equal to 20,000 face value of shares of the company. So they are considered as small shareholders. Now this section applies to listed company and it is discretionary. It's not mandatory. So if a listed company wants, it may suo motu, that means on its own or on receipt of a notice by the eligible small shareholders, it can have one SSD who is elected as who is elected by small shareholders. Who is eligible to send notice? 1,000 small shareholders or 1/10 of small shareholders, whichever is lower. Right. So they will send a notice to the company that we are proposing the appointment of this person as SSD and this is his DIN, this is his consent, and he has given a declaration that he is not disqualified, right? So along with these details, they send a notice to listed company may have one director elected by SSH. Now this is not a normal election which is happening by all the shareholders, so it's not an ordinary resolution in general meeting. It is the election by small shareholders only, so they meet. Only their meeting happens and in their meeting by majority votes such a person is elected who is going to be non-rotational, who is going to be independent. So he also has to meet the criteria of independence, section 149(6), and he also has to give a declaration in that regard. Okay, and he is going to be non-rotational. He has a fixed term for 3 years. Can he be reappointed after 3 years? No. Then 3 years will be cooling. Again, then he can be appointed after 3 years. During this cooling period, he cannot be appointed or be associated in the company in any manner. Okay. Fine. If small shareholders director, someone who is appointed as SSD, is disqualified under section 164 or grounds of vacation are attracted to him, or he fails to meet the criteria of independence, he has to vacate the office. One person can be SSD in maximum 2 companies, but the 2 companies should not be competing business, should not be in the competing business, okay, or their business should not be in conflict with each other, okay. And no reappointment allowed, that is something that I've already told you. SSD can be removed under section 169. This is something which is allowed. SSD can be removed under section 169, right? So I think we have revised everything. Okay. Hi everyone. Let's now revise our chapter of appointment and remuneration of managerial personnel, right? This particular chapter has sections 196 to section number 205. not a lot of sections, but two very important sections of your curriculum, that is section 196 and 197. So we will start with the appointment part. Every company has some executive directors as well as some non-executive directors. The executive directors, that is MD, WTD, along with the manager, is termed as managerial personnel, although not defined in the act, yet we come to know that we are going to talk about their appointment, we are going to talk about their remuneration along with remuneration of other directors as well. The direct appointment of other directors we have already discussed in the chapter of directors. Moreover, if it's a managing director or whole-time director, there also we have discussed the appointment already. Now, appointment has to be in accordance with section 152. Undoubtedly we know that. So we have section 152, we have section 160 for the appointment, and here the appointment is going to be in accordance with section 196. Clear? A manager plus whole-time director is possible, manager plus MD is not possible, managing director plus whole-time director is possible. So you cannot have a manager and a managing director at the same time. Simple reason being because manager is someone who has almost all the powers of the company, and managing director is also someone who has substantial powers of the company. So I made that chart for you, right? Made that diagram for you, rather, a circled diagram in which we are able to understand who a managing director is and who a manager is and why they are not possible at the same time in the same company. So no company can appoint a manager as well as a managing director at the same time. Whoever you appoint, their tenure is going to be maximum for 5 years. This does not apply to a government company. Right, so a government company may have MD which is going to hold office for 10 years, not a problem, right? But otherwise in all other companies, including a private company, you cannot have MD, WTD or manager for more than 5 years. So at once you can appoint for a maximum tenure of 5 years only, but before this 5 year ends, when 1 year is left for ending these 5 years, you can have reappointment. Right, so reappointment not earlier than 1 year before expiry. That means you cannot do that. You have appointed a managing director on 21st Jan and on 22nd Jan you reappointed that person for another term of 5 years. No, it cannot be so quick. See, after 4 years we come to know, yes, about the work, how they have performed, how they are performing. So once we very well know about the work, then is the right time when we can go for reappointment. Reappointment is permissible before expiry of term, simple reason being because we don't want to hinder the flow of work. These are people who are involved in the core work of the company, right? Not exactly the core work, I would say the core management of the company. So the company cannot function without them, and that's why their reappointment is possible even before expiry of their term, but not earlier than 1 year. Section 196(3) tells us about disqualifications of appointment. That is, who can be appointed as MD, WTD or manager. Such person has to be within this age limit. Should not have attained the age of 70 is the language of law, although here I have mentioned 69 as the maximum because ultimately that comes out to be the solution. However, what you will write in examination is that at least of 21 years age and not attained the age of 70. Lesser than 21 is not permissible in or any case at all. But supposedly we have a very experienced person who is more than 70 years of age, who has attained the age of 70 or is even more than that, his appointment is also permissible provided SR is passed. Supposedly SR could not be passed, but the votes that he has got are more in favor than against, then we can take the approval of CG and we can still appoint such person. Okay. What are the other disqualifications? Someone who is undischarged insolvent, someone who has ever done suspension with the creditors, someone who has been convicted for imprisonment for more than 6 months. Such person becomes disqualified for life. He can never be appointed as MD, WTD or manager in any company. Okay. Now, appointment requires approval. There are 3 stages, my dear: BR in BM, OR in GM and central government approval sometimes, not always. So there can be 2-stage process also: board resolution in board meeting, ordinary resolution in general meeting, and that's how the appointment of these people will be made, right? This section of approval does not apply to private company. So in private company, you don't need this approval by central government or this approval by in general meeting. No, nothing required at all. In case of government company also, this subsection does not apply. So if it is a government company and someone needs the approval of CG according to this particular section, for that company it will be exempted, right? So by far, MD, manager cannot be appointed together for 5 years at once. Then certain disqualifications, that is minimum age 21, maximum age 69, it cannot be 70 or more. If it is 70 or more, SR needs to be passed. Undischarged insolvent, not allowed. Suspension done with the creditor, not allowed. Then you have been convicted for more than 6 months, not allowed. After that, what is the process? The first step is to call a board meeting. Now, in the board meeting, you pass a board resolution, you appoint MD, WTD or manager, and in the next general meeting, you need their approval. So, in the next general meeting, you take approval. So, whoever is appointed by passing board resolution is being clearly told that this appointment is subject to the approval in general meeting. If it is approved, then great. If it is not approved, then you have to vacate the office. However, your prior acts, whatever you have done as the managing director or whole-time director, shall be considered to be valid. Okay. Whenever you appoint someone as managing director, WTD or manager, you have to file a form. For appointment of KMP, for appointment of director, we have a form DIR 12 for filing within 30 days of appointment. However, this form is not required because for managerial personnel, these three, you have a form MR1 which has to be filed. MR1 has to be filed within 60 days of this board resolution. Within 60 days. This marks the appointment of managerial personnel and it is the intimation to ROC. Now, in certain cases, you need the third approval as well. 3 stage I told you now, BR, OR and then CG. CG approval is not needed in all the cases. CG approval is needed in certain cases only. If you comply with conditions given in Part 1 of Schedule 5, no need for central government approval at all. But if you don't comply with these conditions, then also you can be appointed subject to approval by CG. How do we get approval by CG? For that, we file the form MR2. It has to be filed within 90 days of board resolution, and when we file that form, CG will either approve our appointment or it will reject our appointment. If we don't get the approval, then the person so appointed cannot continue as the managerial personnel. Okay. So, what are the conditions which are given in Part 1 of Schedule 5? There are 19 acts. If someone has been imprisoned even for a single day under these 19 acts, you have not complied with the conditions of Part 1 Schedule 5, and hence either don't be appointed as MD, WTD or manager, or if you want to be appointed, seek government approval by filing MR2 with central government. Clear? Moreover, if you have been fined under these 19 acts for an amount exceeding 1,000, then also the same thing applies. What are the 19 acts? Central Excise Act, Customs Act, GST, Wealth Tax, Income Tax, CMA, PMLA, SCRA, SEBI, Companies Act, Competition Act, IBC, Stamp Act, SICA, Food Adulteration, Essential Commodities, Fugitive Economic Offenders, Foreign Trade Act, Industries Development and Regulation Act. Right? So you don't have to learn every act name by name, but you should be able to recall whether this is, if you hear a name, you should be able to recall whether this particular act is under those 19 statutes or not. So that is something which is important for you to learn. Next, if your convicted person is appointed as MP with approval of CG, no approval required for any subsequent appointment. Simple meaning that once you have taken CG approval, you don't need this approval again. Second thing, so we have basically 4 conditions given in Part 1 Schedule 5 which needs to be complied with by a person who is proposed to be appointed as a managerial person. If he does not fulfill these conditions, then his appointment is made subject to CG's approval. If CG doesn't approve, his tenure will terminate immediately. Right? What are the 4 conditions? First is imprisonment or fine under 19 statutes. Second is detention under Conservation of Foreign Exchange and Prevention of Smuggling Activities Act. So even if you have not been imprisoned, you have not been fined, but you have been detained for any inquiry or for any purpose, then also you have not complied with the conditions. If you have completed the age of 21 years and not attained the age of 70 years, that means if you're below this or if you're above this, you have broken the condition. You must be the resident of India. So if you comply with these 4 conditions, that is no imprisonment, no fine under 19 statutes, no detention, attain the age of 21 and not attain the age of 70 and a resident. If you comply with all these 4 conditions, then you can be appointed without CG's approval just by passing BR plus OR. Otherwise, you need CG approval as well. Otherwise, you need CG's approval as well. Right. Apart from this, what do we have in appointment part? See, whenever you are calling a board meeting or a general meeting for the purpose of appointment, then you will clearly specify in the meeting that what are the terms and conditions of appointment, what is the remuneration that is being proposed, and other important details, right? Section 196(4) and Section 196(5) does not apply to a private company. Section 196(2), 4 and 5 does not apply to a government company, as I have already told you that. Whatever appointments you're making, whatever forms you're filing, be it MR1 or MR2, it has to accompany the mandatory attachments. In MR2, you also have to furnish the copy of board resolution plus the copy of OR or SR. You will tell to the government that our board has approved, our members have approved the appointment, and now it's your turn because he's not complying with the conditions of part 1 of schedule 5, so you give the permission so that he can continue the appointment. And when you're filing MR1, it has to have board resolution along with it, and it is going to be, of course, certified. Fine. Okay, so we proceed further. Next is our managerial remuneration. Managerial remuneration, we don't get exact how much should we pay to our directors, rather we get an upper capping or upper limit as to what is the maximum remuneration that we can pay to our directors, to our manager, to our non-executive directors. There are 2 cases of remuneration. One is profits and one is loss or inadequate profits. We have in detail discussed about what do you mean by inadequate profits and when can we identify whether the profits are adequate or inadequate. Moreover, you understand profit and loss very well. So if there are ample of profits, there are adequate profits in the company, the overall maximum managerial remuneration limit is 11% of net profits. What do we mean by net profits over here, ma'am? Net profits will be computed according to section 198. Okay, fine. Supposedly we want to pay more than this particular limit, we need to get authorization in general meeting if we want to pay more. Authorization means simple resolution. Now, this 11% limit is the overall limit. We have 4 sub-limits also. 5, 10, 1, 3. When we are paying to our managerial personnel, if there is just one of them, 5% to him, maximum that can be paid. If there is more than one, then 10% is the maximum that can be paid to all of them. To other directors, if there is managerial personnel, that means he is there to work, so only 1%, and if there is no managerial personnel, 3% of net profits is the maximum that can be paid to them. Supposedly, we want to increase this limit. We can increase this limit by passing SR. But we want to pay our directors more. We want to pay our directors more than the limit which has been specified in the Act, but we don't have money to pay to our debenture holders, to repay our creditors, to repay our loan. In such a situation, Companies Act doesn't allow you. It tells you that first you obtain the approval of people you haven't paid their money. So if there is a default and repayment of dues to bank, public financial institution, to the debenture holders, to the secured creditors, to take their approval, and then you take the approval of members for paying more. Okay, so prior approval of bank or PFI, in case it is applicable, and SR if it exceeds the above specified rate. If it exceeds the above specified rate. Okay, fine, ma'am. Now, supposedly the company does not have adequate profits. There are losses in the company. Then whatever payment is going to happen will happen according to Schedule 5. Schedule 5 has different parts, Part 1, Part 2, Part 3, Part 4. Part 1 relates to appointment, we have discussed. Part 2 is divided into further 5 sections we have section 1, we have section 2, which is the most important one over here. Section 1 tells us that if company has profits, pay according to section 197. But if company doesn't have adequate profits or if there are losses, then pay according to this schedule, section 2, item A and item B. What is it, ma'am? Item A is the limit given based on effective capital. What is the limit given, ma'am, based on effective capital? If your capital is less than or negative or less than 5 crore, then you can pay maximum managerial remuneration to your executive directors plus managers 60 lakhs, to others 12 lakhs. If it is 5 crores or more but less than 100 crores, then 84 lakhs, 17 lakhs. So exactly divided by 5 comes out your limit to other directors. If it exceeds 100 crore, if it is 100 crore or more than that but less than 250 crores, then 120 lakhs and 24 lakhs. If it exceeds 250 crore, 120 lakhs plus 0.01% of whatever is the excess to 250 crores. Likewise, 24 lakhs plus 0.01% of excess. Right. So this is the limit which has been given under item A. How do we calculate effective capital? Effective capital means paid up share capital, securities premium, your loans, your reserves and surplus, minus your investments, minus your losses, minus your preliminary expenses. So you get the figure of effective capital. Right. So whatever is the effective capital, supposedly you want to appoint a person as managing director, but you know that your company has been into losses for the past 10 years. Now, whenever you are going to fix his remuneration, you know that you cannot give him remuneration 11% of net profits. How? The company doesn't even have profit. So you know the maximum remuneration that you can pay to him in case of losses is calculated according to Schedule 5, Part 2, Section 2. So you come here, you check the effective capital of the company. Supposedly the effective capital of the company is 2 crores. So now you know that you can maximum pay him 60 lakhs per person per annum. 12 lakhs per person per annum. That is for other directors and this is for executive directors plus manager. Right? But these limits can also be increased provided you pass a special resolution. Provided you pass a special resolution. Right? Okay, fine, ma'am. Now, what is item B? Item B tells us about the appointment of director or managerial person in the professional capacity. What is professional capacity? Someone who is not holding the shares of the company or holding a subsidiary except for ESOP. Except for ESOP, and that too just 0.5% of the paid up share capital. Just a second. So if you are not holding any shares in the company, if you're not connected to the promoters, if you're not connected to the directors of the company, you're not related to them, and basically we are trying to eliminate the promoter group and you have the graduate level qualification. So if you have all these three, then you can clearly say that I am a director who is working in the professional capacity. If a person is working in the professional capacity, then he can be paid remuneration according to item A. That clearly means that in case company doesn't have adequate profits, they are suffering from losses, then they can pay remuneration to their directors, who are working in professional capacity. Like if we have Reliance Industries Limited, there may be Mukesh Ambani. He is not a person who is working in professional capacity. Why? Because he is connected to the company, he is related to the company, right? So someone who is working in a professional capacity can also be paid remuneration in case of losses, in case of inadequate profits, when SR is passed. So for such appointments, you need SR. I have told you the whole history, why law is harsh over here, what is the logic behind everything. But as of now, the only thing that you need to remember, just a second. The only thing you need to remember over here is that if you fall under item A, you have to pay the company can pay maximum managerial remuneration based on effective capital. And if you don't fall under item A, if you fall under item B, then also the maximum managerial remuneration that can be paid to any director is according to item A. So ultimately what you have to remember is the chart of effective capital, right? So effective capital, whatever category you fall into, you will pay remuneration according to that effective capital. Clear? Okay. So that is item A and item B. Now, moving further, because we have a lot in Schedule 5, first of all, let's try to wrap up Schedule 5 and then we will switch to other points given in section 197. We have certain special cases also, certain special cases as in the remuneration. Okay, before that, certain special cases, if the company has inadequate profits or if the company, this I have already told you, if the company has loss or inadequate profits, then if the director is employed in professional capacity, then he also may be paid remuneration according to item A only. What is item A? Item A is according to effective capital, right? If you want to increase even beyond that, SR is needed. If you want to pay within the limit given in Schedule 5, no SR is needed. But if you are falling in the item A, then SR is needed even if within the limit. Fine. Now, limits under A or B are going to be available if, or you can say pay according to item A and B if. So these are the 4 conditions which must be satisfied, then only you can pay according to section 2 of part 2 of Schedule 5. That means if a company has inadequate profits, you can pay within the limit of 60, 84, 120 and 120 plus 0.1%, likewise 12, 17, 24 and 24 plus 0.01% to executive plus manager and to other directors if these conditions are complied with. That means you obtain the approval of NRC or board, there is no default in payment of dues, and if there is default, then prior approval of there is obtained, OR or SR. If it is within the limit, OR. If it exceeds the limit, SR. And details in explanatory statements. So there are certain general disclosures, certain information about the company, about the appointee, etc., etc. All that has to be given in the notice of general meeting. Okay, fine. Then we have some special cases. In these cases, the remuneration can be paid even more than given in section 2 of part 2 of Schedule 5. If the remuneration is being paid by other company and in that company it is within the limit of managerial remuneration, plus you can say that it complies with the conditions of section 197, right? So if it is so and the remuneration to this company's directors are being paid by some other company, then that is permissible. If it is a new company, then for the first 7 years it is permissible. If it is a sick company and has been referred to BIFR, then for 5 years it is allowed. If a resolution plan has been approved with respect to a company under IBC, then for 5 years it is allowed. If the remuneration is fixed by NCLT, then it's allowed. Provided all these cases, remuneration will be allowed if the remuneration is not being received by some other company. If I have a managing director at 2 places and at some other place I'm receiving remuneration, then I cannot be paid extra remuneration if I fall into this category also. Certificate of no objection from creditors for extra payment. Certificate of no default to creditors. So these are the 2 certificates that will be made by the company secretary, and these are the 2 certifications that we need apart from a confirmation that the person to whom remuneration is being paid is not deriving remuneration from any other company, right? Of course, all these cases that I am discussing with you are not so important ones. Now, one more thing that is given in Schedule 5, although it is given at the end, but I am discussing it with you right here. Okay. A person is a managing director in 2 companies. We usually think that we have to check limits for the respective companies only. That means he is an MD of A Limited, we have to check the maximum managerial remuneration in A Limited. And if he is the MD of B Limited, we have to check the maximum managerial remuneration in B Limited. Mr. X can get maximum from both places. It is not so. He cannot get maximum from both places. His total remuneration cannot exceed the maximum of the highest of all the companies from which he is getting remuneration. So this is one small point that you have to keep in your mind. Now, apart from that, we have section 4, which talks about the perquisites.
perquisites which are not part of managerial remuneration. One disclaimer I'm giving right here, this is just a revision and recalling of all that we have studied in absolute depth, right? So if you have forgotten the provisions, please refer to the original videos, then only you will be able to recall the complete concept. If you remember the concept, then this revision is going to help you in immense manner. Now, perquisites, some perquisites which are being paid to the director do not form part of the managerial remuneration. What are they? If there is contribution to PF, gratuity up to a certain level, leave encashment. So these three perks will never form part of managerial remuneration, just like sitting fees doesn't form part of that, right? But if it is an expatriate person, then children's education allowance, holiday passage, as well as that leave travel concession, that is also not going to form part of the managerial remuneration. Okay, so that was about Schedule 5, a lot of content. Now we come back to Section 197. Section 197 tells us the case. If you have adequate profits, you have a limit. If you have inadequate profits, you go to Schedule 5. And we have read about the whole Schedule 5 over here. Now, what else is there in Section 197? Because it is a huge section. How can we pay remuneration? We can pay it as monthly, we can pay it as percentage of profits, or it can be a combination of that. How do we determine remuneration? If it is given in articles or 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 SR, if articles say so. Now, excess remuneration, supposedly any director receives excess remuneration, then that has to be refunded to the company within 2 years. This refund can be waived if SR is passed, but before passing SR, you need approval of bank or PFI if there is default. Okay. Whatever you are being paid other than or whatever you are being paid in professional nature, that is not going to form part of your managerial remuneration. Usually the rule is that whatever company pays has to be within that limit of 11%, because it is considered as managerial remuneration, but your sitting fees is not considered as managerial remuneration. Your amount that you are paying in excess of in your professional capacity, that's not considered as managerial remuneration. Example, a doctor is also MD. So as MD, whatever he is drawing is managerial remuneration, but as doctor, if he gets some visiting charges, that is not managerial remuneration. That will not be considered as a part of a managerial remuneration, right? So when it will be considered as professional, if the services are of professional nature and director has such requisite qualification according to board or NRC. Now, sitting fees that can be paid over and above remuneration, we have to keep in mind maximum sitting fees that can be paid to anyone is 1 lakh. But one more thing that we have to keep in mind is that whatever you pay to a woman director as well as independent director should not be less than what you pay as sitting fees to other directors. So this is also one thing that you have to keep in mind. Okay. Section 197 is not applicable to government company when there is no default, of course, and Schedule 5. It's not applicable to government company. Section 197 is not applicable to government company, and this is only for, of course, public company, because in the very beginning it's written that the remuneration payable by a public company shall not exceed. So, of course, this section is not for private company as well as not for government companies. Now, apart from that, we have certain certain requirements, disclosure requirements, which is for every listed company. So listed company has to disclose that median remuneration, the increase in remuneration, increase in median remuneration, the permanent employees, average increase, that is average percentile increase, then whatever remuneration you are paying according to the remuneration policy or not, the name of top 10 employees who are drawing the highest salary, the names of employees, names and details of employees who are drawing salary more than equal to 102 lakh per annum. If they are employed for part of the year, more than equal to 8.5 lakh per annum, per month, right? So all these details are also needed. These are disclosure requirements which are needed. Now, apart from that, any insurance premium that is paid by the company to secure the liability of directors shall also not form part of managerial remuneration till the time the director is proven guilty. Okay. And then you have punishments.
penalty for non-compliance, etc. Okay, moving on to our next section. Before we move on to section 199, let's quickly recall section 198. What is not to be or what is permissible credit? We have four things. What is allowed as income? What is not allowed as income? What is allowed as expense? What is not allowed as expense, right? So government subsidy allowed, securities premium not allowed, whatever you get from profit from reissue of forfeited shares not allowed, what you get on profit on sale of undertaking not allowed, then profit on sale of immovable property, fixed asset over and above the original cost not allowed. If there is change in carrying value, not allowed. If this is revaluation profit, notional gain, not allowed as a credit. Now we come to debits. What is allowed as a deduction? Working charges, depreciation, bonus, special tax, interest on debentures, on secured loans, on unsecured loans, charitable contributions, whatever repairs are there, brought forward adjusted losses, compensation, insurance, bad debts, all these are allowed. What is not allowed? Income tax, not allowed. Any voluntary compensation that you are paying, that is not allowed. Then change in fair value and loss on sale of undertaking, that is also not allowed. So you have to keep in mind what is allowed and what is not allowed. Then we have a section 199 which talks about recovery of remuneration, not in the case where you have paid excess remuneration because you could not ascertain net profits in advance, but this is a case when the restating of financial statements occur. So in case of fraud, in case of non-compliance to accounting standards and all, you have a chance that there is a possibility of revision of financial statements. That means you're recasting your financial statements. It may lead to a situation that your net profit is reduced and thereby the overall limit of remuneration is also reduced and you come to know that you have paid excess remuneration. So in such a situation, company has been given the power that can recover the remuneration from MD, WTD, CEO, manager, whether past or present. So it can be past also. Maybe the person is now gone and now you are revising the financial statements of some old tenure and you come to know that okay, we have paid excess remuneration. So that is something which has been given power over here. Now, apart from this, section 200, a very small section again, it empowers the company to fix a limit. A limit on what? A limit on the remuneration. Supposedly the company has inadequate profits or losses. In that particular situation, company can fix a limit. Company can say that okay, Schedule 5 gives us the maximum limit of 60 lakhs, but we say that you are being appointed at a remuneration of 5 lakhs per month, but we will not pay you more than 2 lakhs if there is a case of losses, right? So they can do this while granting approval with respect to appointment or remuneration of MD, WTD, manager. Then we have a section, compensation for loss of office, section 202, an important section from your examination point of view. Who is entitled to compensation? MD, WTD, manager and no other person. When is entitled to compensation? When there is a loss of office. When there is a loss of office, fine. So if their office expires before their term, they have been appointed for 5 years, but they have been removed by the company after 3 years. So for 2 years, they will be paid compensation. What is the maximum compensation that can be paid to them? Lower of your unexpired tenure or 3 years. So if your unexpired tenure is 4 years, you have just completed 1 year and 4 years are remaining, you will get compensation only for 3 years. But if your 2 years are remaining, then you will get compensation for 2 years only. So whatever is your unexpired term or 3 years, whichever is lower. What remuneration will I get actually earned? How do I calculate it? Based on average of 3 years profit. If I have not worked for 3 years, such short a period. Okay. There are certain cases where this remuneration will not be allowed. What are the cases? When the director has got another office pursuant to amalgamation or reconstruction, when the director has himself resigned, when the director, any disqualification is attracted to him and he has to vacate the office, when due to the negligence of director winding up has started, when not due to negligence of director, winding up has commenced either before leaving or within 12 months of leaving, and the amount after repaying all liabilities are not even sufficient to repay share capital. So in such a situation, his compensation will not be paid. And if he is found guilty of fraud or breach. Okay. If he is found guilty of fraud or breach.
Again, an important section from examination point of view, appointment of KMP. This actually does not prescribe us the whole process of appointment, rather tells us the requirement of appointment. Listed company and public companies with paid up capital of more than or equal to 10 crores, it is mandatory to have these 3 people. 3 for different set of things. To manage the business, to manage the finance, and to manage the compliances. MD, WTD, manager or CEO, any one of them, and CFO and CS. Moreover, there is a rule which tells that private company with paid up capital more than equal to 10 crores has to appoint a CS. Only a CS, not others. Others are not needed. So a private company may or may not have MD. There is no requirement that you must have MD. And even in public companies, there is no such requirement. But if your public company has paid up capital more than equal to 10 crores or it is a listed company, then certainly there is a requirement, right? How are they going to be appointed? Of course, we have read about the appointment of these people. It's going to happen according to section 196 only. However, CFO, CS, they all will be appointed by passing a resolution at board meeting. If the office of any of these becomes vacant, that is the situation of casual vacancy which has arisen, it is going to be filled by the board within 6 months of the vacancy, at board meeting only, right? Now, there is one more requirement, that one person cannot be MD as well as chairman at the same time. However, it is permitted if the article so provided the company does not carry multiple businesses, or even if the company carries multiple businesses and it has appointed CEO for each business. It has appointed CEO for each business. Okay. Now, a person can be maximum MD in 2 companies, and that too if specific notice is sent and unanimous resolution is passed at the board meeting of the second appointment. And if you talk about KMP, one person can be KMP in only 1 company. It can be KMP in more companies also, provided those companies are only subsidiaries, right? However, he can become director with the board's permission. That's not a problem. And lastly, we have one more section, secretarial audit. It is again needed for certain big companies only. So we have listed company, we have public company with paid up capital more than equal to 50 crores, and we have public company with turnover more than equal to 250 crores, or we even have, it is also applicable to every company having outstanding loans or borrowings from banks or financial institutions more than equal to 100 crore. So in such a case, they have to get their secretarial audit done by a CS in practice. The report is going to be in form MR3, which is going to be annexed with the board's report. And just like an auditor gives a qualification or remark, the board replies to it, gives his explanation. Just like that, if CS also brings a qualification or remark, the board, it is the duty of the board to give an explanation on the same. After that, we have section number 205, which talks about the duties of company secretary. What company secretaries have to do. See, company secretaries are the king of compliances, right? So they have to check the compliances undoubtedly. So they will guide the board of directors about the compliances. They will also be responsible in convening the meetings, obtaining necessary approvals, presenting themselves in the front of authorities or regulators. Whatever board tells them, they are going to perform that. Whatever articles, whatever act tells them, they are going to do that. They have to ensure 2 compliance with the act and compliance with the secretarial standards. That's very important. And of course, perform the duties which are being entrusted to it through act or through board. In this particular chapter, we have discussed one case law of Bell versus Lever Bros, which you have to remember. Okay, fine. Hi everyone, let's now revise the chapter Meeting of Board and its powers. So this is a huge chapter containing a lot of sections and very important from your examination perspective. It commences with section number 173. But before we start section 173, let's have a basic understanding of how board takes its decisions. Now, why do board need to take any decisions? Because company is an artificial person and
Company cannot take decisions on its own, hence the decision making powers are being distributed over board of directors as well as the shareholders, right? Whenever board has to take any decision, that means any issue comes up in front of all the directors collectively known as board, they have to resolve the decision. They have to resolve the problem. So a resolution is passed. What is resolution? Majority or you can say voting happens, right? That is, all the directors have to give their assent or dissent, whether they agree that this should be done or they disagree. If majority of the directors who are present and voting agree, then we consider that board resolution is passed. However, if they don't agree, we consider that the board resolution was put forward but it is lost. So the decisions of board of directors are taken by a board resolution. Now sometimes section 186, section 203, you also have unanimous board resolution. There is a difference between board resolution and unanimous board resolution, that is UBR. This is that whoever is present at the board meeting, so all the directors present, they cannot refrain from voting, they cannot abstain from voting, they have to vote, and they have to vote in favor. So even all the directors present vote in favor, then a UBR is passed. So UBR is not required at all times, it's required in 2 sections. In Companies Act, and in fact it's required under a rule also, but that is not something that we are going to consider right now. Now, how this board resolution will be passed? Undoubtedly, ma'am, all the directors should come together, then the issue will be told to them and then they will resolve the issue. That's how things happen. There is another way of passing board resolution, which is by circulation. That means the decision of board can be taken either at the board meeting or by passing the resolution by circulation. Now this board meeting may be virtual, it may be physical. It may be virtual, it may be physical. Earlier we had this provision that some matters cannot be dealt in at a virtual board meeting, but now there is no such restriction and all the matters can even be dealt at virtual board meeting or the board meeting that's being conducted through video conferencing, right? So this is the general thing. Now, one thing which is imperative from this discussion, which we come to know, is that we must meet, that the board of directors must meet in order to take decisions. And since their meeting is mandatory, they must meet. Companies Act has put in some mandatory requirements about board meeting. Starting from section 173(1), we come to know about the minimum number of board meetings which every company must conduct. See, board meeting is, the matters can take place or they can, directors can vote directly from their place also through circulation, resolution by circulation, but that is something which is not allowed for every matter. There are certain matters for which it is clearly specified that you must meet to take decisions. Okay, you have read section 161. In section 161, there are 4 parts. Section 161(1), additional director, section 161(2), alternate director, section 161(3), nominee director, and 161(4), casual vacancy. Now, out of these 4, only 161(4) says that resolution at board meeting. That means this is a section which clearly specifies that the resolution has to be passed at board meeting only and the resolution cannot be passed through circulation. So a lot of times matters are being specifically reserved for board meeting. So for all the other 3 cases, you may have a resolution by circulation, but not for this one, right? So there are restrictions which have been imposed. Moreover, we have a section 179, which says that certain powers are exercisable by the board only at the board meeting. Okay, so although decisions can be taken through circulation also, but still it is imperative that the board meet, so that all the directors are aware about what is happening in the country and moreover to take the decisions which are being specifically reserved for board meeting. Okay, now what is the requirement? First, board meeting has to be held within 30 days of incorporation, and thereafter every company is going to have a minimum 4 board meetings in every calendar year. In every calendar year. The gap between 2 board meetings is not going to be more than 120 days. So maximum gap 120 days. This is the general rule that we have for all types of companies. However, there are certain exemptions.
Now, before I go on to exemptions, you have to understand that even if the meeting is adjourned, that also has to happen within the time limit specified. That means if you call a board meeting, it is adjourned and held after 4 months, the gap between two board meetings should not exceed 120 days. So this applies to adjourned meeting also. Now, for Section 8 company, we have the requirement minimum 1 meeting in every 6 months. I hope you understand and remember the difference that I have told you in classes. 6 months and half year. So that's a difference and you must understand and remember that. So Section 8 company, 1 board meeting in 6 months. OPC, small or dormant company, 1 meeting in half year. Minimum gap should be 90 days. Minimum gap. Here maximum gap was specified, here minimum gap. Now, private company which is startup, again the same thing as of OPC, small company and dormant company. OPC with 1 director only, the section does not apply. See, meeting, introspecting, all this does not happen when you're talking about company. When you have to take the decisions of company and you are the only one to take decisions, why you will call a board meeting and meet with your own self? Obviously no, right? So you will not meet. Then comes your section 173(2), which talks about video conferencing. That means a board meeting may also happen through video conferencing. I'm not telling you over a telephonic call or a teleconversation. No, it has to be AV, audio, visual, both. So it may so happen. That means a director, if he is unable to attend the board meeting physically, he can also attend the board meeting virtually. So we have a whole procedure which is being listed when the meeting is happening virtually or when the directors are participating virtually. So what is the procedure that's going to be followed? What are the requirements that are going to be followed? What is needed? So section 173(2) read with rule 3 and 4. So that's how we are going to read it. I mentioned this before that earlier there was rule 4 which prescribed certain matters which could be dealt only at a physical board meeting, but now those matters have been removed. That has been omitted. So now we don't have any matter which is specifically reserved for a physical board meeting. Okay, fine ma'am. So a director can attend in person or can attend through video conferencing only. The only requirement is that whenever a company is going for a virtual meet, it has to ensure that whatever setup it is establishing, it is capable of recognizing the people and recording the director's presence and storing everything along with date and time. Moreover, the chairperson and this company secretary who are responsible for convening a board meeting, they have to make necessary arrangements to avoid any type of failure and should take reasonable care for these. See, whenever a board meeting is happening virtually, it's a welcome move. Undoubtedly, it's a welcome move by the government. But there are issues with respect to confidentiality, security and other like matters, right? If we are in a closed compact conference room and a board meeting is taking place, we are sure that no one else who is not entitled or authorized is listening to us. But if we are sitting here out in open and everyone is participating through different places, there might be some insecure surroundings. There might be, right? So this raises a doubt on the confidential matters of any company. However, duty has been imposed on the director as well as the company. That director also has to ensure that you are not around anyone, and the company also has to ensure that the director is sitting alone and only authorized access is being given to the in the board meeting. Right? Fine. So what has to be taken care of? Security and integrity, availability of equipment. All the proceedings will be recorded and thereafter minutes will be prepared. You have to safely keep the records for future. You have to ensure authorized attendance only, as I just mentioned. However, if a person is disabled and requests for an attendant, then that person will be allowed one, and ensure proper audio visual. Okay, so these are the requirements which must be fulfilled, and then only you can go for VC. What is the procedure? And one more thing, is AV mandatory? If a director is unable to attend a board meeting, he requests the company to provide for audio visual facility, and the company ignores and rejects the plea. Is it valid? I would say no.
It is mandatory that you provide audio, visual or video conferencing facility to the directors if they want that. Okay, for this we also have a case law, Achintya Kumar. Now, what is the procedure? Because normal board meetings, people come, we count, we see things, right? We see things, we hear things, we are in a closed compact room. How the things are going to happen over video conferencing, that is also the procedure which has been laid down. What is the procedure? The first requirement. Well, if you want to call someone for your birthday, for your anniversary, for anything, you must give an invitation, right? Or even if it's not a very formal invitation, you must at least notify. If I want to call you for a class, I will at least have to notify when that's going to happen, where it's going to happen, at what time, place, all these details, right? Likewise, when company wants to call its directors, either physically or virtually, it's their choice. They have to at least inform the directors. How do they inform the directors? By sending notice. What is to be included in the notice? That we will read in section 173(3). Later on, in the same section, we have the provision of notice also. But right now, I am concerned about one particular part in the content of notice, that is an option of VC. So when a director receives the notice of board meeting from the company informing when board meeting is going to take place, he's also given an option that the meeting may be, you can participate in the meeting through video conferencing, and this is the information with respect to that, right? So this is the disclosure that's given in the notice. I have received the notice, so I will attend the meeting. But this is something which is not very common, although it's becoming common. But I have to intimate the company that I am going to attend through VC so that company can make adequate arrangements. If I don't intimate anything, it is deemed that I am going to attend in person. Fine. So I informed the company made adequate arrangements keeping all this in mind. And I attend the meeting through video conferencing in the mode as has been specified by the company. What happens is that at the board meeting, the chairman is going to ensure quorum. The next question arises, what do you mean by quorum? Quorum is the minimum number of directors which are required to constitute a meeting. Only then the meeting can proceed. The question is, ma'am, do the quorum need to be physically present or it can be virtually present? See, it may be a situation that all the directors are virtually present. It may be a situation that some are physically present and some are participating through VC. Never mind. The directors who are physically present as well as the directors who are virtually present, they both are counted for the purpose of quorum. So we count the physical directors. If they're present, it's a physical board meeting, right? And that we don't need to compute further, right? So that is how the case is. Once quorum is there, the meeting begins. Then happens the roll call. Roll call is like an attendance. You must have seen a lot of CBI inquiries or police inquiries in movies and web series. What happens? They ask or they interrogate, and the first thing that they ask the accused is that, tell your name. Although I know the name, but still I ask them to tell the name for the record. Right? Same thing is happening here also. The directors are being asked to tell their name, the place from their attending the meeting, the fact that they have received the agenda, and the confirmation that no one else is around. So they have to give this for the record. Although the chairman clearly knows that particular director, but still a roll call happens for the record. Then what will happen? Of course, the meeting has started, there will be people discussing and then there will be voting. So when the people are discussing, there might be these directors also who want to participate and contribute to the discussion. So whenever they contribute, they will identify themselves, and if their voice gets disturbed by any means of disturbance, they will repeat it. Okay? And then voting happens, voting again, roll call, voting. That's how it happens. The chairman at the end announces the summary, and everyone, if they have any objection, they can raise it. After that, the minutes are drafted. That is the true and fair correct summary is being recorded or is being put in writing. Once it is written, it is circulated to all the directors who attended the board meeting. Okay, so they have the chance, they have the option of raising or of commenting on the accuracy within 7 days. If they don't comment on the accuracy, or if they don't have anything to say, it is deemed approval, and if they have anything to say, accordingly they raise that objection. After that, it is going to be entered in the minutes book. The minutes book is prepared under section 118, and is open for inspection under section 119, right, and is signed by the chairperson. Clear? Fine now. Then we have section 173(3), which talks about the notice of board meeting. See, what are you concerned in the notice? You have to inform the directors. What do you have to inform? Date, place, time, venue, option of VC, and agenda. What are we going to discuss in the meeting, right? And when we have to inform? That means if the meeting is commencing at 1 p.m, I cannot call at 12 and say the meeting starts in 1 hour at this particular place, right? A lot of cities where the traffic is huge or commuting takes time, they will not even be able to reach, even if they are willing to and they leave immediately, then also they might not be able to reach, right? So there has to be a sufficient time given to the directors to prepare themselves for the meeting, to make themselves available for the meeting. So ideally 7 days time is required. So company gives 7 days notice to all its directors. No particular form of notice, 7 days notice in writing to every director, either by hand delivery or by post which has a proof, or by electronic means at his address which is registered with the company. If you don't give notice, then 25,000 fine on officer in default. Fine. Now I said one particular point with a lot of emphasis, that is agenda. What is it? Agenda is the matter which we are going to discuss. Now, Companies Act does not make it mandatory to give agenda along with the notice. However, as a part of good secretarial practice, it must be sent, and if we talk about the practical world, it is always sent, because the directors must know what are we actually going to discuss. However, this may so happen that 3 agendas are specified and the chairman wants to take up any other matter which is required, and a board meeting is already in existence, so they can take up that matter, right? Simple reason being because the agenda is not mandatory under law. Fine now. Now, a lot of times this also happens that we don't have time. We don't have time to wait for 7 days to discuss a particular matter, and that's why we want the directors to come together at a shorter notice. So this is also something which is permitted for urgent matters, but there is a requirement. What is the requirement? That one independent director must be present in such a meeting which has been called at a shorter notice. Now, this may so happen that that no independent director is available or no independent director attends that meeting. So, there is another solution. What is another solution? It is, supposedly a shorter notice is given, meeting called, no ID attends it, no independent director attends it. So, circulate the decision to all the directors, and if at least one independent director ratifies it, then it's going to be valid. Ma'am, what about the companies in which we don't have independent directors? This is not the requirement, so you can call the meeting at a shorter notice. Simple. Okay. So, this restriction has been placed on those type of companies only which have independent director. Okay. Sometimes students have this confusion that, ma'am, can board meeting be held on a holiday? Yes. Can it be held outside business hours? Yes. Can it be held outside the city or registered office? Yes. It can be even held outside India. Okay. So, board meetings, that is something which is very well possible. Okay, fine. Now, section 173(4) is only about the penalty that I have already told you. Moving on to the next part, section 174, that is quorum of a board meeting. Quorum is the minimum number of members which are required to constitute or to validly conduct a board meeting. 1/3 of total strength or 2, whichever is higher. Although articles may specify an even larger or higher quorum, articles don't have the power to specify a lower quorum as it will be non-compliance of law, but it can specify a higher quorum. So articles may say that in my company the quorum will be 5 directors. So irrespective of what section 174 says, you have to have at least 5 directors to conduct a board meeting. Fine. Okay, fine, ma'am. Now, what if the quorum is not present, what is going to happen? The meeting will be adjourned. If quorum is not present, the meeting will be adjourned according to what articles say. If the articles don't say anything, it will be adjourned to same day, same place, same time next week. Supposedly at the adjourned meeting also quorum is not present, the meeting will be cancelled. In general meetings, we have read the opposite. What we have read in general meetings is that if in the adjourned meeting also quorum is not present, the members who are present shall be deemed to be the quorum. This is not the case in case of board meetings. Fine. So in board meetings and general meetings, this particular provision is different. Fine. Okay. Now one more thing that you have to understand, that what is interested directors? Who are interested directors? We have a section 184, in which we talk about the disclosure of interest and like things. See, there might be a situation that I am a director and the company is entering into a contract with my father. So I would definitely want that this contract should take place because I'm interested. Somehow I have an interest, and therefore my discussion, any contribution to the discussion, any contribution to the voting cannot be unbiased. Or even if I am so competent to be unbiased, others might not believe it, right? They will still have the feeling that I will give a biased opinion only. So Companies Act prevents such a situation and tells the directors who are interested to not be a part of such meetings, to refrain yourself from participating in such meeting and voting in such meeting in which you are interested in any contract. Okay, fine, ma'am. Now, supposedly there are 9 directors, and out of which 2 directors are interested. So 1/3 of 9 comes out to be 3 or 2, whichever is higher. So out of these 7 remaining directors, you can have at least 3 directors who are present and they will constitute the quorum. That's not a problem, because interested directors, since they cannot participate in the meeting, they are also not a part of quorum. Fine. But let's imagine a situation. There are 9 directors and out of which 7 directors are interested. So if I calculate 1/3 of 9, it will be 3. We don't even have 3 directors who are not interested, because 7 directors are interested. We just have 2 non-interested directors. So in such a situation, there will never be a quorum. So for this situation, it has been specified that if the interested directors at any time is more than or equal to 2/3 of the total strength and higher of number of disinterested directors or 2 directors shall be the quorum. Okay, it shall be the quorum. Now, one relaxation in private companies, because in private companies you will be interested in almost all the contracts and you are only the member, you are only the director. So if you are interested, you are allowed to vote. It's just that you have to give proper disclosure. So this does not apply to a private company. Now, for section 8 companies, quorum is different. 25% of total strength or 8 directors, whichever is lower. However, in no case it shall be less than 2. Okay. Now let's imagine a situation, ma'am, my articles say that you need 5 directors to be the quorum and I have only 3 directors. So how? Because my 3 other directors have died. So how can I get 5 directors? How can I conduct a board meeting? In such a situation, you can call a board meeting even with lesser number than the quorum to increase the directors or to call general meeting. So for these 2 purposes, even if there is no quorum, the directors may act. Okay. Section 175, passing of resolution by circulation. One thing that I have already told you, that resolution by circulation is not allowed in all cases. For the cases where it has been specifically mentioned that you have to deal with this item at board meeting only, then board meeting is needed. We are reading about the notice, we are reading about the quorum, all for the board meeting, not for passing resolution by circulation. So here we don't have any such requirement. What is the process then, ma'am? You draft a resolution, attach necessary papers which help the directors to take a decision, and send it to all the directors by hand delivery, post or email at their address. If you get approval by majority, then in the subsequent board meeting you will note it and include it in the minutes that such a resolution was passed. Okay. Sometimes it may so happen that I have received this draft resolution and I sincerely feel that this is a matter which should be taken up at the board meeting because it needs a lot of discussions. So, if 1/3 of directors require that the resolution should be passed at board meeting, then chairperson shall decline this particular thing and they will call a board meeting and the matter is going to be decided at the board meeting. Clear? The matter is going to be decided at the board meeting. Then comes your section 176, a very small section which just talks about the defects, or you can say validity. See, a lot of times it may so happen that we appointed a director, his appointment was defective, or some disqualification gets attracted to him, or he has to vacate some office, some grounds of vacation has been attracted to him. But he doesn't know. The company is not aware. In such a situation, he continues to act as a director even during that period of disqualification for say 6 months, 7 months. Now during this tenure, he has passed a lot of resolutions, he has taken a lot of decisions, he has entered into a lot of transactions with other parties, third parties. Once we come to know that his appointment was defective, that means he was not a director, proper director, and that means all the acts that he has done as a director are not proper. That means we have to reverse all the acts. The answer is no. Section 176 gives us a clarity that if the director appointment was invalid by reason of defect, disqualification or termination, then whatever acts are done by the company whatever acts are done by the director till company becomes aware of it, they shall be deemed to be valid. Okay. So after his appointment has been noticed by the company to be defective, thereafter all the acts will be invalid. But before that, the acts will be valid. Okay. Before that, the acts will not be considered to be invalid. Just a second. I try hard not to waste your time because I understand you are into such heavy professional studies, and at this particular time, if at this particular point, if I am asking you to devote 1 hour with me, then I have to understand the importance of that 1 hour, and I cannot be like only half an hour to be productive and half an hour some chit chat or this example or that joke. So I refrain from cracking a lot of jokes when I'm into serious studies. Of course, for the flow, for keeping the classes entertaining, you know that we need stories, we need jokes, we need situations every now and then, so that has to happen. But of course, when I'm doing this continuous revision, I don't want to waste your time, and that's why I am trying to be as quick as I can. If you still want that the flow should increase somehow, you can increase the speed, but I wouldn't a lot suggest you that. For the topics wherein you are very confident, you may skip this revision, you may increase the speed, but for the topics you are not very confident, then this is going to help you only, right? So you can revise along with me. I'm trying to cover all the aspects of all the complete section. I'm not leaving anything for you. Now, section 177, Audit Committee. See, 177 has two aspects, Audit Committee as well as Vigil Mechanism. And section 178 has NRC and SRC. First, we'll talk about section 177, Audit Committee. Or as of that matter, any committees that we're talking of. What are these committees? They're nothing but a group of directors of the same company. So, they are dedicatedly being appointed to the cause of something. When I'm talking about audit committee, they have been some directors who have expert knowledge in finance or who understand finance, who understand the financial statements and all, who understand how audit is being conducted, what is the importance of audit and like things. They are being included in this committee. What do?
They see that which auditor should come, so they can give recommendation with respect to auditor, his remuneration. They can see how audit is being performed. They can see other internal controls of the company. They also have to approve some related party transactions, right? So they investigate into certain matters. So not just audit, but overall control of the company. So they have certain powers and they have some certain functions that they need to discharge. So they are going to oversee all those things. Okay. Ma'am, do we need audit committee in all types of companies? The answer is no. See, as the company grows and expands, then you need specific expertise areas. Otherwise, one person can handle it all. One person can handle audit also, he can handle the employees also, he can handle the operations also. So even if you have 2 directors, they can handle everything. But as company grows, you need different dedicated team to handle things. So the companies which are required to appoint independent directors, the same companies are also required to constitute audit committee. Okay, that means listed public companies or public companies which have paid up capital of more than equal to 10 crores, turnover more than equal to 100 crores, loans more than 50 crores. So these companies are required to constitute audit committee, which is mandatory. JV, that is joint venture, wholly owned subsidiary, dormant, not applicable to them. So they are not required to constitute. Now, we need to understand what is going to be the composition of audit committee, what are the powers that they have been given, what are the functions that they need to discharge or they need to perform, any disclosure and punishment for not doing it. The punishment is not given over here, it is given under section 178. So we don't have any punishment which has been specified in section 177. For the for contravention of section 177 also, the punishment is stated in 178 only. Okay, now composition. Minimum 3 directors, of which majority shall be independent and with the ability to read and with the ability to read and understand financial statement. They have to be financially literate, not just literate. Okay. What do? They recommend auditors' remuneration. One important point to note over here that they recommend. They cannot impose their decisions on the board. It is board's discretion only whether they want to appoint or nominate the auditors. Appointment of auditors is a matter of ordinary business which is being dealt at the general meeting of the company, but board nominates the name of the director, nominates the name of auditor. This name is being suggested by the audit committee. When an expert is giving you a recommendation, you must follow it. Although it is your life, your decision, you might not follow it. But when you reject that expert's recommendation, you must have a strong backing reason for that. The same goes for the board. Board, if you are not accepting the recommendation of audit committee, you must disclose the reasons in the board's report why not, along with the composition of audit committee. Fine. So they recommend, then they review auditor's performance, how the auditor is performing, so that we can give a feedback, no, this auditor is not correct, we should not reappoint this auditor, or this is performing brilliantly, what is happening, right? Then examining the auditor's report. If auditor has given any qualification in his report, then you are going to discuss it with the auditor, why this particular qualification has been given. If it is a clean report, no problem at all. Right, but then you will see on what aspects auditor has examined, on what aspects auditor has not examined, what are the things that are happening in the company. So it also acts as a bridge between the management as well as the auditor. Then scrutiny of loans, assets, internal control, monitor use of public funds, additional things, and approval of related party transactions. So section 177 out here is read with section 188. One by one we'll do it. Now, to discharge all the functions, you also have been given certain powers. You can call for comments of auditors, you can review financial statements, you can discuss issue with the auditors, you can investigate and oversee vigil mechanism.
we'll do this later after we do this. Fine. Now, what is related party transaction? What is related party transaction? For this, you need to understand what is a related party. Section 2, clause 76 defines related party. Company, the director of company, relative of director. KMP is relative. Any firm in which they are a partner. Any private company in which they are member or director. Any public company in which director or manager is the director and holds more than 2% of paid up share capital of the company along with its relatives. Then any body corporate according to whom you are acting, or the body corporate who is acting on according to you. Then we have holding subsidiary, associate, investing company, subsidiary of holding, any other as may be prescribed. So all these are related parties. All these are related parties. Company enters into a contract with the related party. Company is buying some goods from related party. Now this is a contract which is specified in section 188. I'll repeat. Section 188 has 7 specified transactions if entered into with related party needs approval. Approval from audit committee, approval from board, and if ceiling limit exceeds, then approval from members also. So audit committee approval, board's approval, as well as members approval if ceiling limit exceeds. Members approval is needed only if ceiling limit exceeds, right? That means you need audit committee's approval also. So audit committee will grant the approval. Fine, ma'am. Audit committee has an option to give omnibus approval also. What is omnibus approval? It is one-time approval. See, if the transaction is not covered under section 188, of course you don't need to give any approval, you can only give recommendation. If the transaction is covered under section 188, then you need approval. But even within that, if the amount is less than 1 crore and you don't take approval from audit committee, then audit committee can ratify it within 3 months, and if not, it is going to be voidable at the option of audit committee. But if the amount is more than 1 crore and the transaction is specified under section 188, then either you can take approval transaction wise or you can take prior approval for maximum 1 year. Okay. For this, audit committee is going to check how repetitive the transaction is and how justified the transaction is. So based on that, they will give prior approval for the whole year. That okay, this is the maximum value, that during the whole year, maximum up to 1 crore you can enter into transaction, or maximum up to 10 crores. Per value transaction is not going to exceed 1 crore. You have to make these disclosures. These transactions are not permitted, and I'm going to review from time to time. Okay, so this, by imposing such conditions, audit committee can grant omnibus approval for related party transactions which need approval under section 188. Clear? If you contravene this, penalty is there. This is the penalty which is given under section 178. Clear? Now, audit committee is also required to oversee vigil mechanism. What do we mean by vigil mechanism? Vigil mechanism is set up for the benefit of employees, for the benefit of directors, so they can report their concerns, their grievances directly. A lot of times it happens that employees are being caught in the web of manager or the exact upper hierarchy. They don't have the access to move to higher authorities. They don't have any access to complain. They don't have any medium to complain, right? Even if they go to their own manager for complaining about him only, he's not going to listen. So for such purposes, for the companies, if your company is a listed company, if your company has accepted public deposits, or if your company has borrowings more than 50 crores, then in these situations, it is mandatory for the company to establish vigil mechanism. Okay, now, vigil mechanism is just a system where you can register your complaints, where you can have access to people who will listen and resolve your problems. For the companies which have audit committee oversees the vigil mechanism. In many companies, it may so happen that you don't have audit committee, but because you have accepted some public deposits, you are required to establish a vigil mechanism, and therefore you do it. So in such a situation, the board is going to nominate a person to oversee vigil mechanism. It also happens a lot of times that people take undue advantage of the system and they file unnecessary or frivolous complaints. So in such a situation, action will be taken against that employee also. I'm sorry. Clear? Fine. So this was about section 177. Now we move to section 178, NRC and SRC. Who is required to establish NRC and for what reason? NRC is again being established by those companies who are required to have independent director or who are required to constitute audit committee. So the same companies are also required to constitute NRC. What is NRC meant for? NRC is going to identify persons who should be appointed as director, who are deserving ones, who are required in the senior management, who should be removed. Formulate the criteria. In fact, even develop the criteria for evaluation of the performance of board, that he is a director who is performing really well, or he is in the senior management, he can be promoted as a board of directors. So this is the criteria that I have developed for evaluation of performance, like who attends at least 7 board meetings. So this is the criteria that they have maybe set up. Now this can be evaluated by them only, or it can be evaluated by some external agency also, or by the board also, right? So all this is the function of NRC. The composition of NRC is slightly different than audit committee. Here you need 3 directors, only non-executive directors, 3 or more, at least 3 non-executive directors, of whom half shall be independent directors, Now, whoever is the chairperson of the company can become the member of NRC, but he will not be the chairperson of NRC. He is the chairperson of company, he is an executive director, he can still be the member of NRC, but he will not be the chairperson of NRC. Clear? Okay. Then we have Stakeholders Relationship Committee. Ideally, when we talk about stakeholders, we include everyone, be it government, be it our suppliers, be it our employees, be it our vendors, all of that. But here, stakeholders mean the persons who have invested into the company. They are the security holders, they are shareholders, they are deposit holders as well, they are debenture holders, they are any other security holders. So collectively, if this number exceeds 1000, then comes the requirement of SRC, that is Stakeholders Relationship Committee. What are they going to do? Vigil mechanism for the reporting of complaints by employees. This is also for reporting of complaints or grievances or problems of stakeholders. Some might not have received the dividend, some has the issue with respect to share warrant, etc., etc. There can be ample of things, right? So they can file their grievances. Stakeholders Relationship Committee, a group of dedicated directors who are going to oversee that all the problems are being resolved or not. So the basic idea is to protect the interest of all security holders, okay, not just your equity shareholders, but all the shareholders, right? Now sometimes it may so happen that I'm genuinely trying to resolve a problem, but the other person is not listening at all or is in some other angle. So if you have tried to resolve the problem in good faith and you are unable to do that, then it will not be deemed to be contravention of the same. Okay, so no contravention if inability to resolve the problem in good faith. You have the penalty. What is the penalty? 5 lakh and 1 lakh. Section 177 plus section 178. So if you contravene any of the provisions of these sections, then this is the penalty. Penalty on company 5 lakh and penalty on officer in default 1 lakh. Right? Now, section 179, powers of board, or I can say powers exercisable only at a board meeting. See,
First thing that you need to understand for this section is that what board of directors can do. Anything that a company can do, its board can. What company can do? Company has to comply with Companies Act. The board also has to comply with Companies Act. Company has to act within the purview of its memorandum of association. So will the board. So you have to understand that anything that a company is permitted to do, its board can do. But there are some powers or there are some acts which only shareholders can do. Like altering the articles of association. A company is permitted to alter its articles even after it has been drafted, but this power has been specifically reserved for the shareholders. So such a thing cannot be done by the board of directors. So all the acts which a company can do within Act, MOA, AOA or any regulation which the shareholders have imposed in general meeting. So within these powers, board can do all the acts which company can do, but board cannot do the things which are specifically reserved for the shareholders. Now, so board has ample of powers. Out of these ample of powers, there are certain things which have to be dealt at board meeting only. These powers cannot be exercised, or these matters cannot be dealt through resolution by circulation. Okay. So BR in BM is needed. That is, board resolution and board meeting is needed for transacting these items. That means whenever you want to call money on shares. See, I have given you a mnemonic of learning this. I hope you remember that and you have learned this well. Calls on shares, buyback, issue of securities, approval of merger, diversified business, approval of financial statements, political contribution, takeover, appointment of KMP, internal statutory auditor, removal of KMP. And then you have big powers. Borrowing money, investment and giving loan guarantees security. These two are covered in section 186 and this is covered in section 180. So section 180, company can borrow. Company can give loan, company can invest, company can give guarantee, company can give security. Company can do this. It is not such that these things are not permitted. These matters can be dealt only at a board meeting. However, these three big powers, big powers can be delegated. You call a board meeting, you pass a board resolution, resolved that the power to borrow money has been delegated to managing director of the company. He is now empowered to borrow money on behalf of the company. The maximum amount that he can borrow is this, etc., etc. So by imposing all those conditions, you can delegate the power to a managing director, manager, commercial, the principal officer of the company or branch, right? He can be a director also. So I hope that's clear. Now, board of directors has all the powers which company has, subject to act, memorandum, articles and regulations. Now, there are around 13 matters which require board resolution at board meeting. Only then they can be discussed or they can be dealt with. Out of these 13 matters, there are 3 matters which can be delegated, right? Now, we come to section 180, borrowing. This is the major thing that is given in this section. Section 179 tells us that the company can borrow, but to borrow it has to hold a board meeting. However, it may also be delegated to someone, but whatever power is delegated, it has to be within the limit which is given in section 180. What does section 180 tells us? Section 180 restricts the general and vast power that has been given to the board. The board can borrow. The board can borrow money. Section 180 tells, hold on, you can borrow only up to this amount. If you want to borrow more than this, you need to go to the members and take special resolution. You need to pass SR and take their approval. Moreover, you also need SR for these things.
So in these 4 cases, SR is needed by the board of directors. Case number 1. Company wants to sell its undertaking. What is undertaking? Undertaking is a separate unit. How do we identify whether a particular venture is an undertaking or not? If that particular venture is giving you or is worth 20% of net worth, more than 20% of net worth, or it's generating more than 20% of income, then it's an undertaking. So if you want to sell off that undertaking, the board cannot take decision on its own. It has to go to the shareholders and get a SR passed. If the company wants to sell only substantial amount of undertaking, not the whole undertaking, but a substantial amount of undertaking. What is substantial amount of undertaking? 20% of that undertaking. So if you want to sell that, then also you need SR. Clear? Sometimes on merger, you have received some amount. Company has received some amount. Now you want to use this amount for some purpose. It's not your money, it's the money of shareholders. You need to take their permission and then only you can use this amount. Supposedly, company has given some loan to a director. Now, can company give loan to a director? Yes, subject to section 185. Subject to section 185. Supposedly, company has given loan to a director and now the director is unable to repay. The director comes to the company and says, I need 1 more year. The board says, okay, fine, take it. Today is your day, tomorrow our day will come. No. The board does not have the power to give extension to the director. For this, you need SR. And lastly, if the amount of borrowing exceeds a particular limit, what is the limit that has been given? Borrowed plus proposed exceeds paid up capital, free reserves, securities premium. If this exceeds, then SR is needed. If it does not exceed, then SR is not needed. That means if your total borrowings are less than equal to paid up capital, free reserves or securities premium, then you don't need SR. If it exceeds that particular amount, then you need SR. In this section, in this particular point, we have a concept called as temporary loans. Temporary loans, what are they? Temporary loans, like you have any short-term loans, they are not going to be part of that borrowing. For example, if there are short-term loans 50 lakhs, and then you have long-term loans again 50 lakhs, and the company proposes to borrow further 50 lakhs. So how will I compute this limit? I will say that my existing borrowings is 50 lakhs and my proposed borrowing is 50 lakhs. So 1 crore is the total borrowings. Now if this amount exceeds this, then I need SR. So I will also calculate paid up capital plus premium plus free reserves and I'll see which one is higher. If my borrowings is less than or within that limit, then I don't need SR, otherwise I need SR. Okay. Section 180 does not apply to a private company. So in private company, the board can borrow any amount that they want to. They don't need to get any special resolution. So for private companies, you can borrow any amount that you want to. There is no restriction or there is no limit which has been imposed. Fine. Section 181. Contribution to bona fide or charitable funds. This is a very small section. Company wants to contribute to these funds, you can. If you want to contribute up to this particular percent, it is within board's limit, and if it exceeds more than 5%, then you need OR. And then you can contribute. Then comes your section 182, which is political contribution. Again, a lot of students have this problem that, ma'am, why political contribution is so liberal that any amount, you can contribute any amount. So I have told you the logic behind this, right? See. Any company other than government and a company which has been in existence for less than 3 years, they can contribute, they can give any amount they want to a political party. It's just that cash contribution is not allowed. They have to either contribute through check, draft, ECS or instrument. So they can. They just have to disclose in P&L account. Okay, fine. Contribution to National Defence Fund
this is an overriding section. It overrides everything. It says that if company wants to contribute to NDF, National Defence Fund, or any other approved fund for defense, go ahead. Even if your articles restrict you, then also you can. There will be no contravention, absolutely no. Okay, fine, ma'am. If you contravene this, there is a penalty. This reminds me, if you contravene section 179, section 180, section 181, that is powers of board, then you have restriction on powers of board, and even if you have charitable contributions. These three sections that we read before, they don't have any penalty which has been specified. That means, ma'am, we have been given that we have to discuss this matter at board meeting only. But supposedly we don't discuss this matter at board meeting and we pass a board resolution by circulation. What is the penalty? You have the penalty which is not specified for the section. So you go to a specific section of penalty, which is section 450, general section of penalty. So for all the sections where a specific penalty has not been specified under Companies Act, we have a general section, section 450. Now, disclosure of interest by director. A director has to give disclosure of interest. For this, again, we come back to our related party. For the students who have not done very thorough study, might not understand that what is the connection between related party and section 184, ma'am. Section 188 is for related party, section 184 is not for related party, but you have to understand that there may be situations when both the section applies. Why? Because we have interest in our related parties. No matter how much we say that we are interested in our neighbors or this or that or this or that, no, we are interested in our family, our relatives, our people. Right? If my mother is being appointed as one of the employees of a particular company, I'll be interested in that contract. If some XYZ person is being appointed, I'll not be interested. So my interest is somehow connected with related party, though it may not always happen so. Now, if I am a director, I have to check in which companies I have the holding, in which firm I am a partner, where body corporate, where association I'm interested. And I have to give all these details in the first board meeting in which I'm participating as a director. I've been appointed as a director. In the first board meeting that I participate, I have to give this disclosure. Thereafter, every year in the first board meeting, I'll give disclosure. And if there is any change in my interest, then after the change in interest, the first board meeting that happens, there also I'll give disclosure. So I have to give disclosures in this manner. The form specified is MBP 1. I give the disclosure. The company maintains a register MBP 4 for recording these things. Okay, fine. There is another subsection, section 184(2), which is more important for examination point of view, that deals with specific disclosure. Specific disclosure. Now, this is when the company enters into a contract or arrangement with body corporated firm and the director of the company is interested in such body corporated firm. Now, this interest has been specified. Section 184 interest has not been specified, so you have to give disclosure in all respect. But here, you have to give disclosure only when you hold more than 2% of paid up capital, or your promoter or manager of CEO and partner or owner of the firm in case of firm. So you have to, if above situation arises, then this director must disclose his interest in the board meeting in which first time the contract is discussed, and he shall not participate in it. Supposedly there is contravention of the same, the contract becomes voidable, such director has to vacate office and there will be a fine of 1 lakh on interested director. Okay. Again, it does not apply to private company, because in private company, the directors who are interested, they can vote. After giving the disclosure, they can vote. Fine. Moving on to our next section, section 185, that is loans to directors. See, the first thing, company is prohibited to give loan, guarantee or security to the directors
of the company, the directors of holding company, the relative of such director, partner of such director, and a firm in which such director or relative is a partner. So you cannot give loan, guarantee or security to your director, to your directors of holding company and to other concerns in which the directors are related. This is the logic, this is the section which it says, but then it has exceptions. See, section 185 deals with such a situations when there is loan, guarantee or security to the directors or its concerned entities. If the director is not related to any entity, this case does not fall under section 185 because section 185 deals with loans to directors, etc. So we are talking about loans, giving loans to director directly or giving loans to the entities in which director is interested. So one is that prohibition, you cannot give to these people. Second is that you are permitted to give to certain people in which director is interested if you pass SR. If you pass SR. Okay, ma'am? Permitted to give loan to or guarantee or security to private company in which director is a director or member, body corporate whose board acts according to us, and body corporate in which we hold more than equal to 25% of voting power. So you can give to such entities in which director is interested. Loan can be given to such body corporates in which the director is interested if explanatory statement is given to the members and SR is being passed. Clear? Now, it's not applicable to private company if no body corporate has invested in that private company and the borrowings are within this limit and there is no default. It is also not applicable to government company if they have obtained the necessary approval from their respective ministry and no default of filing. Moreover, it is not applicable if loan is made to MD or WTD as employee. They are executive directors, right? That means they are employees of the company. So just like advance salary can be given to other employees, it can be given to these directors also. So fine. There might be some scheme which has been released by the company and in pursuance of that scheme you can take loan. So you can take loan, not a problem. There might be a situation when you give loan in ordinary course of business like NBFC or banking company. It is their business to give loan. So just like they give loan to other customers, they have given loan to director also. But obviously, when you give loan to your internal employees, to your internal directors, you give loan at some reduced rate. In any situation, your rate should not be less than the government security yield. If you will give loan to your wholly owned subsidiary, if you give guarantee to your wholly owned subsidiary, guarantee or security to your wholly owned subsidiary. So these are the exceptional cases where it is permitted, right? Where it is permitted. Moving on to next section. Loans, investments, etc. by a company, a very small section, section 186, or rather I would say it has two perspectives. Sorry, 186 is not a small section. It has two perspectives. One is putting a restriction on layering of investment companies, and the second is LGSI limit. First thing you need to understand for this section is what do you mean by investment companies, and since you have to understand about investment company, I'm going to take you over here. Investment company is what? Whose principal business is investing. How do you identify whether a company is investment company or not? See, if I want to check, I open a balance sheet of any company. If that's a factory, it will have a lot of assets as plant and machinery. So I come to know, okay, a lot of manufacturing is taking place in this company. Likewise, if I open the balance sheet of an investing company, I will see a lot of assets as investments only. So more than 50% shall be them. Or if I check the P&L account, I will see more than 50% of its income is coming from that investment sources only. Right? So that's how I identify whether a company is an investment company or not. Although we can talk about any type of company, there is a restriction on number of layers of subsidiaries. But this section 186 talks about investment companies only. It restricts the number of layers of subsidiaries to maximum 2. It does not mean that a company cannot have more than 2 subsidiaries. Undoubtedly, it can have hundreds of subsidiaries, but it cannot have more than 2 layers of subsidiaries, which means a company has a subsidiary, this company has another subsidiary, and this company has another subsidiary. So layer 1, layer 2 and layer 3. So layer 3 is not permitted. Fine. There are exceptions. What are the exceptions? Banking company, NBFC with net worth more than 500 crore, government company, insurance company. These are the exceptions. One more thing, that wholly owned subsidiary is not counted as a separate layer, that is merged with that company only. And. We have a company, this company acquires a foreign company. It becomes a subsidiary. Now this foreign company already has 5 subsidiaries, 5 layers of subsidiaries, I would say. 1, 2, 3, 4, 5. And this is something which is permitted in that country. So this foreign company is not doing anything unlawful. It is a lawful act. And now you want to acquire, you want to make this foreign company as your subsidiary. An Indian company wants to make this foreign company as their subsidiary. You can. So if Indian company is a foreign company, if the investing company is a foreign company with permitted more layers as per foreign law, it is allowed. Now we have other provisions of section 186. This is LGSI. Loan to any person or body corporate, guarantee with respect to the loan, security with respect to the loan, or investment in body corporate. This is shortly known as LGSI. For this, you need unanimous board resolution. So for giving loans to anyone, for giving guarantee, for giving security, or for investing in any body corporate, you need UBR. More than that, apart from UBR, if the ceiling limit exceeds, you also need approval from members. So what are the cases? UBR is must in all cases. If LGSI made plus proposed does not exceed the limit which has been specified. What is the limit? This is the limit. Higher of 60% of paid up capital plus free reserves plus securities premium, or 100% of free reserves plus securities premium. So you check this limit, you compute this limit. If your LGSI which is already there plus proposed exceeds this amount, you need SR. If it does not exceed this amount, no SR is required. Okay. Now, if it does not exceed the limit, no SR needed, you just need UBR. Plus you need PFI approval if there is default in repayment. If there is no default in repayment, no problem. Fine. But if your LGSI exceeds this limit, you need UBR. You also need SR, as well as you also need PFI approval. Ma'am, even if there is no default, yes. If it exceeds limit, you need PFI approval also. Fine. Apart from this, whatever loan you are giving, at least this has to be the rate. The minimum rate is going to be at least yield of government security closest to the tenure. Right, when we compute this 60% of paid up share capital, we have to take capital as both preference plus equity, as well as we deduct call scenarios which have not been received, because we are computing paid up capital. So whatever has been received, that only is taken. There has to be no subsisting default with respect to deposits. If there is, you cannot go for LGSI. Disclosure has to be fully made in the financial statements. Okay, full disclosure in financial statements. Apart from this, there is a register for LGSI which is being maintained, MBP2. This register is also going to be open for inspection by the members, and there is contravention. If the company contravenes these provisions, minimum fine 25,000, maximum 5 lakhs. So your fine can range between this. On the company and officer in default, imprisonment less than equal to 2 years, and again fine between that. Fine. Section 187, a very small section. Whatever investments you are holding, whatever assets you are holding, whatever securities you are holding, it has to be in your own name and in your own possession. Simple. That is the general rule. So company, if it is holding any investment, it has to be in company's name only. However, there are certain exceptions. Sometimes it is important that you have, for compliance of law, you have to hold it in your nominee's name, hold shares. Sometimes you give it to the bank for collection of dividends. Sometimes you have to transfer it to the bank for facilitating sale. Sometimes you transfer it, rather give it as a pledge for obtaining loan. Sometimes when your shares are in demat form, you're not the registered owner, your depository is the registered owner and you're just the beneficial owner. So in these situations, investments might not be in your own name. For this, you have to prepare a register in MBP3, which is going to be kept at the registered office, preserved permanently, and is going to be open for inspection. Section 188. Again, we have a punishment also for this. 5 lakh and 50,000. Okay. Section 188. Related party transactions. Now, see, whatever transaction is happening between the company and its related party, not all the transactions are covered under Section 188. First of all, if they are at arm's length price in the ordinary course of business, they are not covered. Secondly, if they are not at arm's length price in ordinary course, then we have to check whether they are covered under the specified 7 transactions. What are the specified 7 transactions? Sale, purchase or supply of goods or material, disposing of property, leasing of property, availing or rendering of services, then with or without agent, that is clause E, then appointment of OPP, office or place of profit, underwriting of securities. So these are the 7 specified transactions. If the company enters into a contract or arrangement with related party, the transaction which is specified under Section 188, you need BR. If it exceeds the limit, you also need OR. Simple. For BR, notice of BR will be, notice of board meeting will be sent with agenda explaining everything. At board meeting, resolution will be passed. The interested director is abstained from participating and voting. Next thing is we have to check whether it exceeds the limit or not. If it exceeds the limit, then notice of general meeting will be sent along with the explanatory statement and the ordinary resolution will be passed. Related member will not vote. If it does not exceed, no OR is required. No OR is required. Right? Transactions between 100% subsidiary and holding, no OR is required. Whatever transaction is being entered with the related party will be adequately disclosed in board's report. The next question arises in our mind that now what is the limit? What is the limit? If it exceeds limit, we need OR. But what is the limit? The limit, sale purchase of goods material with or without agent, more than equal to 10% of turnover, OR. Property more than equal to 10% of net worth. Leasing more than equal to 10% of turnover. Services more than equal to 10% of turnover. 2,50,000 per month and 1% of net worth exceeds that. Now, if the contract needed approval from board or approval from members, but that necessary approval was not acquired and the transaction took place, the contract was entered into, what happens in that case? Does the contract become void? The answer is no, it becomes voidable. First of all, it can be ratified within 3 months. Even if it is not ratified, it becomes voidable at the option of the board or the members, whatever the case be. Right? If there is any director who is involved, he is going to indemnify the company for the loss. Okay. You have the penalty. In case of listed company, 25 lakh. In case of unlisted or others, 5 lakhs. Right? Now we have very small sections remaining. Section 189, the register. So for section 184, for section 188, you have to maintain the register. MBP4, the register is going to be preserved permanently, kept in the custody of company secretary. When we give disclosure under section MBP1, that details are going to be included in the register. Register will be kept at the registered office. It is going to be open for inspection, produced at every general meeting, and there is a penalty for non-maintenance, that is 25,000. Then comes section 190, which talks about the contracts of employment with MD or WTD. See, whenever a company is appointing MD or WTD, it enters into a contract of employment. If there is no contract of employment, then it will at least have a memorandum of understanding where the terms are being boiled down to writing, right? Whatever it is, it has to be kept at the registered office of the company, and which is going to be open for inspection for members. This is not for private companies. So only in public companies this is going to be an open thing for members, right? Again, there is a penalty, fine less than equal to 25,000 and 5,000 respectively for company and officer in default. Section 191 is somehow related to 202.
Because here we compensate for the loss of office. Section 202 gives compensation only to MD, WTD and manager. However, this section gives compensation to all the directors. In case of sale of undertaking, sale of shares, takeover, there is any loss of office to the directors, then they can get compensation which is not going to exceed the compensation given under section 202. So within that limit, the compensation can be given. Compensation can be given undoubtedly to the executive directors as well as non-executive directors. So when I'm talking about executive directors, there are some restrictions. Since they are involved directly in repayment of deposits, repayment of debentures, repayment of bank loan, taxes, then payment of employee dues or dividend to preference shares or redemption of preference shares, if there is any default in all these, they will not be entitled to get compensation. The non-executive directors will still be entitled, but they will not be entitled, right? Moreover, an additional point to note over here is with respect to the quorum. Usually, see, one more important thing. When we are talking about section 191, we give compensation to all the directors by passing ordinary resolution. So when we are passing ordinary resolution, it may so happen that the meeting was adjourned and at the adjourned meeting also the quorum was not there. So deemed quorum and the resolutions were passed. This shall not be passed. No deemed approval in case of this section. Okay, penalty 1 lakh. Then we come to section 192. Restrictions on non-cash transactions, that is a kind of barter system. Again, this is not going to happen unless OR is passed. So if you want to enter into any transaction with a director which is non-cash, you have to take prior approval by OR, and the value shall be determined by the registered valuer. If it is not so obtained, if the approval is not so obtained, the transaction will be voidable at the option of the company. Okay. Lastly, we have section 193, that is contract by one-person company. It is absolutely nothing. One-person company is entering into a contract with the sole member, who is the director also. So what disclosures you will give, what board meeting you will hold, what permissions you will take, nothing required. You just have to enter it in the minutes book and you have to inform the ROC within 15 days about the transaction because he is a related party, right? So that's how things will take place. That's it with this particular chapter. Okay, let's now revise the chapter of inspection, inquiry and investigation, starting from section number 206 till section number 229. So it has quite a few sections. The initial sections, that is 206, 207, 208 and 209 relates to inspection and inquiry, and the later sections are all about investigation except a few parts which apply to all the cases. Now, there are three terms involved in this particular chapter, as you can very well see: inspection, inquiry and investigation. What do we mean by these three terms? Of course, these three terms are different and you have to understand the difference, then only you will be able to understand the provisions. Inspection is something that happens, examination of books and accounts. Inquiry is like asking people, interrogating people and all that who are involved. And investigation is something which is next level, the detailed examination of things. So maybe first of all, inspection is being ordered, and if the result of inspection creates even more suspicion that there could be some fraudulent activities going on in the company, then that results to investigation. So then investigation commences. Okay, so we have a whole flow of things. Let's start with section 206. Undoubtedly, this is a revision class, so not everything in absolute detail, but I'm going to explain you in such a manner that you understand the whole chapter. Section 206, company files a document. Undoubtedly, we all know that with ROC, a lot of documents is being filed, a lot of information is being received by ROC. Supposedly, ROC receives any piece of information for which ROC finds that the piece of information is creating some suspicion or is incomplete and seeks for more information. So at that particular point of time, ROC sends the first notice to the company. First notice, not for inspection, not for inquiry, not for investigation, but just for seeking some more information. On receipt of information, there are possible cases that you reply or you don't reply. And even if you reply or you reply with some extended time, the reply may be satisfactory, the reply may be not satisfactory, or the reply may be inadequate.
So in case when the reply is not satisfactory, the reply is inadequate, or you haven't replied at all, in all these three cases, registrar gets a reason to go for inspection. That means it will call complete books and accounts and papers and inspect them, right? So it gets a reason to do so. It will record the reasons and send you the second notice, which is of inspection. So now again calling off books and accounts, not just some piece of information, but books of accounts for inspection. Right? How inspection will be carried out? Inspection will be carried out according to section 207. Here one more power comes into picture, which is of central government. Central government may also, if it deems fit, can order inspection. So maybe ROC carries out inspection on its own, or CG appoints some inspector and that particular person carries out inspection. So quite possible there are two cases. Whatever it be, even if registrar or inspector, whoever is carrying out the inspection on whatever grounds, they prepare a report of their inspection which they are going to submit to central government, right? Now when they submit the report, they also give a recommendation that what is their analysis, what do they suggest, that could there be a probability of fraud involved? So should they go for investigation? What do they recommend? It's only their recommendation. This does not bind central government to initiate investigation. Okay, so it's just their recommendation. So report made and submitted to CG under section 208 with recommendation, then CG may carry out investigation. Now inquiry is also given in the same section 206, which tells us that any piece of information, again anyone approaches registrar or registrar receives some information and registrar is satisfied that some fraudulent activities are going on in the company, or there is non-compliance of provisions, or the grievances of people are not being addressed. So in these three situations, registrar, what will registrar do? Registrar will inform the company that these allegations have been imposed against you. If company can give an adequate reply, great. Otherwise, registrar will give an opportunity of being heard to the company undoubtedly, and thereafter initiate inquiry. In the same manner, CG had the power to initiate inspection. Here also CG also has the power to direct inquiry. So CG may appoint inspector for the same. So, and they'll carry out inquiry. So registrar or inspector can carry out inspection or inquiry as given under section 206. How they carry out inquiry or inspection? As given under section 207. So after the order of inspection or inquiry is passed, registrar or inspector, they call for books of accounts and other papers, and it is going to be the duty of the officers and employees, past plus present. They are going to produce books and papers, furnish information and give all assistance. If they don't, imprisonment and or fine, and if they do, then registrar is going to conduct inspection or inquiry. What powers are given to them? They get the same powers as of civil court. They can also place identification marks, take copies of the books, papers, etc. And after they have completed the inspection or inquiry, they will submit the report to central government as given in section 208. Now sometimes it may also happen that central government wants report in between inspection. The inspection is yet not over, inspection is going on, and central government wants some report, updation as to what is happening. In such cases, you have to submit interim report. So ROC or inspector will give interim report to CG if they so direct, and otherwise on completion of investigation, on completion of inspection or inquiry, final report shall be submitted. Now this power to receive report has been delegated to regional director. Next we have the section of search and seizure. This power is also given to registrar or inspector, but they have this power only when they take approval from central government. Sometimes it may so happen that they know, or during inspection or inquiry they come to know that there might be a situation that some documents of the company are missing, and these documents may be destroyed by people involved, or they may be mutilated, they may be secreted, they may be falsified. In such situations, you go to the special court, you obtain the permission of special court, not of CG but of special court. So registrar or inspector, after obtaining special court's permission, they can enter into the places, they can search and seize the documents. Seize documents means you are taking the documents into your custody. Now when you are taking the documents into your custody, the company might ask for some photocopies, so you'll allow them to take photocopies and seize the documents and take them with you. There is a limit of 180 days that you can keep these seized documents only for 180 days, and thereafter you're bound to return them. If you want to examine more, then you can again call them back, right? So you have to remember two important points in section 209, which is entering into the premises with special court's permission and keeping the seized documents only for 180 days. Why am I telling you to remember these two important points? Because when we read the seizure under investigation, this is a seizure over here. When we read about search and seizure under investigation, that is section 220, then these 2 points are missing in that section. No restriction to inspector under investigation. They don't need to seek any approval from special court. Moreover, they also don't have this restriction of 180 days. So exactly replica section is 220 with that difference. Okay, so that we will read. Now, these were the 4 sections relating to inspection and inquiry. Now we start with the sections of investigation. We have 5 sections of investigation. 3 sections about investigation into affairs of the company, 1 section about investigation into membership of the company, and another section about investigation into affairs of other companies, related companies you can say, right? So 210, 212, 213, 216 and 219. So we have these 5 sections of investigation. Now we are talking about the first 3 sections first. That is, you are investigating into affairs of any company, right? What happens? When can you investigate? That is the first question. When can you investigate? See, after submission of a report by the inspector or ROC, after they have done inspection or inquiry, they submit the report to central government along with the recommendation. Central government receives the report and central government, based on the report, decides whether I want to carry out further investigation or not. So on receipt of report, CG may order investigation. Secondly, the members of the company have a very strong doubt that some fraudulent activities are going in the company, so they pass a special resolution and they send the special resolution to company by suggesting that it is our wish that you must carry out investigation of this particular company. Again, CG has a choice. It may not. And in public interest also, CG may do so. So section 210, there are 4 grounds. There are 4 grounds on which investigation may be carried out by central government. However, the 4th ground, that is in front of NCLT, some proceedings are going on where NCLT or court discovers that this company has some problems, some serious issues, and investigation must be carried out. So NCLT directs CG to carry out investigation. So since an order is being passed, it is the duty of central government to carry out investigation. So in the first 3 instances, CG has a choice. In the last ground, as mentioned in section 210, CG doesn't have a choice and must order investigation, right? So whatever it be, CG may order, CG must order, the order of investigation has been passed. After passing the order of investigation, CG appoints an inspector. CG appoints inspector. In some cases, if CG finds that the case is big, the case is huge, the case is serious, and it needs more expert people to be employed to investigate into the fraud or the scam, possible scam, then in such a situation, CG doesn't appoint inspector to investigate into the case, rather assigns the case to a special dedicated office, which is SFIO. Serious Fraud Investigation Office, just like we have CBI. Okay, that is section 212. I told you there are 3 sections of investigation into affairs of the company. One is 210, where there are 4 grounds on which CG orders investigation. Second is 212, where CG assigns the case to SFIO. And third is 213, where members don't go to CG by passing SR. Rather, some eligible members go to NCLT and files a complaint. They file an application. And NCLT in turn, if finds suited, then orders CG. So you make a direct application to NCLT and NCLT orders CG, and thereafter investigation takes place. Ultimately, CG is only doing the investigation. CG is either appointing inspectors or assigning the case to SFIO. But then there are 3 sections. I hope you get that, right? Now section 213, where who can make an application to NCLT, either the members or any person. Which members? If the company has share capital, then at least 100 members or members with 10% voting power. If the company doesn't have share capital, then 1/5 of the members. They become the eligible members. With supporting documents and reasons, they can make applications seeking investigation to tribunal. Or any other person can make application. But when any other person make application, tribunal has to be satisfied of any fraud or any unlawful activity, any oppression. If the company is formed for unlawful purpose, the management or the promoters are involved in fraud, or the members are not being given complete information. So in such situations, tribunal, after giving reasonable opportunity of being heard to parties, then decide about investigation, that whether investigation should be carried out or not. And if tribunal decides that yes, investigation should be carried out, then it is going to direct CG the same, and CG is bound to order investigation. CG cannot say that, okay, I'll see whether it has to be done or not. No. So CG will appoint inspector, and the inspector will prepare a report and give it to central government. Okay, now comes into picture SFIO. What is SFIO? The establishment of SFIO is given in section 211, which is not a very important section. It just tells us about the composition. CG has the power that by notification it can establish SFIO, and it has done that. Head office, Delhi, it has director, it has experts, it has the number of employees, the terms and conditions as prescribed, etc., etc. Now, the important section is 212. Where central government assigns some cases of investigation to SFIO. Which cases, ma'am? That is completely a discretionary choice of government. However, in these 4 cases, government can do so. When government receives a report under section 208, when SR is being passed by the company in public interest, which is an open ground, and on request from Department of CG or SG. Central government is of the opinion that investigation must be carried out by SFIO only, then it assigns the case to SFIO. When the investigation is started by SFIO, all other investigating agencies will stop their investigation. Whatever their findings are, they are going to give it to SFIO. Fine? Okay. Now what will SFIO do? SFIO, the director of SFIO, that is the highest authority, will appoint an investigating officer who will also be called as an inspector under the Act. That person is going to conduct the investigation in the prescribed manner. Ma'am, it has to be a detailed evaluation, a detailed examination. So what do you think? How much power should be given to him? That means who he can call, who he can ask, where can he go, from where can he extract information, what can he arrest, etc., etc. So what powers are given to him? He is given the powers which are given under section 217. So we have a separate section for the powers which will be given to him. Okay, as of that matter, the powers which are given to any inspector during investigation. Apart from the general powers which are given to inspector, he also has a power, a very special power that you will not see in Companies Act ever, and the subsection which is very important, 212 subsection 6, 212(6), that gives the power to arrest. So the offences under this section are cognizable. That means people can be arrested even without warrant. However, not anyone can go and arrest them. Someone not below the assistant director, that is assistant director, additional director and director. On these orders only arrest can take place. Right. So if someone is found guilty of offence, that means I get some material information during my investigation and I'm sure that I have this evidence and I know that this particular person is involved in fraud. So I can arrest that person if I have that authority, undoubtedly. So I can go out and arrest that person. Now when I arrest that person, I have to do two things. First, arrest order plus this material information I have to give it to SFIO so that my department clearly knows that this arrest has taken place on these material grounds. Secondly, I have to produce this person in front of the magistrate or court within 24 hours. Now, when I present, the other person would want a bail, right? Bail will not be given so easily. That means there are strict conditions of bail. Bail will only be given when public prosecutor has been given an opportunity to oppose the bail. That means government lawyer. Our lawyer will go and oppose the bail. So once he opposes the bail, then court has to decide. If court is satisfied that this person who has been arrested is not guilty and he must be released on bail, he is an innocent person, he will not commit any offense when I release him on bail. If court is satisfied of that thing, then only the court will release him on bail. But sick, infirm, under the age of 16 and women, these are the four people who get relief. That means even if special court, if they want, they will not give an opportunity to public prosecutor to oppose the bail and grant bail. So it is at the discretion of special court in those cases. Okay, so here we have the whole part of arrest. Here we have the whole part of arrest. The inspector appointed will carry out the investigation, submit the report to central government. If central government directs, then it will also submit interim report, otherwise just the final report. And the report may state that yes, these people have committed fraud. So CG will take an action in pursuance of the report. What will be that action? CG will direct SFIO that okay, file the complaint and start the prosecution against these people. That means the legal proceedings will be started and adequately they will get the punishment. If some person has got some benefit, then to recover that benefit, CG will file an application with NCLT, and that is known as order of disgorgement. So NCLT will pass an order of disgorgement, that is for recovery of all the illegal gains that have been made by the persons, right? Okay. So that was about investigation into affairs of the company. Moving on to investigation into membership of the company. Sometimes it may so happen that on record there is another member, but actually the benefit is being passed on to some other member, which we call as beneficial owner also, as we have read in section 89 and 90 of the Act, significant beneficial owner and all that part. So sometimes it may so happen that the control is being projected as in someone's hand, but is actually not in that person's hand. So sometimes you need to figure out who the real owner is, then only we will be able to establish that what is the fraud, where the money is flowing, and a lot of other things. So if a complaint is being made by some person or suo motu by government or by reference by NCLT, then CG shall order, and in these situations CG may order investigation into membership, right? To determine who are the financially interested people, who are able to control the policy, who are beneficial owners, etc. So for this regard also, CG shall appoint inspector who shall investigate into matters relating to the company and membership and shall report it to central government. Now, when you are discovering about the membership or when you are discovering about the ownership, it may so happen that you want certain restrictions to be imposed upon securities. You want to find out who the security or where the benefit is going on, and before you could reach that person, the transfer of securities is taking place from one person to another, to another, so you want this to break. In such situation, or if any person files a complaint, then tribunal understands that I must find out the details about this particular security, and to find out the details I must put some restrictions. In such situation, tribunal can put restrictions but not for more than 3 years. This is something which is very important for you to remember, that tribunal, although has been given the power under section 222 to impose restrictions, yet the restrictions cannot be imposed for more than 3 years. Okay, now investigation into affairs of related companies. Related companies does not mean the related party definition that we have read. Related companies means the companies or the entities which have been specified in section 219 only. So when an inspector is investigating into the affairs of a company under these 3 sections, he believes that to find out the whole truth, I also must investigate into these related companies. Then after taking approval from CG, he can do that. Now, what are the related companies? Subsidiary, holding, subsidiary of holding, it could be past also, managing director, manager, employee, any body corporate which is being managed by the managing director or manager. It may so happen that currently you are the manager and it was being managed by the past, or currently it is being managed, you are the past manager, so is, was, it could be, right? Any body corporate whose board of directors includes the nominees of these companies, or any body corporate whose board of directors are acting according to the directions given by the directors of this company. So in such situations, there is a link between these 2 companies, and quite possible there are a lot of transaction flows from one company to the other related company, and to find out the whole truth where the actually money is going, I need to investigate into affairs of these companies also. So after taking central government's approval, you can do that. Next is section 221. Next is section 221, which talks about freezing of assets. Freezing of assets of a company. Freezing of assets of a company. See, if central government makes a reference, or if a complaint is made by members specified under section 244, that is oppression and mismanagement, or if creditors file a complaint, the creditors who have at least 1 lakh amount outstanding, or any other person, they file an application to tribunal, and tribunal believes that company might be disposing of, might be selling off some assets which is not in the best interest of the company, which is prejudicial to the interest of creditors, members, then in such a situation, tribunal can put restrictions on these assets, just like it was putting restrictions on securities to find out the whole truth. It is putting restrictions on assets also. It is freezing the assets. That means it is giving the directions that you cannot remove, transfer or dispose of the assets. But again, the restriction is going to be for maximum 3 years only. It cannot be for more than 3 years. It cannot be for more than 3 years. Okay, ma'am. Now, section 220. I told you we have a section 209 which is exactly replica of 220 except for the 2 differences that I told you. So during investigation, if inspector has reasonable grounds to believe that books are going to be or are likely to be mutilated, altered, destroyed, falsified, secreted, then inspector may enter, seize and search and seize documents and return them on completion of investigation, not within 180 days, and no permission from special court. Okay, fine. Okay. Now, the next section that we are going to discuss is inspector's report. Here I'll give you some clarification. We have read about inspection and inquiry and its report under section 208. So, when inspection or inquiry takes place, the report is submitted under section 208. When investigation takes place, the report is given in section 223 and the action that has to be taken after receipt of report is given under section 224. However, when investigation is being carried out by SFIO, then what report has to be submitted, in what manner, what actions shall be taken after submission of report, all that part is given in section 212 itself. Okay, So section 223 as well as section 224, it is about investigation. It is for the cases of investigation except section 2112, that is SFI. Fine. So apart from the inspector appointed under section 212, all other inspectors after investigation have to submit a report undoubtedly to central government. If central government wants an interim report, then you also have to give an interim report. The report is going to be obtained, the report is going to be authenticated by seal or certificate of public officer. Remember, I explained you the whole procedure of public officer in the class, in the main class, right? That who is a public officer, how the things happen, so that you get that practical knowledge as well. And a copy may be obtained by making an application to central government. So if you want to know what is the result of this particular investigation, what happened, what was the scope and everything, you can obtain the copy of it by making an application to central government. Central government is going to give you that. Okay. Now, when central government receives the report, what actions it can take in pursuance of the report? Central government receives the report, central government studies the report and finds out that okay, these 5 people were involved in fraud. So undoubtedly these 5 people have to get punishment. So central government will initiate prosecution against these people. So legal proceedings will be started and adequately they will be punished. Now, this is one thing. Central government, after receiving the report, finds out that it's important that the company must be closed. So we must sell off the assets, pay off the liability. So winding a petition may be filed by CG. It may also so happen that central government finds the case of operation or mismanagement, and hence CG files an application to NCLT for obtaining relief from operation and mismanagement, or both application may also be filed. So first thing, CG initiates prosecution against the defaulters. Second, makes an application for winding up or relief from operation, or both. Third, files a suit for recovery of property or damages. It may so happen that the company involved has lost a lot of property because of fraud. So for recovering that property, CG has filed a suit on behalf of the company. And when CG has filed a suit, CG will be indemnified by the company because CG is recovering the property on their behalf, right? And lastly, disgorgement. If someone has got illegal gain out of this fraud, then that money can be recovered from him. How? CG makes an application to tribunal, because tribunal is the judicial authority over here. CG is not the judicial authority. So CG will make an application to tribunal. Tribunal will pass the orders of recovery, that is orders of disgorgement. Okay, fine. Now, see, we also have a section 225 and 214, which are both related type of section. Often there is a confusion amongst students that, ma'am, so much of investigation is taking place, then who is going to bear the expenses of investigation? That is the question, right? See, one is section 214, which initiates, just to rule out not so serious applications. What happens if someone has filed a complaint to CG, or there is SR being passed by the company and CG receives that SR, and CG initiates investigation. Before appointing inspector, it will ask the applicant that you deposit a sum not exceeding 25,000 as a security, because we are going to take an action on your request. What if the request is some fake evidence and some false request? So you submit some security. If this turns out to be false, then you will not get your money back. But if this turns out to be true and actually some fraud has taken place and this results in finding someone as guilty, then this money will be refunded to you. So if it doesn't end up in prosecution, then we will use that money to carry out the inspection investigation, and we will take the help of company, whoever is involved in whatever not so in order things. Otherwise, if this results in prosecution, that means the end result of investigation is such that we find some people guilty. So whoever has been found guilty, we will recover from them. If the investigation ends up in recovering some property of the company, then from that property, central government will have first charge on that property. It can use that property to reimburse the money. So all that portion is given in section 225. Right? So that's how central government obtains, or central government gets money to carry out this process of investigation. If it doesn't end up in prosecution, of course, the applicants and the company concerned. Fine? Okay. Now, procedure powers of inspector, section 217. So whoever is carrying out investigation and some part of inspection and inquiry, they have these powers. What are the powers? They can call for information, and it will be the duty of past plus present officers to preserve books, to produce books, and to give all assistance. Now, whenever an inspector is taking books, they can keep them in their custody for only 180 days. Ma'am, earlier you told that there is no limit. I told that there is no limit under section 220. That is the section of seizure. This is a normal section when you ask for books and papers and you have taken books and papers. There you have entered into premises and you have seized the books and papers. Okay, so that is the difference. Now you can examine people on oath. Which people? Anyone? No, not anyone. The employed officers, you can examine them on oath, but if you want to examine some other person, then you have to seek approval from CG, and then you can do that. You will get the same powers as of civil court. All the police, other authorities, government, they all are going to provide you assistance if needed when you take the approval from CG. There is one special point in section 217 which talks about reciprocal arrangements. What happens in that? See, it is very easy to discover truth, find out evidence, inquire people in our country, but when the laws change, to get evidence from a foreign source is extremely difficult. For that, if we want to obtain some evidence from a foreign country, we have to check whether our government has a reciprocal arrangement with them or not. If they have a reciprocal arrangement, it gets extremely easy. How? We will tell our Indian court that there is an evidence which is out there. Indian court will send a letter of request to foreign court will summon that person who is concerned, will inquire that person, will collect evidences and give it back to the Indian court, and Indian court will give it to the inspector concerned and he will prepare the report. Likewise, since it is a reciprocal arrangement, so give and take, foreign court, if they want some evidence from our country, they will send a letter of request. Our government will forward it to Indian court. Indian court will either summon the person himself or call the inspector and assign the case to him. Inspector will investigate, inspector will prepare a report, collect evidences, give it to the court, court will give it to the government, government will give it to foreign court. I hope you get the procedure. So it's give and take. These reciprocal arrangements may be there. Okay. Now, another section, protection of employees. The employees get sometimes scared to disclose the insider information of a company during investigation just because they may be fired later. To protect them, if an investigation is being carried out under these sections, all the 5 sections are mentioned over here, or some pendency of proceedings of prevention of oppression and mismanagement, in both these cases, if the company proposes to suspend an employee, dismiss him, demote him, right, or change his terms of employment to his disadvantage, then in all these cases, it will not be allowed unless you take approval from tribunal. So you have to file, the company has to file an application to tribunal that I am proposing to dismiss this particular employee when the investigation is going on. The tribunal will not give you a reply like, okay, fine, you dismiss him, or don't dismiss him. No. You have to wait for 30 days. Within 30 days, either tribunal will send a notice of objection or tribunal will stay silent. If you don't receive any objection notice from tribunal within 30 days, then company can proceed and take action against that employee. Okay. Now, if tribunal objects and the company is not satisfied with it, company can file an appeal to NCLAT within 30 days. Okay, apart from this, we have section 226, which is a very small section and states that doesn't matter you have passed SR for winding up, doesn't matter any winding up proceedings are going on, doesn't matter there's an application for oppression and mismanagement. These things are not going to affect the investigation. So despite that, if an investigation comes into picture, it is going to be carried out. We have another section, section 227, which tells us an inspector cannot compel the legal advisor to disclose any information other than client's name and address. Likewise, an inspector cannot compel banker to disclose any information other than information related to the company concerned. Banker cannot be compelled to disclose information of other customers, right? And section 228, which tells us that the provisions of inspection, inquiry and investigation are going to be applicable to foreign company also. And section 229, that if in the whole process you do some fraudulent activity, that means you give some false answer to the inspector, you make some false entry, you try to destroy some paper, anything like that, then you will be attracted to the section of fraud. What is the section of fraud which gives the punishment for fraud? It is section 447, right? So that's it with the revision of inspection, inquiry and investigation. Okay, let's now revise the chapter of compromises, arrangements and amalgamation. In this chapter, we have sections 230 to 240. Not a very huge section, but sometimes the students don't understand the underlying concept in this chapter, and hence they end up thinking that this is a very boring chapter. However, if you ask me, this is the most relatable chapter to your practical life. If you have to, or if you're planning to pursue your career somewhere in the field of mergers, acquisitions and like, then undoubtedly this is one such thing that you must know. If I share with you, although we have discussed all this in our regular class, but if I share with you one of the scheme of compromise, scheme of amalgamation arrangement, you can clearly see that under sections 230 to 232 of Companies Act 2013. So this is not something which has been drafted by me, but it is the scheme of amalgamation which actually happens in the real life, in the practical world, between Bharti Infratel and Indus Towers, right? So actually you find the relevance of the section. It is absolutely, of course, along with other provisions, this is something which is very important. Now, since it is a revision class, we cannot go into very much depth about the terms, and I have already explained you the terms. However, the chapter involves three broad terms, that is compromise, arrangement and amalgamation. If I talk about compromise means some type of sacrifice. The sacrifice could be between members and the company, or between creditors and the company. So might be creditors are sacrificing something for the company. Maybe the company is not in a very good financial state, and so the creditors are sacrificing some portion of their debt, or maybe some interest portion or something like that. So that is a scheme of compromise that's taking place. Arrangement is a kind of residuary terms which includes every other thing which is not compromise or amalgamation. It could be some reconstruction of capital, alteration of capital, etc, etc. Now, what do you mean by amalgamation? Although the chapter heading uses only the term amalgamation, when we switch to the sections, we find the term merger, amalgamation, demerger, all of that. So what do we mean by that? If I talk about merger, it could be by formation of a new company or by acquisition. By acquisition means or by absorption means x plus y is equal to y. So you don't form any new company, an old company absorbs another company into itself. Or the merger could be by formation of a new company. So I could say that maybe A plus B is equal to C. So there is a new company which has come into consideration, and two old companies have lost its existence. Now when I switch to amalgamation, amalgamation could be in the nature of merger or could be in the nature of purchase. In the nature of merger, if it satisfies all the criteria, right, and if it doesn't satisfy all the criteria, then it's going to be in the nature of purchase, right. That is something which is not needed because the Act does not identify or does not recognize any difference between two and has not stated different provisions for amalgamation, merger in the amalgamation in the nature of purchase, demerger. No, there are like provisions for all these cases. Okay, and we have section 230, which is for compromise or arrangement, and section 232, which is for merger, amalgamation, demerger. However, section 232 is not complete. It does not give us an elaborate, a detailed and exhaustive procedure as to how merger and amalgamation should be proceeded with, and redirects us to section 230. So I hope you understand that the most important section of this particular chapter is section 230, undoubtedly. Fine. So we'll start with the revision. The very first section, section 237, where there is a power to make compromise or arrangements with creditors as well as members. So company may enter into any scheme of compromise or arrangement. As I told you, example could be internal reconstruction, example could be some debt restructuring and like things, between company and creditors, between company and members. So in this situation, they have to take permission of NCLT. For taking permission, they will make an application. There is a whole procedure which has been given under section 230. It starts with making of an application. Members, creditor, liquidator or company, they can make an application in form NCLT 1 to NCLT. This application will be accompanied with the affidavit containing disclosure, copy of scheme and fees. Now this may be accepted, this may be rejected. Once it is accepted, the next step is that NCLT orders to hold meeting. Hold meeting of whom, ma'am? NCLT is concerned that are all the creditors, are all the members who are concerned, who are involved, happy about it, right? Are they happy and have they actually approved it? That is the main concern of NCLT at the first place. So NCLT asks the company that send notice to your creditors and members and take their approval, and thereafter report to me whether they have approved or not. Then we will consider and sanction your scheme. Okay, so NCLT orders to hold meeting. Chairperson calls the meeting by sending notice. The notice which is sent to the members, to the creditors, is accompanied by the details of compromise or arrangement, valuation report, effect and other matters. At the same time, one notice is also sent to the statutory authorities. Statutory authorities could be income tax, could be central government, SEBI, Registrar, Stock Exchange, Competition Commission of India and all that. Why it is sent to the statutory authorities? To seek objections from them. If they have any objection, they can also give objection within 30 days. Okay. Now this notice is also advertised, English newspaper, vernacular newspaper, and is placed on the website. If it is a listed company, it's also sent to Stock Exchange and SEBI. Fine. Now, after sending this notice, advertising it, placing it on website with all these details to creditors and members, then the meeting is held. In the meeting, the creditors members will vote. Accordingly, they will give their approval, right? Fine, they will give their approval. How can they vote? They can vote in person, they can vote by proxy, they can vote by postal ballot. So an option of postal ballot is also made available to them. Now here, the approval is not a normal one. That is, if there are 1,000 members, we cannot say that if 600 members have approved, then we accord the approval. No. The approval is a two-way approval. Majority of members holding or representing 3/4 value, and this is not of total, it is of the members who are present and voting. Okay. So if the number of members is 500, then majority comes out to be 251. So at least 251 members holding 3/4 value share capital. Say supposedly the share capital is 10 lakh, then at least 7,50,000 share capital should be held by these 251 members who have given the approval. If that is so, then only we will consider the scheme to be approved. The same goes for the creditors also. Creditors majority in number representing at least 3/4 value. Okay. After this approval is taken, the next thing is that NCLT also needs auditor's certificate that whatever accounting treatment is going to be taken place in the books, that will be in accordance with the accounting standards as well as India's applicable, right? So after it has been approved, after CA certificate has been received, then tribunal sanctions the scheme, of course after considering the objections of statutory authorities. Whatever order is passed shall bind everyone. However, the tribunal shall send the order to the company within 30 days, file it to registrar. What is going to be the contents of order? What is going to be the contents of order? Variation of rights, that is the first thing. Variation of rights means what? We have a section 48, which tells that if you have to vary the rights of a shareholder, then in that situation you need to take their approval, right? If it affects some other class, then you take approval of that class also, etc., etc. So there is a procedure which has been given. In case your compromise or arrangement is somehow altering the rights, then you must follow section number 48. Section number 48. Okay. Then to dissenting shareholders, exit offer is given. Conversion of share capital. When preference share capital is being converted into equity under a scheme of compromise or arrangement, supposedly there was some preference capital on which preference dividend was not paid for 4 years. Now under a scheme of compromise, they are converting. Under a scheme of arrangement, they are being converted into equity. Option will be given to them that those pending 4 years dividend, either you take in cash or an equivalent amount of shares. Get that converted into an equivalent amount of shares. Fine. Then all the proceedings of BIFR shall abate. What do you mean by proceedings of BIFR shall abate? See, if it is a sick company, it moves to BIFR to revive itself. Now, supposedly we have interacted with our creditors and the creditors have somehow reduced our repayment burden in some manner. Now the company itself is in a position to grow. Earlier the company, all the money that the company was earning was going into the EMI. Now it has been relaxed and the company has funds to invest into the core business and thereafter earn huge profits. Right, so there is a ray of hope that the company will automatically come back to its good financial state post this compromise or arrangement, and hence that BIFR proceedings are not required, so they shall come on hold. Okay, so and this buyback or reduction of capital, what I have written, it simply means that if you have to go for buyback, then you will also follow the scheme of buyback, that is you have to follow section number 68. Okay, and now we come to section 231. Tribunal has sanctioned the scheme. Tribunal has the power to supervise its implementation, make modifications as and when needed to implement, give directions, and if at all tribunal finds that it is impossible to implement the scheme in a manner as it was sanctioned and it will not bring a right effect, and if not implemented, the company will not be able to pay its debts. That means company is in a kind of insolvency state. Then in such a situation, tribunal might pass winding up orders, that is closing down the company. Okay. Fine. Now we come to section number 232. Merger and amalgamation of companies. So we are talking about the case of merger, amalgamation, demerger, all of that. Whenever an application, here also you need NCLT approval, here also there is a whole elaborate procedure and exactly the same procedure as we have read in section 230. However, the section is different, and so we cannot say that if I am talking about a case of merger, I give my answer in accordance with section 232. No, in accordance with section 230 to 232. Fine. Okay. So applicant makes an application to NCLT for seeking approval. NCLT finds that the application relates to merger, amalgamation or demerger. So it will order the meeting of creditors, members, any class, as it does in section 230 also, and the same provisions of section 230 will apply. That is, the notice will be sent to persons, advertisement, website, everything, statutory authorities notice, then approval will be taken from members or creditors and thereafter scheme will be sanctioned. Okay. There is one more point which is written over here, objection allowed, which I haven't explained you in section 230. What do you mean by objection allowed? It is very important point. Okay. See, some of the members or creditors, since the company got the approval as needed of 3/4 value majority, so the company proceeded with the scheme, but there might be some people who are not very happy about it. See, there are two types of people. One who are not happy but still they accept it, and ones who are not happy and become rebellious. So these are the rebellious ones. They want to oppose. We have to check, are they capable enough to oppose, because capability criteria has been specified. Who is eligible to oppose, that has been specified. Who can object more than equal to 10% of share capital or more than equal to 5% of debt in the case of members and creditors respectively. Okay. So this is how that is going to take place. The same objection criteria is specified here also, because the same provisions apply in this case also. But ma'am, undoubtedly there should be something different in section 232 or something additional in section 232, because we have a separate section for mergers and amalgamation and a separate one for compromise and arrangement. So undoubtedly there is some difference. Yes, there is. There are two major differences, or there are two major additions in case of merger and amalgamation. One, you have to circulate additional documents. Two, your scheme will contain for these. Okay. So along with the notice, there are some additional documents which have to be sent. That is draft notice, draft scheme, complete scheme. There was only, then it's confirmation that it has been filed with ROC, valuation report, financial statement, or you can say supplementary accounting statement if it's not in all cases, if the financial year end was 6 months ago. So in that case, a supplementary accounting statement, the report by directors with regard to effect of merger and amalgamation along with the exchange ratio, what is the price they are going to get and all that, right? So this will additionally be circulated along with the notice, if it is a case of merger, amalgamation, demerger. If all the conditions are satisfied with and certificate of auditor received, then tribunal may sanction the scheme. Now the scheme must contain for these following, since it is a case of merger, amalgamation or demerger. After it is sanctioned, the order is sent to the company and company files it with registrar within 30 days. This point I'll discuss little later. First we are going to discuss the orders. The points which must be there in the scheme, otherwise tribunal can pass orders in this regard. First is transfer of undertaking. Whenever a scheme of merger or amalgamation takes place, undoubtedly there is transfer of assets, liabilities. Sometimes it could be transfer of just one undertaking and like things. Whatever it is, you have to give adequate information about what is going to be transferred, how it is going to be transferred. Second is with respect to purchase consideration. So what are you going to allot? Allotment of shares, right? So order about that. Continuation of legal proceedings. The legal proceedings or the legal cases shall be now against the transferee company. So from transferor company, they'll come to transferee company. The transferor company, that is the old company which is being now merged into the transferee company. This company, all the assets, liabilities have all been taken over by this transferee company. Now this company is a kind of empty box which has nothing in it. However, it does not die because it has to die a legal death, since it is a legal person. So we have to dissolve it. So no winding up needed because it does not have any assets, liabilities. However, we must dissolve it. We must remove its existence. Okay. Then shares to non-resident shareholders. We have to make sure that FDI compliance is done. The employees of transferor company to go to the transferee company. Set off of fees. And before that we have listed company. Supposedly a listed company is being merged into unlisted company. So this unlisted company will remain unlisted only. It will not become listed just because it has acquired a listed company. No. If you marry a celebrity, you don't become a celebrity. Or you do actually become a celebrity, but here the same is not going to apply. And set off of fees. What do you mean by that? Supposedly A plus B is equal to C. So we have to incorporate a new company C. Incorporation fees is there, but these A and B, they are going to dissolve. So whatever fees have been paid by them, they can be set off. Other incidental matters, right? Apart from this, we have this another point, which is
The scheme of amalgamation merger takes quite some time, and if it is at a stretch of 2 years, 3 years, at the end of every financial year, within 200 days, there has to be a certificate of compliance certified by CACS CMA, which is going to be filed with ROC. Okay, that yes, whatever scheme was sanctioned by tribunal, we are following the same. Now, merger and amalgamation of certain companies. This is also known as fast track merger, but it is not available for all types of companies. Okay, it is available for small companies. It is available for holding in its 100% subsidiary. It's available for prescribed companies, which are startups and startup with a small company. So in these 4 cases, companies, instead of going through that long route, they can also opt for fast track merger under section 233. What is the procedure that they have to follow under section 233 is a matter of concern over here. We don't need approval of NCLT. That's the most important point over here. Instead of NCLT's approval, we need CG's approval. Ma'am, how is it going to be fast then? Undoubtedly, taking approval from CG is way more easier than NCLT, because CG is as good as MCA, right? So we have to take that approval. But before that, we have to take approval from members and creditors. Members and creditors. So first of all, we take approval from members as well as our creditors. This is not the case in section 230 or 232, but here we have to take approval from both members and creditors. We sent a notice to seek objection to just 2 people, that is ROC and official liquidator, who is the officer of High Court. So we sent the notice. If they have objection, they will give objection, and thereafter, when we get sanctioned, when we get approval from our members and creditors, we file this with central government, and central government grants us approval and the scheme is implemented. So that's how the process works. Both the companies, that is the transferor company and the transferee company, they both file declaration of solvency with registrar, and this is a separate requirement. Here the process starts. First thing that they are going to do is send a notice inviting objections from registrar and official liquidator. And after that, you have to call meetings of shareholders, meetings of creditors, right? So you call the meeting wherein they are present, and you need to take their approval. How, ma'am? Approval has to be as it was in section 230? The answer is no. Here the criteria of approval is different, and you have to very well remember the criteria of approval under section 233 and section 230. They are 2 different things. There, majority number representing 3/4 value, dual type of approval was needed. Here, for members, you only need that members should represent at least 90% of shares. 90% of shares. And if it is creditors, majority representing 90% value. So here you need dual approval. Here you just need 90% of shares. Fine. Okay. If registrar or official liquidator wants to object, they can make objections within 30 days. They have a time period of making objections. Now, you called the members, you called the creditors, took their approval, you also sent a notice to ROC and official liquidator. The next step is that after taking the approval, within 7 days, you file the scheme with central government, ROC and official liquidator. There are 2 instances which may happen. ROC or official liquidator have an objection, they don't have an objection. If they don't have any objection, central government finds no problem, central government will register the scheme, pass the order of approval. The same order of approval will be sent to the company. Company will file it with ROC. The old company will dissolve and other transfer of assets, liabilities, all will take place. Okay. If objection is there or central government finds that it is not in the public interest that this merger should take place, then central government leaves the case and transfers it to tribunal. So central government makes an application to tribunal and requested that you consider the scheme under section 238 because you are more competent to do so. Now it is at the discretion of tribunal that they can sanction the scheme or process the scheme according to section 232. Fine. Okay. Next is section 234, merger or amalgamation of foreign company. So Indian company can merge into foreign company can merge into Indian company. The provisions are the same. So we have to follow section 230 to 232 only for this also. And here one important point that you have to remember is that foreign company does not mean company incorporated outside India and having a place of business in India, as we read in the definition. No, whether having a place of business in India or not, that is the foreign company for this particular section. So what is the additional requirement, ma'am? If we have to follow the section 230 to 232, what is the additional requirement? Additional requirement is that you need RBI's approval. You need approval from RBI. Moreover, the consideration may be paid in cash, depository receipts, or a mix of both. One more point which is there in rule, it states that supposedly Indian company is being merged into the foreign company. So the foreign company will pay shareholders of these Indian companies. What will they pay? What will they pay? They pay us an equivalent amount of shares. So what is going to be the exchange ratio? That will be decided by that foreign company. So foreign company will take help of a competent person. Here we have registered valuers. What about there? So it is stated that their valuation should be done by some members who are undoubtedly the member of a recognized body which follows internationally accepted principles of valuation, so that we can be sure of fair valuation. Okay, so this is an important point that is there. Fine. And moreover, we also have to take care of the jurisdiction, that foreign company which must be incorporated in certain jurisdictions where securities market regulators, there are anti-money laundering, etc., and that we have to take care of. And you can merge only with the company of that particular jurisdiction. Fine. Moving on to the next section, section 235. One company wants to acquire another company as its 100% subsidiary. That means want to buy all the shares of that particular company. So the company gives an offer to the shareholders of that company that you sell your shares to me because I have an intention to take all the shares. I give you 4 months, you can either reject or accept, it's completely your choice. But supposedly it is accepted by 9/10 value of shareholders. Then it's going to give a huge power to the company. The company now gets the power to acquire shares of even those people who did not agree. This might sound harsh to you, but I hope you remember the logic that I explained to you in the comprehensive class, right? So we have discussed it thoroughly, that why this section is being introduced, and it is for the good. No, it's not, definitely not harsh. Okay, so within 4 months they can accept or reject in case this approval is acquired, but there are some shareholders who disagree. Then in such a situation, transferee company, what they will do is they will send a notice to the ones who disagreed that we are going to acquire your shares. They're not happy with it. So within 1 month they can apply to tribunal. If tribunal finds that something wrong is happening to them, tribunal will give the result in favor and we have to stop. But if the appeal is dismissed or you don't apply at all, then we will take our next course of action, which is executing the transfer deed for transferring the shares of yours into our name. But we'll not give it to you. We'll give it to your company. So we will give the transfer deed, we will give the notice that we sent it to you, copy of notice, as well as the money to your company, and this company will inform you that the shares are no more yours because the company has registered the shares in our name. So the transfer has taken place. So it will be informed to the dissenting shareholders that the shares are no more yours, they have been transferred to this company, and the fact that we have received your money and it will be disbursed in 60 days. Okay, so this is the case. Section 236 is quite close yet has a difference. What is the difference over here, ma'am? That before that, let me take you over here. Section 238, it just tells us about the attachments, that whenever a transferee company gives an offer, it also contains the board of directors recommendation, the statement that if you accept the offer, necessary cash will be available, you will get adequate cash, and thereafter you can sell the shares, and that we have registered the circular with ROC. See, whatever offer you are giving, you also have to register it with ROC. If ROC refuses to register, you cannot go ahead and make an offer. There is a penalty also of 1 lakh for that. Okay, now section 236, purchase of minority shareholding. Supposedly over the period of time, some person has got or has become the shareholder of more than equal to 90% of equity share capital, then he can acquire the remaining ones also. How? You will notify your intention to minority shareholders. There are two options. They might also offer to sell their shares, or you can make an offer. Now this is something which is which has to be considered. Predetermined price. Whatever offer you will be made at a predetermined price, and this pricing has been quite illustrated through the rules also. A registered valuer will be higher, he will value the price, yet that will not be the price. We have to ensure that what SEBI releases as the fair price, or if it is an unlisted company, then what is the fair price that can be calculated on the basis of what price has been paid in the last 12 months. All this is not something that you must remember, but I'm just telling you for information. So based on that, we decide that higher of what registered valuer has taken out or what SEBI has given as a fair value. So according to SEBI regulations, what has come at the fair value, higher of these two, that is the predetermined price. Okay, that is the predetermined price. Because here at once the offer is not being made, offer is made in chunks. Sometimes you're buying 2 shares, 3 shares, and likewise you have attained this particular point already, and now you're availing this particular section. So what you will do is, you will deposit consideration in a separate bank account. You give the money to transferor company only. So transferor company only receives money, pays money, collects share certificate, discards it, issue new certificates. It acts as a transfer agent in that regard. And deposit money in separate bank account, which remains valid for 1 year. So 1 year anyone can take payment from that bank account. The amount has to be disbursed within 60 days. Now one important or additional point which is there in this section which students fail to understand is that there is this minority which was already 10% or lesser. In this minority, there is a majority and minority. Majority which holds more than equal to 75% of holding, and minority which holds less than equal to 25% of holding. Now, in this minority, the majority negotiates with that shareholder, with that actual majority shareholder, and gets a higher price or gets some more money for sale of shares, because they are a good chunk, they can negotiate. Or they reach an understanding that I want more money. Whatever more money they receive, they have to give or they have to share that additional compensation even with the minority segment of shareholders. Okay, fine. Section 237, if central government is satisfied that 2 companies must merge into one another, central government can pass such order. What about our wishes, our will? Central government will first draft the order, send it to both the companies that you both have to merge. This is my order. If you have objection, you can give the objection within 2 months. Your rights and liabilities will not be affected. If at all the rights of members, creditors are affected, then you will get compensation for it. And if you're not satisfied with the compensation, you can even appeal to tribunal within 30 days. So draft is made. It is sent to the companies. Companies can object within 2 months. If companies don't object, fine. If they object, then central government will consider the objections, make necessary modifications if needed, and thereafter pass the final order in official gazette, which will implement the merger scheme. And this is also going to be laid in the Houses of Parliament, right? After that, we have section 239, which just says that whatever company has been merged, has been amalgamated,
The books and papers of that company cannot be disposed of, destroyed without the permission of central government. So you need to make an application to central government for seeking permission. Central government will ensure that there is no evidence left of any offense, prospective offense, and thereafter permit you. Section number 240 states that if two companies are merged, the old company had committed an offense and some officer in default was responsible, he will continue to be liable even after this merger, demerger, amalgamation, whatever is taking place. Right, so that is all about this particular chapter's revision.
Okay, now the revision of prevention of oppression and mismanagement. We have very few sections read with rules and some case laws in this particular chapter. This chapter comprises of not many sections, starting from section number 241 till section number 246. If we look at the chapter overview, if oppression and mismanagement is taking place in any company and if you're being oppressed in the capacity as a member, that is a continuous act of oppression that you're suffering from, then if you happen to be the eligible member, then you can make an application to tribunal for seeking relief from that oppression or mismanagement. This chapter intends to provide the preventive remedy and not the exact cure after an oppression has taken place. So oppression and mismanagement, these are the two terms which are not defined in the act, defined in this whole chapter. However, when we look at section number 241, we are being given two cases when an application may be made. So if you satisfy the criteria, if you fall into those cases and you meet the eligibility requirement, then you can make an application. So when we start with the chapter, we start with understanding the meaning of the two terms. There are two perspectives. One is the general meaning that we understand of the two terms, and second is the given intended meaning, the given intended precise meaning in the section which we have to present in our answers, right? So the very first thing, the chapter begins with a rule, that is majority rule, Foss versus Harbottle, which states that all the decisions will be taken by majority, which is fair enough. Because if we remove this particular rule, we will not have any proper procedure to take decisions in a company, in our lives, in anywhere, right? So obviously, if the decisions are to be taken by board of directors or the members, they are going to be taken by majority of people, which is the majority rule, which is nothing wrong at all. And the courts will not intervene in this internal management as long as the decisions are being taken in the manner they ought to be. However, this chapter says something as an exception to this Foss versus Harbottle majority rule, and it states that sometimes the decisions being taken by this majority could be oppressive, could be creating some atrocities to the minority group, to some group of members, to 1 member, 2 member, 4 member, 5 member, and in such a situation, courts will intervene. How the courts will intervene? NCLT gets the power under this chapter to entertain such applications and complaints, right? This is the slight background that I have given to you. Since it's just a revision class, we're not going to get into very much in-depth meaning of each and every term. Once again, if we come back to the chapter overview, someone is entitled to make an application under section 241. Who is entitled? The members' eligibility criteria or requirement is given in the section 244. So before reading section 241, you need to have that understanding of section 244 and remember who is eligible to make an application. So someone who is eligible to make an application, if the circumstances prevail which are given in section 241, what are the circumstances? There are two cases which are given. One case is termed as oppression and one as mismanagement, although section does not define the terms. Section only states the circumstances we believe it to be the case of oppression or mismanagement, right? So if the members are eligible, they can make an application. If there are the circumstances prevalent, they can make an application to tribunal under section 241. Tribunal passes certain orders under section 242, and out of those orders, a few orders have certain consequences also, some after effects. That is given in section 243, and we have a separate segment, class action suits given under section 245 and 246 is absolutely nothing, right? You're not being asked any question. It is nothing. It's just about the applicability of some part. So that we are not concerned with. We start with the revision of first section 241, but before that, let's have a look at who is eligible to make an application. There might be a company with share capital, there might be a company without share capital. If it is a company without share capital, we don't have any share capital, we just have the number of members. So we can straight away say 1/5 of the total number of members. So if the company is without share capital, 1/5 of the total number of members. But if the company is with share capital, then ideally we have three things. And we can say lowest of all these three, or we can have a division that number wise also criteria could be met, or the value wise criteria could also be met. A company is having share capital. Who are the members who are eligible to make an application? Lowest of either 100 members or 1/10 of the total number of members, or the members who are holding at least 1/10 of the issued share capital. Here it means preference plus equity both. Point number one. Secondly, it's not paid up capital, it's issued capital. So you have to keep this thing in mind. So if you meet any of these three criteria, you become eligible to make an application. However, what is important is that you must have paid all the calls and sums due to the company. If you yourself have failed to pay the calls of the company, then your eligibility requirement also fails, and in that case you are not an eligible applicant. Moreover, sometimes it may so happen that although you fail to meet the eligibility requirement, yet your case is severe and your application is genuine, and you must make an application for seeking relief. In such a situation, tribunal can waive the requirements. Tribunal can say, fine, even if you're not 1/10 of members, you can still make an application. Even if you don't hold 1/10 of issued share capital, you still make an application and we will admit your petition. Right? So this is something which is possible. NCLT may permit the lesser number of members. That is something which is something that I have told you. Now, although these points are established through a lot of case laws as well, but two things I am telling you over here. One, I hold 100 shares and so I am eligible. After making an application, I sell my 50 shares. So my shareholding gets reduced. Later on, after making an application, will my application be still valid? The answer is yes. So I am supposed to hold the requisite number of shares only at the time of filing application and not thereafter. Secondly, I have given my consent, but subsequently I have withdrawn my consent. Will my application be still valid? The answer is yes. Right? So both these requirements, that is the shareholding as well as the consent, is needed only at the time of filing of application and not thereafter. Thereafter, if it is subsequently reduced or withdrawn, it doesn't really matter. So one thing is clear, who is eligible to make an application? So we check whether the company is with share capital, without share capital, where do you fall, and do you meet the criteria as given or not. If you meet the criteria, then you may complain. If oppression takes place or if mismanagement takes place, are likely to take place, right? Because it is a preventive remedy. So one, if the affairs of the company are being conducted, have been conducted or are being conducted prejudicial to public interest. What do you mean by prejudicial? Prejudicial is harmful. So if it is harmful for public, it is harmful or oppressive to the members, it is harmful to the interest of the company. So if any of these things exist and you are eligible member, then you may complain. Secondly, there is some change in the management, or even without the change also this takes place. However, what is being given in the section, if there is change in the management, and now it is expected that whatever actions they are going to do, it will prejudice us. Why change in the management is written over here? Because if there is no change, then affairs are being conducted in a harmful manner. So if there is no change, this point covers it all. But if recently some board of directors have changed, or maybe the two companies have come together, or maybe some shares have been acquired by a particular group, so that ownership in shares have been changed. So now whatever resolution will be passed, they will have the majority and they will be taking the decisions. So if there is some change, if there is no change, either the affairs will be running good or not good. Not good, you can use this ground and you can complain. If there is change in management, then you come to this particular point, right? So there is change in the management, you are expecting that it will be harmful to members, so you have proper circumstances and evidence which suggests the same, then you may also complain. And CG in public interest can also complain, so you can make an application to tribunal. And if tribunal is satisfied that yes, the allegation, the application is genuine and the above affairs exist, above state of affairs exist, and the company is in such a condition that the company must be wound up. But if we go on to wind up the company, it will not be fair for the members who have made the application. Right? Something wrong has happened to me, and you're closing down the company. It doesn't rectify what wrong has happened to me. Right? So in such a situation, tribunal, instead of resorting to winding up, takes some other actions. What are the other actions? This part is given in section 242. So these are the orders of tribunal, what orders may be passed, although tribunal can pass any order as they deem fit. However, there is some list of orders which are given which may be passed, right? So what orders can be passed? The tribunal can say that we are going to regulate the affairs. Fair enough. The tribunal could say regarding the purchase of shares by some group or by the company. The tribunal can instruct the company that, okay, fine, you buy the shares of these people at a fair price. And since you're buying back the shares, it should result in, or it should comply with all the provisions of reduction of share capital. Right. Sometimes it may so happen that some transfer of shares is constantly taking place, which is not in the best interest of the company, and all the shares are being rerouted to a group of shareholders who are misusing their powers or something like that. So tribunal can restrict that transfer. Some further shares are being issued, and if these shares are issued to a particular group of people, they will become majority from minority. Tribunal can stop that allotment. Now, tribunal can terminate, set aside, modify the agreement between directors and company, or between company and some third party. If tribunal does this, it has consequences of 243. Only in this point. Only in this point we have consequences. For all other points, we don't have consequences. What do you mean by that, ma'am? Company has hired, or company has appointed Mr. X as the managing director for 5 years, but tribunal terminated their contract and said that you have to leave the company. Right? In such a situation, two consequences follow, which are given in section 243. 1. Although if a managing director is removed before expiry of his term and he fulfills the conditions given in section 202, he is entitled to compensation. However, if he is removed under section 242 by tribunal, he will not be entitled to compensation. Moreover, because tribunal has found him guilty and that's why has removed him, so he will be disqualified for 5 years. If he wants to be appointed as a director before 5 years, then he has to go to tribunal, seek its permission, and then it can be appointed. Okay. Likewise, although third party and company, tribunal doesn't have the right to terminate a contract of third party and company, right? But still here tribunal gets that power. Tribunal will discuss with the third party, will take permission from the third party, and then terminate, set aside, or modify the agreement with the third party. However, even in that situation, the third party also shall not be entitled to any compensation. So no matter if tribunal has terminated or set aside or modified the contract, then absolutely no compensation, and the concerned directors will be disqualified for 5 years of appointment until they seek the permission from tribunal. Next, setting aside of fraudulent preference. For this, you need to recall and understand what do you mean by fraudulent preference. Giving someone preference for a fraudulent motive or intention. That is fraudulent preference. Like what, ma'am? I have 10 creditors, and if I have to genuinely make payment of these 10 creditors, I will pay the creditor who has been waiting for the longest, right? But instead of making that particular payment, I pay to some creditor who I know is a good friend of mine. So this is giving fraudulent preference to that creditor just because I know that the company is running out of funds, and if I start in that sequence, my friend will not get money. But that's how it should happen. That's a fair play, right? But instead of going for that fair play, here we are involving some fraudulent motive and doing this. Tribunal has the power that in the past, if these type of transactions have taken place, they can set aside this transaction. Tribunal can remove MD, manager, director, appoint them who is going to report to NCLT. They can give instructions about the cost of this and recovery and other matters as they deem fit. So these are the orders which may be passed by tribunal. An application may be given by the eligible members to tribunal. Tribunal receipt of application is satisfied that yes, it exists and winding up would be unfair. Then tribunal passes certain orders. Whatever order is passed, that has to be furnished to ROC within 30 days. Within 30 days. Okay. Now, we have another point over here on which we have not done a lot of questions because these are some recent amended sections which have been incorporated and a new thing which has been incorporated. But then this is important. Okay, so there is something more. What is it? Application to tribunal for relief in case of oppression, etc. And powers of tribunal and section 243. Ma'am, we have read section 241, we have read section 242, we have read even section 243. Then what is it? It is a combination of all three of them. It is an absolutely different topic, but it is not given in one section. Some part of it is given in section 241, some in 242, and some in 243. Okay, so let's begin from the very first part. See, if central government on the basis of some circumstances has a belief that there is a director in the company who is not fit enough to be the director. Fit enough means he is constantly negligent in his duties, he's not performing his duties well, or maybe he's constantly indulged in fraud, right? Some people are there who do mistakes, but some people are there who have a habit of doing mistakes, right? So if central government comes across any such person who is guilty of fraud or breach, or has not done the business according to the principles, or has been doing the business with the intent to defraud or cause injury, then CG wants to know, is he fit enough? CG wants to know, is he fit enough? So CG initiates a case and makes an application to tribunal. Now, tribunal should also have the confidence that do I really need to inquire about this person? So for that, CG gives a concise statement that why CG believes that yes, some inquiry should take place for this person. I don't find this person to be fit and proper. I don't find him to be fit enough to be the director, right? So central government gives the application to tribunal to inquire and record whether or not such person is fit and proper to hold office. Under section 242, tribunal records its decision. So tribunal will hear the case, will call him, will look for evidences and all that, and finally come to a conclusion that yes, he is fit or no, he is not fit, right? So whatever conclusion he comes across, he records that decision under section 242. And if he is fit, great enough. If he is not fit, then such person shall not hold office for 5 years from the said decision, without the leave of tribunal. So if he wants to be appointed, he can take permission of tribunal, and such person shall not be entitled to compensation. Just the same thing that we have read before also. I have made another chart for you all in the same capacity so that you understand the whole, for the same topic, so that you understand the whole concept well once again. Central government, if these circumstances suggest fraud, negligence, or default, not sound business principles, or serious injury to trade or industry, or intent to defraud, then it can make an application to NCLT to inquire along with concise statement. This part is given in section number 241. After hearing, NCLT shall pass order. This is given in section 242(4)(a). If he is fit, no further action needed. If he is not fit, then these three parts are given over here. Such person shall be removed, disqualified for 5 years in any company. If tribunal terminates or sets aside some agreement with the director, he's disqualified to be appointed for 5 years only in that company. But if tribunal finds that a person is not fit enough, then he's disqualified for 5 years to hold office in any company. That's the difference. And also entitled to compensation for that loss, right? So you get double clarity this way, right? So I think this is clear. Okay, now we probably have this last section that we need to discuss. Class action. Class action is a benefit which has been given, and this benefit is not just for the members but also for the depositors. I have made you a proper differentiate between section 241, section 245, that there also some members are coming together and making an application. Here also members are coming together and making an application. So what is the difference? All that difference I've already told you. Right now we'll focus just on revising our concepts, right? So members can also go for class action and depositors can also go for class action. If members, we are talking about members, the company may be with share capital, without share capital. If it is with share capital, the lowest of 100 members, 5% of number of members, or if it is a listed company, members holding 2% of share capital. If it is unlisted company, members holding 5% of share capital. Fine. If the company is without share capital, 1/5 of the number of members. You have to learn it. If you don't learn it, no, you will think and try to uh, focus that what is ma'am trying to tell us. I'm unable to gain this. I'm unable to retain this. So you will face a lot of problems if you don't learn. Wherever in law there is a limit, my dear, you have no choice but to learn, right? Other than these numbers and limits, all that concept building helps you to retain the concepts throughout, but this learning part has to happen. Okay. And if it is depositors, exactly the same thing. 100 depositors, 5% of depositors in terms of number, or the depositors who owes 5% of total deposits. So this is in terms of value and this is in terms of number. Fine. Now, if you are eligible, you can make an application. On what ground? That management of affairs are being conducted in a prejudicial manner. Tribunal will consider the factors. Tribunal might admit your application or it might reject the application, right? You are making an application to seek these specified remedies, which may be granted to you. There is an option at the end, other remedy as well, which is a leftover option. Now, before this, what is the procedure of class action? In the procedure of class action, once tribunal receives an application, tribunal gives a public notice. Public notice as in, we have received a class action application. Now, all the members are being given a public notice. There might be some members who want to opt out from this, they can. But if they don't want to opt out, they are deemed to be a part of this class action application, right? Maybe there might be a situation that two class applications have been filed in the same regard, so they will be clubbed into one and one lead applicant will be selected. Now, it is the choice of the applicants only to select one lead applicant. However, if there is a conflict between these applicants, then tribunal can take a call and tribunal can decide about the lead applicant, which is going to be binding on everyone. Fine. So what orders or what types of remedies can be obtained under this section? The company can be stopped from doing an ultra-vires act, from committing some breach, and some resolution can be declared as void. A resolution for altering a particular regulation of articles of association was passed, but there was some problem which we have discussed in classes, so that can be rendered as void by the tribunal. Restraining company to act on above resolution. Since the above resolution has been rendered to be void, then obviously you will not even act on that resolution. If that resolution was valid, you will take its actions. But if it is not valid, then you will stop yourself. You will not go ahead, right? Stopping the company to act in contrary to the provisions. You can claim damages from the director, auditor, expert, others, and any other remedy which may be granted, right? So these are the different types of reliefs or remedies which may be given under a class action suit. Fine, so that was super quick revision of the chapter of prevention of oppression and mismanagement. Now, corporate governance. See, corporate governance, basically what it means, it is all about managing the business, right? That means adopting such process or procedures to manage the affairs of the company which comply on three parameters: fairness, honesty, transparency. Actually, fairness, accountability, and transparency. But we can say that corporate governance is a procedure by which affairs of a corporate are being managed with regards to fairness, honesty, and good practices. Of course, it is not going to benefit only the company, but it is ultimately going to benefit all the stakeholders. So, corporate governance, if you adopt these processes in managing the affairs of the company, it is going to be beneficial for all the stakeholders were around. Right now, what is this corporate governance? Okay, fine, there are certain procedures or there are certain processes that we have to adapt. Is this procedure complied or written in law? The answer is yes. A lot of corporate governance procedures have been imbibed in law to make it mandatory for the benefit of all stakeholders. However, there are there is still a lot of scope of fair practices, honest practices, good practices for the benefit of all stakeholders, which might not be made mandatory in law, but which are the thought processes of upper management, and it flows down throughout the company, which is called as a top down approach. Okay, so it is about managing a company with regards to fairness, honesty, and good practices. Who manages any company? A company is being managed by the board of directors or the shareholders, right? Ultimately, it is being managed undoubtedly by the board of directors only, but shareholders also have certain decision making powers. So, mainly, they are responsible for the governance of companies. The governance can be good or bad. Of course, good governance, when we talk about it, brings good image, reputation. It helps in good finance, trust in the company, and ultimate growth of the company. So, corporate governance normally applies at the top level, as I explained to you, and it flows from top to bottom, which is also called as top down approach. Now, see, corporate governance is the main motive, or you can say, when we talk about the objectives of corporate governance, it is all about bringing transparency, bringing more justified policies for all the stakeholders. Right. Corporate governance aims at bringing an ideal composition of board of directors, because they are the ones who are ultimately responsible for governance of companies. So if there is an ultimate ideal composition of board of directors, ultimately there will be fair practices in the company. Right. If there is corporate governance, then there will be optimum use of resources. Resources means all the type of resources. There will be reduction in risk management. Okay. And undoubtedly, you are going to develop a strong relationship with your customers, with your suppliers, with the government, with your employees, with everyone. So there will be a strong relationship of the company as well as all the stakeholders. So it brings about transparency, it brings about good management, it enhances the value of enterprise, it makes people accountable, it helps in more innovation, it helps in bringing professionalism in the corporates, and it also incorporates, or all the stakeholders are also contribute towards the company, right? Now, ma'am, is it similar to what we call as ethics? No. Ethics are an individual choice, right? And everyone has an individual choice. So, a manager also has an individual choice, and so is a peon who is working. However, when we talk about corporate governance, we have to adopt the policies which are being developed by the corporate. So, it normally applies at the top level and it flows from there, right? Ethics emerge naturally, but corporate governance is studied, experienced, evaluated policies which you develop over the period of time for ensuring fair practices in the company, right? So in ethics there are no regulations. However, in corporate governance there are regulations which are involved, right? In the same manner, it distinguishes management also from corporate governance. Management is different. Management also applies at all levels. However, corporate governance applies only at the top level, right? Regulations are not important in management, but in corporate governance, regulations are very important. Okay. Corporate governance is not about achieving any result. However, managers are focused. This is our target. This is our target. This is what we have to achieve. So, managers are all about achieving a particular target. However, corporate governance is the process. You have to achieve the target, that's a different thing. But corporate governance is about fair method of reaching, fair method of that procedure, fair method of managing a company towards your target, right? So methodology of achieving results is more important than the actual result in corporate governance, right? Now corporate governance has been evolved because of the corporate failures that we have witnessed because of more investors being participating in the market, and especially institutional as well as retail investor. A lot of retail investors have also increased. So the government also want that only secured information is being passed, and that information should be reliable. So increasing transparency, increasing disclosure, that has led to more evolution of corporate governance, right? So you have to connect with the stakeholders, you have to comply with the regulations, you have a lot of other regulatory requirements also. So considering all these in mind, this is how corporate governance has emerged, and it has a lot of benefits which I've already told you, right? So we discussed about. Now we also have something called as the theories of corporate governance through board management. So we have in total 4 theories, which may be asked as a objective question as well as a proper subjective question. Maybe write a short note on, or maybe you have been given a particular situation and this theory is, you may be asked an MCQ also. Stewardship, where the directors decide and drive. So they are the stewards of the company. Agency, the directors act as the agent of the company. Stakeholder, we include stakeholders. And trusteeship, they are given authority, and it is all about trust. So they are the relationship of trust established, and they're being handed over a huge amount of money which belongs to the company, right? But there is a relationship of trust which involves over there. With this, we come to the end of our very first unit. We move to the next unit of corporate governance, which is corporate governance practices or codes in India. Okay, so for that we have the very first one, which is Cadbury Committee. Cadbury Committee, or you can say Adrian Cadbury Committee. It was set up by Security and Exchange Commission of USA. So it is not an Indian committee which was set up, right? Any committee which is being set up or which is being formed is for a particular purpose. That okay, fine, you do that feasibility study, you research, and you bring your own recommendations that this should be imbibed in law, right? So they also, every committee comes up with their own set of recommendations. There are many recommendations which have been made mandatory by law as on date, but this is backdated what we're reading. Okay, fine, this particular committee was formed back then. So Cadbury Committee, what were their recommendations? They said that listed companies should have audit committee. We know that it is mandatory now, right? And such disclosure should also be made in the annual report. Whoever is the statutory auditor as well as the finance auditor, they should attend all the meetings of audit committee, right? Other members or other board members may also have the right to attend. And the audit committee is going to discuss with the external auditor about the scope of audit, like which audit firm is engaged and all that part. And the chairman of audit committee will be available at annual general meeting to answer the queries. So these are broadly 4 points which you should keep in mind. Next comes your Rahul Bajaj committee. Now this is Confederation of Indian Industry constituted this particular committee. So it is an Indian committee. Now it recommended, what were the recommendations? They were very short recommendations that you have to study. The recommendations being that only listed company, okay, with the turnover of either 100 crores and paid up capital of 20 crores have to set up the audit committee, right? Ma'am, both the conditions have to be complied with? No. Lesser, whichever is less, that you have to comply with. And if you comply with that, then you have to set up an audit committee within 2 years when you reach that particular threshold. Now, audit committee is undoubtedly there to assist the board. Then comes your K.R. Chandratre committee, which is again an Indian committee, and it broadly focused on audit committee only. So companies with paid up capital of 5 crores, they should have audit committee. Now, audit committee will discuss with the auditors periodically. Audit committee will have the authority to investigate also. So investigation powers will also be given to audit committee. Which matters it can investigate? It can investigate matters on its own or those which are referred by the board of directors, right? And then there will be punishment also for non-compliance, which includes imprisonment. And the chairman again of audit committee will be present at annual general meeting to answer the queries. And lastly, we have Kumar Mangalam Birla committee, which is an Indian committee which was set up by SEBI. So this is actually an important one, and you have a lot of recommendations that you have to read about it. It has certain mandatory recommendations and certain non-mandatory recommendations also, which are just recommendatory. Okay, so it came up that this should be made mandatory and this can be made optional or this can be made voluntary. Half board to be independent. Half of the board of directors should be independent, but if the chairman is non-executive, then 1/3 may be independent. Okay, fine. Companies with a capital of 10 crores and net worth of 25 crores. Actually, you can leave this particular point. In fact, I haven't even incorporated this particular point in my charts. committee will be there for investor complaints also. That means a committee should be formed to which is going to study investor complaints, which we have today, right? We have stakeholders relationship committee, we have nomination and remuneration committee, which is also recommended by this particular committee. Okay, so there will be audit committee which was going to investigate. There will be a committee for investor complaints. There will be a committee for nomination and remuneration, right? And then the chairman of these committees will be present at the AGM to answer whatever shareholder queries they have, right? Then annual report should have a lot of details about the directors which are being appointed. Okay, now the next topic that we have is principles of good governance. So we have a board level and we have below board level. What is board level? Standardized, regulated by Companies Act and loader regulations. As I told you, when we talk about corporate governance, it flows from top to bottom. So at board level, everything has been made mandatory. A lot of things have been made mandatory. Where do we read about corporate governance, which board of directors have to comply with? It is regulated by Companies Act, and also major portion of it is also regulated by loader regulations. Loader, SEBI loader regulations is nothing but it is corporate governance only. But obviously it does not apply to all companies, whereas when we talk about Companies Act, mostly provisions apply to all types of companies, right? So if I say that, okay, fine, if you're a listed company, you have to have a woman director. So that is what? That is a step towards corporate governance only. The loader also regulations also have a lot of content to it. Below board level, every company has their own code of conduct, and undoubtedly they have their SOPs, standard operating procedures, they have their department manuals. So that has been designated or designed at the management level, and it flows from top to bottom. That is top down approach that I've already explained you, right? Now we have certain things that we have to read about independent director also in the chapter of corporate governance. Although you know about independent directors, which you have read under Companies Act, but here also we have certain things, and we'll have a broader perspective apart from what is strictly written in law, right? So independent director, there is a code. We all know that Schedule 4 of Companies Act 2013 gives us the code which has to be followed by the independent director. How an independent director will be appointed, we already know that. But here we have something else. We have to ensure, apart from the disqualifications, you also have to ensure that he must possess the appropriate skills. And he will be approved at a general meeting. There will be a letter of appointment which will set out his term, the company's expectation from him, the duties, provision for director and officers insurance if any, and code of business ethics which he must comply with. Independent director should always have high standards of integrity. He should perform his duties. He should do whatever he is doing for the benefit and interest of the company, and he should not involve his personal benefit. So he should keep his professional obligation different or separately, right? He should not do any type of activity which ultimately loses his independence. So he should assist the company, he should assist all the board of directors in the best possible manner, right? So we have certain things from examination perspective. We have the roles and functions of independent director, which we have to read. We have to read about the duties of independent director and the manner of appointment. Manner of appointment, somehow I've already told you. When we talk about the duties of independent director, so duties, independent director should regularly update his skill, take professional appropriate advice whenever needed, attend all meetings, whether they're general meetings, board meetings, committee meetings. He should keep himself well informed, report concerns about any unethical behavior that he comes across. He should not disclose confidential information or unpublished price sensitive information. Okay, so of course there are more points, but these points should be sufficient. Then we have something called as corporate governance ratings. Whenever we rate anything or anyone, it determines his relative standing. See, you cannot say this is A unless you have a D also. Right? So when you're rating someone, it determines your relative standing. Okay, fine, this has been rated as B and this has been rated as A. Then on the parameter or on the tenets of corporate governance, this entity is better than this. So this is better. That is the relative standing. Right, so it determines the relative standing of an entity with respect to other entities, but we're talking in terms of corporate governance only. We're not talking in terms of any other thing, right? So when I talk about corporate governance, there are certain cases where you have to have these ratings, right? There is also a compliance report which has to be furnished by listed entities Compliance report on what? Compliance report on corporate governance. So for that also we have different annexures. I think I have, okay, I'll tell you that. Right. So we have that also, that is one parameter. There is another parameter that, okay, corporate governance ratings. They help the stakeholders provide a lot of information. They helps to determine which entity is better. That is, it helps to establish the relative standing of an entity, right? It enables the stakeholders to form a better decision, right? And it see, we have three aspects, although we have a lot of assessment criteria. If we are being asked an examination that there is Mr. Shah, Mr. X, whatever, he is a stakeholder and he wants to know how this particular company is performing on the tenets of corporate governance, right? Or as an employee, if you want to join a particular company, you would be willing to know that, okay, what is the relative standing of this particular company when I talk about governance. So for that, we have three components. When we talk about this corporate governance ratings, we have ESG ratings, which is the similar thing. So we have environment, we have social rating, and we have governance rating, right? So when we talk about environment rating, we check the environmental key metrics, right? And based on that, the rating is given. When we talk about the governance rating, we check about the board governance, who is governing the company. So what is the ideal composition of board of directors? What is the pay that you are giving? Ownership and control, inclusion of stakeholders and all, and accounting about the maintenance, disclosure, transparency, everything. And thereafter, we have social key metrics, which incorporates other things, right? So based on three: social rating, environmental rating, and governance rating. So you may be asked in examination, what are the three types of rating? When you're being asked the types of rating or ESG ratings component structure, this is what you have to write in examination. Now, you may also be asked about the assessment criteria. That means which points should be kept in mind while you are assessing about the governance of any company. So you should check about the board structure, you should check about accounting, you should check about professionalism, you should check about the disclosure, you should check about the grievances. Whose grievances? Investor, customer, vendor. How these grievances are being dealt with, how much CSR they are doing, right? How much dividends they are being paid, how much compliance they are doing with the law, right? How much disclosure they are doing, how much they're incorporating shareholders in their decision making, right? So all these points should be kept in mind while deciding about the ratings. Then if I come about to listed entities have to submit quarterly compliance report on corporate governance to recognized stock exchanges, and there is format which is being given in the annexure. So we have annexure 1, 2, 3, 4. So these are the four things that you have to keep in mind. Annexure 1 on quarterly basis, annexure 2 at the end of the financial year, annexure 3 at the end of 6 months from the close of financial year, and annexure 4 on half yearly basis. In the regular class, I've even shown you these annexures and explained you what these are all about. We move to the next unit, which is corporate governance in family business. Now, family business is all about where majority voting power is in the hands of the controlling family, like we call Amanis, right? Now, what happens over here is that you may call it family business, you may call it a family company, you may call it family owned business, whatever you may call it. Here what happens is that the power is concentrated in the hands of family. The power, as in the terms of voting, as in the terms of decision making, right? Now this leads to a lot of advantages and this leads to a lot of disadvantages also. If I prima facie talk about the features of such family owned companies which we have in India, the directors or the senior management are from the family only. The formation of a lot of groups is common, right? Coterie is common. Emotions are attached. There is dilution of shareholding from generation to generation because we have 5 children, then we have to dilute the shareholding amongst 5 people, right? There will be conflict of interest undoubtedly. In a family of 2, there is a conflict. So whenever we are talking about the family owned businesses, there will be undoubtedly conflict of interest. Now, the ones who do not belong to the family, that is the non family directors, they're actually defunct in decision making. They're not involved in decision making. So they just have to blindly follow what the family members are saying, even if they're not very much competent or more competent than the non family directors. Hardcore professionals thus avoid working or joining such companies because they don't feel the worth, right? Even if they have something to contribute, maybe the family is not ready to accept the same. And the death or disability of any senior member leads in management crisis. Why? Because they are the ones who have expert knowledge. They are the ones who are leading a family, and if they die, then ultimately the whole business gets shattered because there is no one who is competent enough. There may be, right? Even some family members may not have these features. These are the general features or the common features that we find in family businesses, right? So they may be present, they may not also be present, right? Now, the emerging issues in such businesses are dealt by separation of ownership and management. So now the ownership is in someone's hand and the management is in others' hands, right? So family members are also growing. They're acquiring professional courses from reputed institutes. Their promoters are encouraging more professionals to join the company. The role is being decided at the board level. That okay, fine, this is the role that you have to do. So that role, the person will be restricted to that role only, right? Owners are accepting the decisions of managers. So whatever managers are contributing, the owners are willingly accepting. And you can also form a trust and thereby make your son or your daughter the beneficiary of that trust, so that he gets the benefits but he's not involved in the direct management, which leads to better managing of the company. The next unit that we have is all about CSR, and we also have some guidelines. What are these guidelines? Earlier we had NGRBC, earlier we had National Voluntary Guidelines, which is NVGs. Now we have NGRBCs. So here I have written in short 9 points. You don't have to read them in much detail, but of course you should know all these 9 guidelines. Since it is a revision, I'm not taking you to the actual flow of these. But yes, businesses should conduct and govern themselves with integrity. So undoubtedly there has to be honesty, and there should be a manner of transparency, ethical and accountability. You should provide only such goods which are sustainable and safe. We will read about the sustainability. That means you're not compromising. You're not compromising on the future needs or the needs of future generations. So whatever you're using in your business, you have to ensure that the needs of future are not being compromised with. Right? Businesses should respect and promote well-being of all employees. So whoever is employed, if I'm talking about the value chain, it is right from start to the end. So whoever is employed, whoever you're taking help of, whoever is working for you, you should promote the well-being of them. You should respect the interest and be responsive to all of its stakeholders. Supposedly there is a vendor grievance, supposedly there is any shareholder grievance, so you should be responsive towards everyone. You should respect and promote human rights, very important. Make efforts to protect and restore the environment. So emit less industrial waste. Try to bring different ways of recycling. Try to restore environment in the best possible manner. Then sometimes you may be involved in policy making. You may be a part of it. So you should take that in a responsible manner. You should promote inclusive growth and engage with your consumers in a responsible manner. See, it is very important. Whether you're in a product sector or you're in a service sector, if you're providing a particular product, you have to ensure that it should not be hazardous. You should have to take that responsibility towards consumers and ultimately thus provide whatever you're providing, right? After that, we also have something called as CSR. Right. CSR is covered under Section 135 of Companies Act 2013. We all know that, right? Now, in CSR, this is the overview, what we read in Section 135, read with rules, and then we also have a different perspective. It's actually extracted from the rules only, but still. Steps in the implementation of CSR, that also we will see. So, company which complies with any of the following conditions has to go for CSR. Net worth more than equal to 500 CR, turnover more than equal to 1000 CR, or profit more than equal to 5 CR. So if any of these conditions is complied with, you have to form a CSR committee. And that CSR committee will recommend a CSR policy which board will approve, and thereafter you have to have a minimum expenditure of 2% of average net profits of preceding 3 years as your corporate social responsibility. Okay, what is going to be that expenditure as approved or as covered under Schedule 7 of the Act? However, if your expenditure is not exceeding 50 lakhs, then you don't need to form a CSR committee. What you can do is your board itself can have a CSR policy and they can go for CSR expenditure. You have to have CSR expenditure, but CSR committee is not required. However, if CSR committee is mandatory, then it should be composed of 3 or more directors, out of which at least one shall be independent director. Your CSR policy is going to be placed on the website and also contained in the board's report. How can you implement CSR? That we'll read actually later. If you take any activity outside India, that is not going to be considered as CSR. If you contribute anything to the political party, if you do any activity in the normal course of business that you do, or which benefits only your employees and their families, that is not going to be considered as CSR. Now, you have to do that CSR expenditure. Sometimes what happens is that the CSR expenditure exceeds, or you can say it is invested in such a project which is not completed in 1 year. So directly we cannot apportion the expenditure to that particular year. Maybe you have a requirement of 1 crore in a particular year as CSR expenditure, but you take up a project of maybe developing a school which requires a duration of 2 years. So in the first year, you have spent only 50 lakhs. However, you were required to spend 1 crore, but you could spend only 50 lakhs. Now, what you can do is, for an such ongoing project, if the amount is not spent at the end of the financial year, within 30 days, you transfer that 50 lakhs remaining to unspent account in scheduled bank. Okay, it will be considered as CSR compliance. Okay, and it has to be undoubtedly used within 3 years, and if you have spent excess, then it can be set off also. Now we come to the next part, which is CSR implementation. Okay, how do you implement CSR? First is determining the thrust area. See, there are a lot of areas where you may go for your social responsibility. So you have to decide a domain. You have to fix a particular area. Okay, fine. This is the area where we want to contribute. Okay, where we want to spend money. So you have decided the target area. Thereafter, you identify the project. Okay, in this particular area, maybe we want to develop a particular school. So that is your project. Project is we want to build a school. Then you evaluate the CSR project. Before making expenditure, you are doing that evaluation. What evaluation? That what will be the nature of the project, what will be the cost involved, the linking, who will get benefits of the beneficiary, how much feasible it is, feasibility from all perspective, what will be the time involved, how are we going to monitor it, will the impact of this particular effort of ours be measurable or not. So all that you are evaluating, right? After you evaluate, you go for implementation of the same. Now, implementation may be direct or through third party. See, we have certain specialized implementing agencies also. If we go or look at section 135, any CSR activity may be implemented by a company. You can form your own section 8 company. You can use section 8 companies. I am saying the broad term. Okay, we have in-depth things. I'm saying the broad term. You can form your own section 8 company. You can have the company or the registered trust which is formed by the government or act of parliament, and you can have other also. But if you are going for others, then they should have a track record of 3 years in similar activities. Okay, now there are specialized implementing agencies, like if I talk, there may be the panchayats or voluntary agencies, or there are self-help groups, a lot of Mahila mandals and all. So through them also you can go ahead for your CSR expenditure. Now, there are advantages as well as there are disadvantages of direct implementation. So if you go for direct implementation, it will be flexible. You will have a better supervision because it is being directly implemented by you only. So there will be quick decision making, less coordination, less cost. At the same time, you might not have adequate manpower, you might not have that domain knowledge, right? You might be biased towards a certain thing, you might not take corrective action, right? Maybe you have lack of monitoring, or you have lack of local area knowledge, you don't have that language is not known to you, right? So a lot of things may be creating problem also. If we go for third party implementation, again there will be advantages, there will be disadvantages. Advantages, there may be better supervision, there may be expertise there, they may be unbiased, they have a single point of coordination, right? You can negotiate a lot of cost and you can cut down cost when you are hiring a third party for that, right? there are disadvantages also. What are the disadvantages? Disadvantages, maybe there is more supervision involved because it is not your direct thing that you're doing, right? Maybe they do not have that domain knowledge which you have. Maybe they are biased because they have a certain beneficiary to cater, they want to cater that only, right? Maybe they're not maintaining proper accounts, maybe they're not telling us the negative points, right? Maybe they're dominating a particular area, right? So there might be different problems also. Now, if I talk about implementation, there are internal and external problems which are being faced in the implementation phase, as in preferences deciding, mismatch financially, lack of seriousness, right people to work, you don't have them, internal references, differences in opinion, and if we go for external things, we have political pressure, we have social pressure, we have inefficient implementing agencies, or maybe they are diverting, siphoning money. This is a huge point which I'm diverting money or siphoning money. Siphoning money is a huge point, so I'm not getting into it right away. Fraud, there may be fraud involved. There is an NGO to which you have given 1 crore rupees, but ultimately they're not even working towards it. It is not ultimately going to a beneficiary. So maybe, so these are the issues that we face, right? Now we come back to the evaluation after making the expenditure. So we go back. After making expenditure, how can you evaluate? So you can make a team of 2-3 officers who inspect the document, they make a report, right? And the report is placed before the CSR committee. It is recommended to board for approval, right? Agreement is made by the company and implementing agency for the execution and all that, right? Now, after you have completed this, the next step is monitoring, and monitoring should not be done at the end of the project. It should be done periodically, right? So you can assess the progress, how it is going on, and if there is any wrong thing which is found pre-hand, then you should take immediate corrective action. Thereafter, you have something called as impact assessment. Impact assessment actually helps you to know that whether spending so much of amount was worth it or not, right? So it should preferably be done by an independent third agency, right? Because you might be biased, you might be thinking, no, it was helpful, or somebody who has taken decision, if they are doing the impact study also, they will definitely say yes, it was very impactful, it was very helpful, but no, ultimately maybe it was not helpful, right? So, and it should be focused on the impact only. It should be done immediately. If I take a particular session, if I ask you immediately, was it effective, you will say yes. But if I ask you around 15 days later, no ma'am, we hardly found any, because you tend to lose that memory. That memory fades away. You don't remember, okay, ma'am told me this, right? This was effective. So the same thing happens even in case of taking up a project, right? Whether it is effective or not has to be done immediately after the benefit is being given, right? And then we move to the last unit, which is actually a short one, sustainability management. So we have 3 approaches to sustainable development, which is social, environment, economic approach. Social approach is for the people, environment is for the planet, and economic is for the profit, which is also called as triple P, right? Triple P approach or triple bottom line approach, whatever you may call it, right? Now a manager has a lot of areas or a lot of steps that it has to undertake. The same goes for sustainably managing the company also. You have to identify the problem, you have to set the thrust for solution, you have to set a target, evaluate a project, select that project, plan action, use technology, innovate, schedule your actions, organize staff, directing, monitoring, corrective action, and review. The same thing goes here as well. Now, sustainability management or sustainable management is what? You are not compromising on the needs of future. You are fulfilling the needs of present, but without compromising the needs of future. That is something which is very important. So you have to maintain the quality of life on this planet, right? You should do such businesses, you should undertake such activities which are sustainable. If you wish to stay in the business, you have to ensure sustainability also. Okay, so this is something which is important. Sustainable management maintains the economic viability, it limits the resource depletion, it maintains quality of life on planet, company can generate more savings, and it can lead to better performance also. Thereafter, we also have something called as sustainability reporting, for which we also have read about ESG ratings. So there we have to, the listed entities have to give a compliance report on CG. There, that is being incorporated, right? Now we are going to revise SEBI regulations. The first one, SEBI ICDR. First thing is conditions for IPO. That means the eligibility of issuer who can go for initial public offer. Now, before I start with this, a quick recall which you all should know, but even if you do not know, just have some basic ideas. How can someone or how can a company raise funds through public issue, through bonus, through rights, and through private placement? So when we're talking about private placement, it is an offer to a specified person, maybe to QIBs, maybe to other persons, other investors. They could be institutional investors, they could be retail investors like us also. And when we're talking about public offer, then public offer means IPO, that is initial public offer, FPO, that is further public offer, and then we have offer for sale. Okay, so the first thing that we are talking about is IPO, right? Now, IPO, that is initial public offer. Who can go for IPO? There are certain eligibility requirements. See, if there is a promoter or a group which is debarred from accessing the capital market by SEBI, then definitely they cannot go for initial public offer. If you don't make an application to stock exchange for approval, you cannot go with that, right? If you haven't made an agreement with depository, no. If you are going for partly paid shares, no, right? Arrangements of finance of towards 75% have not been made, then no, right? If you want to utilize the amount for general corporate purpose of more than 25% of what amount you are raising, no. So your amount that you're raising should be for core purposes that you should have been allocated. If the promoter is a willful defaulter, no, right? Then issue is open for less than 3 days or more than 10 days, so it has to be within that time frame. Or if there is non-compliance of minimum subscription, which ideally is 90%, right? So if these are not met, if these conditions are not met, then you cannot go for IPO. Apart from that, you need to have a merchant banker, you need to have a registrar to issue, you need to have a compliance officer. Now there comes two cases. One is, as I say in my language, that a company which has a good track record, that means that the company which meets the eligibility criteria which is given over here, then you just have to follow the conditions of IPO and you can go ahead with IPO. So IPO is allowed only if you meet these conditions. What conditions? Your tangible assets should be more than equal to 3 crores, of which less than equal to 50% in monetary assets. That means your most of the assets should be in operations, right? Your minimum average pre-tax profit should be 15 crore, 3 out of 5 years. That's how you calculate. Net worth more than equal to 1 crore each preceding 3 year, right? So if you meet these eligibility requirements, great. But if you do not meet this eligibility requirements, can you go through IPO? The answer is yes. But in that case, you have to go through book building. Okay, so you may make IPO if proposed IPO is less than 5 times pre-issue worth and issue through big building and 75% to QIP, right? So because we want that assurance that IPO will not fail, right? Because you're not such a big company. Okay, so if you satisfy the criteria, fine. What criteria? You have to remember it from examination perspective. If you don't satisfy the criteria, this has to be how you are going to do that, right? Now, what is going to be the price of shares in case of IPO? The price is determined in consultation with the lead merchant banker, or price may be built through book building process. When you are not sure of what price our shares can fetch from the market or what demand will be generated, we go through book building process, right? Because book building process is somewhat which elicits demand in the market. So when we're not sure, we go through that book building process, right? So I hope this is clear. Now, differential pricing. Differential pricing is also a topic in which a lot of questions is asked in examination. So, differential pricing is allowed, but it is subject to a limited variation. What variation? Individual investors at a price not lower than 10%. So, whatever price you're offering, 10% lower, not below that, right? Anchor investor not lower than the price that you offer to others. Then shares to employ, lower than floor price, but difference not more than 10%. And face value. This is also a very common objective type question which may be asked in examination, is the issue price. What can be the issue price? So minimum issue price can be 1 rupee also. But if your share price, if it is less than 500, if the amount is less than 500, the face value has to be 10. If it is more than or equal to 500, then the face value not less than 1. So minimum face value has to be 1. This can be asked as an objective type of question also. So what we understand by book building, it is a process to ascertain the prospective quantity and price when we are not sure that what will be willing to be purchased by the buyers, right? So that's how we go for the book building offer. But how do we resolve the pricing issues? We have the guidelines of differential pricing and we have to keep in mind those guidelines. And on the basis of that guidelines, we can go for differential pricing also. Okay. Now, promoters' contribution has to be minimum 20% of post-issue capital. Promoters' lock-in period, we also have a lock-in. Promoters' contribution has to be locked in for 3 years and for 1 year. I hope you remember that, 3 year and 1 year. Now, last, book building allocation. Okay, let me make it more clear. Minimum promoter's contribution is locked in for a period of 3 years from the date of commencement of commercial production or date of allotment in public issue, whichever is later. And promoters holding in excess of minimum promoter's contribution, that is locked in for 1 year. So minimum promoter's contribution is locked in for 3 years, and above that is locked in for 1 year. Then we come to book building. The last topic that we have to read in ICDR is about book building. Now in book building, I have already told you that is the process to elicit demand, to assess the price, right, to determine the quantity, right. Now what we have to remember from examination perspective is three things. If book building is happening by eligible entity, that is I am eligible to go for IPO, that is I fall under regulation 6.1, and then I'm making book building issue. So what is the minimum allocation to which category? Net offer to public. See, if I divide the whole securities, I have a category of promoters, I have a reserved category, and then comes net offer to public category, in which you have the institutional investors, you have QIBs, right? QIBs are institutional investors only. So you have QIBs, you have non-institutional investors, you have retail investors also. So all these people come in net offer to public category. So what is going to be offered to them? So there we have a limit that if you're going through book building, or if you're not going through book building, how that allocation will be done. So if you're going through book building, more than equal to 35% should be for retail investors, more than equal to 15% to non-institutional investors, and less than equal to 50% to QIBs, out of which 5% to mutual funds. Okay. Now, if you fall under regulation 6.2, that means you're not eligible and you're raising through book building. You do not meet that eligibility requirements. You do not have that good track record. That means you fall under regulation 6.2. Subregulation 2 of regulation 6. Then what will be, how it will be allocated to net offer to public category? Less than equal to 10% to retail investors, less than equal to 15% to non-institutional, and more than equal to 75%. There also we read that this is the minimum criteria, that at least 75% should be given to QIBs, because we need that assurance, right? So more than equal to 75% to QIBs, out of which 5% to mutual funds. Now, if it is other than book building, then more than equal to 30% to retail individual investors, remaining to other applicants, right? So this is the limit that you need to remember. Okay, now the topic of insider trading, that is prohibition, SEBI PIT regulations, prohibition of insider trading regulations. First thing is, what is insider trading? Trading of securities by insider is kind of insider trading. Now, who is an insider? Insider may be a connected person or the person who has possession of unpublished price sensitive information. The question is, who is connected person? Connected person who is associated with the company or in past 6 months has been associated with the company, maybe even by frequent communication, which allows him access to UPSI, right? Now, we also consider certain persons to be deemed connected person, like the relative, immediate relative of such connected person, then holding, associate, intermediary. In fact, when we talk about the mutual fund, we talk about the investment company, we talk about the stock exchange, right? And the banker of the firm, public financial institution, and such firm, HUF, in which director or banker or his relative has more than 10% stake. They are also called as connected person, right? Now, insider trading is completely prohibited. That is the first thing, that any insider cannot trade. In fact, insider cannot, in the regulation imposes two restrictions. Restriction number 1, you cannot share the unpublished price sensitive information. The question is, what is UPSI? The most important definition in this particular regulation has 3 components: unpublished, price sensitive, and information. Information relating to company and its securities, which is not available to public, that means it is unpublished, and if it is made available, then it will materially impact the share prices or the prices of securities. So it is price sensitive. What could it be? It could be information related to financial results, but it is not restricted to only these. Then dividend, then maybe mergers, acquisitions, change in key managerial personnel, and like things, right? So that is UPSI. Now, any insider who is a connected person or has information about UPSI is not has been told by law that you're not allowed to share this information. You're neither allowed to trade if you have this information, right? So there is restriction on communication of information, as well as there is restriction on trading also. You cannot communicate except for legitimate purpose, performance of duty, or discharge of legal obligation. Okay. So this is one thing. Supposedly you communicate this or you go against the regulations, then it is your burden. That means the onus to prove that you did not have UPSI is on the connected person. However, when we talk about the offense with respect to other persons, the onus to prove that someone has possession of UPSI is on the board. Okay, now if we talk about the next thing, that is trading. So insider is not allowed to trade, but however, insider is entitled to formulate a trading plan, give it to the compliance officer, and thereafter, when compliance officer records approval and he submits it to the stock exchange, you're allowed to trade upon public disclosure, right? So this is something which is allowed also. That means trading is allowed in certain cases. Then we have two things: code of fair disclosure and code of conduct. Okay, but before that, every listed organization also is required to maintain a structured digital database. See, supposedly for legitimate purposes, you have to share UPSI, right? So you will maintain a digital database where you will share. Where you will record the nature of UPSI, the persons to whom UPSI is shared, and all that. So it is going to be a digital database which has to be preserved for at least 8 years. If investigation is going on, then for such higher period, right? Now we come to the next part, that is code of fair disclosure and code of conduct. So first thing that we call code of fair disclosure is applicable in every listed company. So every listed company is going to formulate and publish on its official website a code of practices or procedures, you can say, with respect to disclosure of UPSI, that when you can disclose, how you can disclose. In fact, we have schedule in this regulation, schedule A and B, that we have to read about. So schedule A gives us rule with respect to the same. It says that there should be prompt disclosure to general public of UPSI, because the more you hold a certain information, the more chances of leakage of information is there. Then there should be a senior officer who is going to be designated as Chief Investor Relations Officer, who will disseminate this information. There should be proper response to the queries or the rumors which are being generated, and you should develop best practices to record proper meetings. You should not provide UPSI to the analyst, right? So these are the rules with respect to disclosure of UPSI. Then we have Schedule B, which contains the code of conduct. This code of conduct is applicable on designated person, not on everyone, designated person, to monitor their trading. So compliance officer along with the board, they recognize some people as designated person, and their trading is being monitored. So they cannot trade just like that. They need to obtain pre-clearance from the compliance officer, and thereafter they can trade. So compliance officer, I think I have written this right. So designated person is covered by the code of conduct along with its relatives. Pre-clearance needs to be obtained by designated person for trading in securities. Trading window. Supposedly, how compliance officer gives pre-clearance. Compliance officer will ensure that, okay, you are a designated person based on your roles, whatever you perform in the organization. We know you are a designated person. You may be exposed to UPSI. So we have identified you as a designated person, and now we are going to monitor your trading, right? We're going to regulate your trading. So you come to us, and when you come to us for obtaining pre-clearance, we will ensure, and in fact, we will take a declaration from you that you do not possess any UPSI. Then we will give you pre-clearance. Okay, fine, you can trade. The trading window is open for 7 days. Within that, you have to trade. Otherwise, you need pre-clearance again. Okay, so prior to approving that, compliance officer will ensure that. In fact, compliance officer reopens trading window, even considering a lot of factors. And other than that, code of conduct may also specify the formats, that is the application for obtaining pre-clearance or reporting of trades, right? So compliance officer will provide reports to the board, more appropriately audit committee. Fine. Okay, then we also have something called as institutional mechanism, and something called as the disclosure of trading by insiders. We broadly have to read only two disclosures: when KMP is appointed, and the securities that he is holding, and if in a quarter your trading exceeds the figure of 10 lakhs, then within 2 trading days you have to disclose that, right? So over any calendar quarter, if it in aggregates it exceeds or is in excess of 10 lakhs, then you have to report that, you have to disclose that. Okay, so that is the obligation to disclose. After that, we also have something called as institutional mechanism. What is institutional mechanism? Institutional mechanism is about Audit committee reviewing the compliance, chief executive officer reviewing the compliance, and more importantly, or the most important thing, that every listed company will formulate a policy for inquiry of leakage or suspected leakage of unpublished price sensitive information. Okay, so this is something which is important. In fact, if inquiry is being made, then everyone, all the intermediaries are also going to provide adequate support, and there should be a whistleblower policy also. Okay, so now we move to the takeover code. Okay, takeover code. What is takeover? See, we have an acquirer who is taking control over the target company. So there may be a person who is acquiring control. That person is known as acquire, and the company whose control is being acquired is the target company. One company is acquiring shares of another company, or maybe one person is acquiring certain shares of another company. That means, ma'am, if we go out and buy a few shares, is it takeover? The answer is no. We go and buy shares and we obtain maybe 10%, 15% control. Is it takeover? The answer is again no, right? Takeover code hits when you reach the level of 25% or more. However, takeover, the intention or the meaning of takeover is to obtain control, and it is considered that we obtain control when we hit the mark of maybe 25% or more, right? Fine. Now we have different types of takeover. Friendly takeover, wherein promoters willingly accepting or willingly want to transfer the securities. Hostile takeover, when the promoter defends that they do not want to transfer the securities, yet takeover is happening. Horizontal takeover, which happens in the same line. Vertical takeover, which happens in backward or forward integration. And conglomerate takeover, which is takeover by a company in absolutely different industry. Okay, now this takeover code is mainly to protect the interest of the investors, because when takeover is happening, more importantly, when maybe hostile takeover is happening, then some management, substantial change in management takes place. There is new set of people who are going to manage the company. They may be having new vision, and the old investors might not want to continue with them. So in such a case, they should be given an exit opportunity, and that exit opportunity is given by way of an open offer or public offer. That is what we call. So when public offer triggers, that is something which is very important. See, open offer are of two types. One is mandatory and one is voluntary. Mandatory open offer, when undoubtedly you have to give a public offer, you don't have a choice. When there are two trigger events. Trigger event number one, or the first trigger point, you can say, acquirer, the person who is acquiring shares or voting rights in the target company. So acquirer plus the persons acting in concert, right? All those who have a common objective or connected, right? They acquire more than equal to 25% voting rights. So the moment you hit the mark of 25%, you are obligated by the code to give a public offer according to regulations for at least 26% of total share capital. So the first thing that you have to do is make a public announcement. We will see the process also, open offer process, but you have to give open offer process, open offer. Okay, the second trigger point is, now when you are already holding 25% voting rights, that means somewhere in the past you've already given a public offer. Now you already hold 25% or more voting rights, and you intend to acquire more than 5% in any financial year. So that is the second trigger event, and again you have to mandatorily give offer according to the regulation. Supposedly you hold 25% voting rights, and now you intend to acquire only 3% more. That is creeping acquisition. Up to 5% is creeping acquisition, which does not trigger the requirement of public offer. Okay, it does not trigger the requirement of public offer. So there are two trigger events that you have to mandatorily remember. Now, this code requires open offer on occurring of trigger events and some disclosures. What is the open offer process? Whenever the event has triggered, any of the event has triggered, you will appoint the merchant banker. Merchant banker is the manager to this open offer, who will assist or who will undertake the entire process. So first thing that he does is make a public announcement. Within 5 days, a detailed public announcement. But before detailed public announcement, 2 days before, you have to open an escrow account and deposit amount therein. You are not supposed to know what percentage of amount it, although I've told you this, but you're not supposed to know it, so don't get into that. We have a very little coverage of the regulations in our syllabus, and I am teaching you, or I'm making you revise according to that syllabus only. Okay, so 2 days before you have to deposit in the escrow account. Now, after detailed public statement, within 5 days, the draft offer letter which you're going to give to public has to be submitted along with fees to SEBI for their comments or their response. The same draft letter of offer is also sent to the target company and the stock exchanges. Now, SEBI usually responds within 15 days, and when you get the response of SEBI, within 7 days, you give the letter of offer to public. If you don't get a response of SEBI after expiry of 15 days, then within 7 days, you give letter of offer to public. When you get a response within 12 days, that tendering period should start. What is tendering period? The period which is of 10 days in which the shares are being tendered. That means the shares are being sold, provided by the public, right? So that is tendering period. How will the acquirer pay to public? By cash, or by issuing shares of acquirer or PAC, or by issuing debt instruments, or by issuing convertible debt securities. Now, offer once made cannot be withdrawn, but supposedly we did not get statutory approvals that were needed to make this open offer. So, of course, you have to withdraw the offer. Supposedly the acquirer dies, or maybe there was some conditions stipulated in the listing agreement which have been violated. So, or maybe SEBI decides according to merits of the case that yes, withdrawal is needed. So within 2 days, merchant banker will make an announcement in newspaper along with the reasons, and also simultaneously inform SEBI, stock exchange and target company, right? And the offer will be withdrawn. Okay, the offer will be withdrawn. Now, we also have something called as voluntary offer. Voluntary offer, wherein voluntarily an acquirer wants to give public an offer and acquire their shareholding. But for that, there are certain preconditions. What are the preconditions? That you should prior be holding 25% or more. See, you might be thinking that, ma'am, when we hold 25% of shares, then of course that is the first trigger event and we have to mandatorily make an open offer. So how is it voluntary offer? See, when you hit the mark of 25%, you get the requirement of mandatory open offer. So in the past, you have made that mandatory open offer. Now you're already holding maybe 26% of shares in that company. Now you want to give a voluntary offer. No trigger event has come, so you can do that, subject to there will be no further acquisition in next 6 months. You can also make a conditional offer, and there shouldn't be any creeping acquisition last 52 weeks. That is up to 5%. Okay, so that should not be happening, right? Then we have disclosure. There are 3 disclosures that we have to read. Disclosure number 1, about the promoters. So as on 31st March, whatever is your holding along with PAC, you have to intimate within 7 days of end of financial year to stock exchange and target company. As on 31st March, if there is any person who has 25% or more holding, okay, if your entitlement is 25% or more along with PAC, then you also have to inform within 7 days to stock exchange and target company. And likewise, you also have to intimate about encumbrance. What is encumbrancy? Sometimes what happens is there are certain securities which are being provided to us as a pledge, as a security. Now, what if the person does not return the loan or repay the loan? Then that security will be ours. And if it will be ours, then maybe I already hold 10% securities in a company, and by way of this encumbrance, I also get 20% more. So it becomes 30%. So there are very high risk involved in encumbrance. So whenever there is creation or invocation of encumbrance, the promoters have to inform to stock exchange and target company. So this is an event-based disclosure, that if there is creation of encumbrance, you have to intimate the same to stock exchange as well as the target company, stock exchange as well as the target company. Fine. Now we also have the obligations of acquirer and obligations of target company. Obligations of acquirer, he has to ensure that firm financial arrangements have been made. He should be able to implement the open offer. He should not alienate, that is dispose of the material assets of the target company. If he wants to do that, then this intention should be prior disclosed in the detailed public statement. If not, then you need to obtain special resolution. Okay, the responsibility of compliance will be on the acquirer as well as the persons acting in concert. If we talk about the obligations of target company, then target company, the directors have to ensure that okay, there is smooth functioning of the business, ordinary business, right? So that should continue. You will not fix any record date between the tendering period, 3 days prior, 2 days prior, and the tendering period, no record date. And you have to provide information about your shareholders to the acquirer. Okay, so this is the obligation of target company, right? We'll now revise the chapter of Competition Act, Competition Act 2002, right? Fortunately, unfortunately, the term competition has not been defined in the Act, but we must know about what is competition before we can proceed with the chapter. Although on the term competition, you won't be asked any question, but competition basically is not the competition that we talk in general parlance with our peers or something like that. No, we are talking about the market rivalry. What type of market rivalry, ma'am? There are so many business entrepreneurs who eventually sell products or sell their services. So, whatever economic rivalry is going on between such market players to attract the customers, that is competition. Now, sometimes it is presumed that competition is not a very good thing, but it is undoubtedly one of the best things an economy can be gifted with. Competition by fair means, by healthy means, is extremely helpful in increasing the productivity and efficiency of any organization. How, ma'am? If I, as a customer, go out and do not have a choice, like I go out to a departmental store and I have 6 shampoos out there, I can see the quality, I can compare the prices, and I can get the best one suited for me according to my needs. But if I don't have a choice and maybe a shampoo is available at a price of 10,000, well, I would stop like washing off my hairs, right? So competition helps to reduce the prices. Everyone tries to become cost effective, improves the quality, and also brings innovation in the product. So undoubtedly competition is something which is needed, and from customers perspective as well as economy, there is utmost need of competition, and it's highly beneficial. Earlier we had an act, MRTP, which did not really regulate competition, to try to curb competition somehow, and that's why it was repealed, and Competition Act 2002 came into effect, which focuses on promoting more of competition because it is healthy, on protecting the consumer's interest, and ensuring that everyone has the freedom of trade, but preventing those practices which hamper competition, right? So that's why MRTP Act got repealed, and we had a new Competition Act which has 9 chapters. Actually, not nine. I would say 1 to 8, then 8A, and then 9. Right. And it has a few sections in every chapter. Chapter 1, preliminary. Chapter 2, the most important chapter of this particular act, which talks about 3 things: anti-competitive agreements, abuse of dominant position, and combinations. Then chapter 3, it's all about competition commission, and thereafter we have the other sections one by one. In the last chapter, miscellaneous. We don't have to read everything, but whatever we have to read out of that, the most important one is chapter 2, out of which maximum questions are being asked. Other than that, sometimes composition of CCI and all is also asked, or sometimes appeal is also asked in examination. So the Act extends to whole of India. The Act has come with these objectives. As we discussed, Section 2 talks about the definition, which we are not going to discuss. As and when needed, I'll tell you a few definitions while through our revisions. The very first section, chapter number 2, which talks about basically 3 things. The first thing, anti-competitive agreements, which is given in section number 3. To understand anti-competitive agreements, we first need to understand what do you mean by agreement. When I'm talking about agreement, it need not necessarily be some formal type of arrangement in writing. No, it can be any arrangement, written, oral, formal, informal. It can be any understanding, or it can be doing anything together. Like we have decided that you also do this, I'll also do this. So action and concert can also be an agreement. And sometimes it may so happen that we have entered into such an arrangement, or we have come to such a consensus, that it is not something that if you deny, you will be dragged to the court. That means it is something which is not enforceable, but still it will be an agreement. So agreement, maybe it is enforceable, maybe we have decided something legal that we can make the other party bound, or maybe something illegal. It doesn't matter. It could be an action in concert, it could be an understanding, it could be an arrangement, anything it could be. They are called as agreements. Now, my dear, agreements are of 2 types: vertical and horizontal. vertical and horizontal. Vertical means the agreement between enterprises or people at different production chain. What is production chain? You produce the goods, you supply the goods are being delivered, the goods are being sold. So we have the production chain. We procure raw material till the time of it is delivered to the customers. We have that production chain or the supply chain, you may call. Now in that you have different people. Like we have the manufacturer, we have the wholesaler, we have the retailer, right? We have these type of people. There may be one person, there may be a group of people, right? We have distributors, so we have different people in this production chain, right? Now if people are entering into an agreement with each other, let's say my example, I am the manufacturer, you can say, of the classes, and there is some distributor of the classes. So there are different distributors. I enter into an agreement with one of the distributor that you are not going to sell my class below this price. That means I have entered into an agreement of resale price maintenance. Do you think there is anything wrong in it? Well, no, ma'am. You can say such thing. You can put such a condition. So I have entered into an agreement like this. So it is ideally not something which is wrong at prima facie, or it is not something which is hampering the competition. No, the other people are still competing, right? You get my point. So we have this vertical agreements. Now, when I talk about horizontal agreements, horizontal means between the same stage of production chain. That is, if I enter into an agreement with all the other law teachers and we come to a consensus that we are not going to sell the classes below 20,000. Now, it is hampering competition. It is not good for the benefit of customers or consumers, right? So this is something which is not good. So now listen to me very carefully. When I talk about vertical agreements, they may be good, they may not be good, right, for competition. So prima facie we presume them that okay, fine, vertical agreements are acceptable. But if they create a barrier to new people, that means I am entering into such an agreement that new people are unable to enter, or I'm driving out the existing competition, or I'm hindering the entry, or it is not beneficial for the consumers, or it is affecting the improvement or development, then this is going to be considered as having an appreciable adverse effect on competition, and hence this agreement will not be bring into effect. It is going to be void. Okay, so vertical agreements prima facie they're not anti-competitive. However, if this is proved, then they are anti-competitive. So how do we determine whether they are anti-competitive or not? By looking at the factors, right? However, when I talk about horizontal agreements, that means between the same production chain, that is generally between the rivals, they are somehow presumed to be anti-competitive. So we have section 3, we have two things. Point number 1, any agreement that you enter to, whether horizontal or vertical, is going to be, if on these factors is anti-competitive, that is going to be void. However, there are certain agreements which are presumed to be anti-competitive. That means the people of same production chain, all the manufacturers decided that we are not going to give any supposedly they are producing tomatoes maybe, so they are not going to supply tomatoes for 15 days. If they do not supply tomatoes for 15 days, there will be ample of deficit in the whole nation, and then they can inflate the prices, right? So they are limiting the production. What is cartel? Cartel is a very important definition in this particular chapter. Cartel is any group of association or any group of people who are trying to limit or control the price, the production, or the distribution, sale, anything. So collectively, they are coming together and they're limiting or controlling these things. Then that is known as any association, any group of people, that is known as cartel. So formation of cartels for this purpose is not allowed, and it is presumed to be anti-competitive. Even if you say, no, we have come together for this, this was going to be beneficial. No, you cannot prove that. This is going to be presumed to be anti-competitive at the very first place, right? Okay. Likewise, let's have a look at other examples also. When I talk about the vertical agreements, what are the other examples, ma'am? We have tie-in arrangements where people are being bound that okay, fine, if you want this product, you have to buy this product as well. So seller maybe puts some condition that you have to buy this on your second purchase or something like that, right? So you are somehow trying or binding the other person. right? If that's causing a hindrance to uh, other people to enter into the market, then it may be anti-competitive or any other factor. Otherwise, it will not be anti-competitive. There are many exclusive agreements also, like exclusive supply agreement, wherein you enter into an agreement restricting in any manner the purchase in the course of his trade from acquiring goods other than those of the seller. That means you are going to acquire only my goods, right? So that is exclusive supply. So exclusivity agreements are also there. Sometimes you refuse that, okay, I'm not going to deal with you, right? So refusal to supply a product or service to non-competitors or whatever, there can be a case. And resale price maintenance, I have already told you. So these are all kind of vertical agreements. When I talk about horizontal agreements, one very important thing that you have to remember over here is bid rigging. What is bid rigging, ma'am? What is bidding? Bidding is auction. The auction is something which promotes competition and should be held in a fair manner. That means if there is a house on auction, 5 people are there, they are all going to bid, right? Somebody bids 1 crore, somebody 2, somebody 3, 4, 5, 6, 7, 8, 9, 10, whatever, right? So on 10 crore, finally the deal gets closed. And one person has to pay 10 crore to acquire that house. There was healthy competition, there was revenue generated and everything. So this is something which is healthy. Now, there could be an agreement between these people that we all are going to submit identical bids. Or you four don't bid at all. Now, what are they doing? They were increasing the price. So if they do not bid, the person bid at the price of 50 lakhs. So he said that only I will bid and I'll get this houses at 50 lakhs and I'll pay all of you 1 crore each. He said, fine. We are going to just sit here and not bid at all. So we are going to get 1 crore for nothing. Great. And if I talk about that particular person, he got the house for 4 crores by paying 1 crore each and 50 lakhs. Otherwise, he had to pay 10 crores. So they made a good deal, right? But this is something which is called as bid rigging, right? So this is anything. If you try to squeeze out the bidders or submit identical bids, or you enter into an agreement that we are not going to bid against each other, so that is all something which is bid rigging and it is presumed to be anti-competitive. Fine. So we have read it 2 aspects in section number 3 in anti-competitive agreements. Moving on to the next part, prohibition on abuse of dominant position. Now here, section number 4. First thing, what do you mean by dominant position? See, dominant position, when will you be in a position to dominate someone? When you have that strength. That okay, fine, if he stays or if he goes, I am okay. Then you'll be able to dominate the other person. Otherwise, you'll never be able to dominate, right? So dominance is a position of strength that you can operate independently. Dominant position is not bad. You may have that position of power. That is not bad. You may have that dominance in you. That is not bad. But if you abuse the dominant position, that is incorrect. And that is something which is prohibited. What is abuse, ma'am? Unfair pricing. You're charging 100 rupees for some product which is just worth rupees 5. So unfair pricing or predatory pricing maybe. You know that you have ample of feed. Supposedly Reliance. Okay, Reliance comes into a new sector like maybe telecom, and Reliance comes with the plans. Like when Reliance Jio came, it provided like plans. Okay, fine, I'm going to give everything for free. Right. Now, what is it? Reliance has ample of profits in the other sectors. So Reliance is in a position, maybe, I'm just not giving you a real life or practical example. This is something which was permitted. So, of course, there was no abuse of dominant position which was identified. However, if you look at the angle, you will realize it. What did they do? They tried to somehow bring down the prices. All the other telecom operators who did not have that strength maybe were not able to compete, right? If you provide a product which everyone else is selling at 10 rupees and you provide the same product at 5 rupees, then how long will the other competitors be able to survive? Because everyone will come to you. So they are making no profits. They're not able to recover their cost. So ultimately a time will come when they will be driven out of the market. And then you can increase the prices just like Reliance Jio did. They could increase the price now. Now they can charge whatever price they want to, because a lot of consumers or customers have migrated to the network. right? So this is called as predatory pricing. Please don't ask me, ma'am, how it was allowed and when it was allowed and all that, right? It depends upon case to case. We have a CCI, we have a Competition Commission of India, which also decides whether it is dominant position or not, whether there's abuse or not, and thereafter they pass orders, thereafter they do things, right? We are just discussing the simple case. Limiting production, as we discussed about barrier to entry or using position. Now, how do you get to know whether you have that dominant position or not? See, I may be a new entrant, right? I may be a new person and I have just come to the market. I'm trying to make a place in the market, and that's why I'm giving things for free, or I'm doing this, or I'm doing that, right? So you can do that. You can do that. Reliance did that. Reliance was new to the sector. So Reliance did not enjoy the dominant position in the telecom sector. So if you identify that a relevant product market, then Reliance was new. Reliance was not enjoying the dominant position. And since there was no dominant position, there's no point of abuse, right? So likewise, we need to determine whether there was a relevant, in which market are we talking about with respect to the product or with respect to the geographical region. I may be very dominant at a particular place. I may not be very dominant at the other place. So which relevant market are we talking about? And then we determine dominance on the basis that how much market share do I have? What is the size of my enterprise? What is the size of other competitors? How much consumers are dependent upon me, and what is the market structure? So based on that, it is being decided that whether a person enjoys a dominant position or not. And if a person enjoys a dominant position, thereafter inquiry happens by CCI under section 19, whether there's prohibition or whether there's abuse of dominant position or not. If there is, then thereafter orders are being passed. So these all we read in section number 1931 later, right? Fine, ma'am. Then we come to combination. Section number 5. A lot of mergers that happen. Supposedly two companies are being merged into one. We have to look at the provisions of Companies Act. We also have to, maybe they are listed, we have to look at a lot of SEBI compliances. We also have to look at the provisions of Competition Act. Because if the big giant market players, they come together, maybe they may create a monopoly, and after creating monopoly, they may hinder the competition. So somehow it is important to keep a check on them whether we should allow this merger or not. So CCI plays a very important role. Competition Commission of India plays a very important role in approving these combinations. And every merger has to be approved by CCI? No. You may acquire shares, you may acquire assets, you may acquire control. If it exceeds the threshold, ma'am, what is the threshold? See, there is a huge section number 5 and it's given in different parts, but we have it a summarized version, which I've shared in the notes as well. So with that summary, you have to recall that limits. And if it exceeds that limit, if it exceeds the threshold, then that is going to be termed as combination. Now, you cannot enter into any combination which is creating an appreciable adverse effect on competition. So you have to make an application to CCI, and once CCI approves your combination, thereafter only it will be treated as valid. So any person or enterprise, if they're entering into any combination, they have to get the board's approval, and within 30 days, they have to submit the proposal for approval to CCI. Now, CCI will reply within 210 days. If CCI does not reply within this time, then it is deemed acceptance. So if they reply, great. If they reply as negative, then you cannot enter into that combination. If they don't reply, even better, because it is deemed acceptance. Fine. Okay, fine, ma'am. Now, CCI may also inquire into the same. Now, the next set or the next part that we have is Competition Commission of India. What is Competition Commission of India, CCI, that we have been talking so far? Central government establishes this Competition Commission of India, which is going to be a body corporate. First of all, its composition: chairperson, minimum 2 members, maximum 6 members. In case there is a vacancy, senior most person will take charge, and they are going to be appointed from the selection committee, which is going to maintains a panel, and from that the appointment takes place for 5 years. Retirement age 65 years. They have to take an oath of office and secrecy before they enter the office. Right. Once they're appointed, they're not appointed for life. They can resign by giving 3 months notice to central government. Central government may permit to go earlier. They can also be removed by CG when, if they acquire some other employment, because during their membership, employment is not allowed. If they turn insolvent, incapable, or offense, right? On these grounds, they can be removed, right? Clear. But if they acquired financial interest, or if they abused their position, which everyone will deny, and that no, I have not acquired any financial interest, or I have not abused my position. If any member of CCI abuses their position, then in such a case, if they have been put allegation on these two grounds, then first of all, CG will refer to Supreme Court. Supreme Court will hold an inquiry and present a report, and thereafter CG will remove them. On other grounds, CG can remove them directly. Right. During membership, you are not allowed for any other paid employment. And after termination, also, you're not allowed for till 2 years in connection with any prior party, any enterprise which has been a party to CCI prior to that. You cannot be employed in that for 2 years, and others it's allowed. Right. Coming back to our main chart. So composition, I think, is clear. What powers do they have? They have the power to inquire, they have the power to pass order, they have a lot of miscellaneous powers to make rules, regulations, a lot of things are there. Duties are given in section number 18. They are the same duties as we talk about the objectives of the act. So whatever objectives of the act, the same duties have been conferred to CCI also. Meetings, we'll read section number 22. Office, head office at Delhi and offices at other places in India. Fine, ma'am. Meetings. So they are going to meet at such place and time as prescribed. Quorum 3 members, chairperson presides over the meeting. If he is not present, the senior most person will preside over the meeting. The decisions will be taken by majority, and there will be a casting vote of the chairperson. Now, after we read this whole part of Competition Commission of India, we also have something called as appointment of Director General. So for the purpose of assisting the Competition Commission, central government also appoints Director General, and then there will be officers, other employees, and all that part. Right. Then we come to one of the most important sections, again, section number 19, which talks about inquiry into. Section 3, Section 4. Section 3 means anti-competitive agreement. Section 4 means dominant position. So reference may be made to CCI by central government, state government, or statutory authority. So CCI receives some information from these people, or on receipt of some other information, or COMO2 also. CCI may hold an inquiry that some enterprise has contravened Section 3 or Section 4. Of course, keeping in view the factors. What factors, ma'am? The same factors that we have read in the respective sections. That if you want to determine the appreciable adverse, whether an agreement has appreciable adverse effect or not, you have to check whether it hinders the entry of new entrants or something like that, right? If I talk about dominant position, how much market share you have, what is the size of your enterprise, what is the size of your competitors, so the same factors that we have read before. And based on that, CCI passes the order. We have an elaborate procedure of inquiry which is being given, that how inquiry takes place under section 19. Reference is made by CCI. Right. Okay. We look at the reference, we find that there is no prima facie case, we'll dismiss it. CCI is going to dismiss it. But if they find that, okay, prima facie, we think that, okay, investigation should be done. So they will direct the Director General that you prepare an investigation report and thereafter forward to the parties concerned. Now, Director General recommends that yes, there is contravention. So further inquiry will take place. If they recommend that there is no contravention, then we need to see how the inquiry was initiated. Was it initiated because a reference by CG, SG or SA was made? If yes, then we must look at their perspective. Why did they make a reference? Because according to the Director General's report, there is no contravention. So we will invite their comments. And based on their comments, if we find that yes, prima facie case exists, then we will proceed with the reference and further inquiry will take place. If no, then we'll return the reference. If it was some other, we'll just give the opportunity of being heard to whoever informed us, and then further inquiry is not needed. If it is needed, it will be carried out. Otherwise, it will be dismissed. Based on the inquiry, CCI comes to a conclusion that whether there were anti-competitive agreements or whether there was abuse of dominant position, right? If yes, these are the orders which may be passed by the commission. They can impose penalty. These are the maximum penalties which may be imposed. They can ask to discontinue whatever you are doing and not to re-enter, modify whatever agreement you have made, or maybe pass other orders, or maybe divide the dominant enterprise, maybe pass order for division. So this is also something which is possible. Next, we come to combination. Right. Now listen to me. Every prospective combination has to give an application to CCI and approve and get their approval, and thereafter you can enter into combination. But there may be some mergers which did not get the approval of CCI, but still they have merged. So there could be some combination which has taken effect without CCI's approval, and CCI got this information suo motu or on some source. So within 1 year of the combination taking effect, if they find that no, prima facie there is no appreciable adverse effect on this merger, on this combination is the merger which exceeds the threshold. Fine. Acquisition which exceeds the threshold. So if there is prima facie no appreciable adverse effect, they'll just impose penalty and pass orders, whatever they think like. But if there is appreciable adverse effect, then this combination cannot take place unless we inquire and assure that this is not going to happen. So they will issue show cause notice to the parties to respond within 30 days that why we should not carry out investigation. After the receipt of response from the parties, within 7 days, CCI will direct the parties that you publish all the details to bring it to the public knowledge, and the public will file objections if they have. CCI can ask for additional information. CCI will also refer to the Director General and ask for their report. What do they think? And after considering the objections, after considering the DG's report, after considering all the information that has been obtained, they will pass the orders according to section 31. That means they may approve your combination, they may reject your combination, or they may ask to modify the combination. Now you have agreed to merge on certain terms, and now some authority is asking you to modify the terms. You may not accept it. If you accept it, fine, the combination takes place. If you do not accept it, then no combination. Supposedly you also have some amendment in mind and you say, okay, fine, we accept this, but slightly change this also. Then you can submit your amendment. If the commission agrees, approve. If the commission disagrees, they'll give you 30 days to accept this modification that they suggested. If you accept it, approval. If you don't accept, then it is considered to have appreciable adverse effect, and this is a combination which will not be allowed. So we have this elaborate section number 31 which talks about all of that, right? Apart from that, CCI has the power to issue interim orders also. If you want to appear before CCI, you can appear in person, or you can take the help of some representative like chartered accountant or company secretary or cost accountants or legal practitioners. Commission has the power to regulate their own procedure. They're not bound by code of civil procedure. They can rectify the orders. There are sections of penalties, section 43, 43A, 42. So you have to read about that penalties also. Then comes a section which is almost common in many of the acts, contravention by companies. So if companies do this offense, of course, they cannot be put behind the bars. So there is officer in default also who takes charge. Then you have something called as competition advocacy. What is competition advocacy? See, with regard to competition, central government makes a lot of policies. Now, whatever policies central government is making, central government gives a reference to CCI. CCI within 60 days give their opinion. Now they are only giving their opinion that this should be made or this should be made with this modification, because on ground, real grounds or practical grounds, they are the ones who are working. Ground reality, they know it better, right? So their opinion counts a lot, but it's not going to bind central government or state government, right? They constitute a fund which is called as competition fund, where the money comes from central government, and out of that fund, all the salaries and everything is being paid, accounts are being maintained, audit is being done, and returns are also being filed. Apart from that, we have something called as appeals. If you're unhappy with the orders of CCI, you can go to CAT. If you're unhappy, you can go to Supreme Court. CCI is Competition Commission of India. CAT is Competition Appellate Tribunal, which ideally does not exist now. The powers and the functions have been taken over by NCLAT. Right, so we do not have ideally Competition Appellate Tribunal now, but we read this only in our Act. So this is not very relevant, but the chairperson, maximum 2 members, I'm not teaching you the composition. I'm not revising the composition with you, because I don't think this should ever be asked in examination, although it can be. So you must read it once, right? And then thereafter you can make an appeal to Supreme Court within 60 days if you are still dissatisfied. Sometimes commission can be superseded by central government. So if they do not discharge their functions the way they are supposed to, central government can supersede that. Central government can also make rules. The commission, CCI, has the power to make regulations. So all that miscellaneous trivial sections which are not very relevant, and we are not considering them as a part of our revision, right? Thank you. Okay, so now the revision of Foreign Exchange Management Act 1996. Now, let's come straight to the point. That is the first relevant topic, residential status. But before we read residential status, before we revise it, we also need to know who a person is. So, a person is an individual, HF, company, partnership firm, LLP, any body of individuals, association of persons, all of that. Apart from that, a person, any branch, office, or agency is also a person. So they are also separately distinguished as persons, and their residential status is also need to be determined. Fine. But why do we need to determine the residential status? Because we have to make rules for entering into foreign exchange transactions. Ma'am, what is foreign exchange transactions? First thing you have to understand is what is foreign exchange. Foreign exchange includes foreign currency. What is foreign currency? Foreign currency means any currency other than Indian currency, that is INR. What is Indian currency? INR, of course, but what is currency? Currency does not necessarily mean the currency notes, but it includes the letters of credit, the checks, travelers' checks, postal orders, money orders, everything, right? So, a lot of part is included in currency. Indian currency, anything other than Indian currency is foreign currency, and foreign exchange is beyond foreign currency because it also includes the deposits, etc., which are payable in foreign currency and some other things. So ultimately, foreign exchange is something for which rules are made. Why? Because the government is regulating the same. Okay, so first thing is to determine the residential status. You can be a person resident in India or you can be a person resident outside India. Who a person is, that you already know. Now, this residential status, when we have to determine for an individual, how do we determine that? If I have to check, if I have to enter into any foreign exchange transaction, I want foreign exchange, I want dollars. Will I get it or will I not get it? That depends upon my residential status, that whether I am a PRI or whether I am a PRY, right? So if I reside for more than 182 days in previous year, that is the first condition which must be fulfilled for me to become a PRI. If that condition is not fulfilled, straight away I am a PRY. That means even if I have come for employment from some other country, but then I do not fulfill this first condition, I will be a PRY. If I fulfill this condition, then still some things need to be checked. That is condition number 2 needs to be checked. Why have I come to India? I have come to India, and in the previous year, I was in India for more than 182 days. Supposedly, I am not residing permanently in India. I have come to India. So why have you come to India? If I have come to India for business, for vocation, for employment, or for an uncertain period, then they'll consider me as PRI because now I'm here to permanently settle down. But if I've just come to India for some visit or anything like that and I've stayed for some longer tenure, they will not consider me as PRI. So I will be a PROI. I hope you can find and trace it in the chart. Now, if I have gone out of India, so why I have gone out of India? Have I gone out of India? I was there in the previous year for more than 182 days. If I've gone out of India for employment, business, vocation, or uncertain period, then I am a PROI. From the same day when I go out of India, I cease to be the PRI and I become PROI. But if I've just gone out for some visit and all, I will still be a PRI. Now we come to persons other than individual. Persons other than individual. That means a company, LLP, anything like that. So if they are incorporated in India, PRI, not incorporated in India, PROI. But the branch, office or agency, they are not incorporated anywhere. They are located. So if they are located in India, undoubtedly PRI. But if not located in India, that means located outside India, then in all the cases, they are not PROI. Sometimes, if there is a branch, supposedly a company is here, but branch is somewhere else, that branch is controlled by this Indian company. So that branch will also be a PRI. So any branch, office, agency which is controlled by or owned by PRI, then that will also be a PRI. Otherwise, it will be a PROI. Now, after we have known the residential status, the question is, how can you get foreign exchange? So no person can deal in foreign exchange according to section 3 on its own. You need someone who is authorized to do so. We have someone called as authorized person, about which we read in section number 10, though I will tell you. There are three basic authorized person: authorized dealer, which is the banks, money changer, and offshore banking unit. So only they are authorized person to deal in foreign exchange. So if we want foreign exchange for any purpose, supposedly my relative stays abroad, or I am going out of India, then I will need some money undoubtedly. So I need dollars. Where will I get dollars from? From these authorized person only. I cannot get dollar from anywhere else. I cannot make any payment outside India. I cannot receive any payment from outside India just like that. I cannot acquire any asset outside India. Now we all have that, right? There are people who have that, right? So this whole section 3 is written like except as otherwise provided in the act. So if any act, provision of act, if any rule, if any regulation, if any master direction, circular, anything permits, then that can be done. So it's not that these transactions are prohibited, these things are prohibited. No, generally this is the instruction which is given except as otherwise provided under the act. Then come to section number 4, which talks about holding of foreign exchange. So I cannot hold dollars. I cannot acquire, I cannot hold, I cannot own, possess, transfer anything, not foreign exchange, not foreign security, not immovable property. However, there are provisions which permit the same. So according to those provisions, I can hold, I can transfer, I can possess, I can do those things. Clear? Fine. There are two types of transactions, and the two most important things that we have in this chapter: current account transactions and capital account transactions. Both are defined in section number 2. Capital account transaction: any transaction which alters that is assets, foreign assets and liabilities of PRI, or Indian assets and liabilities of PRY. What is current account transaction? Anything other than that. But current account transactions definition specifically includes 4 things. If you are making payment for trade, that is import export, it is current account transaction. If there is short-term credit, as we have discussed, buyer's credit, supplier's credit, they all are current account transactions. Interest on loans, income from investment, living expenses for your children, parents, spouse, travel expenses, education expenses, medical expenses for your children, parents, spouse, right, along with your own self. So they are all current account transactions. Now, 2 things we have read so far: residential status and the transactions. That means, ma'am, if I want to travel abroad, it is a current account transaction. Is it permitted? I mean, we have made the classification, but how do we come to know that we can enter into such transaction or not? So current account transactions are all freely permissible unless they are prohibited. They require approval of CG, of RBI. Okay. So we read current account transaction, section 5, read with Foreign Exchange Management Current Account Transaction Rules 2000. All these are freely permissible unless. So we read these with these rules, and rule number 3, 4 and 5 are important, and schedule 1, 2 and 3 of this is important, right? So in schedule 1, we have a list of prohibited current account transactions for which you cannot get foreign exchange. Let's have a look at that list. See, they are all permissible unless they fall in the list of rule 3, schedule 1, prohibited transaction. Roll of foreign exchanges not allowed. If you are traveling to Nepal and Bhutan, obviously their Indian rupees freely convertible, freely acceptable, so you don't need foreign exchange for travel to that places, and you'll not get foreign exchange for the same. And then there is a list which is given in schedule 1. If you have earned a lottery and you want to remit that lottery money out of India, you'll not get foreign exchange for that. If you want to get foreign exchange for purchasing some lottery ticket or some magazine which is banned, no. If you want to pay commission on exports, you will get foreign exchange, but not to joint venture or wholly owned subsidiaries. If you want to pay commission on exports under rupee state credit route, no. Rupee state credit route is a kind of arrangement between two governments. Okay, wherein government is giving you a platform that you export. So why do you need to pay commission? Dividend balancing. Sometimes dividend is required to be balanced with an equivalent amount of inflows. Only then outflows are allowed. So it has going to be balanced. So ultimately foreign exchange is not required. Callback services. That means you are not using Indian telecom operators. Instead, you are using a telecom operator of some other country. That is, person is calling you back and is connecting you to some other country. So this is ideally which has been stopped also, and for this you will not get foreign exchange. Likewise, NRSR account has also been discontinued, but the interest of it will not give you foreign exchange. Okay, so this is a huge list, I know, but then you have to learn it. In fact, it is being dealt in classes in such a manner that I don't think any student anywhere, it doesn't matter where you are studying, how you're studying, but you take it repeatedly, so ultimately you end up learning it, I am sure. Okay, then we have Schedule 2. The transactions given in Schedule 2 require central government approval. Now, here central government means through respective ministries. So, central government works through its respective ministries, and those ministries will give you permission. So, drawal allowed if approval obtained. First thing, cultural tours, Ministry of HRD. So if you want to go for any cultural tour and you want foreign exchange for that, you have to get approval from Ministry of Human Resource Development. In fact, there is a proper department, Department of Education and Culture, from where you get permission. Then these coming 3 points are for PSUs specifically. If they want to get advertisement done in print media, which the amount of which exceeds 10,000 USD, they will not get foreign exchange unless they get approval from the Ministry of Finance, Department of Economic Affairs. However, in 3 cases, they can get foreign exchange without CG's approval. When they want to advertise their tourism or for international bidding or for investments. Freight of vessel by PSU. So if PSU has to pay freight for hiring a vessel, then foreign exchange will be given only when you obtain the permission from Ministry of Surface Transport. If PSU or government department is making imports on CIF basis, that is cost, insurance, freight, everything they are bearing, then also they need approval. Same, Ministry of Surface Transport. Multimodal transport operators, who are they? The operators who get the goods transferred from one place to another, but they are using different modes of transport, not just one mode. That is not just by truck, but maybe by truck, sea truck, something like that, right? So in such a situation, the facility that they use abroad, that is their agent, they collect money in INR, but they have to pay their agent in foreign exchange. So for this payment, you need to obtain a registration certificate from the Director General of Shipping. Hiring charges of transponders. If you want some of your show to be telecasted somewhere else, then you have to pay for that, right? So you need to obtain permission from Ministry of Information and Broadcasting. Container detention charges, the huge containers wherein the goods are being filled and they're being exported, or they're being shipped, right? So those containers are being hired and you have to pay charges from them. If you detain it for long, then you have to pay more charges, right? In such a situation, there is a rate which is prescribed by the Director General of Shipping, and if you exceed that rate, that means you need more funds to pay for that, then you need to obtain the permission, and thereafter you can pay it. Prize money. Sometimes there are a lot of activities which happen abroad. So international, national and state level sports bodies can sponsor any amount. But if we want to sponsor any amount, then 1 lakh USD is the upper caping. After that, we need to obtain the permission from Ministry of HRD, again Department of Youth Affairs and Sport. Then membership of P&I Club, Protection and Indemnity Club. This is again for a kind of ship insurance. But for that, you need CG's approval. Okay. Insurance Division of Ministry of Finance. Fine. Now, first schedule, prohibited. Second schedule, CG's approval. Third schedule, this is like freely permissible kind of transactions. They have a caping. They have given you a limit. If you do the transaction within this limit, no approval. Beyond this limit, RBI's approval is needed. What is the limit? There's a huge limit which has been given, 2,50,000 USD per financial year per person, right? So a huge limit has been given. So if within the limit, within prescribed limit, drawal without RBI's approval, it exceeds the prescribed limit, then approval is needed. For what transactions, ma'am? Private visits. There are some specified transactions, and then there is a buffer. All kind of capital account transactions are covered here, unless they are prohibited and others. Private visit. If you go on a private visit to any country other than Nepal and Bhutan, because for there you don't need foreign exchange. So if you visit any country then you can get up to 2,50,000 USD without any approval. If you want to gift, if you want to donate, if you are going out for employment, if you are immigrating, you're shifting to another country, maintenance of your close relatives abroad, for your business travel, for your medical treatment, for your studies, and all other types of capital account transactions are covered here. There are 3 stars which I have made, 4 stars, some people might say: immigration, medical treatment, and studies. Now, these are 3 expenses for which 2,50,000 USD might not suffice, because if medical treatment is very huge and expensive, then every time obtaining RBI's approval will be a little difficult, and even RBI will be occupied with so many applications. So, for them, it is written that it is permissible up to your actual expenditure. So, even if your actual expenditure is more than 2,50,000 USD, then also it is allowed, it is permitted. Fine, ma'am. So these for individuals. Now we have some permissible things for other than individuals also. So they also have a limit. If it exceeds that limit, you need RBI approval. If it is within the limit, you don't need RBI's approval. But what is the limit? The limit is separately given for each type of transaction. The first thing, supposedly there is a company who wants to donate for creation of chair, or a contribution to any educational institute or to any technical institute which is working in the same field. Up to this amount, what amount? This amount has to be calculated. This amount will be lower of 1% of your exchange earnings of 3 years, or 50 lakh USD. So whatever amount comes, up to this amount you can donate without RBI's approval. More than this amount, you need RBI's approval. If you want to pay commission, you have a flat in India, you have sold it to some foreign person who was brought by an agent abroad. So you have to pay commission to that agent, for which you need foreign exchange. The maximum amount that you can get without approval is the amount calculated, which is higher of 25,000 USD, or 5% of inward remittance. Next, you are paying for consultancy services. Consultancy services have a huge capping. If it is infrastructure consultancy up to 1 crore USD, you don't need RBI's approval. And for others, 10 lakh USD. If you have to pay for pre-incorporation expenses for that, then higher of 5% of investment which has come, or USD 1 lakh. Right? Okay, fine, ma'am. Of course, all those transactions you have to learn, because a lot of questions are being asked from current account transactions and capital account transactions. So this is the summarized version. Section 5, they're freely permissible unless these 3. So there are 3 things that we have to learn. Coming to capital account transactions. Now, unlike current account transactions, their nature is kind of reverse. They say that current account transaction allowed only if permitted. So they have a list of permitted things. They don't have the list of general things that everything is permitted except this prohibited. Of course, they have a list of prohibited transactions as well. However, they also have a list of permissible transactions. So some permissible transactions. Here, one important difference that you must keep in mind, Section 6 read with Foreign Exchange Management, Capital Account Transaction Regulations 2000. There we had rules prescribed by central government. Here we have regulations specified by RBI. Okay, so in that regulation, we have Schedule 1, we have Schedule 2. Okay, so there is some permissible transactions. For PRI, it is given in Schedule 1. For PROI, it is given in Schedule 2. Then we also have some prohibited transactions, and we have certain types of transactions on which restriction cannot be imposed. Okay. First thing, the transactions on which never CG or RBI, no one is going to impose restriction. That is amortization of loan, that is repayment of loan, depreciation of direct investment. Direct investment means investment in equity. If that depreciates, you have to pay more. That is, if it is in a loss, then you have to pay more. Then that transaction, no prohibition, no restriction will be ever imposed. Okay, fine, ma'am. There are some transactions on which prohibition is there. Like, a person resident outside India cannot come to India and invest in chit fund, nidhi companies, or agriculture and plantation activities, or real estate, including the construction of farmhouse. But real estate does not include the development of townships, residential commercial premises, roads, bridge, investment trust, and everything. And TDR. TDR is transferable development right. Now, this is a kind of certificate which is issued by government to us if we want to compulsorily acquire a particular, if government compulsorily acquires a particular property, then it issues us a certificate which is transferable. So we can give this development right to someone else as well. Now, what are the permissible transactions for PRI? They are given in Schedule 1. So PRI, that is, I am a person resident in India, I can invest in foreign securities, subject to all the regulations, okay? I can take loans from outside India. I can get immovable property from outside India. Not get it, but acquire. I can give a guarantee in favor of PROI. Although it is a contingent liability, if PROI doesn't pay, I will pay. So I am creating a kind of my contingent liability, but it is permitted. Now, import or export, although is a matter of current account transaction, yet import export of currency is a matter of capital account transaction. Then, even if I am getting loans in Indian rupee by PROI, that is also a capital account transaction. Maintaining a foreign currency account is also capital account transaction, because there also everything, I have a constant liability created. I have a constant foreign reserve created. Now, foreign currency account, I have told you, we can have RFC account, we can have EEFC account. A person who comes back to India brings a lot of foreign exchange, he can hold it in his RFC account, he can take back whenever he want to. EEFC account, the exchange earners, I am an exporter, I earn a lot of foreign exchange, I'll keep it in my account. I get saved from all that foreign exchange fluctuations, I can use it as and when needed. So these are the foreign currency accounts, which maintaining means capital account transaction. I can get an insurance policy from outside India. I can give loan to PROI. I can remit out of capital assets, or I can enter into derivative contracts like depository receipts. So these are permissible transactions for PRI. Now the same thing, permissible transactions for PRI. They can get securities in India, they can invest in India, they can acquire or transfer movable property, they can give guarantee in our favor, they can export import currency, they can give deposits, they can hold bank account, foreign currency account in India, they can remit the capital assets out of, they can enter into derivatives contract. So everything is exactly the same for PRY also. Okay. Now, after this, we have a section called as Section 8, which tells us which gives us or imposes a duty on us. If I am an exporter, I have exported goods worth rupees 50,000 USD, then it's my duty that I realize that payment and bring it to India. Right? Government is promoting so much exports, or government is helping so that more foreign exchange reserves come here. So it is my duty that I realize and repatriate. Now, what do you mean by repatriation? Repatriation does not simply means that bringing into India. You have to bring it into India. You can either sell it to the authorized person, so it gets injected into the system, or you can hold it in your permitted currency account, that is EEFC. So if you hold it in that, that is also meaning repatriation. So you have no non-compliance. Or if I have taken a foreign loan, I collect some payment and I repay that foreign loan, so that government here does not has to extract foreign exchange for repayment of loan. That means government saved its foreign exchange. Any saving is inflow. So inflow as good as repatriation. So these three conditions are all repatriation. Okay, now the topic of FDI, that is foreign direct investment. What is foreign direct investment? It is the investment by a person resident outside India. So PROI is making investment in India, right? So when we're talking about investment in India, it could be in an unlisted Indian company or listed Indian company. When we talk about unlisted Indian company, the amount doesn't matter. But when we talk about listed Indian company, the investment has to be 10% or more in post-issue paid up equity capital. Now, even if it falls below 10% at a later stage, it will still be called as FDI. If it is less than 10%, of course, it is called as a portfolio investment, and it is not called as a foreign direct investment, because direct investment is always about acquiring control, which cannot be acquired unless it is at least 10% or more. Right? Now, we have certain prohibited sectors wherein FDI is not permitted, which includes your lottery business, whether it is a private lottery or it is a government lottery, gambling, betting, like things, chit fund, nidhi companies, TDR, that is transferable development rights, you cannot trade in that. Real estate business or construction of farmhouses, then you also have about manufacturing of cigars, tobacco, and like products. Sectors which are not open to private sector or private investment, they're also not open for FDI, like atomic energy, railway operations, and investment by Bangladesh or Pakistan. In fact, I would say there is a quick update on FDI. What is that update, ma'am? Now, any entity, any resident, any entity, if belongs to a country which shares a land border with India, they need prior government approval before making this investment. Okay. Now, what is the procedure for receiving FDI? So we have two formats. We have automatic route, which requires prior approval of RBI government, and we have a direct route. Automatic route does not require prior approval, and approval route, undoubtedly, as the name suggests, needs prior government approval. So whatever is the concerned ministry, it shall give the approval, and thereafter you can proceed with the FDI. Okay. Now, we have the sectoral caps also. What is sectoral caps? Depending upon every sector, there is a sectoral cap which has been given. Like maybe it is said that 49% is allowed for approval route. So that is the sectoral cap for approval route, right? Or maybe total 72% FDI is permitted. So if that is said, you cannot go beyond that percentage. So you can go only whatever is the total investment, 72% can come from an FDI source. That is the sectoral cap in that particular sector, right? So we have different caps. We don't have to read those caps in our syllabus. Okay. Now, as we move further, we have permitted investments by PROI. So there are certain permitted investments and there are certain respective annexures which have been given over here. That means if you want to subscribe to capital instruments of Indian company, you may according to annexure 1, right? If you want to purchase or sell instrument of a listed Indian company on the recognized stock exchange, then of course you have annexure 2 for the same. The conditions have been laid down and the procedures have been laid down. So as per the directions which have been laid out, you can do that, right? Then purchase by NRI or OCI, that is overseas citizen of India, on repatriation basis, annexure 3. Purchase by NRI or OCI on contribution to capital of LLP, firm, proprietorship, or non-repatriation, that comes down to annexure 4. Then securities other than capital instruments, annexure 5. In LLP, annexure 6. By FVCI, that is your venture capital investor, annexure 7. In investment vehicle, annexure 8. Issue or transfer to depository, annexure 9. And ideas, annexure 10. Ma'am, do we need to learn these annexures from examination perspective? My answer would be a yes. You must learn the annexure numbers because we can expect a multiple choice question from this, that maybe in which annexure this particular thing is stated, right? Okay. Now, other than that, we can definitely acquire through rights issue or bonus issue, right? If there is a startup company may issue convertible notes, that we have read under the chapter of deposits also, that if a startup company issues convertible notes for an amount of 25 lakhs, then that will not be considered as deposits. So that is something which is allowed. If the companies are being merged, right, then of course maybe issuance of share happens through to an outside source. So that is something which is allowed, right? In all these situations, you have to conform to the pricing guidelines which have been issued. Now, we also have certain conditions for exit. What are the, see, if I have an option to invest in India, I also should have an option to exit, like divest, right? If investment, the opposite of investment is what? Divestment, right? So you may also go for an exit. Is it allowed? Of course, it is allowed. But when you exit, that means you're selling your securities. When you're selling your securities, the biggest problem that comes is valuation. So valuation will be subject to RBI guidelines and, of course, payment of tax, capital gains, whatever is applicable. Okay. So foreign entity refuses to take shares, it can be sold to third party. The problem comes in pricing in case of unlisted companies. So independent valuation by reliable agency subject to RBI guidelines and tax, income tax shall be there. In capital instrument held by another Indian company which has received FDI may be transferred to PROI subject to reporting requirements. So this is a general thing which we know. Okay, moving to the next part, that is external commercial borrowings. Now, what are external commercial borrowings? Ideally, it includes the trade credits also, which we have to read about. External commercial borrowings is borrowings for a commercial purpose from an outside source, right? So, this is raised by resident entities from outside entities. So we have some eligible entities who can raise commercial loans from an outside source, and we have some eligible lenders also, right? Recognized permitted lenders. Now the purposes are also specified in this master direction, that for what purposes you can use this loan. So we have permitted users, we have non-permitted users, we have maximum all-in cost ceiling, that is the maximum cost which may be charged for this particular purpose, right? So all this type we have to read. We have two types of ECB. One is FCY denominated ECB, that is foreign currency denominated ECB, and then INR denominated ECB. FCY, which we are taking in foreign currency, INR, which we are taking in Indian rupee. That may also be the case. Okay, it includes the trade credits, but we will read about the trade credits later. Trade credits beyond 3 years are actually ECBs, but trade credits up to 3 years have a different guideline, although they come under the same master direction. Okay, now, who is eligible borrower? Entities which are eligible to receive FDI are also eligible to receive ECB. However, when we talk about INR denominated ECB, all entities which can receive FDI can receive FCY ECB and can also receive INR ECB, plus microfinance and NPOs can receive additionally INR ECB. Okay. Lender. Who is eligible lender? So, lender should be a resident of FATF or IOSCO compliant country. That is something which you must remember. MAMP is minimum average maturity period. That is 5 years. You have to remember this, and you only have to remember about 5 years. Although there are in-depth workings, more workings, but about which you haven't been taught, and this has not been incorporated much in your syllabus. So I wouldn't say that you go into those much details when you're revising this particular topic. All you can remember is minimum average maturity period is 5 years. Now, for what uses? We have a negative list. You can take ECB, but ECB proceeds, whatever money you're getting from that loan, you're not going to use that for real estate, for investment in capital market, for equity investment, for capital purposes, working capital purposes, except what is permitted. For general corporate purposes, except what is permitted. For repayment of rupee loan, that means you have taken a rupee loan, you're taking ECB, and then you're repaying that rupee loan. No, that is not going to happen. Okay. Okay, then we come to parking of ECB. What is parking of ECB? Supposedly we have raised a loan, but we have a few months to spend that particular loan, to spend that particular amount. Till that time, it has to be parked somewhere. You cannot keep it at your home, right? So how do you park that ECB proceeds? Now we have two ECB, FCY or rupee, right? So if you want to park it abroad, so ECB proceeds which are meant for foreign currency expenditure can be parked abroad. No problem at all. If you want to park domestically, then whatever ECB proceeds are meant for rupee expenditure, they have to be repatriated immediately to India, and you can keep it with your AD category 1 banks. Okay, that rupee banks that you have. But this has to be for a maximum period of 12 months only. Remember these details for a maximum period of 12 months. Okay. Now we also have certain reporting requirements. What are the reporting requirements, ma'am? In this, you have to read and understand the concept of untraceable entity. Okay. What is untraceable entity? See, if there is any borrower, he has raised ECB, but the entity, or you can say the auditor, the director, they're not reachable, they're not responsive, they're not replying over the mails, over the calls, over the letters, and it is for a period of at least 2 quarters, right? So that becomes an untraceable entity. Okay. Now borrowings under ECB, you have to go for some monthly requirements. That means monthly reporting, and entry not operative on MSET, entry not submitted auditor certificate for 2 years or more, revised ECB with untraceable entity on top, no fresh application by entity to be processed. In such case, no fresh application will be processed, you know that, right? So AD Bank will not entertain your fresh application for ECB if you are an untraceable entity. Okay, ED to be informed. ED, what is ED? Enforcement Directorate. So if any entity is found to be untraceable, if any entity is recognized as untraceable entity, then Enforcement Directorate will be informed when the entity is designated as such, and there will be no remittance to such entity under automatic route. So if you want any inward remittance, then that has to be permitted through approval. You have to take approval for the same. Okay, fine. We also have something called as refinancing of ECB. What is refinancing of ECB? Refinancing of existing ECB. That means maybe it has matured, but you want to refinance it, right? So, what is important and what you should remember is that your outstanding maturity of original borrowing is not reduced, and all in cost fresh ECB is lower than the all in cost of existing ECB. Okay, then only you will refinance, right? Then comes your point of conversion of ECB into equity. Supposedly your ECB is matured but it is not paid. Then what can happen? Then maybe that ECB, supposedly someone has given us loan, we are unable to repay that loan. So what we can do is we can offer them equity. The same thing is given here also. Okay. But what is needed is, if it is covered under automatic route, great. If approval is needed, then you'll take approval. So it depends which sector do you follow in. Can they invest? Because you are taking a loan from an outside source. So from that source, if you are converting your loan into equity, that means it is resulting into FDI. So we have to check FDI norms. Is it permitted? Does it come under automatic route? So accordingly we'll do that, right? Then comes your security for raising ECB. If you have taken a loan, you ought to provide security. So AD category 1 banks are allowed. They can create a charge on your assets, immovable, movable, any securities, personal guarantees, whatever it be, in the favor of overseas lender. Okay, then we come to the topic of trade credits. What is trade credit? Trade credit is the credit which is provided for import of goods. You are importing a particular good. It may be a capital good, it may be a non-capital good. And you are importing this particular good. You need, what do you need? You need credit. Just like we take goods over here in India, we might be needing credit, right? And we are being provided credit by the shopkeepers or by the banks, whatever. So here also the same thing is happening. You have two types of credit. One is buyer's credit and one is supplier's credit. Supplier's credit means whoever your supplier is, that is going to provide you the credit because you're importing a good from him. Right, so he is giving you credit, so that's an incentive from for you to take goods or import goods from him only. Right, so it adds as an advantage to the supplier also. Okay, so it refers to the credits extended by the overseas supplier. That is called as supplier's credit. And if it is extended by bank or other financial institution or other recognized lenders, then that is known as buyer's credit. So we have two types of credit. Who is eligible borrower? The person resident in India who is importing the goods. Okay. Now we have a limit. Amount under automatic route. 150 million USD per import. Okay. For oil, gas, refining and marketing and airline and shipping companies. For others, it is 50 million USD per import transaction. Recognized lender, I have already told you. The period of trade credit, this is also something which you must learn and remember. Period of trade credit, it is going to be up to 3 years for import of capital goods, and for non-capital goods, 1 year or operating cycle, whichever is less. So for import of non-capital goods, you have to ensure what is your operating cycle. If it is 8 months, then 1 year or 8 months, whichever is less. So it comes out to be 8 months, right? So within 8 months, the trade credit should be paid. That amount should be paid in case of non-capital goods. And in case of capital goods, it is going to be 3 years. Beyond 3 years, trade credits don't exist. It has an upper ceiling. Beyond 3 years, if you are taking even for your imports, then it falls under the category of ECB. Okay. But for shipyards and shipbuilders, even if you're importing non-capital goods, the period can go up to 3 years. All-in cost ceiling benchmark rate plus 300 BPS, and for your INR denominated trade credit, benchmark rate plus 250 BPS. Forget this. This is for existing one. I'm not even telling you this again. Okay. Now, hedging is also permitted. I hope you understand what hedging is. I've explained you in the class also. If that is why, if you're taking a foreign currency denominated trade credit, maybe you're taking trade credit from a place and thereby you're converting it. Maybe you are taking that advantage of currency exchange or whatever it be. So that is something which is possible, and hence you can exchange the currency also, and accordingly, according to the terms, according to your approved management policy, you can go for hedging also, and you can go for change of currency also. But FCY to INR is permitted, INR to FCY is not permitted. For trade credits in SEZ, let me take you to another point over here. Your IFSCs are also considered as a foreign zone, right? Hope you understand that. So if you are taking trade credit from that, that is also covered over here, but they have a separate guideline. So trade credit can be used by unit or a developer in SEZ, including FTWZ for purchase of non-capital and capital goods within an SEZ, subject to compliance with the parameters given above. So the same parameters. Any entity in DTA, that is domestic tariff area, which I'm talking about, is also allowed to raise trade credit from a unit or a developer of SEZ, including FTWZ. So you can also do that. Not very important or not much important. Now we come to security for trade credit. Security may be given. For that, you must have a security clause in the loan agreement. There should be no objection certificate from the existing lenders in India. Right, your agreement should be coterminous with the underlying trade credit. It should not be that your trade credit has different terms and your agreement has different terms. And in case it has to be invoked, then whatever payment you are making towards guarantee, it is no way going to exceed your amount of trade credit. Now we have some reporting requirements. What is the reporting requirement here? AD category 1 banks come into play and play a major role. AD1 category banks, you have to do some monthly reporting. Reporting of what? Details like trade credit, its drawal, utilization, and all that too. Director Division of International Trade and Finance, Department of Economic and Research each month. Then there has to be quarterly reporting about issuance of bank guarantees for trade credits. You also have a role. What role? See, you have to ensure that whatever trade credit is being transacted, is being taken, it complies with the parameters of the policy and FEMA. You also have to ensure that there shouldn't be double financing on a particular import. You also have to ensure that when we are importing non-capital goods, you have to check the period. Trade credit period cannot extend beyond 1 year or operating cycle, whichever is less. In case of capital goods, undoubtedly we have a period of 3 years, so straight away banks can check that okay, fine, it is within 3 years, trade credit is fine. But in case of non-capital goods, it may depend upon entity to entity, so you have to check their operating cycle and ensure that the trade credit falls within that particular period, right? Okay. Okay, let's now revise the chapter of Banking Regulation Act 1949. The first thing that we need to know before we read the act is some brief history, right? So what history is very important is that which was the first bank which is still in existence, that is SBI. Now was it SBI? No, it was ideally Bank of Calcutta, which was renamed as Bank of Bengal. Then two other banks came, all three were merged, they became Imperial Bank, and thereafter SBI came into picture, right? So we have SBI, which is the oldest bank. Of course, it is all governed by RBI, right? All the banking sector comes under RBI. If I talk about the banking sector, it has been classified into two types of banks: scheduled banks and non-scheduled banks. What are scheduled banks? Which come under the second schedule of RBI, right? We can say that further scheduled banks have been classified as nationalized, other private sector, regional, rural, foreign, etc., etc. Now, what do banks do in general? Banks accept deposit and lend loans. There can be different forms like savings bank, current, FD, RD, cash certificate. The very first section that we read in this act, prima facie, is section number 6, which talks about the different forms or different forms of business in which the banking companies may engage. What are the different forms of business? They can be the agent, insure, guarantee, underwrite, transact every kind of guarantee or indemnity business. They can sell or realize their claims. They can hold the property. They can execute trust. They can undertake things relating to lease, right? And then they may undertake any business, right, or do anything which is incidental to their business, to the promotion or advancement of their business. Now, although this list is exhaustive, but it is not comprehensive. That means it contains everything, but it has not been given in detail. So we have a lot of hidden services or general utility services which are being performed by banks, which can be a part. Like I discussed with you, we have locker facility. Now, different sections, section 18, section 43. Prima facie, we have two basic requirements of SLR and CRR. What is it? every bank except deposits. Now, whatever deposits banks are accepting is liability from bank's perspective. And there are two types of liabilities. One is demand liabilities and the other is time liabilities. Demand liabilities that we have to pay as and when demanded, and time liability which is for a fixed period like fixed deposits. Demand liabilities like savings bank. Now, whatever are your total deposits, that is your time and demand liabilities, net demand and time liabilities, a certain percentage of that has to be kept with RBI in a current account opened with RBI on which you do not get any interest. That is known as cash reserve ratio, and a certain portion or certain percentage has to be kept in liquid assets. I am writing it over here 4.5 and 18.5. You write this, although this is not at all needed, right? I have told you different ratios, different percentage. The current percentages are not asked, but still you can write this, right? They have to be maintained in liquid assets. Liquid assets means what? Maybe gold or maybe some investments or securities which are approved, right? So that they are readily available as cash. So whatever you receive, you have to keep certain portion as CRR, certain as SLR, certain as other statutory requirements, certain you have to transfer to reserve fund also. Then you have to keep for your day-to-day expenses, and then whatever is available can be given as loans. We have an important set with respect to board of directors. At least 51% of the person should have specialized knowledge. Specialized knowledge in what field? Accountancy, agriculture, banking, finance, law, small scale industry, or any field which, in the opinion of RBI, has relevance in the banking sector. Okay. Now the directors and other than chairman and WTD are going to hold office for 8 years and others for 5 years. Who can become the chairman? The chairman can be the whole-time member, whole-time director or part-time director as well. In case he is the whole-time director, he is entrusted with all the responsibilities. In case he is part-time, then we have managing director which comes into picture and he is entrusted with all the responsibilities. Okay, so Reserve Bank has the power to appoint that. Then we have something with respect to capital. Now, Section 11 prescribes the requirement of minimum capital by a banking company, which we don't have to study. But Section 12 provides something more, which is that subscribed capital should be more than equal to half of authorized capital and paid up capital should be more than equal to half of subscribed capital. So this is something that you have to learn. Whenever there is any change, you are being given a buffer of 2 years to bring it back into the same proportion. With respect to capital, we also have something called as Basel III norms, right? For that, what all things are needed? First is the capital adequacy ratio. Now, capital adequacy ratio, of course, is very important with and is also being forced to provide for NPAs, right? What is the capital adequacy ratio? The minimum capital that you have to maintain in comparison of your risk-weighted assets. Indian commercial banks have been instructed to comply with Basel III recommendations. So I told you about Basel III recommendations. We had Basel 1, Basel 2 and then Basel 3. Now in Basel 3 recommendations, you have to be compliant. A minimum total capital of 9% of your total risk-weighted assets. But apart from that, you must also maintain buffer when you have good period. That means if you have, when you have a better capital quality, then you must maintain buffer to deal with the times when you have stressed assets more, right? So that is something which must be kept in mind. You cannot pay dividend unless your capitalized expenses have been written off. This is the main thing. The other things are not there, right? This is not there. What is important is until your capitalized expenses are being paid off. Even if depreciation or other things are not paid off, you can still pay dividend unless your capitalized expenses are written off. That means preliminary expenses, commission on issue of shares, brokerage and all that. Then you have to transfer at least 20% of net profit each year to reserve fund. Scheduled commercial banks, 25%. Certain restrictions. Banking companies cannot invest in other companies so as to acquire a controlling interest. That means you cannot make someone else your subsidiary. Only if it is necessary and you take RBI's approval, then only you can form someone as your subsidiary. Otherwise, it is not allowed. Okay. Moreover, restriction on loans to the director or to the firm in which director is interested or to some guarantor of director. It is not allowed. Moreover, we have other restrictions that RBI can give directions on certain matters, that for what purpose you can give advance, the margin that you might have to maintain, the rate of interest that you charge, or the maximum amount that you can give, right? Then we have something called as license of banking companies. Any banking company which operates has to obtain a license before it can run a banking business. How do you apply for license? You have to make an application to RBI. Now, RBI will inspect certain things. What is the company in a position to pay its claims? Are their affairs not detrimental? And is it in the public interest that we give license? If these conditions are being satisfied, then RBI will grant license. But again, this license may be cancelled. When can it be cancelled? If you do not do banking business, you cease to carry on banking business, or you do not comply with the conditions, then in such a situation, your license will be cancelled. If you are dissatisfied with the decision of RBI, you have 30 days to make an appeal to central government. Apart from this, RBI also has a lot other powers. RBI has the power to control your opening of new business. So if you want to open a new branch, you have to seek RBI's approval. If it is temporary within the same city, it is allowed. If you want to, RBI also has the power to publish information, to give you directions, to remove managerial person if needed, to appoint more directors, or to suspend the board as and when needed. Apart from that, there are various information that you have to furnish to RBI which are covered in different sections. So I have compiled all of that. Banking companies have to prepare their financials according to third schedule given in the Banking Regulation Act. Although it is a banking company, but it is not required to comply with the format given in Companies Act. The balance sheet P&L for every accounting year, and which is going to be duly audited. And auditor is also required to make additional report on certain matters which are specified in section number 30. That is going to be submitted to RBI. Apart from that, there is various other information in the form of different returns also required to be reported to RBI, like assets and liabilities on last Friday every month, unoperated accounts for 10 years within 30 days, and profit and loss account, balance sheet, audit report that I already told you, right? RBI is also entrusted with the wide powers of inspection. Now we come to suspension of business. We are trying to suspend business. That means nobody is suspending. The banking company itself wants a period of moratorium. That means it wants that no claims and no litigations should be filed against me because I'm unable to discharge my obligations. So if a banking company cannot repay debts, cannot pay or cannot make payments as and when demanded and meet its obligations, it first of all discusses with RBI. RBI makes a report. On the basis of that report, along with an application, we apply to High Court. And High Court gives us a stay for maximum 6 months. That is known as a period of moratorium, when there will be no action taken against the banking company and it will be given certain tenure to revive. Right? Then we have winding up of banking companies. A banking company cannot be wound up voluntarily. Okay, so it is not allowed unless you have RBI's approval. So unless RBI certifies that you will be able to pay every penny, every debt in full, then only voluntarily a banking company can shut its business or operations. Otherwise, by RBI, it can be done on what grounds? If you do not have the license, that means you're disentitled. If you're prohibited to receive deposits, when you cannot receive deposits, you cannot carry on the business of banking. If some compromise has been sanctioned and pursuant to that compromise it is happening, if you're unable to pay debts or in any way your continuance is prejudicial or harmful for the depositors, then in these situations, winding up may happen. And one more thing we have, that is about amalgamation of banking companies, which is allowed in two-way approval, shareholders 2/3 majority voting and RBI's approval. So once you get these two approval and the scheme of amalgamation is sanctioned, banks may be merged into one another, right? And thereafter assets and everything will be transferred, right? Now, role of RBI. RBI, we all know, is the apex bank, and when we talk about the monetary banking of financial policies, RBI has a major role to play in it. Now, RBI controls the entire banking system or all the banks, but control is not the correct word that we should use. Why? The reason being, in the changing scenario, RBI wants to promote the development of all the banks. So it rather acts as a facilitator, right? Now we have certain functions of RBI. In acting as a facilitator, it also has a department of banking operations and development. So the main focus is to develop the entire banking system, focus on the betterment of its operations, right? Banks have a lot of functions to do, a lot of things to do. They have to expand their branches, they want to merge, they want to liquidate, they want to reconstruct. In all these process, RBI plays a major role. So it makes the regulations, it prescribes the compliances, it oversees everything. So first is the regulatory role. RBI has a regulatory role to play for commercial banks as well as for local area banks. Secondly, under Banking Regulation Act, it has been conferred the power to inspect banks, of course, for the betterment. So it has the power to inspect. So inspection is also one of the functions. Third, anti-money laundering and combating financing of terrorism. So when people generate money by a crime, that is the proceeds of crime, and thereafter that is being used for terrorism, all this process is very toxic for the nation and must be prevented. And who does it? Who ensures to do that? It's the RBI. Okay, next is its appointments division. See, RBI has a lot of divisions or departments or cells, you whatever you call it, right? So RBI also has an appointments division. An appointments division, we have two things, right? We have private sector banks and public sector banks. When we're talking about the private sector banks, whatever appointments are being made as MD, chairman, the proposals are being sent to RBI and RBI approves the same. When we talk about the public sector banks, RBI makes recommendation to government regarding appointment of those, their payment, their salaries and everything. Then we have licensing of branches. Whenever any bank wants to open up a new branch, close down the existing ones, shift, or all that part is being done by RBI. So RBI grants approval or authorization to commercial banks for doing the same. Then we have banking policy. See, the policies, whatever have been made, are also important to be reviewed. So, first you make new prudential norms, second, review the existing ones. They both have to be done. Ma'am, policy or guidelines in respect of what? In respect of capital adequacy, in respect of income recognition, asset classification, then capital structure, risk management, implementation of Basel framework, settlement of NPAs, FCRA matters, that is Foreign Contribution Regulation Acts matter. So, all that. Issue of directives. See, again, under Banking Regulation Act Section 21, RBI has the power to give directions to the banks, right? In respect of what? In respect of the accounts, deposit, SB accounts, payment of interest, payment of additional interest, additional brokerage. Then we also have a defaulters list cell under RBI. Defaulters list, as the name suggests, it is going to make and prepare and update the database with respect to defaulters. So from where RBI gets this information, from all India financial institutions, it gets the information about the defaulting borrowers and categorizing it into different categories. So willful defaulters of 1 crore and above, 25 lakh and above. So likewise, all the defaulters are being, that information is being collected and disseminated. Then we have an international banking section, and all the 3 points get covered in that international banking section only. First, Indian banks are operating abroad or outside banks are operating in India. In both the cases, you need some policies, you need some set of guidelines, you need some approvals as and when needed. So all that is being done by RBI. RBI also grant approval for dealing in precious metals and about the policy matters relating to the same. Then we also have some banking branches which are being opened in special economic zones. They are called as offshore banking units. So their approvals are also being given by RBI. Then we have industrial and export credit section. It operates through 3 desks: policy desk, export credit desk, and industrial rehabilitation desk. So policy desk related to policy, export credit, exim and all that. Industrial rehabilitation, whatever units are being sick, giving concession to them and all that. Then we have a legislation section. Legislation section has 2 points involved. One is it interprets the law. The law means Banking Regulation Act, RBI Act, and all other associated rules. Second, a bank sends an application for getting exemption from various provisions of Banking Regulation Act. So application is being sent to RBI, but that is being processed by this legislation section only. Then comes your role in management of foreign exchange. Now again, when we are talking about foreign exchange, we have two types of transactions. One is capital account transaction, the other is current account transaction. When we talk about the current account transactions, RBI cannot impose restrictions. RBI does not have the power to do so. However, central government can impose restrictions, but central government imposes these restrictions in consultation with RBI. And RBI just consults the government for that respect. However, there are certain current account transactions for which it is written that you need RBI approval. So for that, RBI will grant the approval. But otherwise, RBI cannot impose restrictions on current account transactions. However, when we talk about capital account transactions, then it has the power to regulate, prohibit, and restrict certain type of transactions by making regulations for the same, like transfer or issue of foreign security. Okay, like you are transferring foreign security to a resident, or borrowing or lending in foreign exchange, export import of currency notes, transfer of immovable property outside India. So these are certain transactions which can be regulated, which can be prohibited, or which can be restricted by RBI by making respective regulations. Then whenever you're making an export, then that export, the proceeds of that export must be realized back to India, right? That is being again covered or within the function of RBI. RBI also has the function to grant exemption that, okay, fine, you don't have to realize the money. The section 9 of FEMA. And whenever we want foreign exchange, we have to go to authorized person. Now, this authorized person gets authorization from RBI only. Apart from that, RBI acts as a bank to the commercial banks. That means it gives loan to bank also and to government also, and it also oversees the payment and settlement system of commercial banks. Okay, let's now revise the chapter of SARFAESI. Now, this particular chapter, if we see the full form, securitization and reconstruction of financial asset and enforcement of security interest. So, the name itself involves the three most important elements contained in the chapter: securitization, asset reconstruction, and enforcement of security interest. This act gives the power to banks if they lend money to someone and they default in repayment, right? In such a situation, how can banks recover their money? Of course, they have IBC as a financial creditor. They can make application under IBC subject to fulfillment of other conditions. But they also have some right under SARFAESI Act. So banks, if they want to recover their non-performing assets, the loans that they have granted were not repaying, they have been recognized as substandard loss or doubtful asset, or they are fall in the NPA category. To recover that, one very important right that banks have been conferred upon under this act is enforcement of security interest given under section number 13. What is enforcement of security interest? It is like whatever security bank has, that secured asset can be sold and your money can be realized towards payment of your dues, right? Other two things, securitization and asset reconstruction. Ideally, banks have NPA, but it is very tedious job and very difficult for the banks to recover the same because banks have a lot of other functions to discharge. So this act incorporates, establishes a new type of company, which is asset reconstruction company. Ideally, it is a type of financial institution, not a bank, but regulated by RBI and registered also under RBI. So this company helps the banks to recover NPAs. How it helps? We have methods of asset reconstruction. That means the loan through asset reconstruction company can be reconstructed. Maybe their payment can be rescheduled. Maybe if the borrower, the one who has taken loan, that is the company who has borrowed loan, maybe they are not performing well because of the management, and that's why the creditors are suffering. So management can be taken over and the payment can be realized by the asset reconstruction company. We also have something called as securitization, where what happens on the basis of that secured asset, the security that has been given to banks, on the basis of that, asset reconstruction company raises money from qualified buyers by issuing them security receipts. And from that money, of course, that payment can be made to the banks or the secured creditors, and eventually it can be recovered by the asset reconstruction company. So these are the general meaning of the terms. We also have other important definitions, which of course you'll go through. The first section that we read in this chapter is section number 3, which talks about registration of asset reconstruction company. So any company which wants to do the business of asset reconstruction or securitization has to get itself registered. They must have minimum net owned funds 100 crore, that is prescribed, and certificate of registration. How do you get certificate of registration? You have to give an application in the prescribed manner to RBI. RBI will inspect your application and see whether the conditions are being complied with or not. What are the conditions? No loss in preceding 3 financial years. Adequate arrangement. How are you going to recover? How are you going to realize the financial assets that you will eventually buy? Adequate experience of the directors. No offense by directors involving moral turpitude. The sponsor should be fit and proper. We also have proper RBI guidelines to determine whether a person is fit or not. Who is a sponsor? Sponsor is someone who has more than equal to 10% equity in the company. Okay. And compliance with prudential norms. So if everything is satisfied, certificate is granted by Reserve Bank. But even if certificate is granted, it can be cancelled under section number 4. However, if the conditions are not complied with, RBI will give an opportunity of being heard and reject the application. If you become asset reconstruction company, if you get that certificate, then 3 things require prior approval of RBI. Your substantial change in management, your change in registered office, and your change in name. All these 3 require approval of RBI. Now, if you have got that certificate, but later on you cease to do that business, or there is no investment of qualified buyer, or you do not comply with some condition or direction, you don't maintain the books as you are supposed to, you don't produce the books for inspection, or you change your name, registered office or management without approval of RBI, then in all these situations, your certificate may be cancelled. Of course, opportunity will be given to fulfill the conditions, and if you're dissatisfied with the order, you can appeal to central government within 30 days. Right? Now, whenever asset reconstruction company want to acquire this right or interest in the financial asset, they can do so by making the payment or by issuing the debentures, by entering into an agreement. What happens is the bank is transferring the financial asset in your name. That means all the legal formalities need to be done again. All the legal documents will be prepared again, which involves a lot of stamp duty. But here the stamp duty will be exempted. So if you are taking that financial asset for asset reconstruction or securitization, then no stamp duty. Apart from that, if you're taking, then of course there will be stamp duty, right? Okay. Now, banks or financial institutions, how do they transfer financial interest? Once they transfer, they give a notice to the obligor. If they pay, great. If they do not pay, then they have to pay to asset reconstruction company or not to the bank, because the asset has been transferred. Right? Very simple thing. Now, this is ideally securitization. After acquiring financial asset, ARC may offer security receipts to qualified buyers, raise funds, and they have to maintain separate accounts for every scheme. Whatever amount they realize from the loan, they have to utilize towards repaying the money that you have borrowed from qualified buyers. That is towards redemption of investments. If you do not do that, they can call a meeting and take adequate action. Then comes the section number 9, measures for asset reconstruction. So these are the methods by which asset may be reconstructed. Now you have to remember one thing, that asset reconstruction or taking these measures is not something which is very easy. RBI has made policies, regulations with respect to each one of them. Okay, so if we want to do that, we have to comply with all the conditions that have been imposed by RBI, and thereafter we can do that. If we do not comply with the regulations or policies, then application against us can be made to Debt Recovery Tribunal. Okay, what are the measures of asset reconstruction? ARC, Asset Reconstruction Company, may take over the management, may sell some part, may lease some part, may reschedule the payment, may enforce their security interest as banks do on their own, may settle the dues at a lesser amount, may take possession of the secured asset, or may convert your debt into equity. Right? So they can take some shares of the company and let go of your debt. So that can also happen. Now, they can also act as agent, they can also act as manager or receiver, but they can do so if they take approval from RBI. So there are other functions also of asset reconstruction company which may be undertaken. We have a very small section, section number 11, which talks about the resolution of disputes. Okay, so if any dispute occurs, it is not going to be referred to any court, it will be taken through to arbitration. Okay. Now we have other sections where powers of RBI have been determined. So RBI has the power to determine policy, issue directions, call for statement, information, audit, inspection. All these are small sections that we have. Now another important section, section number 13, enforcement of security interest. Okay, so banks have this right under the act. They do not have to take any permission from court or tribunal. So they do not intervene when you are enforcing the same. When can you enforce the same? When the borrower defaults. Now, the default does not mean one non-payment. It means if you have classified them as NPA or you have given them a notice and they have not made the payment within 90 days. So then default happens. So if you have defaulted, you have adequately recognized them as NPA, then you can send a written notice to the borrower. Now, the written notice will state, this is the amount payable. If you do not pay within 60 days, we will enforce our security interest. That means we will enforce any of the rights which have been conferred to us in section 13, subsection 4. There are 4 points given. Okay, so if you do not pay, this is going to happen. This may happen, right? Borrower pays, great. Borrower doesn't pay, this will happen. Borrower also has a right to raise representation or objection. So if he raises, it may be accepted by the bank or the lender. It may be rejected. If it is accepted, then we'll work accordingly. If it is rejected, then you cannot go anywhere and appeal. You have been communicated the reason for the same, right? So what are the consequences that are given in section 13(4), ma'am? Secured creditor can take possession of secured asset. They can take over the management. They can appoint a manager to manage the asset. And one more point, what they can do is, supposedly borrower has a building. Borrower has mortgaged this building and took a loan. They are unable to repay the loan, so that building becomes the secured asset of the bank. Right. Now, bank wants to enforce the security interest. That means bank might take possession of the building. That building is occupied by some people who pay lease rental to the borrower. Bank can give a notice to that lessee and instruct them that now you are not going to pay lease rental to them, you are going to pay lease rental to. So this can also happen. This is also one of the methods which are given. Okay. Apart from that, if secured creditor is trying to sell an immovable property and you have a reserve price, that means minimum price, and no bidding takes place at a minimum price or over that price, then secured creditor himself can also bid and take the property. Okay, so that is something which can also happen. Now, one important thing in section number 13 is that till, that means before the date of publication of notice of public auction or inviting any quotation, even before that, if payment is made, then the sale can stop. Then no sale will take place of the secured asset. So if you pay even before all that auction, then also no action will be taken. Whatever action has been taken, no further action will be taken. Right? Okay. Now we have section number 15, which tells us the manner of takeover of management. Who takes over management? There are two persons. One, the secured creditor. When they want to enforce their security interest, they can also take over the management. Secondly, the asset reconstruction company, when tries to reconstruct assets, then they can take over the management. In both these situations, what they're trying to do is they're trying to recover their loan. For that, they believe that management is acting in such a way which is not beneficial for the creditors. Hence, we must intervene and we must manage the company in such a way that we are able to recover our dues. So they will take over the management for only that tenure till they realize their debt in full. After that, the management will be restored. Okay. So in such a situation, what happens? If the borrower is a company, the secured creditor, that is the bank or asset reconstruction company, they take over the management, they remove the directors. All the directors, existing directors, will vacate office and they will appoint the directors, as many as needed. The directors who vacate the office will not be entitled for any compensation. Okay. During this takeover time, the powers of shareholders are also put on hold. They cannot pass a resolution and appoint some director, or they cannot pass an order of winding up unless they take approval from the secured creditor. Okay, after that, we have something called as appeals. If you're dissatisfied, the borrower is not happy with the way this takeover is happening, or with the way the measures of asset reconstruction or anything is taking place, if you're dissatisfied, within 45 days you can appeal to debt recovery tribunal. Okay. Now, debt recovery tribunal might think and believe that yes, the secured creditor or maybe the asset reconstruction company is trying to exploit you. They are not doing these measures according to the policy. So they will ask to restore, or maybe ask to the secured creditor back to the borrower, something like that, or other order. If you're still aggrieved, or maybe the order is not passed in your favor, or no order is passed in 4 months, then within 30 days you can appeal to DRAT, that is Debt Recovery Appellate Tribunal. For that, you have to deposit at least 50% of the amount due. You may request the appellate tribunal and they can reduce this amount to 25%. Clear? Fine. Okay, let's now revise the chapter of Insurance Act and thereafter IRDA. Insurance, what is insurance? It is basically spreading the risk over a large number of people, right? So ideally, the individual, whatever loss he might suffer, whatever risk he has, that is being spread over a number of people. How it is spread? By entering into a contractual arrangement with a company of transferring risk. So we have two parties involved in this contract of insurance. One is the insured and other is the insurer, that is the insurance company. Insurance company provides the risk cover and the insured pays the premium against the same, right? Till 1912, we did not have any insurance law, and all the insurance companies were governed by Companies Act only. But later on, undoubtedly, we formed insurance law and it was introduced. Now, today we have Insurance Act, undoubtedly we also have IRDA, but apart from that we also have LIC Act, we also have Marine Insurance Act, and we also have General Insurance Business Nationalization Act. So all these were also passed, which continues to stay. Now, one more thing is very important that you have to keep this in mind. You can write it somewhere. FDI in insurance sector. Now, earlier, FDI in insurance sector was allowed only up to 26% through automatic route. This has been enhanced to 49% under automatic route. We know that we can attract foreign people or foreign investments into different businesses that we Indians carry on. One of the businesses is insurance. Now, does government permit foreign people to intrude into this business? The answer is yes. We have two routes of FDI. One is automatic route and other is approval route. Automatic route, that means you will not be needing the permissions, and straight away by complying with all the requirements you can enter and you can start with the business, right? Or you can invest. So under automatic route, earlier FDI was allowed only up to 26%. Now it is allowed up to 49%. We have different types of insurance. If I broadly classify, I can classify into three categories: life insurance, general insurance, and health insurance. Although health insurance is a part of general insurance, however, it has been differently classified because it has been differently defined also. So we have a separate definition. General insurance includes the all other asset, general, fire, marine, miscellaneous, plant and machinery. All that insurance is general insurance, right? So insurance companies spread the risk among a large number of people and to make small premiums as against the coverage. What can you insure? You can insure anything in which you have insurable interest, which goes as the first principle of insurance law. What is insurable interest? We have different types of interest. We have security interest, we have absolute interest. Likewise, we also have insurable interest. Insurable interest in any property means if damage happens to this property, I will suffer pecuniary or monetary or financial loss. If I don't suffer any loss, I don't have insurable interest in this property and I cannot get it insured. If I have a car and the car damages, I will suffer monetary loss, so I have insurable interest in the car. Even if I'm not the owner of the car, I have taken it on lease, then it brings I am a taxi driver, it brings me money. So I have an insurable interest in that, right? So it is important that you have an insurable interest in the property. Okay. Now, the second thing comes to be good faith, utmost good faith. What is utmost good faith? Uh, you can remember the maxim, of course. It means basically honesty. Both the parties involved in this contract of insurance have to observe good faith and honesty towards each other and make adequate and full disclosure of all the material things required. Whatever information you are exchanging, that has to be true and correct. If it is incorrect, or if you try to hide some material information, that means you have not acted in good faith and then the contract may be avoided. Then we come to representation. But before representation, misrepresentation, we have to understand what representation is. Representation is any statement which is made by one party to the other. It may be implied, it may be expressed, whatever it is. Now, representation, if they are an integral part of the contract, that means if you say something which is the basis of the contract, then that becomes a warranty. And if that is not complied with, then the contract is avoided, right? But if it is not an integral part of the contract, not so material, then we have to see first thing whether it was willful or it was innocent. Secondly, what is the how much has it affected the contract, right? So then it can be avoided, or then it can be turned out to be void. Please strike this, because this will only create confusion to you. You have to remember that life insurance policies cannot be questioned after 3 years of commencement. See, if I have obtained any insurance policy on providing incorrect information on the basis of fraud, then of course, whenever the fraud is discovered, that the contract can be avoided, right? But if it is a life insurance policy and I have obtained it on the basis of fraud also, then insurance companies have only 3 years to check this, to inspect this, to identify whether the other person is lying about something, or etc., and avoid the contract. If they cannot do that, after 3 years, it is not going to be questioned. Okay, after 3 years. So within 3 years of commencement of policy, you can question life insurance policy, not after that. Then comes your condition. Condition is something that you put on the basis of which policy is granted. So some conditions are precedent, some conditions are subsequent. Conditions precedent, if you don't fulfill this, if you don't pay the premium, if you don't do this, then of course the contract is void. Even if we have entered into a contract, that is not valid. And conditions subsequent, that after this you have to do this. If you do not do that, then of course the contract will be avoided. Okay, so conditions are general things. Then we have indemnity and subrogation. Indemnity is making good the loss. Life insurance, you can never make good the loss. If someone has died, you cannot never replace that person, right? So it is not a contract of indemnity. Others are a contract of indemnity, so you make good the loss. And subrogation, what do you mean by subrogation? Subrogation is ideally a right that allows someone else to make the payment. That means I have, maybe I entered into any accident, and I am liable to this third party, but I'm not making the payment. It is the insurance company which is making the payment. So subrogation is the legal right that allows the insurance company to make the payment. Now, whenever I'm saying indemnification means I'm making good the loss of the other party. Supposedly, the other party has taken a cargo insurance and the cargo is lost. The cargo is worth rupees 1 crore, but you have taken an insurance policy for only 10 lakhs. So undoubtedly, your loss will not be made good, right? So it is subject to certain conditions. What policy you have taken, and supposedly you have taken a policy of 1 crore, but then your loss is only 10 lakhs, so you will get only 10 lakhs. So these things have to be considered. Although we say that we put the insured in the same position as he was, but again subject to these things. Then comes your proximate cause. Proximate cause means what? It is the nearest cause. Any mishap which occurs may be because of number of things or number of series which happens. Fire was caught for certain reason. But then if in your insurance policy it is written that because of fire we'll give you the claim. So fire is the nearest cause, and that's why you should get the claim. So we have to check the nearest cause and not the remote cause. Then comes your insurance and consumer protection. Consumer Protection Act covers insurance sector as well. So we, the insured who have taken the insurance policy, whether we are taking it for our business or for our personal life, we are treated as consumers and we have the chance to move to consumer forum for any complaints. However, the insurance companies are not consumers. So if they have any complaint, they have the adequate forum as some civil courts. They cannot move to consumer forum. When do we consider our policy to start or commence? Whatever date is mentioned, what time, whatever time is mentioned. If date is not mentioned, it is governed by the provisions of Indian Contract Act, and whenever the time of acceptance, that is going to be the commencement. If time is not mentioned, we consider it midnight, right? Now we have some other provisions relating to insurance. Point number one, if we want to take insurance from some foreign insurer, not allowed except with the permission of IRDA. IRDA is the authority for which we have another act as well. Then comes a requirement as to capital, minimum paid up capital. In case of life insurance or general insurance, 100 CR, health insurance, 100 CR, reinsurance, 200 CR. And if I talk about reinsurance, we have another requirement that you cannot start or you cannot be registered unless you have 5,000 crores net owned funds. Because you are now going to protect the insurance company. That is what reinsurance business is all about, right? Every capital of insurance company will comprise of equity shares, and voting rights will be with the equity shareholders, and the paid up amount will be same for all the shares. Now, insurance companies are also required to prepare their financials according to the format specified in the Act. So they have to prepare balance sheet, P&L, revenue account, and P&L appropriation. Get it audited by the auditor, who shall have the same powers, duties, liabilities, penalty as given under Companies Act, chapter of audit and auditors, right? Whatever audited account and statement they prepare, that is going to be printed and 4 copies furnished to the authority, signed in the specified manner. Actuarial report is for life insurance business. So if you're carrying on life insurance business, once a year you have to carry out the investigation and value your liabilities. So get your liabilities valued by an actuary actually and report according to the regulations. You also have to prepare a record. Record of what? Record of all your policies. Policies, that means whatever you have issued, the names of policy holder, the date when the policy was effected, any transfer, any nomination, everything, and the record of claims. Whoever has claimed, whatever claims have been granted, whatever claims have been rejected, if rejected, on what grounds? Okay, so every record has to be maintained. How? It may be maintained in any form, including electronic form. However, if in the regulations you exceed the specified threshold, then it is going to be in the electronic form only. Right? Okay, then we have investment of assets. So you have to keep your money invested. What amount invested? Liability minus whatever premium is due, whatever you're going to collect. That amount you have to keep invested in assets at all times. In what assets? 25% government securities, 25% in government or other approved securities, and balance in other approved investments. If you're carrying on general insurance business, then 20% in government securities, 10% in government or other approved securities, and balance according to the regulations. Fine? Okay. Then we have Investigation and Inspection Authority, that is IRDA, may at any time direct person to be the investigating officer and investigate the affairs of insurer or intermediary. What do you mean by intermediary? Intermediaries include the surveyors, loss assessors, and brokers, and everyone. We have 3 people involved in the chain, right? So we have the insurance company, we have the surveyors, loss assessors, and other people, and we also have insurance agents who solicit and procure the insurance business, right? Okay. Now the investigating officer will investigate. So it will be the duty of the insurance company or the intermediary to produce all the books of accounts, registers, documents, everything, and provide full assistance and cooperation to the investigating officer to let him carry out the investigation. Once he carries out the investigation, he will make the report to the authority. Any insurance company cannot pay any commission to any person other than insurance agents or the intermediaries. Okay, that means can the insurance companies appoint insurance agent? The answer is yes, you can appoint insurance agent to procure business, but one person will not act as an agent for more than one insurer. One life insurer, one general insurer, one health insurer, whatever. Okay, and this I have already told you that no policy of life insurance is going to be called in question on any ground after 3 years, right? On any ground of misstatement after 3 years, within 3 years it can be called, right? Okay. Moreover, the insurance agent or the intermediary cannot become the director of the insurance company. Then one more thing, dividing business is not allowed. That means you cannot say that if I collect a lot of premium, then you will get this much benefit. If I have to pay so much of claims, then you will not get this much benefit. Just like how it operates in case of mutual fund. If the market is high, then you'll get high returns. No, this is not going to happen. Undoubtedly, there can be a component of bonus which may be provided, but then it is not going to be strictly based on dividing business, right? We have two councils, Life Insurance Council and General Insurance Council. Then we have surveyors or loss assessors who must possess the required qualification, and they must be the member of Indian Institute of Insurance Surveyors and Loss Assessors. Okay. All the assets and liabilities are going to be valued for not more than market value, and every insurer or reinsurer at all times have to maintain assets over the amount of liabilities. That means your assets will always be more than liabilities at least 50% of the minimum capital. If this is not complied, then you are deemed as insolvent, right? Moving to the next part, that is IRDA, Insurance Regulatory and Development Authority. Right, so we have this authority to safeguard policyholders, and this is not just regulation, this is also development. So this also upgrades, or this also develops the whole insurance sector. Central government establishes an authority which is going to be body corporate, and the head office will be determined by central government. It will have a chairman, maximum five whole-time members and maximum 4 part-time members. Maximum age of chairman 65 years, others 62 years. They will be appointed for 5 years at once. They can be reappointed. If any member or chairperson want to resign by giving 3 months notice to central government, they can resign. They can also be removed from their office if they become insolvent or insane, or convicted for offense involving moral turpitude, or they act against public interest or acquire some financial interest which is not legal. Okay. Now, when they leave this authority, they have a bar on employment for 2 years. So for 2 years, they cannot be employed or appointed in central government, state government, or insurance sector. The authority is going to meet and take decisions by voting. The votes shall happen, and in case there is a tie, chairperson will have a casting vote. So chairperson is the person who's actually responsible for the whole general superintendent and everything. Then we have a section number 14, which prescribes wide powers of the authority. So authority, first thing, whenever you want to open an insurance company, you have to register with IRDA. So that registration certificate is being granted, it is being suspended, it is being cancelled, all done by IRDA. Right. Then you also specify the code for your surveyors, code of conduct, how you have to behave. Then specifying the qualifications for the agents, intermediaries, conducting a lot of investigations, regulating the tariff advisory committee. What is tariff advisory committee? The committee which is being formed to prescribe and make norms for your minimum, maximum tariff and all that, the premiums that are being collected by the insurance company, so that undue advantage is not taken by the companies and the policy holders do not suffer. So uniform, to maintain that uniformity in the tariff of the premiums, right? So that is being supervised, and other regulating investment funds, a fund which is being maintained, settling disputes. So all this is being done by the authority. For this, the authority also has a fund, IRDA of India Fund. So central government grants necessary funds for running this authority. So it gets money from central government and other sources, and it uses the money for payment of salary of the members and other legitimate expenses of the authority. It has to maintain all the books of accounts and annual financial statements, which are going to be audited by CAG and also presented before Parliament and central government. Right. Apart from that, central government has the power to issue directions to the authority. If the authority is not performing well, if there is some fraud or they're constantly defaulting in the directions, then they can also be superseded by the government. So central government, maximum tenure of supersession, 6 months. So within 6 months, they can bring in new people and reform the authority. You also have to furnish a lot of returns or information to central government. All the members, chairperson, everyone is going to be the public servant, and insurance advisory committee will also be formed, which is going to advise IRDA on certain matters and also on making regulations. So that are some general part apart from this sections that we have read, right? Okay. Let's now revise some legal provisions relating to MSME sector. What is MSME? Micro, small, medium enterprise. Right. Now, it is no such special type of enterprise or any special type of business form of organization. Any enterprise means which is engaged in the manufacturing sector or the service sector, which meets the criteria as given under this act will be called as MSME. Now, MSME is a highly dynamic sector, and government undoubtedly wants to promote it as it generates a lot of employment, it results in equitable distribution and a lot of benefits, right? So we have a dedicated ministry, the Ministry of Micro, Small and Medium Enterprises for the same. Although the primary responsibility for development of MSMEs lies with the state government, central government undoubtedly facilitates a lot through the ministry that we have. Now, coming to the act, we have MSME Development Act 2006. The first thing that we read is about the definition of MSME, what will be called as micro enterprise, what will be called as small enterprise, and what will be called as medium enterprise. So we divide the definition into two categories, manufacturing sector and service sector. However, for both the categories, we have a composite criteria, which is the same given, so there is no change. What is the criteria, ma'am? We check two things: investment in plant and machinery and turnover. They should both be below a certain threshold to come into this type of category. So if investment in plant and machinery is less than equal to 1 CR and turnover less than equal to 5 CR, micro enterprise. Investment in plant and machinery less than equal to 10 CR and turnover less than equal to 50 CR, small enterprise. Investment in plant and machinery less than equal to 50 CR and turnover less than equal to 250 CR, medium enterprise. Now, when we read this definition, we have to take care of certain things, that investment in plant and machinery will be according to ITR, and it will include all the tangible asset but will not include the land and furniture and fixtures. If we talk about turnover, again, IT returns, GST returns, the data will be compiled from there, and moreover, the value of exports shall be excluded. Okay. Then we come to certain other important definitions, of which we have just one very important definition, which is appointed day. Appointed day has a relevance when we study about the delayed payments to MSMEs. So it has more relevance over there, but we'll read the definition. We'll revise the definition first. If MSME has supplied some goods and you are supposed to make payment, this act ensures that you make timely payment. What is going to be timely payment? That all we'll discuss later, right? Here we are concerned about that when goods are delivered, it is the day of acceptance. Okay, and when the day of acceptance is there, after that expiry of 15 days, following day is going to be the appointed day. But sometimes it may so happen that the goods have been delivered, but there is a dispute. That means the goods have not been accepted yet. So till the time the goods have not been accepted, the date of removal of objection will be considered as the date of acceptance, and thereafter we will compute the appointed day accordingly. Now, Section 3. Central government establishes a national board for MSME. They examine factors affecting the development of MSMEs, review policies that CG has made, give recommendations, and also advise CG on the use of fund that CG has constituted under this act. So CG constitutes a fund known as MSME fund, wherein CG gives all the grants, and that has to be utilized only for MSME sector. CG itself is responsible for that fund, and CG ensures the monitoring and everything of the fund. Okay, so advisation matters will be there from national board, and also we have an advisory committee which is again constituted by CG, and it advises CG on certain matters, and it also advises this national board on certain matters. Okay. So we have different authorities and different bodies which have been constituted under this act. We have another thing that we have to read for national board, which is composition of board, which I have not reproduced over here, nor I'm discussing in this revision class. Why? Because it is huge. So composition you have to learn. They all are going to meet once in 3 months in every year. Apart from that, we have a section 9 also, which just gives power to central government to formulate guidelines, notification policies with respect to different issues. Like, we want the MSMEs to be more competitive, we want to develop their skill, we want to upgrade their technology, some management issues, providing them infrastructure facility, cluster development, credit facility. So using that powers, CG has in fact formulated a lot of schemes for the development of MSME units. So this is huge list of MSME schemes that we have. Anyway, moving to the next part is our registration. under section 8. See, registration of MSMEs is not mandatory, but if you want to avail the benefits under the act, then you must get yourself registered. How to get yourself registered? Simply by filing a memorandum with the specified authority as given by state government. So where do we file memorandum, and what is memorandum? Memorandum is nothing but like an application form only. It's called as memorandum because you're furnishing information and that's it. It's a free of cost process. There are two ways to do it. Udyam registration portal, you can file Udyog Aadhaar memorandum, or NSIC. NSIC, what is NSIC? That we'll discuss later. But they have designed a single window system. They also have the power, and using that, they work for promotion and betterment of MSMEs. So they have designed a single window system for MSMEs and their champions control room at DIC. So you can do that by filing form over there as well. Then we have one of the important things in this chapter, that is delayed payment monitoring or delayed payments to MSMEs. See, payment to supplier has to be made. If MSME has provided any goods, the Act ensures that you make timely payment to these MSMEs. If there exists an agreement between buyer and supplier, then you have to make payment before the date specified in the agreement, and this date cannot be beyond 45 days. Supposedly you do not have any agreement with respect to payment, then you have to make payment before appointed day that we discussed. That means after the goods have been accepted, you have 15 days time to make payment. Fine. If it is not paid, then the buyer will be liable to pay compound interest at monthly rest from appointed day or the day agreed at 3 times of bank rate specified by RBI. That's not complete. The interest will not be allowed as deduction to the buyer, and moreover, he has to also report the same in his annual accounts. The amount that he has not paid, principal amount, interest, separately in his annual accounts. So he has to incorporate that also. Okay, fine, ma'am. Now, we have another point with respect to this, which is counsel. Supposedly, there is delay in payment. Supposedly, there is dispute in payment. Where can the parties go? Is there a separate forum which is there in this act? The answer is yes. We have a separate forum called as Micro and Small Enterprises Facilitation Council, MSEFC, which is established by state government. So undoubtedly, we'll have different councils. Minimum 3 members, maximum 5 members. These members will be selected from Director of Industries, representative of Association of MSA, representative of banks or financial institutions, persons with special knowledge. What is this council going to do? They are going to deal with the disputes. So any party can refer to the council, and when council receives such reference, the first attempt the council makes is conciliation. That means the council tries to resolve the differences between both the parties and bring them to settle by acting as a conciliator themselves or referring it to someone else. If conciliation cannot take place, that means if settlement cannot take place, then it acts as an arbitrator and it decides who is correct, who is incorrect, and gives a judgment, gives a verdict, gives an arbitral award. Okay. Any reference made to the council is going to be decided within 90 days. Which reference can be made to the council? See, if the supplier falls in the jurisdiction of that council, the council can act as arbitrator or conciliator. It doesn't matter where the buyer is from. The buyer can be anywhere in India. The supplier has to be in his jurisdiction. Now, all these things happen through an online platform, which is MSME Samadhan, online portal for delayed payment monitoring system. Just like we have MCA portal, likewise, we also have this portal. Fine, we want to reach to this particular council, but we will file it online and it will be reached to that particular council. That council will take action, and all the government ministry, everyone is involved, so everyone can monitor what things are happening and how things are happening. Okay, fine, ma'am. Now, I think I told you about NSIC, National Small Industries Corporation Limited. It was established in 1955. It works through different offices, and the main purpose is just to provide support services to MSMEs. Right. Now, we come to the various schemes or benefits. See, first thing, government has formulated a lot of schemes for the betterment of MSEs, but they do not have adequate knowledge and hence they are unable to get the benefits. What are the benefits, ma'am? Security support, financial support, technical support, improving their livelihood. Why? Because they are providing you infrastructure, credit facilities, modern testing, flow of credit, modern management, entrepreneurship development, the same things that we discussed in section 9, skill upgradation, right? A lot of support. So all that support they are providing and it's benefiting MSMEs in a lot of ways. But MSMEs are not aware and hence they are mostly unable to utilize or benefit themselves from these schemes. However, out of all the schemes or benefits, we are reading a few. First one, revival and rehabilitation. Whenever MSME are being given some loan, they might not be in a position to repay it back, and that's why restructuring may be needed. So this scheme provides about restructuring of the same. Procurement preference policy, government ensures just to in order to encourage them that they should continue their production, government ensures that okay fine, this much or supposedly maybe these many items we are going to procure from MSMEs only. So it does not matter whether the big shot players are producing that, government will take that product from MSME only, right? Likewise, you have reservation policies by government that government reserves a certain thing that this is going to happen from MSME only. We are going to encourage women entrepreneurs also. Okay, so a lot of reservation policies, a lot of preference, procurement preference policy, all that happens by government for the betterment of MSMEs. Okay, digital MSME. What is digital MSME? The government wants MSME to digitalize, right? That means by using ERP, by using accounting softwares, by using all those things. So in that, government helps these MSMEs by creating more awareness, by providing them training with respect to ERP, by providing them, telling them their benefits. Then we have ECLGS, which basically relates to COVID-19, and it is emergency credit linked guarantee scheme. It tells that banks or NBFC who provide credit to MSMEs will give you 100% guarantee cover, but capping of 4 years and rate of interest maximum 9.25 for banks and 14% for NBFC. Then we have SBL, Secured Business Loan by SEBI, 10 crores maximum for 10 years. PMEGP, Employment Generation Program. So credit subsidy will be given by government for generating employment. Reservation policies, I already told you. Special consideration in international trade fairs and all. And training will also be provided through the training programs that we have. After that, we have some recent announcement, of which one scheme is important and that I have designed a chart for the same. Credit Guarantee Scheme for Subordinate Debt. We have MSME who has already taken loan and they are unable to repay that loan. That means they are recognized as NPAs or stressed assets by these banking institutions or the lending institutions. Now, government is saying to give them more credit. To promoters of MSME unit, equal to 15% of his stake, subject to maximum of 75 lakh, and guarantee coverage will be provided by the government. It will be treated as separate loan, and for the same 20,000 crores have been allocated. So provision has been made for. Okay, fine. Okay, let's now revise the chapter of cyber security, that is the laws and regulations relating to cyber security. We all know that the chapter is ideally being divided into 3 parts. First, we have some content of IT Act that we have to study. The second portion is all about business intelligence, and the third portion is cyber crimes, which is again related to IT Act but has been given as a separate topic over here. Right now, although we have a lot of framework and background to understand about IT Act and also to understand about business intelligence, but since we are just revising this particular chapter, I'll not get into those intricate basics and details. We will straight away come to what is the core content and is required from examination perspective. So if we talk about IT Act, Information Technology Act, we know that it is an act of parliament. It was notified on 17th October 2000 and it's applicable to whole of India. In fact, its applicability extends beyond as well. Now, why this particular act came into picture? We know about electronic transactions, we know about electronic records, we also know about digital signatures, right? Earlier, we did not have electronic records, we did not have electronic transactions, and digital signatures, forget it. We just had physical signatures, and they were only considered to be authentic and if there is a paper on which you have my sign, then that is authentic and that can be treated as evidence, that can be treated as my command, right? But now, after inception of this particular act, because we know that the times are changing and we have onset of technology, so a lot of things are being digitalized, so the signatures also need to be digitalized, right? But obviously this should not be misused by people, and to prevent misuse, a lot of laws are required. So first thing, this act gives legal recognition to the electronic transactions and digital signatures. It also facilitates the e-filing of documents, especially when we're talking with the government departments. It further amends other acts like what, ma'am? Like IPC, like Indian Evidence Act. And we have a certifying authority under the act, mainly that relates to digital signatures. So licensing, monitoring, all of that is also covered over here. Fortunately, unfortunately, we don't have to read the entire act. We just have to read a few sections of the act. So we will only compile those relevant sections. Before we actually go on, some part of the cybercrime I'm discussing here itself, because here we have incorporated in our charts. Now, what is cybercrime? To be precise, we have crimes in our physical space also, like someone may intrude into our house, that is a cybercrime. Trespassing, that is a crime, right? Trespassing. Someone has come to my physical place. That means someone has intruded into my physical space. Now, if someone or any criminal activity takes place in the cyberspace, cyberspace means by using computer, by using the technology, by using the network, right? If they are intruding into the cyberspace that we have, then that is a criminal activity taking place in cyberspace, that is cybercrime. Now these crimes are recognized because if someone is hurting my emotions physically, then that's a crime. If someone is kidnapping me physically, that's a crime. If someone is following me physically, passing certain comments physically, then that is all a crime. Then the same thing, if happening in the cyberspace, should also be considered as a crime. If someone is stealing anything that belongs to my house, maybe that's some precious jewelry, maybe that's some cash or whatever I've kept at my place, if stealing that is a crime, then what I have stored in my computer, that is my data, and if someone is trying to steal that data, then that should also be a crime. Just because it's happening in some cyberspace, we cannot say that, oh, no, it's not a crime. Of course, it is a crime. So we have to recognize such type of cyber crimes, and these crimes are recognized not just under IT Act, but also under IPC. So under IT Act, we have tampering, Section 65, hacking, Section 66, obscenity, Section 67, unauthorized access, Section 70, breach of confidentiality, Section 72, false TSC, Section 73. Ma'am, do we need to learn the section numbers over here? The answer is yes. Although we have classified cyber crimes against into three categories: against person, against government, and of course against property, right? But we'll read that later. These section numbers from examination perspective are to be learned. Okay, now under IPC, if someone tries to threaten you by sending an email, Section 503, defamatory message by email, Section 499, forgery, Section 463, bogus website fraud, Section 420, email spoofing, Section 463, webjacking, 383, email abuse, 500. We have learned, we have discussed about the terms. Okay, now back to the IT Act, back to the core IT Act that we have to study. Electronic records. If I have to deliver a document to you, when I'm dispatching, you know it. When I'm giving it to you, you know it. You know exactly the moment when it's taking place because it's happening in the physical space. But when the electronic document is moving into some cyberspace and reaching a person, what is the time and place? Because it's all happening in the cyberspace, right? So just for the clarification, although we know it, but this section is kind of a clarificatory section. So we have an originator and we have an addressee. I am the originator. If I'm sending the document to you, you are the addressee if you're receiving the document, right? We all have our computer resource. Computer resource means my computer or my network that is within my control. And we have a computer resource or network outside my control, and then there will be your computer resource, right? So what will be the time of dispatch when it enters a computer resource outside my control? That means it hasn't reached you yet, but it has gone out of my control. So it is somewhere in the network which is not in my control. So that will be considered as the time of dispatch. What will be the time of receipt when it enters your computer resource? That means when it enters the designated computer resource. When it enters the designated computer resource. What will be the place of business, place of dispatch, and place of receipt? Right? Because time and place become important when we want to enforce certain type of contracts. Okay. Now, under this act, we have certifying authorities. What are certifying authorities? See, central governments appoint CCA, and CCA gives license to CA. CA means certifying authority. Certifying authority issues DSC to person like us. So we have 4 people involved: central government, CCA, CA, and then people like us. Right? So CCA, that is Controller of Certifying Authority, they recognize certifying authority, they regulate them, give them license to issue DSC and also supervise them. Adjudication. Central government appoints an officer who is going to be considered as an adjudicating officer. See, if we do anything which, if we're trying to contravene any of the provisions, then he is going to hold inquiry, and after considering the factors, he decides about our contravention, that whether we have contravened a certain provision or not. If you're dissatisfied with his order, we can appeal within 45 days to another authority, that is Cyber Appellate Tribunal. If we're still aggrieved, we can further make an appeal to High Court within 60 days. A lot of times, data is being collected by government, by other organizations also. What type of data? Our personal sensitive data. What is our personal sensitive data? You go out to get an Aadhaar made. You have to give your biometrics. Isn't it personal sensitive data? Can't it be misused? Banks have your credit card, debit card information. Right? Some have your health conditions information. So there could be ample of personal sensitive data which is only available to you and which you do not share in the public domain. Any document or any data which is available in the public domain is not your personal data. So which you keep it to yourself, but you have to disclose it to government because government has made certain things and you have to tell, or you have to give it to certain organizations. Now, you have fulfilled your duty as a citizen to do so. But it's government's duty. It's the organizations who collect your personal duty. It's their duty to protect your data. Data protection hence refers to the set of policies which are being implemented to protect sensitive data. And it can be collected only if it is lawful, if it is for lawful purpose. We people are aware that it's being collected. We are given an opportunity to review what data is being collected. You ensure its security, and you also designate a grievance officer, that if we have any issue, we can contact that person and he will be resolving our problems. Okay, so we have to maintain confidentiality. We don't have to disclose it to any third party. If we do it, penalty under section 72A. If we don't secure the data, that means if security is compromised, then damages under section 43A. Okay, fine. Moving to the next part, business intelligence. Business intelligence. What is business intelligence? See, we have a lot of raw data which cannot be used for decision making. That means maybe an organization has made 1 lakh sales. What decision you'll make by just getting that data? No. But if we classify the data, if we analyze the data in such manner that we get useful information out of this, then that is going to be helpful. Now, business intelligence is a technology-driven process, is not the manual process, but is a technology-driven process which actually analyzes your data and converts your raw data into useful information which you can use to make data-driven decisions. Right? Like if from that 1 lakh sales data, we get to know that, okay, fine, 70% of women consumers are interested in our product. So we get to know, okay, fine, our product is being liked by women consumers, so maybe we should target more over there. So marketing department can make a move. They can make an informed decision based on data. Otherwise, they would be just going around by some gut feeling or experience, right? Undoubtedly, people take a lot of decisions, but then if the decision is data driven, it helps a lot. It improves your efficiency, it increases revenue, and it also helps to gain competitive advantage over the rivals. Now, how this business intelligence process works? It is a technology driven process, so undoubtedly it has to collect all the data first. Where will the data be available? Maybe one data here warehouse for the entire organization, or maybe department wise we have different data, like financial data can be obtained from ERP softwares. So all the data has to be compiled, integrated, and then proper sets have to be prepared. So data preparation is ideally the first step. I can say these are the 4 steps that we have to focus on: data preparation in sets, then analytical querying on that data, distribution of KPIs, key performance indicators, and then use of information. We have to distribute KPIs in such a manner that we can actually decide that, okay, fine, when we're talking about maybe average response time to a customer, we are able to compare our actual data to our standard ones, right? So accordingly, the KPIs have to be distributed, and then use of information to take that decision. So these are the 4 steps involved in the process, how business intelligence works. We have ample of BI softwares or BI platforms which are available. Ad hoc analysis, that is the first one, which deals with the issues on temporary basis. Then we have OLAP. OLAP is for more complex queries, online analytical processing, which actually uses multi-dimensional database. From here, you're picking up information and you're able to combine, drill down, and do a lot of things, right? We've discussed everything in detail. It's just I am only pinpointing something that you need for your examination perspective. Mobile BI, something that's available in your smartphones, tablets. Then we have real-time BI, which gives you up-to-date view, not something which is historical. Operational intelligence only relates to your operations. Then you have open source BI. Open source BI, in which you have two refined versions. One is free, one is paid. Embedded BI, the most important one. It actually incorporates the features of business intelligence in your homegrown business application. So you have an app, in that only they'll provide you these features. Collaborative BI, which you can share with others, right? Location intelligence, it all talks about the location and geospatial data, right? So we have different types of softwares, and on that only the modern BI platforms are the tools that we have: data visualization, tools for building dashboards, storytelling features, usage monitoring, right? I have shown you that picture also. I gave you an example of what Qlik, right, and Tableau, right? So we have a lot of tools which are available. See, some tools are absolutely free. As I told you before also, if we wanted to edit a photograph back in the old times, it was not possible for a normal person to do so. Only the experts could do so. But now we can also do so. Why? Because we have photo editing softwares which are free and user friendly. We're just putting the softwares, adding filters to our photos, right? So we can do that. Likewise, this was possible only by the IT analyst back then. But now, thanks to these BI platforms and tools which are available, and in which we do not require any coding, anything like that, we just feed the information and it analyzes the data and brings us useful information so we can use it, right? Next is cybercrime. Cybercrime, although I have already explained you what cybercrime is all about, if we talk one by one, cybercrime against person, the first one, cyber stalking. So if you are trying to create some physical threat by stalking people in the cyberspace, like going to their maybe mail, phone, text, webcam, whatever it be, that's cyber stalking. Obscenity, indecent exposure to something which should not happen. It includes child pornography. Defamation, trying to lower the dignity of someone. Cracking is exactly hacking also, I would say. Or let me first discuss hacking only, because hacking is getting that unauthorized control or access, and cracking is someone is breaking into your computer and is tampering with your confidential information. Spoofing, distancing the origin, like pretending that it is being sent by someone else. Email spoofing is what? A spoofed email is what? It misrepresents the origin. That means you do not know, you think that this person has sent it, but it's using a different path or a different thing. Carding is all about the frauds related to ATM card, credit card. Fraud is a generic term, and threat Threat is maybe giving threatening messages via mail or anything like that. That is all threatening. If I talk about against property, we have broadly five things. Squatting. Squatting, fighting over a same common domain name, maybe. Um, then vandalism is trying to intentionally destroy the property of other. What could be the property? Here we are talking about the computer, we are talking about the computer resources, we are talking about the data which is in there. Hacking, now hacking is against a person also, because you get into someone's private space, but then after getting into someone's private space, if you're destroying that, that is a crime against property also. Virus, again, virus does the same thing, gets into your system and destroys everything. Trespass, unauthorized entry. Then we have against government, which is considered to be the most important from examination perspective. Cyber terrorism, very, very, very important issue. There could be hate websites, there could be hate mails which are being circulated, and it should be prevented. Warfare is again related to hacking, but hacking and then spying with a political motive. That means you're trying to steal that confidential information, or you're just trying to spy, just like CCTV does, right? So hacking and getting into someone's cyberspace and then spying. Piracy, duplicacy, right? And duplicacy of government records, maybe like you have a government license, issuing license, or maybe counterfeit currency notes, etc., etc. Unauthorized information, it could be political, it could be religious, it could be any information that government does not want to disclose to public, but you are getting access to that by getting into someone's cyberspace, right? So that is different types of cyber crime. Now the revision of PMLA. Now, the very first section that we have to read in PMLA is ideally section number 3, which talks about the offense of money laundering, who is deemed to have committed an offense under money laundering. So for that, we first need to understand what do we mean by a scheduled offense. Scheduled offense ideally is the offense which is specified in Schedule 1 of the Act, which is divided into 3 parts, Part A, Part B and Part C. Part A, all offenses. Part B, offenses of value 1 crore or more, and Part C, all offenses. So these are the offenses which are specified in Schedule 1, which are considered to be scheduled offense. If you do any of this offense and you derive something out of that offense, it could be your intangible asset, it could be your tangible asset, movable, any money, anything, that is known as proceeds of crime. Now that proceeds of crime, if you hold it, if you try to conceal it, if you try to possess it, if you try to use it, that is involvement in any activity relating to proceeds of crime. And if you involve in any activity relating to proceeds of crime and you're trying to project it or use it as an untainted property, then that is offense of money laundering. Even if you attempt to do so, then also it is an offense. If you indulge, then of course it is. If you assist someone, it is. If you are a party to that, it is an offense. Whether directly or indirectly, you are directly doing it or you're getting it done through someone. In both the cases, it will be an offense of money laundering. Now, the process of money laundering, ideally you can say money laundering is an act through which black money is converted into white money. Of course, black money can be obtained through different sources, like by evasion of taxes or by indulging yourself into some illegal activities. The offense, the money obtained from only those offenses which are specified in scheduled offense and conversion of it is money laundering. So if I am a criminal and I'm trying to wash off my money, that is actually money laundering. There are various methods through which you can do money laundering, like you can do smuggling of cash, structuring, then entering into real estate transactions, stock market scams, bogus companies. Of course, here we are not trying to teach you how to do money laundering. This act is all about prevention of money laundering. So the act hereby intends to prevent money laundering. That is how people should not at all enter into this process of money laundering. That is the main focus. The two authorities under the act are Directorate of Enforcement and FIU, that is Financial Intelligence Unit of India. Okay. Now, there are 3 stages of money laundering: placement, luring, integration. Placement is when you place the proceeds of crime into the system. Luring is to make it far away from the source, and by entering into a series of transactions from here to here, here to here, here to here. And integration is finally returning the money as if it was a legitimate source. Whenever anyone enters into this process of money laundering or attempts to do this money laundering, he is deemed to have committed an offense under money laundering. And when he does an offense of money laundering, he is liable for punishment. The punishment is given in section number 4. Now, before we go on to section number 4, we remember that Schedule 1 is divided into 3 parts. Part A, paragraph 2, the most important one, is relating to the offenses under Narcotics, Drugs and Psychotropic Substances Act, which is very important for you to learn, because if you indulge into the proceeds of crime of that particular act, then you have a little serious punishment. The punishment of offense of money laundering involves rigorous imprisonment and fine. Rigorous imprisonment, minimum 3 years, but the maximum differs in both cases. If it is an offense of drugs, then maximum imprisonment 10 years. But if it is other than that, maximum imprisonment only 7 years. Okay, so that is the only difference in both these type of punishments, which you must remember and must learn. Okay. Now we have different definitions, and first let's talk about the reporting entities. Who are the reporting entities? That is the first question. Reporting entities: banking companies, financial institutions, intermediaries, and even I would say the persons who are designating certain types of business or profession, who can be the persons who are dealers in precious metals, real estate agents, registrar, and casino, and all that. These are the places through which money laundering actually takes place. Because if I want to convert my black money into white money, how do I convert this? How do I enter into this financial system? The choices that I have are these reporting entities only. Right? That is the banking company, financial institution, intermediary, and the person who are carrying on designated business or profession. So through them only I can inject money into the system. So obviously they will be exposed to the proceeds of crime. They have to be cautious, they have to maintain proper records, and they have to do proper reporting. So government has imposed an obligation on them only, that you take care of all these things. What you have to do is you have to maintain your record about the identity of your client. And when the client ends the relationship with you, that means I have closed the account, despite that fact you will still maintain my record for next 5 years. So after closure also you have to maintain account for 5 years. You have to maintain the transactions record, the transactions as may be prescribed. So whatever high value transactions have been prescribed, you have to maintain a separate record for that also. And when the transaction takes place after 5 years, you have to keep on maintaining that record. After that you can discard. And the same thing has to be reported also in such manner and time as prescribed. Reported to whom? Reported to the Director of Financial Intelligence Unit of India. Okay, so it has to be reported to that. Whatever information you're obtaining from the client, that has to be maintained as confidential. Apart from that, we have some more sections. We have section number 11A. What is 11A? Verification of identity by the reporting entity. Supposedly I am a bank. If anyone comes to me to open a bank account, what I have to do? I have to verify his identity. How can I do that? I can do Aadhaar online authentication, Aadhaar offline verification, then passport verification, or any other document proof, right? So banks take that. Aadhaar is not compulsory. You have a choice. You can provide any of this document to verify your identity. It is your choice. The banks cannot compel you that you have to give Aadhaar only. Even if you don't have Aadhaar, very well the relationship can be established. Earlier, government had authorized only the banks to do this online Aadhaar verification. Like if you go to a bank, I hope you know that online Aadhaar authentication can also be done. Now this has been also allowed for NPCI. Okay, so National Payments Corporation of India are also permitted to do so. Then we also have a section called as 12AA. 12AA is about enhanced due diligence. That means some more cautious of the specified transactions. If a person comes and wants to deposit or withdraw a huge chunk of cash, why? If you want to enter into any foreign exchange transaction exceeding a specific amount, why? High value imports, why? Or any transaction which involves high risk, why? So in such cases, you must verify the identity of clients, verify their ownership, verify the financial position, verify to whom it is going, right? And if the client fails to give you information about the same specified transaction will not take place. And you have to maintain this information, maintain this record again for a period of 5 years. So we have 3 sections wherein reporting entity has to verify something and maintain records. Section 11A, Section 12, and Section 12AA. These records have to be maintained. These records can be called by the Director of Enforcement anytime, and it is the duty of reporting entity that you must furnish information within the prescribed time and manner. Apart from this, some additional information also like cash transaction reports, suspicious transaction reports can also be asked. Whatever information the director obtains through this course has also been required to be maintained as confidential by the director himself. Now, the director has the power to impose fine. Before I tell you this section, I must recall the hierarchy. Directorate of Enforcement, Adjudicating Authority, Appellate Tribunal, Special Court, and then High Court. That is how the hierarchy moves when we are talking about this particular act, right? So Directorate of Enforcement has director, it has additional director, joint director, deputy director, assistant director, other officers. So these are the hierarchy which they have. Now, supposedly the director himself thought so, or it gets an application by some authority, officer, or person that this reporting entity is not fulfilling its obligation. Reporting entity is bank. Bank is not doing what it has to. So director, after inquiry, can pass certain orders. But during inquiry, it sometimes happens that the accounts are all complex. You are unable to identify what is going, what is happening. So in such a case, the director can direct the reporting entity that this is a panel of chartered accountants maintained, select one and get the audit done. Right? We will bear the cost. So the audit will be done and the report will be in our hand. Now we can come to a conclusion that whether they have complied with the obligations or non-compliance is there. If non-compliance is there, then we can issue further orders. And if the case is not so complex, the director himself may carry out the inquiry and come to a conclusion that yes, there is a failure to comply with the obligations. In such a case, there can be 4 directions, 4 orders which may be passed. Issuing of written warning, then giving a direction to comply with specific requirement, giving a direction to do some more reporting, sending submission of some more reports, and imposing some monetary penalties. Okay, whatever order is passed, the copy will be forwarded to the parties. Now, authorities under the Act, we have adjudicating authority, which is constituted under Section 6. We have appellate tribunal, which is constituted under Section 25 of the Act. And what do? They carry out the proceedings with respect to attachment and confiscation of property. In fact, appellate tribunal is designed to hear the appeals against the order of adjudicating authority as well as the director. Right? Then we have financial intelligence unit. This comes under Department of Revenue, Ministry of Finance, and is basically responsible for collection of suspected financial transactions. So it collects, it analyzes, it disseminates all that information. Right. Then we have Enforcement Directorate, one of the most important authorities under the Act, which again comes under Department of Revenue, Ministry of Finance. And this particular agency, its main task is to enforce PMLA and FEMA and to investigate offense under PMLA. So it has the powers to investigate also under PMLA. In fact, we have Section 5, which talks about attachment, as seen before. That also, who has the power to do that? It is anyone not below the rank of deputy director to do so. Now, special courts, central government in consultation with Chief Justice of High Court, they designate some session courts in different states and different duties as the special courts. Now, these special courts will try the offense of PMLA, plus they also try the offense, or you can say try the scheduled offense, which is underlying the offense of money laundering, right? Okay, then we have the procedure of investigation. In procedure of investigation, undoubtedly there are parties who are involved or authorities which are involved. The first authority, adjudicating authority. The second authority, Enforcement Directorate, which has been conferred the powers of investigation and attachment, confiscation. Thereby, adjudicating authority confirms the attachment or confiscation. Then we also have appellate tribunal, wherein you can prefer for appeals. Then you have special courts where the offense of money laundering is being tried along with the scheduled offense. And then you also have reciprocal arrangements, which we talk about, that is the bilateral agreements which exchange information and aids in the process of investigation. Thereafter, appellate tribunal, this is something that we've already discussed. You can appeal to appellate tribunal within 45 days, and appellate tribunal's endeavor is to dispose of the matter within 2 years. If you're still not satisfied, you may go ahead and appeal to High Court. Now we have something called as reporting, and it is connected to section number 12. So section number 12 imposes an obligation on reporting entities to report certain matters. In the same league, we have prevention of money laundering, maintenance of record rules 2005, which imposes an obligation that you need to maintain records. Maintain what records? Maintain records which involve the cash transaction of more than 10 lakhs, some integrated transactions which are less than 10 lakh but in aggregate they exceed 10 lakh per month, all the receipts of 10 lakh or more by NPO, any transaction which involves counterfeit currency, other suspicious transactions including the transactions of immovable property valued of 50 lakh or more. How do they have to maintain this? They have to maintain this in a prescribed format along with the obligation to identify your clients and ensure their authenticity. They have to, every entity must have a designated, must have a principal officer which is going to make this report to director of FIU. Along with this, there is also a concept of suspicious transaction reports. Now, what is a suspicious transaction? It may involve cash, it may not involve cash. However, if it creates a suspicion that maybe this involves proceeds of crime, or it appears unusually complex, or it does not appear to have any bona fide purpose, then such type of transaction is considered as a suspicious transaction, and thereafter report has to be made and accordingly furnished to the director of FIU. We also have a KYC, centralized KYC registry, which has been incorporated in the year 2015, and this is a kind of central repository which has been created. So entities have to within 10 days file electronic data with the KYC registry, and this is going to include the data, keep the data, analyze and transform the data, right? Okay, after you have completed the entire marathon, we are still left with the chapter of IBC, which holds a very, very, very important place, I would say, in our syllabus. Now, insolvency and bankruptcy code, I could not incorporate in the same marathon due to time constraint, as YouTube allows us to upload a video of only 12 hours, not beyond that. So for IBC, we've already uploaded a revision video, which is also valid for you. That's why I'm not re-uploading the video. What you have to do is you have a link for IBC revision. You go to that link, watch IBC revision. But for new syllabus, we also have personal insolvency, which is added to your course. Okay, so that personal insolvency revision of 5-7 minutes will be followed after this particular video, but I insist the students first you go watch the entire IBC and thereafter watch this personal insolvency. Okay, now I also want to give you a clarity on PPIRP, that is pre-packaged insolvency resolution process. Although that is not included in your syllabus, yet it has been ideally notified. Okay, so we do not know whether this will be asked in your examination or not. So safe side, if you have time, go for that also. And that is also separately uploaded on the channel, so you can have a look for the same. Okay. Okay, so after we have discussed about the liquidation process, that is, all the assets are distributed, thereafter liquidator distributes the proceeds within 90 days to all the stakeholders, and when the assets are liquidated, he makes an application for dissolution, right? Makes an application to adjudicating authority for dissolution. Now we have to discuss about the bankruptcy process for individuals. As I've already discussed with you that don't have to read the entire personal insolvency process. As we read for corporates. In corporates, what we read is first CIRP, then liquidation. If CIRP fails, then the company is liquidated, the assets are being sold off and the liabilities are paid off. However, for individuals, what is personal insolvency? What parts are covered? The individuals, partnership firms, personal guarantors. Now, if they do not pay, that means they are in a state of insolvency, but we're not discussing how to treat this insolvency. Of course, an application by creditor or the debtor himself is made to debt recovery tribunal, and thereafter insolvency resolution process is being undertaken. If that repayment plan is rejected or the repayment plan turns out to be non-satisfying your debts, or it is a case of fraud, then you can also make an application for bankruptcy. We have to read the process of bankruptcy and not of insolvency. That is not in our syllabus, right? So what happens in case of bankruptcy? First, we make an application of bankruptcy in the eligible cases. Thereafter, interim moratorium is declared. During interim moratorium, there will be no legal proceedings, right? No suits and all, anything you can file and everything. After that, bankruptcy trustee is appointed. Who is appointed as bankruptcy trustee? Someone whose name is being suggested, right? If no name is being proposed, then an application will be made to IBBI. IBBI will recommend the name, and that person will be appointed as bankruptcy trustee. Okay. Thereafter, when the confirmation is being received that okay, fine, bankruptcy trustee is appointed, then bankruptcy order is passed by DRT. DRT is the adjudicating authority in this case. Now, after passing of bankruptcy order, which is also the commencement of bankruptcy proceedings, so bankruptcy commencement date is also this date, all the property that belongs to the individual now lies in the hands of bankruptcy trustee. So he has now all the property. The adjudicating authority also issues a notice, gives a notice to the creditors and issues a public notice where people are being informed that such individual is being, against such individual, bankruptcy order is being passed. So if you have to recover anything from this individual, submit your claims. So the claims are being invited and bankruptcy trustee is expected to register those claims. Once he compiles all the claims, he has to call the meeting of creditors and thereafter constitute committee of creditors. Okay. And after constituting committee of creditors, of course, he makes the payment in accordance to the chapter. He administers the state. He makes the payment. After he has made all the payment that he had, like that he could recover, then he prepares a report on the same and presents it in front of the creditors. Then they give him a release. They release him. Fine, you have discharged all your duties, so now you are released. After he is released, he applies to adjudicating authority. Adjudicating authority passes an order and the bankruptcy trustee is discharged, and so is the bankrupt, the individual against whom order was passed. Right, I had made you prepare another chart which contains the details, I would say the detailed timelines and everything, that when application can be made, within how many days you have to apply, like within how many days the order is passed, within how many time you have to register the claims, within what time period you have to constitute COC. So everything is a little more detailed in this chart that I made you write. For all those who haven't, who don't know this, I'm showing it to you, just a glimpse. Okay, so that's it.